हेलो एवरीवन, गुड मॉर्निंग टू ऑल ऑफ यू। वेलकम वंस अगेन टू दिस लाइव कमोडिटी एनालिसिस। स्टार्ट करते हैं आज का सेशन। फिलहाल देखोगे मार्केट को। सो कल एक न्यूज़ आई थी दैट यूएस प्रेसिडेंट डोनाल्ड ट्रम्प सेज ही पोस्टपोन्ड द स्ट्राइक और इन फॉर 2 to 3 days। उसका एक इम्पैक्ट क्रूड ऑयल में देखने के लिए मिला था। फिलहाल क्रूड ऑयल में ध्यान रखना, कल फ्यूचर का कॉन्ट्रैक्ट एक्सपायर हो गया है, तो अभी अगर क्रूड ऑयल ट्रेड कर रहे हो तो नेक्स्ट मंथ का ही फ्यूचर यहाँ पर दिखाई देगा, ठीक है। तो बेटर रहेगा कॉन्ट्रैक्ट चेंज कर लो, बेस्ट है। टू रिमूव दोज लेवल, ये कॉन्ट्रैक्ट वैसे ऑटोमेटिकली चेंज हो जाता है, बट अगर आपको इसमें शो नहीं कर रहा है, यू कैन चेंज फ्रॉम हेयर। ये नीचे ऑप्शन है एक। 9916 चल रहा है फिलहाल के लिए। 9915 जून मंथ का कॉन्ट्रैक्ट। सो चेंज इट। कल की जहाँ पर क्लोजिंग हुई थी वहीं पर ओपन हुआ है एग्जैक्टली। नेचुरल गैस को देखोगे ऑलमोस्ट दैट इज ऑल्सो फ्लैट करेंटली। ठीक है, देखते हैं कुछ ट्रेड बनेगा तो विल सी। इंडियन मार्केट भी देखोगे, निफ्टी एंड बैंक निफ्टी हल्का सा फ्लैट ही लग रहा है मुझे तो। निफ्टी तो ऑलमोस्ट फ्लैट ही ओपन पॉसिबल लग रहा है। लेट्स सी क्या होता है। आज निफ्टी की एक्सपायरी भी है, विल सी दैट।
and quite a long way from experiencing that, then technically that would be an appropriate containment strategy. Because much as this technology is manifested in software, it lives on the internet, it still sits on chips, whether you're training a model or serving a model. So in order to ask a model a query, you have to have access to one of those NVIDIA GPUs. And, for what it's worth, there are really only like one major company in the world that produces those high-end GPUs, NVIDIA, and they manufacture the vast majority of their chips at TSMC in Taiwan. that use one single company, ASML, a Dutch company that manufactures the core chip that produces the chips, and they sit in the Netherlands. So it's actually a very narrow supply chain. And so I think the point I was sort of trying to make is that if you wanted to adopt a containment strategy, there is a supply chain where you can impose chokeholds on it.
And in 10 years from now, which country do you think will be leading the world in AI? Is it going to be the US? Will it be China? Will it be Europe?
It's going to be the US, I'm pretty sure of that. I mean, the fundamentals in the US innovation ecosystem are unquestionably the best in the world. I mean,
what could flip that balance of power?
Well, I mean, I think it's hard to say. I mean, I really do think that the US is in the strongest possible position. At the end of the day, you know, it's talent that drives, you know, this innovation. And talent still concentrates around a small number of physical places. Despite everything that we've experienced in the pandemic and people wanting to work remotely, you know, it's still really important to be physically proximate to other people who, you know, are working with you in the office. I mean, you know, I think that trend isn't going to change. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities, but that is going to take 5 years or so. The export controls that the US has implemented, you know, are real, and they really will prevent China from getting access to the next frontier of models, so the GPT-5 onwards. Right now, I don't really see how China could train those kinds of models.
Is there any downside, any unintended consequences that could come from this containment strategy the US is employing?
Yes, I think it is a very aggressive strategy. The counterattacks have already started, right? China restricted galenium, which is a raw material used in chip manufacturing. And I expect them to have their own reactions in time. You know, we're very dependent on their supply chain. And so the idea that we could completely decouple, I think, is misguided.
I'm going to just put you on the spot really briefly and wonder, can you tell, because we're all friends here.
Sure, go for it.
Like, do you have a major regret about your work in AI? And do you also have a major single goal?
Yeah, my major single goal is to show that it is possible to create safe and ethical artificial intelligences which are accountable to humans. There is a possible trajectory where, you know, some groups may recklessly experiment with algorithms that can self-improve, and if in 10 to 15 or 20 years time those kinds of AIs are set loose on the open web in, you know, a reckless way, then I can imagine that possibly causing serious harm. And so for as long as I can remember, almost 15 years that I've been involved in AI, I've been trying to raise awareness and concern about the possible ways in which it can go wrong. And part of doing that is to show a bunch of practical ways that it can go right, both with writing my book and laying out a series of containment strategies and things that we have to do in politics to improve our governance and regulation, but also in actually building and making Pi, which I think is hopefully going to continue to remain a very safe and controllable personal AI that can work for you.
Mustafa, thanks so much for coming in. Been a pleasure.
Thanks very much for having me. It's been great.
Helen Toner, thank you so much for joining us. You're a director at Georgetown Center for Security and Emerging Technology, and you're also an OpenAI board member. Dan Wang, thank you so much for joining us. You're a visiting scholar at the Tsai China Center at Yale Law School, and you've been studying technology and China for many years now.
And we've just heard from Mustafa Suleyman, and he thinks that China's emerged as one of the biggest contenders in AI. So Helen, I'm just curious to start with, do you think we're overestimating China's capabilities?
It's certainly true that they're a big player. And it's also true that we shouldn't underestimate them and that we have a bit of a history of underestimating China's ability to innovate. I mean, I think 10, 15 years ago, the story, at least in Washington, D.C., where I'm based, was, yeah, China can't innovate. If they're producing things that look like new technology, it's because they've stolen them. I think that's clearly no longer true. At the same time, I think it's also very possible to overestimate them. And sometimes I think I see that as well. So are they a serious competitor? Yes. Are they eating our lunch? No.
So that copycat culture, it's fair to say that most people are thinking we're past that stage. Dan, what do you think of that?
Well, I think it's certainly the case that China focuses on different things. So President Xi Jinping is, I think, a little bit less enamored with the internet platforms, with a lot of the cryptocurrencies, with a lot of the AI businesses that Silicon Valley specializes. He's also a little bit less enamored of Wall Street and financialization and hedge funds. And if I had to think about what Xi's broad views are, it would be much closer to being something like capitalism with German characteristics, which is much more about building cars, building hydraulic pumps, building heavy machinery, the heavier the better, about all sorts of these major industrial projects. And I think China is very much a leader in things that include electric vehicle batteries now, solar photovoltaics. It is making a lot of electronics products, and it is innovating on a huge sort of a lot of the automotive supply chain. But I think they have a little bit less of a focus on AI, and therefore there is not so much political direction anymore to really push forward these consumer applications.
I think it's fair, though, some of those areas, the US is also innovating very, very strongly. So are there any areas where China is innovating significantly better than the US?
Well, I would say something like electric vehicle batteries, where China has something like the 70% of all global expansion, all global capacity of electric vehicle batteries is now mostly in China. When it comes to the clean technology supply chain, again, these very industrial projects, these pieces of heavy machinery, that is a little bit more the focus. I think the US is really strong in things that include semiconductors, artificial intelligence, biotechnology. These are things, the smaller things where China is not so good, but there are big areas in which China is way outbuilding the US.
I mean, the semiconductors is getting significantly better in China. I mean, partly maybe as a result of the Huawei issue. Helen, what's your view on the semiconductor side of this?
So China's definitely been investing for decades in trying to have their own independent semiconductor supply chain. And they've been making some progress. The thing to know about semiconductors is there's a huge range of sophistication, from the really basic semiconductors, computer chips that go in basic devices, your smart fridge, your car, up to the kind of more advanced chips that might go in a brand new iPhone, up to very advanced chips that go in kind of the data centers, gigantic warehouses full of computing, which is what you're training advanced AI systems on. So China has made a lot of progress on the more basic end of the semiconductor sort of scale, and is still really struggling to hit the most advanced end. And that's where, it's not even, you can't even say the US is, alone able to create those advanced semiconductors. But what you have is an incredibly advanced global supply chain.
Many describe artificial intelligence and its development across these two superpowers as an arms race. Is that framework misguided, do you think?
I think it's a bit misguided. I think you really want to look at what kind of AI are we talking about, and in what way might it be a race. I think the place where it's clearest that it makes sense to think in a competitive framework is in kind of military domains. So, it's just true that the US military really wants to make sure that it is keeping pace with, and ideally a little ahead of, the Chinese, or a lot ahead of the Chinese military in terms of what technology they have.
Dan, Washington has taken some steps to curtail some of China's ability to get their hands on the cutting edge chips that really power these AI platforms. What's your take on that? Is that an effective strategy, or will China just find a way to build their own?
I think that China is going to try to figure out a lot of the way to build their own. A lot of the chip makers now have been under very significant stress from U.S. sanctions dating back to about a year ago now, released by the Biden administration, that is really stopping their ability to access not just the high-end chips, but also the semiconductor production equipment as well.
And I think in general, it's really difficult to distinguish between what kinds of technologies should the U.S. really not want China to be able to develop, and where is it fine. So, you mentioned, clean technologies before, where China, if you're looking at, manufacturing solar panels, as you mentioned, EV batteries, a lot of other areas, China is doing amazingly at that. And what you're starting to hear in some, U.S. policymaking circles is that maybe that's a bad thing, that China is making a lot of kind of clean technology stuff. And I find that a little sort of tricky to reckon with, is at what point do we want to really shut them out or prevent them from being, able to manufacture anything if it's something good, useful that we can use. Of course, if it's technologies that we think have really significant military value, I understand, but then it starts, the lines between those categories start to get very, very blurred.
It seems like these tensions are just ratcheting it up even higher as time goes on. With each administration, they're intensifying. So to your point, if we do need these other technologies, solar technology for this transition into a greener future, I mean, what kind of happens next? How much do we place on kind of the AI arms race that could then potentially work against us in climate change? Is that a concern, or is that too far in the future still?
Well, a few months ago, Beijing did announce some export controls on certain solar technologies involved in making production wafers.
So it's already happening.
It is already happening, that there are some threats out there that, relatively speaking, Beijing has been pretty restrained against retaliating against American companies of the likes of Intel, of the likes of Tesla so far, but these things could escalate more.
How does the relationship between, the ruling party in China play out against the kind of the development of companies?
I think the Chinese system is definitely more top-down when it comes to AI development. You see less kind of individual tech companies like OpenAI or Google taking the lead, and more these kind of multi-institution partnerships, or maybe you have a university and a tech company and a government, department all collaborating on big AI projects. That's much more common in China. At the same time, China is a huge country, so there's a limit to how much the government can achieve from the top. So a lot of what you see is sort of Beijing providing direction, providing ideas, providing sort of signaling of this is what we in the central government would be excited about.
Dan, how would you compare how the Chinese government is handling AI with its people versus how they handled social media?
Well, I think President Xi Jinping doesn't necessarily view AI right now, a lot of these ChatGPT-like applications, as some of the most economically productive things that are coming into our society. So I think that President Xi looks much more at AI like he would at Facebook or Twitter, now known as X or whatever it is. These are platforms like TikTok that, if you're asking me, is something like TikTok or Facebook really increasing my personal productivity? Well, I would say actually it is really horribly detracting from my productivity. And so I think that a lot of these AI platforms right now create speech issues. When an ordinary Chinese person sitting in Beijing or Shanghai asks AI, well, what happened in 1989? Well, what do you think of socialism? What do you think of President Xi's performance? These AI tools are having a lot of challenges actually answering socialist correct values that are in line with the government's ideas. And so these are major speech platforms, first and foremost, and perhaps not really the economically miraculous thing that raises our productivity growth at the very moment. Now, it might happen later on. Right now, I think the party views it as somewhere between economically not that useful and potentially very socially destabilizing.
So from a consumer standpoint, AI is almost, it can potentially create more problems for the Chinese Communist Party. But then if you look at it from like a surveillance standpoint or military type of AI applications, that's kind of in a different camp. Is that right?
Yeah, that's right. And I think they're definitely, one area where China is, I would say, leading in AI is on surveillance. They really have leaned hard into facial recognition, voice recognition, even gait recognition. So how you walk in a crowd, can they pick you out by that? I think in the West, there's been some development of these technologies, but with a lot of criticism from civil society, a lot of hesitation, sort of, I would say, like very yellow light. And in China, it's been blaring green light.
On the topic of WeChat, when we spoke ahead of this, I think we touched on the fact that there are some generalized misunderstandings about China's approach to social media and data and AI. AI relying on huge amounts of data, and the perception is that because of things like WeChat and similar things in China, that there's this huge pool of data that the population in China is just very happy giving over and is used to giving over, and therefore is just sitting around waiting to be exploited by AI. And I remember that you made a pretty significant point. It's like, that's probably not really the case. And people think that's the case, but it isn't. So I wonder if you could touch on that.
Yeah, I think people have this perception that because the Chinese government is very controlling and has a lot of access to what's going on in Chinese citizens' private lives, that means that there's these beautifully curated, extremely complete, large databases of information that can be used to train AI systems or to do other things. But for anyone who's ever worked with data, you know that cleaning data, structuring data, making sure that the right information is flowing in the right places is incredibly challenging. So it's both true that the Chinese government can get very detailed information on the private lives of its citizens if it chooses to, and also true that it's incredibly messy the way that works, and incredibly difficult for any given actor to get access to something. So, for instance, a company trying to train some AI model using data is actually subject to a pretty significant data governance setup in China, data governance regulations that make it really challenging to use customers' data for things it wasn't already designed for, or that you didn't already get consent for.
Which we learned from Cambridge Analytica scandal just as one case, and there are many others. That is not the case in the US. It's not the case in Europe. There's a lot going on. The EU's AI Act is pretty widely praised by some people, not everybody, but it's quite broad and far-reaching. But that's not the case in China, in terms of what you're saying.
So China's setup is now more similar to the GDPR that exists in Europe. So around kind of protecting consumer data and giving people the right to opt in to different uses. Of course, in China, there's always the exception, unless the security services think that you might be a dissident, and then they're going to get whatever they want on you. But in terms of kind of companies, they're certainly relatively restricted in what they can do.
Switching gears a little bit, Dan, I'm curious about how China's sluggish economic growth recently weighs into the government's calculus and how they're thinking about AI's potential to spark social unrest.
I think that the Communist Party is very much involved in trying to think about, how to control possible social unrest. I was in Shanghai in November 2022 when there were protests in the streets denouncing zero COVID, denouncing the Communist Party by name, that these were things that were erupting. And so I very much sign on to Helen's description of AI, that China is leading in the AI of censorship. It is leading in the AI of facial recognition. That right now it looks very much like the US is a place where ordinary consumers can tinker with and play around on a lot of these AI tools, whereas in China is mostly reserving these very powerful tools for its own use, potentially to control society. That right now China is in a moment of economic weakness. This might deteriorate further, this might get a little bit better, but there is always this presence hovering over there that the state security might ramp up its technology, really to make sure that there are no socially destabilizing incidents.
Well, Helen, Dan, thank you so much for being here. It's been great to learn from the both of you.
Thanks so much.
Thank you very much.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Paused for now. President Trump says he's calling off a planned strike on Iran, citing appeals from Persian Gulf allies. But he warns the U.S. remains prepared to attack if a deal is not reached. Oil and stocks decline after Trump's comments. Investors worries about lack of progress in Iran, keeping inflation concerns front and center. And NVIDIA CEO Jensen Huang says China could eventually reopen its market to U.S.-made AI chips, signaling a possible thaw in tech trade tensions. It's just gone 8 a.m. across the Emirates, 5 a.m. over here in the UK. I'm Joanna Bersecci in London today and this week. Building up on the big news overnight and the fact that President Trump has decided to hold off on further attacks on Iran, at least for the time being. No imminent attacks, and he says that's at the request of Persian Gulf countries. Let's also see how markets are reacting to this fairly consequential geopolitical news. Inflation once again front and center. Abir Abu Ahmad is in our Dubai studio. Abir, just walk us through how investors have reacted to this bombshell announcement from President Trump overnight.
Good morning, Jumana. So like you mentioned, President Trump is holding off an attack from in Iran after speaking to Persian Gulf officials. He said he spoke to the rulers of the United Arab Emirates, Qatar, and Saudi Arabia, and they held him off from attacking imminently Iran. Now, how markets are reacting, what we're seeing in U.S. futures is they're down 0.2%. This is after a flat close in the S&P 500 yesterday. Something else that's quite interesting in the U.S., perhaps not very relevant to the war, is something that our colleague Anthony Stevens pointed out earlier, which is this rotation that we're seeing outside of semis and into software. Now, since the start of the year, software stocks have not been doing very well. Hardware stocks, on the other hand, have been outperformers. So we're seeing a rotation from one to the other, a trend that he pointed out that I thought was quite interesting. What we're seeing in Asia this morning is 0.6% on the downside. And this is, again, as investors take cash and don't pile their money into stocks, because we just don't know what is happening in the Middle East and whether a truce is achievable at this point. So a sense of jitters is coming across markets in Asia. Brent crude prices, as a reaction of President Trump's comments, 1.9% lower. It is at $110 a barrel this morning, Jumana. And then when we talk about bonds, now we saw what happened with the bond markets yesterday, especially in Japanese yields and those decade high yields. U.S. Treasury bonds not doing much this morning, 1 basis point higher for the yield on the 10-year notes. Now we flip the board, and this is an interesting chart that I saw today, and this is relevant to Japan. The yields on the 30-year notes and the 10-year notes accelerated to the highest levels in decades. Data that came out this morning, Jumana, about Japan's gross domestic product suggested that for the first quarter, it was higher by 2.1%. Now, this is much higher than consensus of 1.7%, and perhaps giving the BOJ more reasons to hike rates. Now, we keep an eye on the yields in Japan, again, decades high, as you can see in the chart, but also we keep an eye on the yen and those comments from Prime Minister Sanai Takaichi about whether fiscal stimulus or some economic packages are warranted now with the impact of inflationary risks coming out of the region. But that is what we're keeping an eye on. So bonds, markets, and Brent all in focus this morning, Jumana.
Yeah, the triple Bs, Abir Abu Ahmad and Dubai, thank you so much. Well, President Trump says he has called off strikes on Iran, planned scheduled for later today. That is after Gulf allies asked for more time to seek a diplomatic resolution. Trump says the U.S. remains prepared to attack if an acceptable deal is not reached, but did not give a deadline.
I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that, where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
Well, let's stay in Dubai now and speak to Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa, and Russia. Stuart, well, yesterday we were having a discussion about what the U.S.'s options are and whether they actually do end up going down the military route. It seems now, from what President Trump has actually told us, that they were very close to launching a renewed round of attacks on Iran, but held off because Persian Gulf allies restrained them. Does this mean that there's a potential for a breakthrough on a deal in the next few days?
Good morning, Jumana. So, I think you need to apply a certain level of skepticism to the Truth Social posts, because, as you know, they're frequent, they're often, they need to be treated with a degree of caution. However, it must be said that it did feel like there were fewer and fewer options here. Iran seemed like it was totally unbending on the key issues as far as the US is concerned, and at the same time the US was unwilling to compromise on what it sees as the red lines. So on that basis, maybe we are getting closer to a deal. I have to say there is very little visibility on where exactly that might be and where are the common grounds here. But clear, I think, from a regional perspective, that a diplomatic option remains the preferred option over a kinetic one.
Yeah. And Stuart, I think what's also become apparent, and again, there are a flood of headlines coming through from various Iranian state media outlets and so forth, but is it fair to assume that for the diplomacy angle to proceed, there also needs to be an understanding of what the framework is for discussions as opposed to an actual deal breakthrough, and that it seems as though Iran had been wanting to separate the issue of the Strait from the nuclear option. The US want to combine the two issues together.
Yeah, agreed. But I mean, I think there's a fundamental problem here. So I'm going to point to one example. The US produced a one-page memo, I recall, a couple of weeks ago, that was supposed to be the framework. And I think you look at the complexity of trying to resolve the long-standing multi-decade issues between the US and the Islamic Republic, and secondarily between the Islamic Republic and Israel, and then thirdly between the Islamic Republic and the Persian Gulf, and to try and distill that into a single-page memo feels absolutely extraordinary. It is so simplistic that it's hard to see how you can make much headway with that kind of framework. However, we are now into, I don't know how many weeks of particularly Pakistan, but I'm sure others trying to mediate here, and perhaps we're moving close to something that both sides can live with. However, at this stage, you know, and with Trump making the kind of comments that he made yesterday about holding off for 2 or 3 days, again, it feels like an extraordinary time frame to try and reach a deal when there's no evidence that they're really making much progress.
Yeah. And Stuart, finally, how should we read the decision out of the US Treasury to extend the waiver on Russian oil?
Yeah, it's very interesting. So, you know, yesterday we did have those reports out of Iran that there was potentially a similar sort of deal in the offing. That, of course, has subsequently been denied. But I think one of the key concerns here for the White House is to try and keep a lid on energy prices. Now, it's hard to say exactly what sparked this decision to extend the Russian waiver. But as we've spoken about repeatedly over the last couple of days, you know, you had that very violent reaction in the bond market. And I think that's really what focused minds on trying to sustain enough supply to keep prices, energy prices, at a level where it's not going to spark this sort of rampant inflationary effect right across the world.
Yeah. Stuart, thank you so much. Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa, and Russia. Well, joining us now is Ozan Ozkiral, founding and managing partner at Tanto Capital Partners. Ozan, good to have you with us. I guess this could go two ways, and it's binary. We could see a resumption of kinetic military action, or we could potentially see a breakthrough. How do you, as an investor, piece together what could be two very divergent outcomes?
Good morning, Jumana. I think our base case is that even if the hostilities cease, Iran has proved that it can exact pain in the region by playing an asymmetric warfare. And therefore, I think the new normal that we're meant to price is one where prolonged conflict is likely to continue, and a world where we're going to see the impact of inflation come through to the markets over the next months or so.
On the impact of inflation, certainly there are signs that it's beginning to creep up. We're seeing it in U.S. wholesale PPI and CPI. There are green shoots of inflation beginning to show up in markets, in the data, I should say, but less so in equity markets. At what point do you think equity markets are going to have to start paying closer attention?
I think this is a major problem. Equity markets should have paid closer attention to this when the hostilities started, but the market is trading quite narrow. What worries me is that the participation rate in trading has gone down, and therefore investors are, if you will, hiding behind the Max 7 and pretending that things are fine. Things are not fine, because we're going to see the lag effect of this war. Even if the war stops today, it's going to be, again, a couple of weeks or months until the inflationary impact filters through to the real economy, and the market should really be trading this. Now, what we've seen over the past week and Friday in particular is that we don't necessarily have to have a single event for the sentiment to change, and that on its own is quite dangerous to me. I think we should be trading the current geopolitical and macroeconomic factors a little bit more carefully, Jumana.
Where do you see the opportunity to trade it, though? Because again, if you had bought $150 upside in oil, you'd be out of the money right now. If you had bought S&P puts, you'd be out of the money right now. So where is it likely to show up if you wanted to express that sustained inflation view? And I guess maybe bond yields is the answer.
I mean, bond yields look like they may be the answer, but I would not go long any bonds, especially the longer dated bonds. I don't see why any investor would want to put them in their portfolio, given so much uncertainty persists. The way I would want to play it is, again, look, if you take a step back, thematically, there are areas that we should place capital towards. You know, let's just take AI, for example. But the way to play the AI game, I don't think is necessarily going to be through the equity markets. We could focus on trying to play the infrastructure and the energy part of the AI game, which is actually much more grounded in reality and is likely to provide a longer-term hedge versus trying to go long again the Max 7 stocks. Commodities is quite dangerous. You know, I think taking a step back and understanding who wins through this sort of a prolonged conflict is important. You know, we're in a world where money market funds yield more than they did before. Granted, not as much as inflation perhaps, but maybe to have some liquidity and then go long innovation vis-a-vis the more infrastructure part of the innovation cycle is not a bad bet.
The other big geopolitical event last week, of course, was that high-stakes meeting between President Trump and Xi Jinping. And you fast forward a couple of days, and yes, we got a few agricultural deals, you know, talks, reports of China buying those Boeing jets, a warning that came through from China on Taiwan. Would you say that this was a summit that moves the needle in terms of the global geopolitical power structure?
The meeting on its own wasn't a notable one from that perspective. But let's say one thing. This time next year, we'll be talking much more about Taiwan than we are doing right now. I think once the wars in both Europe and Middle East abates at some stage, what will remain is that strategic rivalry between US versus China, especially around semiconductor manufacturing, especially around Taiwan. Now, I don't think China really wants war. I think China's perspective is to try to kind of convince Taiwan that they belong within the Chinese framework. And obviously, it's not in the United States' interest to let that happen. And I don't see an obvious way to bridge that gap. Now, again, we're discussing US selling arms to Taiwan, which would be a deterrent of sorts. At the same time, we have witnessed through what's happening in Iran that you cannot bomb a country into submission necessarily, let alone an island. And therefore, given that if you will, the prize at play over here is semiconductor supremacy, I think we're going to hear a lot more about this, and I think we'll be talking about issues around Taiwan a lot more this time next year, Jumana.
Yeah, I think that probably is a fair assumption. Ozan Alzkaral, Tanto Capital Partners Founder Managing Partner, thank you so much. Well, still ahead, we will talk rates and global markets with Dirk Willer, macro strategy and asset allocation global head at Citi. But up next, Russian President Vladimir Putin visits Beijing, hoping to exploit Middle East turmoil to get a deal on a gas pipeline. This is Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Welcome back to Horizons Middle East and Africa. I'm Joanna Bersace in London. Now, Vladimir Putin arrives in Beijing for talks with President Xi Jinping to exploit Middle East energy turmoil and deepen energy links with China. Bloomberg understands the Russian president is hoping China will be more flexible in negotiations on a contract for gas prices for the planned Power of Siberia 2 pipeline project. Let's bring in Bloomberg Chief North Asia correspondent Stephen Engel for more. Talk to us about the purpose of this trip and perhaps the economic incentive for the Russian president to be in Beijing right now.
Sure. I think this was a planned trip long ago before we knew the exact dates that Trump would be here. Of course, he was here last week, Thursday and Friday, but it's a stretch to say it was just a coincidence. I mean, I think the one mission is they can debrief each other, obviously, on what was discussed with Donald Trump. But really at the forefront and what will likely dominate the agenda for these talks tomorrow here at the Great Hall of the People will be what Vladimir Putin has wanted, sort of the sign-off, and Xi Jinping agreeing to the terms of gas contracts for that proposed and planned Power of Siberia 2 LNG pipeline that is really awaiting China's sign-off, if you will. They've been long negotiating about the length of contract, the size of deliveries, how much LNG to justify the extreme cost of this pipeline that will cut down through Siberia, through Mongolia, and into China. And that's something Xi Jinping has been trying to sort of drive down the price. He knows that Russia needs the Chinese, purchases of the LNG because of what's happened in Europe. That market has dried up for Russia. But on the same side, you can talk about what kind of leverage does Vladimir Putin have right now? Well, obviously, we've been talking about it consistently, and that is the war in Iran has driven up oil prices. All nations are looking for energy resilience and backups, and that might be a lever that Vladimir Putin is going to be pushing. I would guarantee that's going to be a lever he's going to be pulling to see if the appetite in Beijing right now to approve those contracts so we can get this across the line and get the pipeline built, whether there is appetite for that in Beijing right now.
Yeah, and of course, let's not forget overnight the U.S. Treasury actually extended the waiver on purchases of Russian oil. So he's got that as a tailwind. Is there anything else we can expect from this meeting, Stephen?
Well, there are expected to be a number of different commercial deals. Keep in mind, really, China has been a main economic lifeline as the war in Ukraine enters a fifth year. Now, it's a strong but very uneven or unequal relationship on the commercial side. Simply, Russia needs China more than the other way around. If you look at exports from Russia to China, it's about 3.7%, or excuse me, China's exports to Russia, about 3.7%. 36% of Russia's external trade is with China. So it's an unequal relationship right now. And Vladimir Putin is bringing with him 5 deputy prime ministers, 8 ministers, a central bank governor, and also heads of large corporations. So we could see a deal flow come out of this. That is something that obviously, as the war in Ukraine really drags down on the Russian economy, it's showing more strain. As I said, the war in Ukraine enters a fifth year. So any kind of economic lifeline that Beijing can provide would be very much welcome to the Russians.
Stephen Engel, thank you so much for your reporting. 2 back-to-back summits, Bloomberg's chief North Asia correspondent. Now, coming up, NVIDIA's CEO tells Bloomberg he expects China to eventually allow the import of artificial intelligence chips from the U.S. We'll have that exclusive interview next. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to Horizons Middle East and Africa. I'm Joanna Bersecci in London this week. NVIDIA CEO Jensen Huang says semiconductor demand in China is incredible, and he expects authorities there to eventually allow the import of AI chips from the U.S. Huang was a last-minute addition to a delegation of business leaders who traveled to Beijing for President Trump's summit with Xi Jinping. He spoke to us exclusively in Las Vegas alongside Dell CEO Michael Dell.
The president wants America to win everywhere. Right. The president wants America to lead the AI revolution. And so H200s are licensed to sell to China. The Chinese government has to decide how much of their local market do they want to protect and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open. President Xi was very clear that he wants China to be an even wider open market. Premier Li Qiang was very straightforward and explained very eloquently that China will be an open market. So I'm looking forward to China being a more open market.
To clarify, Jesse, you were able to meet with those officials directly to discuss whether or not you can sell to those Chinese tech companies.
I didn't discuss directly with them about H200. Right. I was there to represent the United States, and I was honored to do so. I was there to support President Trump, and really glad to do so. But that was really the focus of my trip. President Trump had some conversations with the leaders, and I'm looking forward to what they decide.
Michael, you did not go to China, but I think what's interesting is you are a member of the President's Council of Advisors for Science and Technology, as is Jensen. Your net conclusion on whether or not China will become open to American technology companies to do business there?
You know, we have a business in China. Obviously, we comply with all the restrictions and various controls that are in place. But I hope that there's more economic collaboration between the United States and China. That ultimately is what will lead to greater outcomes and prosperity for everyone, and a greater likelihood of a successful relationship between the countries and around the world.
NVIDIA CEO Jensen Huang and Dell CEO Michael Dell speaking exclusively to Bloomberg Tech co-anchor Ed Ludlow. Now for a look at some of the other stories we're following today. Iran's semi-official Fars news agency says Tehran has started a Bitcoin-backed insurance service for Iranian shipping companies that want to transit the Strait of Hormuz. The insurance service, dubbed Hormuz Safe, provides Iranian shipping companies and cargo owners with fast, verifiable digital insurance with payments settled in Bitcoin. Bloomberg has learned UBS has lost several senior wealth management bankers in the Middle East less than 2 years after hiring them. The departures highlight an intense race for banking talent in the region, which was becoming a major hub for the world's ultra-wealthy before the Iran war began. The UAE in particular lured the world's ultra-wealthy thanks to a favorable tax regime. But coming up, a new Ebola outbreak in DRC and Uganda is raising fears the virus could prove harder to contain. More details next. This is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Horizons Middle East and Africa, our top stories this morning. Paused for now, President Trump says he's calling off a planned strike on Iran, citing appeals from Persian Gulf allies. But he warns the U.S. remains prepared to attack if a deal is not reached. Oil and stocks decline after Trump's comments. Investors' worries about lack of progress in Iran, keeping inflation concerns front and center. And the U.S. is now stepping up its response to the Ebola outbreak after a missionary tested positive for the virus in the DRC. We are live in Johannesburg with the latest. It's just gone 8:30 a.m. across the Emirates, 5:30 a.m. over here in the UK. I'm Joanna Versace in London. Market's not really sure how to read the latest news coming out of President Trump that they've held off on attacks on Iran. It could be a good thing or a negative thing, and so far there is no full resolution. Abir Abu Omar is in our Dubai studio and ready to break it down for us. Abir, how are markets reacting today?
A sea of red, Jumana. You can see the screen behind me. U.S. futures 0.3 down. Asian equities already trading 0.7% down. Now, if you remember last week when it comes to the U.S., we were talking about the return of the AI trade and AI investments. And now, as you mentioned, investors turn back their attention to Iran, to President Trump's comments about an imminent attack against Iran that did not happen after he was persuaded by Persian Gulf officials. So markets not really really understanding what to read out of that. Another interesting trend that we're seeing very specific to the United States is this rotation that we're seeing outside of hardware and into software. That's a flip of the picture that has started since the start of the year, something that is pointed out by our strategists. Now, when it comes to Asian equities, led down by the Kospi yet again, it was falling as much as 4% in South Korea earlier, so that is weighing on the overall index. Now, when it comes to Brent prices, these are a reflection of the comments from President Trump and again, the attack that was held off against Iran. 2% lower this morning when it comes to Brent crude. We continue to monitor bonds across the world, but when it comes to the yields on the 10-year notes in the United States, not doing much today. Now, remember, the 10-year yields last week had their biggest gain in about a year, driving down bonds. We continue to keep an eye on bonds in Australia and New Zealand still trading, and also JGBs. Now, when I speak about JGBs, we flip the board and we take a look at how yields are doing. Now, how yields are doing in Japan is a story from yesterday, but it continues into today. The 30-year notes are the highest since 1999, Jumana. The 10-year notes on the yield front are the highest since 1996. And that brings me to data that came out this morning from Japan, and it is about the first quarter GDP that came out much higher than expected. 2.1% for the first 3 months of the year, not really reflecting the inflationary risks or the full extent of the inflationary risks from the Mideast war, and that is higher than consensus. It was at 1.7, so really brings into perspective that notion of the BOJ hiking rates. Now, our Bloomberg economics team is still expecting a rate hike on the base rate for Japan, but they say that the likelihood of that is still very much uncertain as we continue to monitor those inflation concerns coming from the region and how long the war will continue or the ceasefire will hold, Jumana.
Abir, thank you so much. Abir Abu Hamad in Dubai. Now, the U.S. is stepping up its response to the Ebola outbreak after a missionary tested positive for the virus in the DRC. Washington has now imposed new travel restrictions, and the CDC is expanding its emergency response as concerns grow over the spread of the rare strain. Our chief Africa correspondent, Jennifer Zavazaja, joins us from Johannesburg. Jen, just talk us through how serious the Ebola outbreak is right now.
Well, Jumana, by the WHO standards, it's quite serious. And that is just if you take a look at what we are hearing from the WHO and also from a number of other agencies, largely because there is a risk of international spread. And there's also a need for coordinated response. And that's really what we've been seeing over the past few days since we did get that emergency declaration by the WHO. And really, that is because this new strain of the Ebola virus is one that many people fear has gone undetected for a number of weeks, and potentially one that could have been gone undetected through borders where a lot of trading goes on. There's quite a bit of mining activity that goes on. And so at this point in time, Bloomberg reporting is suggesting that about 350 suspected cases have taken place in the DRC, and just about 91 deaths. And really the concern is how wide-ranging is this disease? And really, considering we don't have a vaccine for this current strain, what are the protection measures that authorities are going to be putting into place at this point?
You know, you mentioned that there was a certain strain of this that was spreading undetected for weeks. And I just wonder how the cuts to U.S. foreign aid have affected the response capacity on the ground here. Could the strain have been detected sooner had there not been those cuts?
That has come up quite extensively, Jumana, and the discussions as we've been talking about this crisis as it's unfolded, because in previous outbreaks, a lot of the funding that has come from the U.S. and USAID in particular has helped in terms of detection and also deploying a vaccination. Now that we have, of course, seen the Trump administration and the U.S. scaling back significantly last year on that, the concern is that potentially we are going to see the the attacking of this virus a lot differently than we've seen in the past. I should point out, though, that what we did hear from the WHO over the weekend, this emergency declaration, is meant to spur donor agencies and also countries into action. We did hear from the State Department and the U.S. CDC on Monday saying that they are providing about $13 million in foreign aid. So we are seeing some sort of foreign assistance that is stepping in. But many people are, again, wondering what are the effects of this USAID cuts, especially because we've been reporting on some of the cuts having an effect on crisis zones, which of course is the DRC in this area in particular, and this having a compounding effect on weakening infrastructure and the response that a lot of these agencies and also workers in the region have had to deal with, just given the scaling back of funding and support that they've had over the past year.
Jen, thank you so much for the crucial reporting. Jennifer Zawazaja, our Chief Africa Correspondent in Johannesburg. Well, Equity Bank is ramping up efforts to double its regional footprint as the lender looks to diversify revenues. The CEO, James Mwangi, tells Bloomberg's Jennifer Zawazaja how East Africa's biggest bank is looking to facilitate free trade in Africa.
At the moment, we are in 5 countries, and we have a ambition of being in 15 countries by 2030. Simply because we are a leader and a champion of financial inclusion. To date, we have 23 million customers, and we have an ambition using technology, and particularly digital public infrastructure and digital financial services, to reach 100 million customers by 2030.
Have you identified those countries that you want to add, outside of the ones that have been named? I think it's Mozambique, Zambia.
It is true we are in DRC, Rwanda, Uganda, South Sudan, Tanzania, Kenya, and Ethiopia. But those don't constitute Africa. They're just part of Africa, East and Central Africa. So the ambition is to ensure we're in the whole of Africa. We are facilitating the African continent of free trade area trade, and that will require us to have capability. We are approaching that in a twin approach. The first one is entering countries, and we have earmarked Ethiopia, Zambia, Mozambique, and Angola in the medium and short and medium term, and then we could pick another 5 countries.
Have you identified those other 5?
They will be part of the remaining countries on the African continent. It may be another cluster, but as you can see, we have approached this from trade routes. So we prioritize on where is the highest volume of trade from where we are. At the moment, the first huge trade traffic was with Uganda. Then we went to Tanzania. Then we went to South Sudan. Then DRC became a huge corridor. We're now realizing that the hottest corridor is the Lobito corridor between DRC, Angola, Zambia, and Mozambique. So that is how we evaluate. So as African trade takes shape, it will give us the priority. But the ultimate objective is to be an African bank banking the entire Africa.
That was Equity Bank CEO James Mwangi speaking to Bloomberg's Jennifer Zawazaja. Now for a look at some of the other stories we're following. Protests over rising fuel prices turned deadly in Kenya, with 4 people killed and dozens injured. The unrest disrupted transport across major cities after bus and taxi operators launched a strike over soaring diesel and gasoline costs. Ghana wants large gold mines to sell at least 30% of their output to the central bank to support local refining and boost forex reserves. The government says the gold would be purchased in unrefined form to help expand domestic processing and create jobs. Officials say miners have agreed in principle to the proposal, though talks on pricing are still ongoing. Now, coming up, our next guest says global rates are breaking out of key ranges as the Hormuz standoff fuels rising inflation risks. More with Citi's global head of macro strategy and asset allocation, Dirk Willer, next. This is Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Traders are turning risk off as concerns around Iran linger, even after President Trump says he's holding off on fresh strikes on the Islamic Republic. Markets are facing a key test as bond yields remain under pressure due to high oil prices, increasing bets that global central banks will keep rates higher for longer. Joining us now is Dirk Willer, Global Head of Macro Strategy and Asset Allocation at Citi. He is also the author of the book, Trading Global Macro Markets. Interesting time to be putting out a book about trading global macro markets. Maybe we can talk about that later. But Dirk, let me just start off by asking you about the move that everyone's been talking about in the last few days, and that is the rise in fixed income in bond yields. And I wonder whether it is actually possible at this point, say specifically talking about 10-year USD, to come up with a fair value. We're sitting at 4.6% now. Where should that 10-year US Treasury be in light of the various inflation risks to come down the track?
Yeah, no, very good question. Thanks for having me. I would say fair value in treasuries depends, of course, a lot about your Fed call, right? And the Fed call became really quite tricky because, as you know, Chair Walsh came in with a strong view that AI will be disinflationary and that the Fed should not react to short-term data prints and rather focus on that big picture. The problem is, of course, at this stage, there's very, very little evidence that there is a sufficient job destruction from AI to justify any action by the Fed on that front. So with this big uncertainty on the front end, that also means fair value at the back end is difficult to ascertain. And so the market right now is, in a sense, pushing yields higher. And I do think we are at some crucial levels that not so long ago people would have thought should be the ceiling for yields. But given this uncertainty at the front end on the Fed reaction, these levels could be breaking. And then I do think if that were to happen, there would potentially be some follow-through. So the curve really could steepen further, even or especially maybe if the market doubts that the Fed can react on the hawkish side.
Yeah, let me just ask you, because again, there are so many different narratives in the market right now. There's the sort of energy crunch going on. There's the rise in fixed income yields, which is related to that. And then you've got the AI mania that's showing up in equity space, particularly in the US and in Asia. At what point do rising bond yields start impacting the rally that we've seen in equities?
Yeah. Another very good question. I think it will take a while. So what is true is that whenever we build these equity bubbles, bond yields rise, right? Because there is a positive wealth effect, there's a strong growth effect, and rates are naturally going up. But remember, in 2000, it took 175 basis points of Fed hikes, and it took the Fed to withdraw major liquidity in January of 2000, liquidity that they had really pushed into the market to fight or the risk of the Y2K bug. And so it was a combination of major liquidity withdrawals together with an aggressive hiking cycle that in the end was too much for the equity market. So now you, of course, never know which hike is the one that pushes the market over. But certainly at this stage, we still seem to be fairly far away from such a situation. So, and by the way, that is actually a chapter in the book that you kindly mentioned where we discuss what rates price action really undermines equities. And you find it really has to be fairly aggressive moves before that tends to happen. So we don't think that the rates price action will already be the end of this bull market. But given how overbought the market is, that doesn't mean it can't go sideways for a while. But we think we need meaningfully higher rates before the equity market would have basically the end of the bull market at this stage.
Yeah, there is an article in the Wall Street Journal today. The title is "The Economy Kevin Warsh is Inheriting is Not the One He Wanted," and certainly, what we are seeing is increasingly other members of the Fed, the FOMC, are getting slightly concerned about the inflation risk to come down the track. What do you think this means for an incoming Fed chief who, was nominated by the president with the view that, maybe he'd start bringing about an easing cycle, but in fact, the conditions on the ground have changed significantly in the last couple of months?
It's a very difficult situation, for sure. I mean, I would say at this stage, probably the best outcome he can hope for is that we get maybe still some negative seasonality in the labor market, which is almost the last argument left for focusing more on the dovish side. And then at some stage, maybe it is true that these AI-related job cuts will hit the labor market hard. And then that would maybe down the road at some stage open the door for cuts. But certainly at this stage, there are not many arguments that Chair Warsh can use to convince the rest of the committee to lean on the dovish side. And we already saw it in the last meeting, of course, the last Powell meeting. We had those dissents that really could have been, in some sense, you could have just adjusted the wording of the statement slightly and maybe avoid these dissents. But I think it was a little bit sending a message to the incoming chair. Listen, there are some questions which way the Fed should be leaning. And so you have the combination of yes, a stronger labor market than we thought. The last NFP print was a big deal. I think it was the first time we had two positive NFP prints in a row for quite some time. They were coming in both above 100K, and no matter what you think the break-even rate is, it's certainly above that, suggesting a decent labor market. And of course, we have no Iran deal yet. So the combination means, Warsh will have to work hard to just not hike rather than cut in the short term.
Yeah. Dirk, really good to have you with us. Thank you so much for joining our show. Dirk Willer, Global Head of Macro Strategy and Asset Allocation at Citi. Now, coming up, Israel's economy is showing mounting signs of strain from the ongoing conflicts in the region. We'll discuss that next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Shevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back to Horizons Middle East and Africa. I'm Giovanna Bersecci in London this week. Israel's economy is showing mounting signs of strain from the ongoing conflicts in the region. New data shows the economy contracted more than expected in the first quarter as the fallout from the Iran war disrupted businesses and consumer activity. Joining us now is Ziad Dawood, Chief Emerging Markets Economist at Bloomberg Economics. I remember when the IMF put out their updated economic forecast for the region, Israel actually stood out positively versus the rest of the countries in the region. But of course, now the latest figure is suggesting that there has been quite a deal of economic damage. I mean, no surprise there on back of the war. Just talk us through the impact the war has had on the Israeli economy.
Sure. So the war has had an impact on the economy. Before October 2023, Israel used to grow at 4% a year. After October 2023, that 4% slowed to 1%. That's a significant slowdown. Over 10 quarters, that accumulated to about a 7% of a gap between where the Israeli economy is and where it could have been had the wars never happened. And that gap is significant. Now, of course, if you look at financial markets, you don't see that. Stock prices are surging, the currency is rallying, but if you look at economic data in terms of the growth slowdown, if you look at the consensus forecast and how it's continuously revised down whenever there is war, there's a sort of a disconnect between financial markets and real economic data.
And how dependent is the recovery of the economy on the current ceasefires actually being maintained? I mean, these are very tenuous ceasefires with Iran, with Gaza, and in Lebanon, and in southern Lebanon, which clearly has been very volatile as of late.
Yeah, if you think about if Israel's economy were to recover to its pre-war or pre-October 2023 path, I think it needs two conditions. The first one is that the wars need to end, and for that ceasefires are important in Gaza, in Lebanon, but also in Iran. And the second condition is that the state of war that the country has been in for the past 2.5 years need not have caused lasting damage. And that assumption could happen, but it's also challenged by a number of factors. There's a risk of outward migration, there's a risk of declining foreign direct investment, and there is a ballooning defense budget. And if you spend more on defense, you spend less on productive activities like health and education. But ceasefires are crucial. No lasting damage is crucial for Israel to return to its pre-war path.
Ziad, thank you so much. Ziad Dawood, Bloomberg Economics Chief Emerging Markets Economist. Thank you. Well, so much of the talk over the last couple of days has been about the rise in bond yields, but of course the catalyst for rising bond yields has been the inflation shock emanating from this part of the world, from not London where I am today, but of course the Middle East. And what we did get yesterday was a confirmation from President Trump that they are looking to hold off on any imminent attacks on Iran with the view that they're going to give negotiations a chance. Now, markets have not really been clear on how to read this. Here in front of me, you have 10-year yields moving moderately higher this morning, about 1.5 basis points. 10-year yields sitting at 4.6, 2-year just above 4%. So worth bearing in mind there that the market is accounting for a series of now rate hikes out of the Fed. 2-year yields higher, obviously, than the Fed base rates, which indicates that the markets are looking ahead to the potential for rate hikes out of the new incoming Fed chair, that is Kevin Warsh, a ceremony money will be held for him on Friday. But beyond that, also just want to flag oil and the price action that we're seeing there this morning. The U.S. Treasury have announced an extension of the waiver on Iranian oil, so that is helping to cap some of the price movements this morning. Just shy of $110 is where Brent is sitting at, so down about 2.1%, and then WTI at $107 at 1.5% weaker on the session. But that is it for Horizons Middle East and Africa. I'm Joanna Rossetti in London. Stay with us for Daybreak Europe.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. President Trump says he's called off a strike on Iran planned for today after an appeal by leaders in the Middle East. Meanwhile, oil slides after Trump's reprieve, and it's risk off for stocks as optimism fades for an agreement to end the war. Plus, trying again, EU officials look to settle their differences over the US trade deal as they seek to avoid more tariff escalation. Well, a very good morning. If you're just joining us, it's 6 a.m. here in London. And there was a moment yesterday where oil prices dropped on hopes of a breakthrough in the Middle East talks. But even with President Trump saying that he's holding off on fresh Iran strikes, we do see stocks dropping this morning, at least in the Asian session. We're down 0.6% on the MSCI Asia Pacific Index. Looking for losses in the Wall Street session as well. S&P E-minis down 0.3%. But Euro Stoxx 50 futures are managing to eke out gains at the moment, up 0.2%. Now, if we flip over to the cross-asset picture, you can see oil down, Brent down more than 2% as things stand at $109 a barrel. Bonds are mixed this morning. If we look at the 30-year Treasury yield, we're up a basis point at 5.13, and the dollar is edging up as risk sentiment remains cautious. Now, speaking of risk, let's look at the risk events on the docket for today. At 7 a.m. London time, we get the latest jobs data from the UK, expected to show a labour market that before the Middle East war might have been turning a corner, but was still soft enough to bring inflation to heel. Then at 3 p.m. London time, we get the latest US pending home sales numbers, and then we've got a raft of central bank speakers as well. From the Fed, we'll hear from Anna Paulson and Chris Waller. From the ECB, we'll hear from Philip Lane, and from the Bank of England, it's Sarah Breeden. So a busy day ahead. Let's set you up for it. We begin with President Trump saying that he's called off strikes on Iran scheduled for later today. That after Gulf allies asked for more time to seek a diplomatic resolution. Trump says the US remains prepared to attack if an acceptable deal is not reached, but didn't give a deadline.
I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
Joining me now is Jemana Basetchi, Bloomberg Horizons Middle East and Africa anchor. So, Jemana, there's a threat underlying that.
Yes.
Just bring us up to speed on the latest position.
Absolutely. And I was sitting here next to you 24 hours ago, Lizzie, and we were saying that President Trump has a couple of options ahead of him. He could try to push through the diplomatic route or go down the kinetic action, military action once again. And he himself has revealed that they were actually very close to launching another set of attacks on Iran. But at the request of Gulf allies, he specifically cited Qatar, Saudi Arabia and the UAE, he's refrained. And while he hasn't given a deadline, he did say that we could put it off for 2 to 3 days. That is a short period of time because they, and here he's referring to Gulf allies, think they are getting very close to making a deal. So we do have a couple of days window. While he hasn't given a direct deadline, we can obviously read into this that we've got a couple of days perhaps to get another Iranian response. Now, the thing is, the background to all of this is throughout the day yesterday, there were multiple headlines coming through, as you just referenced, when talking about markets, about what the Iranians were asking for, whether they would acquiesce to what the U.S. were putting forward. What we do know, and this is something that we've been repeating over the last couple of weeks, is from the Iranian perspective, what they have been insisting on is sort of making a divergence between or a sequential approach to these negotiations, and that they, number one, want to focus on the reopening of the strait, the lifting of the blockade, war reparations and unfreezing of assets. And once that's secured, they will discuss the nuclear file. The U.S. are saying, no, you have to discuss all of these issues together. And so in all likelihood, if we do get some sort of a breakthrough in the next few days, it will be around a framework towards discussion as opposed to a full comprehensive deal itself.
Talks about talks so that both sides can look like they've come out victorious. All right, so we'll try and wait for that. Meanwhile, you've got the US issuing this new Russia oil waiver to free up supplies. What's the significance of that then?
Yeah, very significant. And also there was a flood of media yesterday suggesting that the U.S. were even considering introducing a waiver, extending a waiver on Iranian oil supply. But actually it transpired that the actual waiver that got extended was on Russian oil. This is the second time the waiver gets extended. The existing one expired on May the 16th, a couple of days ago. So the U.S. Treasury did have to make a decision, and they've now extended it to mid-June. Again, a couple of weeks. And clearly the focus here is on doing what they can to cap the price of oil. We have Brent back trading at around $110. The strait's still an issue. It's still effectively shut, controlled, monitored. There are blockades in places. And every single energy expert we have been speaking to, Lizzie, has told us that in June, as long as this blockade and the strait remains effectively shut, you're going to start to see a real tightening of physical supplies on the market. So the U.S. have thrown this into the mix to perhaps, alleviate some of the pressure that's to come. Politically, though, sensitive, of course, for the Europeans. This gives another lifeline to the Russian economy at a time when, of course, European allies have been pushing for further sanctions on Russia. But for Asian economies, it's welcome because they need lower oil prices.
With Putin in Beijing, we'll be discussing the impact on the war in Ukraine later on in the programme. But for now, Bloomberg's Shimada Basechi, thank you very much for the update. Well, that latest news in geopolitics is somewhat leading to the caution in markets, but specifically in South Korea, we're seeing stocks slumping because of weakness in tech stocks. Let's get more on that now with Winnie Xu in Hong Kong. Winnie, what are you seeing?
Yeah, good morning, Lizzie. As you mentioned, it's pretty much another risk-off day for Asia. We're looking at here MSCI Asia down for a third day, and that is the longest of such streaks since March. And yes, we did have oil actually declining a bit after President Trump said that he is calling off these fresh strikes on Iran. But given the lack of progress when it comes to the real de-escalation, we are seeing that investors are still more worried about inflation, the elevated oil prices, and bond yields. Now, that's weighing on risk sentiment overall, but you flip the board and see how, as you mentioned, South Korea's Kospi index here leading declines. Now, it was down as much as 5% earlier today, and now paring back a little bit of losses. But still, we're seeing tech stocks, Samsung, SK Hynix driving declines, tracking those losses in the U.S. peers overnight, as there's also some concerns that the Seagate technology might not be able to keep up with these soaring demand for memory chips. Now, it is also dragging down the Kospi, dragging down the Korean won, weakening past that 1,500 level against the dollar. Now, you flip the board and take a look at that bright spot in Asian stocks today, which is actually in Japan, specifically Japanese banks here on the topics up 3%. And that is coming as Japanese bond yields remain elevated. And also the first quarter real GDP data coming in better than expected. The number we're at a 2.1% jump year over year for first quarter versus the estimate of 1.7%. So that also raises the bets for the Bank of Japan to raise rates earlier than later. Back to you, Lizzie.
Winnie, thank you very much. That's Winnie Xu in Hong Kong. And staying with the bond market, if we look to treasuries, long-dated US Treasury yields are hovering near a 3-year high on the continued inflation concerns as investors look to assess these latest developments in the US-Iran war. Let's go now to Ven Ram, cross-asset strategist at Bloomberg MLive. And Ven, we've seen oil prices move lower overnight, but why isn't that easing the selling pressure on bonds?
Morning, Lizzie. I think that we have seen the peak intensity of selling pressures last week. I don't think that is going to follow through very much into Asia. Yes, yields are ticking slightly higher, as you noted, but I don't think we are going to see those violent moves of last week. I think that, selectively, duration is looking increasingly attractive. Of course, there are risks surrounding that view because you've got inflation, you've got a war going on and all that. But fundamentally, if you look at US 30-year, you're getting 5.15, and if you're looking at the UK 30-year, you're getting 5.75. Those are compelling yields, despite the problems. I mean, that is already in the price. I mean, the idea of bigger deficits, wider deficits, the idea of faster inflation is already embedded into some of these longer duration bonds. And if you're fully swapping out the currency flows into other currencies, the pickup is quite good as well. So I think that, there is an opportunity for duration selectively here, Lizzie.
Well, let me ask you about gilt, Sven, because we've had the Greater Manchester Mayor, Andy Burnham, backing the government's fiscal rules. Of course, he's seen as the top candidate to replace the Prime Minister, Keir Starmer. Is that enough to ease the fears of gilt investors?
For the moment, it will buy the market some respite. You saw the pound come back yesterday, the biggest comeback in some time, 0.8% up yesterday, although it's down broadly because of the dollar today. But I think that, what it will do, what Burnham's comments will do is that it will give gilt some respite. We saw some intense selling. The 30-year sold off by almost 30 basis points. So some of that moves will be retraced. But longer dated bonds will stay on the back foot because the markets really don't know how to handicap Burnham. the statement yesterday that we got out of his camp was kind of forced by the markets and by the IMF statement on fiscal discipline in the UK. So I think that was forced out of his mouth, really. So I think that the markets will wait to see what is he going to be doing if he's actually getting into office. And I think that the markets will handicap 30-year gilts until such time. But as I was saying earlier, if you're balancing your risks adequately, I think there is a buying opportunity somewhere here.
Yeah, I do want to know what different policy he'll be offering. What's the point of a new leader if you don't have new policy? Well, Ben, thank you very much. Ben Ram, cross-asset strategist at Bloomberg MLive. Still ahead, though, the Russian president heads to China just days after Donald Trump's visit. More on that later. But first, we'll bring you the latest from Paris, as finance ministers from a group of 7 nations are preoccupied by these global bond jitters. We'll go there next. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell,
With deep analysis of the forces driving the price action.
focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Welcome back to Bloomberg Daybreak Europe, 6:14 a.m. here in London. And as G7 finance ministers meet in Paris, their planned agenda to tackle imbalances ranging from the US budget deficit to China's weak consumption is at risk of being overshadowed. Global bond jitters have taken centre stage since, for a few weeks now, leaving ministers and central bankers preoccupied with oil-fuelled inflation risks. Let's go now to Bloomberg's chief Europe correspondent, Oliver Crook. He joins us from Paris. Oliver, where are we then on a joint position for the G7?
Yeah, as you alluded to there, Lizzie, the French really went through sort of acrobatic efforts to try to get a framework in place ahead of this meeting in order to have something that the G7 could sign on to, which is something that is increasingly difficult with this U.S. administration, as we've seen in a number of the other sort of G7 format meetings. And so they sort of went on this idea of sort of imbalances and sort of the bits of the communique that we've seen sort of circulating around. There's always a question of whether there's going to be a final communique, particularly in the days of Donald Trump. But it seems that there's going to be some language on Russia that may actually not make it in. But I think the thing that will be most interesting is probably this issue of critical raw materials that will make it in. And this is a really sort of G7 position where there is a lot of sort of collective buy-in, a lot of concern from the G7 nations about the stranglehold that China has on critical raw materials, on the mining, on the processing, all of these sorts of things. So you think you'll probably get some language there. There is also concern among the other G7 or G6 of the 7 that the U.S. sort of policy in trying to tame the oil market is undermining some of the political goals of the G7. Namely, in Russia, you see the United States saying that it's going to waive some of the sanctions on Russian crude oil. That, of course, is going to increase the sort of coffers for the Russians to spend on their military budget. And, of course, the sort of perennial trying to tame the oil market with Iran, which, again, making some similar policies. So for the G7 leaders, a lot of them are also trying to seek clarity from Scott Bessent, who is sort of the author of a lot of these policies. And that's the conversation we've had for the last day and a half.
Well, look, you've got borrowing costs high, deficits stretched. Where exactly is the fiscal room for governments to respond if this gets worse, Ollie?
I think that that's the big question, Lizzie. If we look at sort of what we've seen over the last couple of weeks since the beginning of the war in Iran, and now it seems that the bond market is waking up to it and is really going to be the protagonist in this conversation. We've talked about the spend, the fiscal stretch that we've had across European economies, while at the same time that, the fiscal room not being there. Bond yields are now elevating. Rate hikes are going to have to come down the pipeline. The nature of inflation, we need to figure out, is this just going to be energy inflation? Is this going to spread across a sort of inflation complex? And of course, this comes at a time, Lizzie, now, when you see all this sort of stretch, how many shocks are we away from something really disorderly happening in the markets? You're starting to see the hints of it in the bond market. You have the equity markets in the United States because of tech and AI sort of at all times sort of vertical. Is there sort of the ingredients there for something quite disorderly to happen within the markets and obviously have very large economic consequences? And that'll be really my conversation a little bit later with the governor of the Banque de France and the president of the Deutsche Bundesbank a little bit later this afternoon to get their assessment of inflation, where we are, what conversation are they having with finance ministers, what are they telling finance ministers, and what is the solution going forward? And of course, Lizzie, the big question, what is the rate path ahead?
Well, we look forward to those conversations, Ollie. That's Bloomberg's Oliver Crook in Paris. And as he says, Oliver has exclusive interviews from the G7 finance meeting throughout the day, including with the Secretary General of the OECD, that coming up on the opening trade, and later on surveillance, a joint interview with the heads of the Bank of France and the German Bundesbank. Well, coming up on Daybreak Europe, however, Google and Blackstone join forces in a bid to capitalise on the AI spending spurt. All of that next. This is Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Google has agreed to form an AI cloud business with Blackstone in a bid to create 500 megawatts in computing capacity by next year. The project will be majority owned by Blackstone, which is providing an initial $5 billion in equity capital. Let's get more detail now. We can bring in Neil Campling, Bloomberg senior strategist. Morning, Neil. So what does this deal tell us about the race to build data center capacity then?
Well, let's put the capacity in context.
This deal itself is less than 1% of the capacity for data center build-out that's been announced this year alone. Data that we've seen says that over 100 gigawatts of capacity have been announced so far this year. To put that in context, that is the size of the entire installed base of power of Germany. So, and that's just the additional capacity being announced. So it's a huge number, obviously. And this deal is basically telling us that we can expect a lot of these kind of JVs, combinations to help fund the capacity that's rolling out, to help fund sort of the enormous compute power that is required. Now, another piece of research recently suggests that 60% of data center announcements so far this year are likely to be delayed in terms of the build-out. That could be in terms of local regulations, governments, it could be capacity, it could be related to the memory crunch, which is obviously front and centre of people's minds. So there are many reasons for the delays to these to the capacity. There's funding requirements, clearly, but there is clearly a massive race in terms of the amount of that's required power. So this power that's been announced so far is for the next 15 years in terms of that combined capacity. But there's just no end in sight to the compute demands for data centre build-outs for AI.
OK. Well, speaking of AI, we've also had this closely watched verdict in Elon Musk's legal battle with OpenAI. A federal jury rejecting Musk's claim, finding he waited too long to sue the company. Does that clear the way for an OpenAI IPO then?
As long as we don't get an attempt to take it back into the courts, clearly it would have been very difficult for OpenAI, I think, to come to the market when there was this massive overhang in terms of the ownership structure and who had rights. This does clear a path, and because this year is such a huge year for the big tech and AI-based IPOs, now is the opportune time to come to market. So I think once we get past another big IPO that's taking place that also is related to Mr. Musk's involvement, then absolutely we're likely to, I think, to OpenAI to come to market probably in that window in terms of late third quarter, where people often try and place IPOs when they can.
Of course, you're talking about SpaceX. Do we have any clues on the timing for that? And you know, when you're talking to people, how sceptical are they about the valuation?
The valuation is the big question. It's very difficult to get a sense of where the valuation will pitch. Obviously, there's been a change as to what goes into that particular business in terms of SpaceX has now been combined with XAI, for example, but the profit is being driven by the low-orbit satellites. And so the questions around the valuation are going to be a key consideration for investors to try and understand the future projection. But again, that particular deal is not only about a test for the valuation around Musk Inc. and the valuation around SpaceX, but also to get a sense of how we are pricing these deals in the AI landscape when, as we say, OpenAI and Anthropic are likely to follow down the path for the IPOs this year.
And also putting a price on FOMO, of course, when it comes to Elon Musk. Neil, we'll probably get you back when we get a green light on that, but Bloomberg senior strategist Neil Campling for now. Thank you very much. Well, staying with tech, the NVIDIA CEO Jensen Huang says that semiconductor demand in China is incredible, and he expects authorities there to eventually allow the import of AI chips from the US. Huang was a last-minute addition to a delegation of business leaders who travelled to Beijing for President Trump's summit with Xi Jinping, and he spoke exclusively to us in Las Vegas alongside the Dell CEO, Michael Dell.
The president wants America to win everywhere. Right. The president wants America to lead the AI revolution. And so H200s are licensed to sell to China. The Chinese government has to decide how much of their local market do they want to protect and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open. President Xi was very clear that he wants China to be an even wider open market. Premier Li Qiang was very straightforward and explained very eloquently that China will be an open market. So I'm looking forward to China being a more open market.
To clarify, Jesse, you were able to meet with those officials directly to discuss whether or not you can sell to those Chinese tech companies.
I didn't discuss directly with them about H200.
Right.
I was there to represent the United States, and I was honored to do so. I was there to support President Trump, and really glad to do so. But that was really the focus of my trip. President Trump had some conversations with the leaders, and I'm looking forward to what they decide.
Michael, you did not go to China, but I think what's interesting is you are a member of the President's Council of Advisors for Science and Technology, as is Jensen. Your net conclusion on whether or not China will become open to American technology companies to do business there?
You know, we have a business in China. Obviously, we comply with all the restrictions and various controls that are in place, but I hope that there's more economic collaboration between the United States and China. That ultimately is what will lead to greater outcomes and prosperity for everyone, and a greater likelihood of a successful relationship between the countries and around the world.
The NVIDIA CEO Jensen Huang and Dell CEO Michael Dell speaking exclusively to Bloomberg Tech co-anchor Ed Ludlow. Now to some other top corporate news we're following this morning. Meta is moving 7,000 employees into artificial intelligence-related roles as part of a broad corporate restructuring that includes planned job cuts later this week. The company says the changes will create a flatter structure with smaller teams as it ramps up investment in AI products and infrastructure. Meanwhile, Uber has increased its stake in Delivery Hero. It now owns 19.5% of the German food delivery company and just over an additional 5% in options as Uber looks to strengthen its position outside the US. That move sent Frankfurt-listed shares in Delivery Hero higher after the European close. Well, we've got plenty more coming up on Daybreak Europe, with futures pointing a touch higher here in Europe, up 0.2% as we see losses on the MSCI Specific Index down 0.5%. Stay with us. Good morning from London. This is Bloomberg.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. President Trump says he's called off a strike on Iran planned for today after an appeal by leaders in the Middle East. Oil slides after Trump's reprieve and it's risk off for stocks as optimism fades for an agreement to end the war. Plus, trying again, EU officials look to settle their differences over the US trade deal as they seek to avoid more tariff escalation. Well, a very good morning. Welcome to the programme if you are just joining us. 6:30 a.m. here in London. And as we look at the equity and futures picture, it's a little mixed this morning. We're seeing stocks lower on the MSCI Asia Pacific Index, as they are for S&P E-minis, so losses set to come out of Wall Street. But there was a moment yesterday when oil prices dropped on hopes of a breakthrough in the Middle East, even with President Trump saying that he's holding off on fresh Iran strikes. It seems we're seeing stocks dropping, though futures pointing higher here in Europe, up 0.2%. Now, if we flip over to the cross-asset picture, you can see oil down again by 1.6% on Brent. 110 is where we trade at the moment. And bonds kind of mixed this morning. The 30-year Treasury yield now up 2 basis points at 5.14, and the Bloomberg Dollar Spot Index is higher, eking out gains of 0.2% as this risk sentiment remains cautious. Now let's turn over to the front pages, shall we? This morning we have the Financial Times reporting that the Chinese president told Donald Trump that Vladimir Putin might end up regretting Russia's invasion of Ukraine. The paper also says Trump suggested the three leaders should cooperate against the International Criminal Court. Meanwhile, if we look at the Wall Street Journal, this morning they say that the American rebellion against AI is gaining steam. It cites recent polling to argue that the only thing growing faster than the AI industry may be Americans' negative feelings about it. And AI also leads Germany's Handelsblatt this morning, whose headline reads, €1 billion for AI. The SPD wants to mobilise private capital. It says the proposed investments aimed at helping Europe to catch up with its global rivals. Well, you can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak, which, as ever, terminal subscribers can find by going to DAYB Go. Now, turning back to the geopolitics, Vladimir Putin arrives in Beijing for talks with President Xi Jinping to exploit Middle East energy turmoil and deepen energy links with China. Bloomberg understands that the Russian president's hoping China will be more flexible in negotiations on gas prices for the planned Power of Siberia 2 pipeline project. Well, let's get more now with Bloomberg's Balazs Pens. Balazs, good morning. What's realistically likely to come out of this trip then?
Well, as you said, Lizzie, energy will be high on the agenda. In all honesty, we know a little bit less about this meeting, about what to expect, than we did about the meeting that just wrapped up between Presidents Trump and Xi. But we do know that the two leaders will discuss energy security, gas shipments, the Siberia 2 gas pipeline, which has been in the works for a while, but there has been a hold-up over the pricing of the gas to be shipped on that pipeline. And we assume that with the Middle East conflict putting pressure on energy prices around the world, the Russian side will hope that they will have a little bit more leverage in this relationship. They become more important for China as an energy supplier, and this sort of security of supply has become more important for China. So they will be hoping that they can hammer out a deal here and get something concrete, move forward with that pipeline, which they have been discussing for a while now.
And Balazs, what do these back-to-back meetings with Trump and Putin say about Xi's role in global diplomacy now?
That's really interesting. In a way, you can say that the road of global diplomacy runs through Beijing now. This is not the first time that this happened. A few months ago, President Xi had back-to-back phone calls with Presidents Trump and Putin, which just shows how important the Chinese relationship is for both sides, both the Americans and the Russians. And we could go down the list. We've seen European leaders traveling to China, most recently the Spanish Prime Minister. So Beijing has really played a very central role in global diplomacy. And when it comes to these very difficult conflicts, whether it's the Middle East or Ukraine, everybody is looking to President Xi to kind of help play a decisive role in which way they will go. So there's a lot hinging on this particular meeting, and it just goes to show how important Beijing has become in this scene.
OK, Balash Pans out of Hong Kong, thank you very much for the update. And on the other side, we've got EU officials meeting today in an effort to finalise legislations for the bloc's trade deal with the US. Failure to reach an agreement means that the European Union would risk missing President Trump's July 4th deadline to have an accord in place. Let's go now to Rosalind Matheson, Bloomberg's chief Asia correspondent. Ros, what's holding up this deal being finalised?
Well, the US would say it's the EU holding things up. This deal that was signed almost a year ago, and the EU can't quite get itself over the line. Of course, under this deal, the EU agreed to eliminate levies on American industrial goods in return for a tariff ceiling of around 15% on most European goods. But there's been a bunch of issues that have come into this. One is simply that European officials kind of wanted to slow down and wait to see how did the landscape change after the US Supreme Court struck down Donald Trump's use of emergency powers on trade. There's been periodic tensions over Greenland as well. Donald Trump threatening to annex or trying to buy Greenland, and officials saying, well, we can't do this trade deal while that is going on. And also EU officials would say the US has not fulfilled its end of the bargain. It's not actually managed all the elements of the deal it said it would. For example, it's extended the list of goods that are subject to steel and aluminium tariffs, for example. And so there's a bit of accusations on both sides, but the feeling, as you said, we're coming to a deadline here that Donald Trump has now extended and set for July 4th. So we do need to see some kind of action by then.
Yeah, so with all this finger-pointing, Ros, what's the risk that we get back into a period of fresh trade tensions?
Well, it's a bit hard to know. There is a risk of that. Obviously, Donald Trump does like to threaten, and sometimes he retreats again. But he might just decide he's tired of it and he wants to have these tariffs. And he says he's going to raise auto tariffs to 25% from 15%, which would be a really serious issue for European car makers and whatever sliver of competitive advantage they may still have globally in their sector. And so it's a real question about that. Does he decide that he's tired and go ahead? And if he does, European officials will say, well, we have to do something in turn. So do we go back into the deep freeze, essentially, on trade, a series of retaliatory actions against each other, complicated by the fact there are bilateral tensions between Europe and the US, particularly the US and Germany over Germany's stance on the war in Iran? Does that all come in as a factor? And underpinning all of this is, even if we get to a deal, and Europe does say it wants to try and get this done by July 4, by the way, they are intending to try and get there, is that underpinning all of this is the reality is that the relationship is shifting and neither side really sees the other anymore as a reliable partner. And that's why getting this deal done is so hard.
A diplomatic minefield. Ros, nice to see you. That's Bloomberg's Ros Matheson. Now to some other top stories we're following for you around the world this morning. The US is stepping up its response to the Ebola outbreak after a missionary tested positive for the virus in the Democratic Republic of Congo. Washington has now imposed new travel restrictions, and the CDC is expanding its emergency response as concerns grow over the spread of this rare strain of the disease. Meanwhile, New York City Mayor Zohran Mamdani is set to meet the JP Morgan CEO Jamie Dimon and the Goldman Sachs boss David Solomon as the Democratic Socialist looks to strengthen ties with business leaders. The meetings follow recent talks with executives from Blackstone and Bank of America. Mamdani has faced pushback from billionaires and the real estate industry as well over proposals to raise taxes on the wealthy and to target second homes. And the US Department of Justice says it's creating a $1.8 billion fund to pay out for claims of alleged government weaponization as part of an agreement to settle President Trump's lawsuit against the IRS over the 2019 leak of his tax information. But critics have condemned it as an inappropriate slush fund to reward Trump's political allies. Well, those are some of our top stories from around the world this morning. But coming up, we shall focus on the UK. Mounting pressure on Prime Minister Keir Starmer to step aside. And we'll have key economic data as a focus for investors this week. We'll preview the jobs numbers next. This is Bloomberg.
about 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe, 6:42 a.m. now in London. Well, the UK's political drama is likely to take a back seat this week as investors instead focus on the data. We have labour market statistics due out shortly and inflation coming tomorrow. Let's speak now to Anna Andrade of Bloomberg Economics. Anna, good morning. I do wonder how much the Iran war will have blunted progress in the UK jobs market.
Hi, morning, Lizzie. I think right now in the data that we're going to receive today, we're unlikely to see sort of major shifts in the data yet. So what we're likely to see is actually a fall in the unemployment rate in the first quarter when you compare it to the sort of 5-year high that it was recorded at the end of 2025. And we're actually going to see sort of wage growth in the private sector falling also a bit towards close to 3%, which is the level that we think is consistent with the 2% inflation target. Now, on the surface, it might seem that everything's okay with the jobs market. Obviously, this data is unlikely to sort of trigger any sense of urgency to respond from the Bank of England. But of course, we know that sort of the worst is yet to come. As you know, unemployment is sort of a late cycle indicator. And as higher energy costs and tighter funding conditions sort of work their way through the economy, we don't expect this fall in the unemployment rate that we've seen in the first quarter to mark the start of a downward trend, but we actually expect it to pick up over the coming quarters and to peak at 5.5 in the first quarter. Now, obviously, if the unemployment rate is not going to sort of shift in a way that's concerning for the Bank of England, where are we going to look for signs of weakness? Well, we'll be looking here at Bloomberg Economics specifically in leading labor demand indicators. So that's things like vacancies, payrolls. There's been a bit of signs of weakness there in the last print, but that's what we'll sort of be looking at because that weakness, that early weakness is what sort of also will shape how the Bank of England reacts to the Iran war.
OK, so perhaps not too focused on this data for the BOE, but given your outlook, Anna, what are you expecting in terms of BOE hikes for the rest of the year?
Yeah, so if things play out as we forecast, we actually expect this weakness. As I said, in the jobs market, we expect inflation to pick up to close to 3.5% maybe in the first quarter of 2027. It will be a bit delayed as well, and we'll have CPI data tomorrow. And that's because, you know, the rise in electricity prices won't feed through as quickly as fuel prices, and also because there's also all of these indirect effects that will take time to feed through in the data. If things plan out as we forecast, so, you know, weakness in the labor market, a bit of an increase and acceleration in inflation, but a contained one with no major surprises, we actually think the Bank of England will hike rates once this year. And the key reason why we don't think it will hike as much as markets are expecting, which is around 3 rate hikes, is really the labor market. Like, this is not 2022 in the sense that we're seeing a labor market that's operating below capacity, which is a very different picture to the labor market that we saw, coming out of the energy crisis. So we're currently seeing only one rate hike, but let's see how things plan out.
Yeah, so plenty more data coming in the future months to see whether that difference between your view and the markets will plan out. I also have to turn to the fiscal side of the equation, Anna. We've had the Greater Manchester Mayor Andy Burnham, the current favourite to replace Keir Starmer as UK Prime Minister, of course, ruling out changing the government's self-imposed fiscal rules. Crucially, he says defence won't be exempt. I wonder how much comfort investors should take from that. Do you believe him?
Well, let's wait and see. Now, I think the market moves that you've seen in the pound and in rates do sort of show that investors have taken some relief. I think, at the very least, what it shows is that Andy Burnham and his team sort of know that they're not acting, in a vacuum, that, policy sets, in a broader macroeconomic and market context, and that they actually need sort of the investors sort of buy in, or at least to be at least a little bit on their side, otherwise things go wary. Now, whether that will actually translate into whether the situation will hold 1 year from now, I think it remains to be seen. I think if Andy Burnham really wants to sort of induce change in, the UK economy, I think if it's talking about sort of borrowing more investment, these are things that are very, very hard to square with the current constraints that the UK faces. So maybe I'll take a little bit of comfort, but I wouldn't fully buy it yet. Let's wait. Let's wait and see what happens 1 year from now.
Anna, thanks for the analysis. That's Anna Andrade from Bloomberg Economics, and I'm sure we'll hear more from all the candidates as we head towards that leadership race. Now, to some other top stories we're following this morning. The Standard Chartered CEO Bill Winters says that artificial intelligence will eliminate thousands of jobs at his bank as it replaces what he called lower value human capital. The lender plans to cut more than 15% of support staff by 2030 as it expands its use of AI to streamline operations. Standard Chartered employed about 52,000 people in those roles at the end of last year. Elsewhere, the US Justice Department says it's dropping all criminal charges against Indian billionaire Gautam Adani. That decision follows an announcement that the US Treasury was resolving a sanctions-related investigation involving the Adani Group's flagship company. Last week, the SEC moved to settle a fraud case against Adani and his nephew. The move signalled a potential for a dramatic US comeback for Asia's richest person. And Renault says it's aiming to build independent technology for electric vehicles in Europe to compete with Chinese car makers. The CFO, Duncan Minto, also told us that the war in Iran has had a limited impact on supply chains so far. Let's take a listen.
Less than 1% of sales are in the region for us in terms of direct exposure. But obviously there could be larger impacts on the supply chain. Today, so far, we haven't seen any impact. But obviously, as an automotive manufacturer, we're very prudent about what could happen in the coming term. So cost is very much a focus for us.
Exactly. You're trying to make your company leaner, right? If that's the case, I do wonder why you wouldn't share also some of your factories that are not running at full capacity with Chinese companies as well, like other European car makers are doing.
Yes, Sherry, some European car makers, obviously the car market in Europe hasn't actually found the level it did pre-COVID. But Renault Group had done a lot of restructuring at that point in time. In terms of capacity utilization, unlike some of our peers, we're running over 90%, so we don't actually have any spare capacity to give away.
How well are you competing with Chinese car makers like BYD that, of course, are becoming more popular in Europe, especially given, of course, the issues surrounding energy prices soaring?
Yes, you have seen, as you referred to just earlier, a very large uptick in terms of EV demand in Europe since the beginning of the troubles in the Middle East. Whether this is a short-term thing or more of a longer-term thing linked to Renault's portfolio, because we have a dual strategy both on the EV car side, where we have a full portfolio of models, and on the hybrid side, which has been a very important part for Europe. But in order to go against Chinese competition and really raise the bar of the group, we had part of a Future Ready plan, which was announced very recently, the desire to keep fixed costs flat throughout the plan, to work on variable cost reductions, but I guess the most important factor is speed. And we've already proved that with the launch of Twingo, which we managed to launch within 21 months, which I think is a benchmark for Western manufacturers.
Future-ready strategy also, as you said, is about really cutting costs, not necessarily prioritizing volume, right? In that sense, give us a little bit more of your strategy on how you would compete with these cheaper Chinese car makers.
Yes, so Future Ready, one of the founding parts is about efficiency, capital efficiency, and keeping our fixed costs flat. But the plan is also a growth plan. At the end, in the auto sector, everything's about the product and the technology. So Future Ready sees us build our own independent technology in Europe, be that our EV platforms, in which we're seeing a lot of demand coming from partners outside, so external partners coming to ask us to produce for them due to the efficiency of these platforms. But it's also about growth for us outside Europe.
That was the Renault Group CFO Duncan Minto speaking to Bloomberg's Sherry Yarn a little earlier. Well, let's just check in on these markets, shall we? It's not the prettiest of pictures for equities and stocks this morning. We're down for the MSCI Asia Pacific Index by 0.6%, slightly dragged down by the Kospi. That's down 2.5% this morning. Weakness when it comes to tech in South Korea. And we're also looking at a lower open for Wall Street, down 0.3%, but a bit of brightness for Euro Stoxx 50 futures. Let's see if that holds towards the open. Flipping, though, to the cross-asset picture, and you can see partly why we've got negativity in the equities picture. Of course, there was a moment where we thought that there'd be a breakthrough in the Middle East talks. President Trump saying he's holding off on fresh Iran strikes, but caution around this latest geopolitics. Brent there at $110 a barrel. And when we look to your bond space, yields higher when it comes to treasuries. We have the 30-year yield up 2 basis points, and for 30-year JGB yields, we're up 7 basis points at 4.16. Well, coming up, we shall frame your day ahead with the best of our terminal charts for today. So do stay with us. This is Bloomberg.
The world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe, 6:55 a.m. here in London. And just in our last few minutes together, I want to talk about what the pressure has been on long-term government borrowing costs, because we've talked about how the Middle East war is pushing up oil prices in general, that they're a touch lower today. But you can see that this pressure is a global story. Here we've got the US, the UK, Germany and Japan. Yields higher in all of them, and it is becoming a structural problem, not just because of higher oil prices, but layer in more fiscal issuance, the AI investment boom creating competition and fiscal expansion on top of that. And you can see this isn't just a UK or US problem. This is around the world. Now, at the shorter end of the borrowing curve, let's flip over as well. You can see that higher oil prices are also putting pressure on the Federal Reserve to hike rates. That inflation pressure creating a difficult dynamic for Kevin Walsh. And flip one more time, if we look to the equity space, you've also got pressure on certain sectors. I've picked out autos this morning. You can see the global stock moves in the yellow at the top here, but this is a story around the world. So both in Japan and in Europe and in China, where you've got lots of electric vehicles, of course, auto stocks under pressure from this war. So just a few charts to set you up for your day from the terminal. But to access all of these, save them, search for them. And for any charts that we've used on Bloomberg TV throughout the day, terminal subscribers can use the function CHRT TV Go. Let's take a quick look at the risk events on the docket for today. We were just previewing with Anna Andrade the jobs numbers. They come out at the top of the hour, just a couple of minutes to go. We also have US pending home sales data and a raft of Fed and BOE speakers. The opening trades coming up next. The Secretary General of the OECD coming up. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, everybody. It's Tuesday, May 19th, and this is what is on today's agenda. Oil drops as President Trump says there will be no attack on Iran today, at least. Korean stocks fall as Seagate puts memory in focus. And UK assets brace for Labour data. Oh, and the fiscal politics.
So, King Kospi, the crown is slipping, at least for now, down 2.4%. The losses had been heavier earlier in the session on that sell-off in the chip sector, as Anna was saying. That's rippled across the Asian markets as well. Brent crude then currently down 1.6% at around $110 a barrel on the Trump lines around Iran. European stock futures, though, pointing to gains of 0.2%. Is today the day when actually Europe benefits by not having a lot of exposure to the chip space, pointing higher by a little over 0.1%. The countdown to the opening trade starts right now.
Tuesday morning, good morning. A few interesting things happening out there, and Anna and Tom have just talked about them, but let's dig into them in a little bit more depth. What is fascinating this morning is that oil's down, but stocks are down as well. US futures are lower. Now, recently, what you've seen is oil down, stocks up. We're not seeing that, but that points us maybe towards the chip story that Tom was talking about. We'll come back to that in a moment. And the other interesting thing is that as the Cosby goes down, Europe goes up. Is Europe the anti-Cosby kind of trade at the moment? And I think Tom's point is well made around all of that. So I think there's an interesting sort of churn happening within the markets. But basically what we're looking at this morning is oil lower. This on comments coming through from President Trump indicating that he has been asked by a number of GCC countries not to attack Iran again, to restart the war, to end the ceasefire. Does that hold? Does that hold for long? The implication here is that we are getting ready for another round of conflict, Anna, and you wonder kind of how long this oil drop can last for.
Yes, yeah. Do you focus on the fact that there's no attack today, or do you focus on the fact that there was an attack planned, according to President Trump, and maybe it comes in days, if it comes at all? It's interesting. Also, we've got this other story that the U.S. Treasury is extending the waiver on Russian energy as well, and so clearly mindful of that's for another 30 days. So they're removing the sanctions there for another 30 days. So clearly mindful of the fact that we need more oil in the system, we need more energy to get into the system. But stocks did still move on some of the Iran lines yesterday. We are still as much as we want to move on to AI and all the rest, certainly European stocks, to your point, moving yesterday on some of these conflicting headlines around what was coming out of the Middle East.
Because the case could be made that the status quo, as things stand, can't stand, that one way or another something has to happen, either a deal or a return to military conflict. So how the markets price that? Are the bond markets now pricing in a return to conflict? The bond markets are again selling off, yields up, and you're seeing that across the Japanese space. There's some economic data out of Japan as well that ties in to what is happening there in terms of pricing in potentially that hike from the BOJ in, of course, June. But the uncertainty, therefore, that continues. It does seem like the status quo can't hold in terms of what is happening around the Straits of Hormuz. So which side do we go on, and how much is being priced in by these markets as inflation risks rise?
And on the bond market, there are people now who are starting to say, is there value here? Goldman Sachs saying, looking at the 30-year at 5.13%, some emerging measure of value, but they are cautious. So that is a sort of sense of where the conversation is right now, because a lot of people have obviously been getting out of bonds. Barclays, PGIM, all pretty negative on bonds just over the last couple of days.
The other key theme for us today is what's been happening. So a second straight day of losses in the semiconductor space. Interestingly, so the Philly stock index fell. The Philadelphia Semiconductor Index fell yesterday again for a second straight day. You had companies like Micron under pressure, Marvel under pressure. But interestingly, the software stocks actually performed to the upside. So that dynamic has switched, at least in the last 24 hours or so in the US. You saw the read across, of course, to the Asian markets, the Kospi, but also Taiwan under pressure as well. And this was... And this is something you've been highlighting, Guy, is concerns about whether or not the demand for chips is cyclical or not. And it's the Seagate CEO suggesting in comments at an event that maybe he thinks that it's indeed cyclical, suggesting that he doesn't want to build out too many factories in case that demand starts to ebb. And that seems to be one of the catalysts for the sell-off.
OK, explain this to me, because I'm feeling thick this morning and I don't understand what is happening here. Why did Seagate go down on this? Because it strikes me that what he said at this JP Morgan conference should be good for investors. Basically, he's saying we're not going to fall into the trap of building too much capacity. We're going to focus on higher density drives. We're not going to fall into that trap once again. I would have thought that would be positive, not negative.
That supports the bottom line. If you're thinking about the profits, then maybe that supports the bottom line. But does it suggest a lack of conviction that this is a change to a more structural growth story, and maybe people had been buying into a structural growth story. I don't know. I'm also feeling slightly slow on this particular subject, but it certainly weighed on Seagate, but it weighed on the whole sector. Yeah. So it wasn't even just that company, and he's kind of said it before. He said it in a Bloomberg News interview not that long ago. He's reiterated the point. Meanwhile, Blackstone and Google teaming up. They seem to think that the infrastructure demand will continue and for years ahead because they have a challenge. They have a proposition at least to invest, potentially, if you include margin and leverage, about $25 billion to build out data centres to kind of compete with the likes of CoreWeave. And you're hearing from executives that they are implementing AI and there is a job cost to this, whether in the banking space or in the tech space. If you look at Standard Chartered or Meta, both announcing adjustments to headcount on the back of the AI investments. Let's talk about the UK, shall we, a little bit? We've got some data just breaking on the UK, and, at the margin, this looks weaker for the UK labour market. So if we look at private earnings, excluding bonuses, 3 months year on year, we've dropped down from 3.2% to 3%. That's the extent of the wage rise, and that is a little below the estimate of 3.1. And then we look at the unemployment rate over 3 months, and that is now at 5%, ticking up from 4.9. This is in keeping with what Bloomberg Economics was saying ahead of these numbers, that they are expecting a tick up in unemployment, and that will weigh on Labour's ability to demand more wages, and so that's for them the reason why we won't get quite so many hikes from the Bank of England. But the UK story is complex right now. Yeah, there's an inflation problem, and there's a labour market problem,
and there's a politics problem.
There is definitely is there a problem? I don't know whether there's a problem yet. Andy Burnham trying to sound like he understands the bond market concerns yesterday, saying all the right things. It sounds a bit like Starmer to me, trying to say as little as possible to upset the apple cart in advance of an election, which is quite consequential. But do you?
Yes.
But do you? But yeah, okay, fine. Yes. From his team. Yeah. The question is, do you believe him? Because basically, have you watched the video of him walking around? He's talking about anti-Thatcherism. He's talking about reversing the supply-side reform that Thatcher delivered. He's talking about nationalisation. He's talking about demand-side reform. He's talking about building lots of council houses. He's talking about all of these things which are going to cost money. So therefore, I don't understand how you can stick with the fiscal rules and deliver all of what he is talking about, this kind of anti-Thatcher rhetoric that reverses, 40 years of supply-side reform that the UK had? So, therefore, how much commitment does he have to the tax pledges that were made by this government in the manifesto, which takes us back to that question about how far away from the manifesto he goes and where that takes the politics. But, that's certainly... And actually, the IMF warning just yesterday, warning, stick to the fiscal rules, as you'd expect, but also warning about the UK's ability to take more tax rises. So that's another interesting dynamic to watch.
Yeah, the short-term reaction, of course, was that gilt yields were lower on the back of this news and the pound was slightly stronger. We'll see how gilts react today. Still quite elevated. Yes. So, yes, down a little bit. So the bond market sort of said, thank you very much, we'll take that for now, but there are still significant questions. Matthias Korn, the OECD Secretary-General, is going to be joining us very shortly. Alexandra Jackson, Rathbones Asset Management Director of Equities, is going to be joining us. We'll have a big focus there on what UK assets look like in this age of turbulence that we're seeing in British politics. And Miguel Stilwell de Andrade, EDP's CEO, is going to be joining us. So have a fascinating conversation about kind of what is happening with the solar story, the renewable story, inertial rotation, all those great sort of things that we need to be focusing on a little bit later on, Tom. Here's what else we are watching throughout the day. At 9:10 UK time, the BOA's Sarah Breeden will be speaking at City Week, speaking, of course, of the UK and the reaction from the BOE, so we'll be across those lines for you, of course. G7 finance ministers continue meeting in Paris, and Russian President Vladimir Putin travelling to Beijing for that visit. And aftermarket will get Euronext earnings results plus stateside Home Depot earnings out of the US, and of course the team there will be breaking those for you. Looking forward to that a little bit later on. What else do you need to know this Tuesday morning with 50 minutes to go until the market open? Standard Chartered is planning to cut more than 15% of its back office jobs, joining other lenders in adopting AI to replace workers. The bank employed around 52,000 people in such roles at the end of last year, with a footprint spanning India, China, Poland, Singapore and Hong Kong. CEO Bill Winters has framed the move not as cost-cutting, but get this, rather replacing, quote, lower-value human capital in favour of machines. Talking of which, Meta is moving 7,000 employees to AI-related roles as part of a broad corporate restructuring that includes planned job cuts later this week. The company says the changes will create a flatter structure with smaller teams as it ramps up investment in AI products and infrastructure. And a jury has rejected Elon Musk's claims that OpenAI betrayed its mission to benefit the public
by morphing into a for-profit business. Finding Musk waited too long to sue the company. The verdict follows a trial over the bitter feud between the entrepreneurs who worked together at the launch of the startup back in 2015. The outcome, of course, is a major relief for OpenAI, this as it weighs a potential IPO this year. Musk and his lawyers, they have vowed, of course, to appeal. This is one of the big IPOs that we are waiting for. So it looks like we could get one this week, but the kind of the OpenAI Anthropic story coming hot on the heels as well.
So that's the context, is that there is competition, obviously, between these two men around the race to AGI, but there's also the competition towards the race to the IPO. We have more details, of course, around the SpaceX IPO than we do around OpenAI's IPO at this point. But also, there's competition for liquidity. It doesn't seem like SpaceX is going to have much trouble in terms of attracting that ahead of its IPO, but that competition remains intense, and Musk says that he is going to potentially appeal this decision. But he's been relatively successful in court cases of recent times, but in this case, so far, a loss for Musk.
Yeah, I mean, Elon Musk saying he's going to appeal, as you said, because the substance of this was not tested, and he wants the substance to be tested. Interesting, though, tomorrow is a big day then in the SpaceX story, possibly, because we might get some further information about the timing and some filings around that. But we heard from Elon Musk yesterday saying we've got to get the SpaceX IPO going here pretty soon, and that was enough to send space and space exploration and satellite stocks higher yesterday. We saw Firefly Aerospace, York Space Systems, Rocket Lab. These companies not seeing this as a competitive threat, it seems, or competition for liquidity in this space, but something that puts more focus on space more broadly. So tomorrow we watch. There's a launch as well, I think, from SpaceX.
Maybe this is the new high bandwidth memory trade, is just switch out of that and go to space.
Yeah, I think the two things in some ways are connected with the data centres in space.
There you go, back to data centres in space. Every story leads back to data centres in space. 12 minutes past 7 here in London this morning. Coming up, the EU races to finalise its trade deal with the US as the bloc seeks to avoid more Trump tariffs. We will have the details coming up shortly. Plus, Jensen Huang tells Bloomberg he believes the China market will eventually open up to NVIDIA. We'll bring you some of that interview with the CEO later in the show. And up next, we'll be joined by Nicholas Bickel, who's the CIO at Edmund de Rothschild Private Bank. If you want to get involved in any of these conversations, IB plus BBTV Go. That's the function to use on the Bloomberg terminal. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg 10.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
President Trump speaking there at a White House event on Monday evening, with oil prices declining now on the back of those comments and other action taken by the Treasury in the U.S. President Trump says the U.S. remains prepared to attack if an acceptable deal is not reached, but he did not give any specifics around any timeline. Let's bring in Jumana Basechi, who's Bloomberg's Horizons, Middle East and Africa anchor, of course, and with us in London this week. Jumana, good morning. So bring us up to date with the things that have stood out to you from what we've heard from President Trump and these latest threats around Iran.
Well, it was pretty revelatory what he was saying yesterday, both in the Truth Social post and in the little clip that you played, in that they appeared to be weighing up the possibility of military strikes, further military strikes on Iran. He says that they decided to hold off by a couple of days at the request of the Gulf allies. He specifically referenced Qatar, Saudi Arabia, and the UAE. And of course, we're taking this at face value, but yesterday when we were sitting around here, we were talking about the fact that he once again threatened Iran. He said the clock is ticking. He's telling them to come back to the negotiating table and sign up to a peace deal. Now, what is going to happen in the next couple of days? We probably have a couple of days window to allow things to breathe. He does say that negotiations are going on in the background, and indeed we know that these negotiations are happening. Iran once again submitted their refreshed, I would say, counterproposal via the Pakistani mediators to the U.S. yesterday, and we'll see where we go from here. But I think in terms of, as it pertains to sort of markets and next steps, what is clear that's emerging from all of the reporting is that if we do get a breakthrough this week, it will likely be a framework around discussions as opposed to an active, fully comprehensive peace deal. You're going to get the sequencing, you're going to get an idea around how they're going to tackle the reopening of the Straits, the issues around the sanctions, and of course the nuclear file. The US want to lob everything together, the Iranians want to separate. So we'll see if that framework actually comes up this week.
And meanwhile, there's another benefit for the energy complex of Russia, it seems, because the US Treasury has extended this waiver, this sanctions waiver, for another 30 days, just as Vladimir Putin is about to set down in Beijing. That seems to be a win, at least on surface level, for Putin.
Well, absolutely. And it's funny because that announcement came after several hours of speculation, again, in Iranian state media, that the US were going to apply a waiver to Iranian oil sanctions, which clearly didn't manifest. But later on, Treasury Secretary put up a post, Scott Bessent, saying that they had once again extended the waiver on Russian oil. This is the second time they do so. It had expired a couple of days ago. So it's in place. But clearly it's just another measure that the U.S. government is taking to help put a lid on oil prices. Brent is sitting back at $110. We're still talking about the 2 blockades around the Strait of Hormuz. No end to that in sight. And more we hear of these energy experts and energy analysts saying that these stockpiles are being run down, and we are getting to a critical month in June where you could start to see an actual squeeze on physical supplies. The U.S. probably anticipating that, but giving this gift to President Putin.
Sure. We're still at 110, though.
We are still
and we
at
could
110.
squeeze from there, and that's the point.
And China have been buying less. They've been stockpiling less, which is the key factor here.
In terms of the demand side. John, nice to see you. Thanks very much indeed for joining us once again. John Abaseci on what is happening with the Middle East story and how it relates to the oil story and how it relates to the inflation story and then how it relates to the bond market story, which we're all very much focused on. Nicholas Bickel, CIO at Edmund de Rothschild's Private Bank, joining us around the table to carry on the conversation. Good morning.
Good morning.
Selling bonds?
Yeah, I mean, we were selling sovereign bonds since many months, but I think we are at a pivotal level right now. Not surprisingly, it's focusing on a sovereign issue. I mean, it's not spreading to the corporate bond market as of today, but I mean, it's a signal that the market is sending to, I mean, government that probably surge in AI spending, high inflation, and the situation between Iran and the U.S., as well as this inflation around and rising deficits, surging deficits, is probably becoming an issue, at least for the sovereign rate.
You said it's at the moment it's not spreading into the corporate bond market, but does what happens in the sovereign government bond market stay in the sovereign government bond market? It has to impact other assets.
I mean, for the moment, it's focused on the sovereign bond market, and we do not see the spreads of the corporate raising much. I mean, the part of spread when you're buying a bond at 5% is really, really thin, and it's not spreading right now. But the reality is that if you have higher level of interest rate for a long time, you will have an effect also on equities. That's the reality, and especially the one which are highly indebted. I mean, even a hyperscaler, if you look at hyperscaler, they just announced more than 750 billion spending, which is quite equivalent to the cash flows they will generate this year. So they will have no liquidity room for
buybacks.
And I mean, they will need definitely to issue debt.
Okay, so it can weigh on those businesses, even though they're not maybe highly indebted, even if they're taking on debt, maybe not highly indebted, but it weighs on them because they don't do buybacks. Is that how these two stories come together?
Yeah, absolutely. And I think it's a question of time. Same as inflation. I mean, inflation is not an issue as soon, or raising oil price, as soon as it's only a question of time and it's taking a few months to resolve, and I mean the Strait of Hormuz and so on. If we have a spike in sovereign rates for a couple of months, it won't be an issue because we're not in a deflationary situation, we're not in a recession. I mean, consumers are still consuming. So you have the other side which can compensate for higher rates for a certain period of time. But definitely, if it's higher for longer, you will have an effect at the end of the day on equity market.
Okay, and how high should we expect Treasury yields to go in this context then, Nicholas? I mean, we're at 4.6% on the US 10-year. If we get to something like 5, well, is that likely? And what kind of impact does that, maybe just a psychological level, have on the markets?
Yeah, we won't be surprised to see the 10 years at 5%. That was our central scenario, I mean, back end of last year. We were, betting on the steepening of the yield curve. Now we are seeing a more parallel shift around all the curve, and it's probably also putting pressure on Stephen Wire over the short term. But I mean, I won't be surprised to see 5%. And I mean, if we have a higher inflation and if the growth stays steady, it won't be an issue over the short term.
Would you buy at 5%?
No. Not yet. No,
so you see it going higher then?
Okay, yeah. No, I mean, we may have short-term spikes. That's not unusual to see short-term spikes. And probably we'll start looking at 5%, but we probably won't buy it at 5% depending on all the other externalities. I mean, we have a lot of uncertainty around the market. And I mean, normally market hate uncertainty. They decided to skip it out and to focus on their certainties, which are earnings growth and capex from hyperscalers But I mean, we are surrounded by uncertainty, so it's not the trigger of the 5% which will let us buy the treasuries at that stage.
What are you buying at this point? Are you looking at gold? Are you looking at tips? Are you looking at keeping cash on the sidelines? Where are you putting capital right now?
I mean, we are focusing on the reality, and the reality is that we had a tremendous earnings season. We had good guidance, and I mean, we haven't seen revised earnings due to higher inflation or higher energy price, even in Europe, not so much. So that's a reality of the market, which is having companies which are able to survive in this type of environment. And if you look at the past, having an inflation around 4%, if it's what we're looking at, is probably a good environment for equities, and it's probably the only assets which could, well perform in this steady 4% environment. So we're still overweighting equities, typically in the US and around all these capex, rather than focusing on the consumption and staple and so on. But we're still overweighting equities, but we're reasonably confident that we'll have a normalization of the performance after, 7 weeks of growth, 7 weeks of bounce back in the market. That's not unusual that we'll see a kind of re-rating, I will say.
So you're buying equities for the nominal growth hedge. You said you wouldn't buy at 5%. I just want to follow up on this point. And you said it could spike through that.
Yeah.
To where?
That won't be the only trigger.
Sure, but how high could a US 10-year go?
We'll start looking at it. Definitely endowment fund or life insurance, which have very long time horizon, they will start to buy at 5%, 5.5%.
Where would you start to buy?
What we'll start to buy when we will see the end of a steepening of the yield curve. I won't buy duration if I believe that the steepening of the yield curve will continue.
So so you think
we'll focus on the short
think
term.
It will? Yeah, by the sounds of things. 550, 6%.
Who knows? The sky is the limit, I would say. But I think 5% will be probably the starting point to look at the bond, but won't be a trigger to start buying massively treasuries, I think.
Unless we get the reopening of the Strait.
But if we get the reopening of the Straits, probably we'll have decelerating inflation and we'll have also decelerating rates. It's also a combination of all that factors. And higher interest rates, long-term interest rate, is also a reflection of higher growth. We're facing companies' growth and companies' earning growth, and which also pledge for higher yield, at the end of the day.
Okay, Nicolas, thank you very much indeed. Thanks for joining us.
My pleasure.
It's Tuesday morning. Nicolas Bichel, CIO at Edmond de Rothschild's Private Bank. Coming up, we're going to go to the G7 Finance Ministers meeting in Paris and speak exclusively to Matthias Cormann, Secretary General of the OECD. That's coming up next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in Season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch Season 2 on all these lovely channels.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Minutes to go until the start of trading here in Europe. Let's talk about where we are right now. At the moment, Europe actually looks fairly good in terms of the futures picture. We are looking at a positive story, as you can see. If the Kospi goes down, does Europe go up? Is that the trade that we're watching here at the moment? There's a little bit of that maybe in the market this morning, but we'll dig into the details as we work our way towards that opening trade, Anna.
Yeah, European stocks then disconnected perhaps from some of the tech themes in the Kospi, also maybe disconnected from the Japanese dynamics in bond markets right now. The Japanese story was higher yields, up 6 basis points at the 10-year. We're pretty flat across the European space today in terms of the 10-year horizon at least. I can see very small movement either side of the flat line on these bond markets. Yesterday, the direction of travel was lower yields, even more so in the UK. So we'll watch the gilt open, of course, at the start of the 8 o'clock hour.
Well, that global bond market sell-off has taken centre stage as Group of 7 G7 finance chiefs discuss how oil-fuelled inflation risks overshadowing the world's economic prospects. Bloomberg's chief Europe correspondent, Oliver Crook, is in Paris for the meeting. Ollie.
Yeah, that's right. There's a lot of conversations here about the impact, of course, of the Iran war, what is the effect it's having on growth and, of course, on inflation. And that is going to be one of the sort of areas of expertise for our next guest here, who is Matthias Cormann, the Secretary General of the OECD, who has one of the broadest views, I think, on the global economy. And we'll have a sort of interesting analysis of the effects so far of this war in Iran. So I'd like to just begin there with your perspective on kind of what we've seen. It's changing day to day, your assessment of the impact on growth and inflation across the world.
Well, I mean, the overall assessment is that it's putting downward pressure on growth and it's putting upward pressure on inflation. I mean, we provided an initial assessment in our interim economic outlook in March, but we will be revising that assessment in the next few weeks in a formal sense. But clearly, downward pressure on growth and upward pressure on inflation.
Yeah, and you were one of the first to revise your economic forecast after the war, and of course, everybody has sort of followed suit for that. For the new forecasts that are come out, is there going to be upside or downside risk, or you expect that inflation expectations are higher and growth lower? Is that?
Well, look, I mean, at the moment there's clearly a lot of downside risk, and in as much as the conflict in the Middle East is concerned, I mean, nobody really knows how much longer it will go for and how much worse it might get. But in the meantime, and of course, the longer it goes, the higher the risk of secondary effects. I mean, we've had a very significant energy supply shock, a very significant energy price shock. But of course, what we are interested in, what we're watching, is to what extent there is now a flow-through effect on prices more broadly, on wages, and I mean that is of course also what central banks would be looking at in setting their monetary policy.
And as you have the conversations in this room with these central bankers and these finance ministers, do you feel that the sort of greater risk is to growth or to inflation? Is it right to sort of categorize these? Because there's a big debate about acting too soon, acting too late.
Well, I mean the challenge for policymakers in terms of monetary policy now is that we have both an elevated risk of higher inflation at the same time as their downside risks in terms of the growth outlook. So clearly central bankers will look very carefully at the data. They will focus on making sure that inflation expectations remain anchored, and it's going to be important to communicate very clearly the balance of decisions. I mean, normally you would be able to see through an energy price shock, but of course, if it starts contaminating prices more broadly, if you see increases in wages as secondary effects, then central banks will need to take action, even if the economic growth outlook is somewhat weaker.
And we've seen, we heard from Christine Lagarde from the rate decision last time around, saying that the secondary effects weren't really materializing yet, but that was a couple of weeks ago. Are you starting to see the secondary effects materialize?
Well, I mean, that is what we're keeping an eye on. I mean, across advanced economies, what we see is that core inflation remains, relatively okay.
Yeah.
But of course, I mean, that's precisely what we will be looking at.
And thinking about the G7 sort of format, this is obviously a format that was originally sort of designed to deal with exactly these kinds of global shocks. We now have an administration in the United States that takes a more skeptical approach, to say the least, to sort of multilateral organizations. What do you think is capable, what is able to be achieved and sort of deployed at the G7 level to sort of dampen some of these effects?
Well, I mean, I think the G7 is an incredibly important format. I mean, having the United States as the biggest economy in the world, working together with, all of the other major economies, advanced economies, market-based democracies around the world. I mean, I think it's a very important platform for dialogue, for cooperation. In the end, working together on shared approaches, on common approaches, helps to lower costs, helps to boost certainty for business, and I mean that's good for the economy everywhere, and it's good for the economy in the United States.
And is there a sense that, because obviously the war in Iran is a very large undertaking by the United States, I think one that the United States is starting to realize they may need some more support from some of the peers in the G7. Are we getting a more conciliatory tone from the United States?
I think the tone across the G7 is always constructive. I mean, of course, at different times there are different challenges that need to be worked through, but it's always with a view of finding the best possible solutions, of course.
Well, the French finance minister yesterday accused me of depressing him, but I'm going to put a similar question to you about the sort of larger picture where we see, obviously, growth being choked out, inflation rising. We're seeing rates going to be rising across the globe, very, very likely, at a time when fiscal space is very, very stretched. And in the United States, you have a parabolic equity markets in Europe, still relatively close to all-time highs. Do you not see the potential here for a sort of disorderly shift, particularly now that it seems like the bond market is waking up to this and rates are going higher, higher, higher?
Well, we've got to remember over the last 6 years or so, there have been a succession of very significant shocks to the global economy, and the global economy has been remarkably resilient. It is true that we are now testing that resilience. But when I look at where we were at the end of 2025, coming into 2026, we were about to upgrade the growth outlook. I mean, there are different things that are happening in the economy at any one point in time. And then there are also some positive developments in the economy. And all of the investment associated with the AI transformation are very, very significant and are drivers of growth. So, I mean, of course, it would be better if there was a resolution to the Middle East conflict sooner rather than later in terms of the global economic growth outlook. Of course, that would be better. But when we look at the way the global economy has performed, it's been remarkable, the resilience that's been demonstrated.
And you mentioned AI, and that's something that obviously I think economists are taking a very close look at. Obviously productivity gains, but also the impact on the labor market. We just had a story out today about Standard Chartered saying that they're going to cut some of their corporate functions by 15% by 2030. What is the balance of sort of risk from AI in terms of the research that you've done so far?
Well, I mean, clearly the benefit, I mean, there's going to be incredible benefits for humanity. I mean, there will be a big transformation in the labor market. I mean, the labor market requirements will change, as they always do when you have significant structural transformations in the economy. But, on balance, we see it as a positive, including for the labor market.
And something that you're obviously in charge of and spent a lot of time on is digital taxes and the taxation agenda across the world. Pillar 1, we understand the United States wants that to be delayed. Is there a risk that there's going to be now fragmentation, everybody kind of going their own way on digital taxes? What update can you give us?
Well, the first point is that, global minimum tax has been an unmitigated success in terms of multilateralism. When we have an agreement, including with the United States, on the operation of global minimum taxes moving forward, which was supported by 147 countries and jurisdictions around the world. In relation to Pillar 1, the reallocation of taxing rights, it's true that that is the more challenging part of the conversation as we seek to make international tax arrangements fairer and function better in a globalized, digitalized world. But the conversation is continuing. I mean, the United States and others remain at the table. What we don't want is a return to unilateral digital services taxes. I mean, it is much better to have an agreed multilateral solution that provides fairness and that is effective for everyone.
Well, Matthias Cormann, thank you very much. That's the Secretary General of the OECD here, assessing the situation, obviously, for inflation, for growth, but of course multilateralism and that all-important sort of digital and global tax system.
Ollie, great interview. Thank you very much indeed for bringing it to us. Oliver Crook, our Europe correspondent. Let's turn our attention to what is happening in the bond market. Investors very much weighing in on the recent bond market sell-off and the challenges that it poses to central banks.
There is a risk premium being priced. If the Fed's going to restart a hiking cycle, they're not just going to hike once or twice. They're going to hike multiple times. And it's going to be on the backdrop of a stronger economy. At this point, there really isn't enough in the data to make that conclusion.
We're not there yet, but we're getting there. Kelsey Barrow, fixed income portfolio manager at JP Morgan Asset Management, talking to the team stateside. We're going to discuss more on that risk story for global central banks next. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
42 minutes past the hour, 43 minutes past the hour. Welcome back. You are watching the opening trade. European futures are positive. US futures are negative. The Nasdaq is down by around 0.3%. But let's turn our attention to what is happening on the other side of the world. Japan's economy growing much faster than expected at the start of this year. This solid expansion, one could argue, gives the BOJ maybe scope to argue that the economy is resilient enough to withstand maybe higher borrowing costs. The central bank may be looking to continue its normalization policy, maybe to accelerate that normalization policy. Bloomberg's Japan economy and government reporter Paul Jackson joining us from Tokyo. Did this data give the green light to the BOJ? Is it June or is it July?
I think that's pretty close to the mark. It creates a window of opportunity that the Bank of Japan really should grasp, I think. If it doesn't act quickly on inflation, that could start to get a bit hairy down the line. And also, we've got the yen in a very vulnerable spot, not to mention the impact on potentially on yields. I think if they do raise in June, that will perhaps help to take a bit of the edge off the super long range, which has set new record highs just today, the 30 and 40 year tenors. So I think an early move before signs of the war, like weakening the economy going ahead, which could become more apparent in the current quarter. I think you've got everything aligned optics-wise to move, as you say, in June or July. Now, I think the market has got 70% on overnight swaps, expecting a move in June. I think that's the time when they should go. Could be some upset if they don't go then. And that's really the kind of environment we're heading into, is if they don't move, it's going to really get messy and cause ructions in markets.
Paul, would that move higher then in June, as the markets are starting to price, be accompanied by a stronger fiscal impulse from the government? The Prime Minister is discussing and working through a potential additional budget. What are the details of that, and how could that impact the BOJ's decision?
Well, I mean, I think the launching of an extra budget at this point may make investors think, whoa, what's going on? This is Prime Minister Takaichi on her expansionary fiscal policy. She's out of control with the spending, getting into that kind of narrative again. But the reality is these emergency measures are taking on energy to try and limit the impact of the Middle East war and the energy prices. The figures are adding up on the subsidy prices. So these measures that they're taking are chewing up a lot of money, and they essentially have to have an extra budget to pay for it. But the way investors view the extra budget, and we still don't know the size of it, could start to play out again in the bond yields and put quite a lot of pressure on the government again. So I think really a rate hike in June is probably your best option to just try and calm markets down and show that authorities in Japan are taking the inflation situation seriously, and that they will keep on top of it going forward.
Paul, thanks very much. Bloomberg's Paul Jackson live in Tokyo for us with the Japanese story. Let's turn our attention to global markets then, with the markets in 3 minutes on the opening trade, with Markets Live Executive Editor Mark Cudmore. Mark, good morning. So we're just hearing there about the Japanese story. The role that Japanese bond markets are playing is a really interesting one right now. Looking at the US Treasury market, though, 4.6% on the 10-year. We spoke to a guest earlier on who was talking about, this likely to go to 5% in his view, and even that might not encourage him into the market. How are you thinking about the global bond conversation at this stage?
Well, first of all, in a longer-term view, I completely agree with that guest. I think ultimately yields are going a lot higher. I just think this does not happen rapidly or in a straight line. I've had that view for the last, number of years, and I think we're going into a much higher range, and that plays out over years. And the reason that is that ultimately there are a lot of people who are income collectors who will basically seize jumps in yields as a chance to just buy into long-term bonds. So the kind of transition to a higher yield environment takes place over months and if not years. But I think we do need to move into that world. In the short term, I don't think bonds are quite out of the current sell-off just yet. We've paused in the short term. I think some of the political concerns in the UK have damped down a little bit with, the comments from Andy Burnham last night about being a little bit more fiscally restrained or expressing sentiment in that regard. And also Trump, again, providing some people who I think real optimists out there that there might be a diplomatic solution to the Strait of Hormuz. So it's temporarily paused, but I think this sell-off has more to go in the short term. Then we'll get those dip buyers in bonds. But later on this year, we'll see much higher yields again.
How do stocks do if yields are going higher over the long term?
So I actually think that stocks can cope okay with higher yields if it's for the right reason. If that's because the economy is doing really well, then that's actually okay. Now, the problem is we have higher yields for some good reasons. There is a relatively resilient and strong economy, and we've got a lot of spending in the AI space, which is driving the K-shaped economy or supporting the K-shaped economy. But we also have higher yields for a lot of bad reasons. We have the supply side inflation shock, which isn't being resolved, and we have fiscal concerns. So that's an image to say that I think it's going to ebb and flow. Ultimately, higher yields are bad for stocks, but it's maybe less dramatic kind of at some binary level. I will say, though, given the move higher in yields the last couple of weeks, I actually think right now bonds are closer to the dip buying moment than stocks. We talked about this yesterday. I think we're now in a couple of weeks where stocks can retrench a bit, only in context of the extraordinary gains. This is not the end of the bubble. The dip will be bought again, but the dip won't be bought that quickly.
Mark, I was going to follow with that, with what the dip buying impulse will be, particularly when it comes to the semis and the sell-off that we've seen in the US and Asia today as well. You think that could happen, but maybe at a more moderated pace?
Yeah, I just think you've got to put it in context of two things. One is we've just seen extraordinary gains. So quite sizable headline pullbacks will still leave us like massively up on any reasonable look back window. So it's not kind of blowing up this bubblicious bull market we're seeing in this sector. We've also got just massive herding because everyone's using the same AI advice for these trades. So that's why I think it can be quite painful. It'll clean out the first initial dip buyers who then get cleaned out. So maybe this lasts a few weeks this time.
Bloomberg Markets Live Executive Editor Mark Cudmore. Mark, thank you. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLive Go on the terminal. Let's bring in Charlie Wells right now, standing by for your stocks to watch this Tuesday. Charlie.
Good morning, Tom. So look, let's start with chips because we're getting some conflicting signals here. I want to bring up yesterday's trade because this is really interesting, right? And we're getting some conflicting signals as well, right? Jitters over in Asia on tech. Let's look at yesterday's trade. We see red here, but you also see some green on that screen with Infineon. They got a price target upgrade from Morgan Stanley, so that seemed to give them a boost yesterday. Interesting, and you're going to want to pay attention to BE Semi because they also today got that price target increase. Does that give them a lift in a sort of jittery space? That is definitely one to watch. Let's take a look at an individual company, Delivery Hero. I want to bring them up because late in the day yesterday, we got news that Uber had increased its stake in the company to 25% if you include options there. So interesting because Delivery Hero this month has been on an upward journey. You see that kind of positivity coming early in the month when we got news of one of their largest shareholders selling some stakes. You also saw another bump when you got to some management changes. So does this continue? There's also this narrative coming out. Bloomberg Intelligence talking about it, about how Uber increasing its stake to 25%. That leaves optionality for a takeover. So again, do we see this positive momentum when the market starts to open with Delivery Hero? That is one to watch as well. Let's end with Standard Chartered because we have that headline out this morning. Bill Winters, the CEO, talking about how the company by 2030 could replace some 15% of support staff with AI. Now, what we know is when we hear these sorts of headlines coming from firms, the market tends to reward them. They like that efficiency story, but we're also starting to get pushback on that narrative of this claim of potential AI washing. Are these really kind of efficiencies, or is this just job cuts colored by AI? So that's the question we're going to want to have as we go into trading with Standard Chartered this morning.
Charlie, thanks very much. Charlie, with some of the stocks in focus, I'll add a couple of UK names that have caught my attention this morning. Currys, if we're keeping track of the consumer, especially with the labour market data out this morning and showing signs of a little bit of softening, but they see their full-year adjusted pre-tax profit coming in higher than had previously been expected, at least at the top end of the range. So maybe that's a positive on the UK consumer and a little broader across Europe. And Crest Nicholson, also in the UK, this a real estate business. They're delaying the publication of their half-year results because they are still trying to conclude talks with their lenders. This is a story that we know a little bit about already. So I wonder what's in the price and whether there's any further movement on this one.
The UK housing market is struggling. Yields are high. How do you get a mortgage? Can you get a mortgage with any degree of certainty? What is happening in terms of input prices into that sector, labour as well? There's so much going on. It's a really tough place to be. This is at a time when we thought we were going to get a housing boom. So investors had positioned that, and it didn't materialise.
Yeah.
Because at the end of last year, the expectation was that the Bank of England would be cutting 2 to 3 times, so that the economy would be ticking over with some level of growth, that inflation would be coming down. All those things have changed, putting that additional pressure on the housing market in the UK.
And we had that labour market data out this morning, and it was the payrolled employees number that looks weak. and that's put a bit of downward pressure on the pound, actually, going into today's session. So the payroll employees number dropping 100,000. It was supposed to be down by about 10,000.
Yeah.
So we'll get a chart in the next part of the programme, but it does show a bit of a drop downwards. And is that going to be something that limits the number of hikes we can get from the BOE?
If the US 10-year goes to 5%, where will that put gilts? We're at 4 points. Where are we now? 5%. Do we get to 5.5? Do we get to 6%? What would a 6%? I appreciate we're dealing with probably more 2-year swaps and kind of that. But what would those kinds of levels do to the UK housing market in terms of just affordability?
Yeah, and people asking questions about the US housing market with the 30 yield doing what it's doing at the moment, because that's the part of the curve that's crucial in that geography.
Yeah, how much is priced into the 10-year right now? Are we pricing in 2-3 hikes from the BOE? Does it push it higher on that? The 30-year is close to 6% anyway. It's a sniff away from that right now, 5.75. But of course, the focus remains on the 10-year.
With all that said, futures are pointing higher, partly because we don't have quite so much tech, perhaps, here. Certainly not as much as the Kospi. The Kospi is on the back foot over in Asia, but Europe is looking a little brighter. So with one guest accusing Oliver Crook of depressing him, we certainly won't be accused of that this morning. European futures pointing a little higher this morning. We'll be back with the market open. This is Bloomberg.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Tuesday morning, good morning. Couple of minutes to go until the equity trade kicks into gear here in Europe. We are looking at actually fairly positive futures here in Europe, which is interesting in light of what happened overnight out of Asia and in the United States. This was the session for the S&P yesterday. What you saw was energy doing quite well, but what you saw is information tech doing less well, and that continued into the Asian trade. Stocks like the Kospi, markets like the Kospi coming down pretty sharply, and in some ways, this favours Europe. We are the anti-Kospi trade. We don't have much tech here, so actually maybe on days like today, Tom, we benefit.
At least for today, that is the dynamic that you could point to with gains in the futures. European futures looking to build on the upside of yesterday, pointing up by 0.3%. Yesterday it was media at the top of the list in terms of your sectors, was autos under pressure. Today, look at the basic resources, look at energy, of course, Brent a little softer in the session. WTI, though, in positive territory the last time I checked. FTSE 100 futures pointed to gains of 47 points, up 0.5%. DAX futures looking to add around 74 points, up 0.3%, Anna.
Let's talk about some of the individual stocks in focus then, Tom, as we head towards the market open for this Tuesday morning. And we'll start with the banking sector. Standard Chartered is in focus. The CEO saying AI will replace, quote, lower value human capital, which sounds a bit ominous. But we'll watch that one at the start of trade to see where that takes us. There's been a briefing with media, it seems, over in Hong Kong, I think, certainly in Asia. Delivery Hero in focus as well. Uber Technologies has increased its stake in the German food delivery company Delivery Hero. They're trying to counter competition from DoorDash outside the United States. They don't want to buy as much as 30% of Delivery Hero, which would trigger a bid, of course. And Currys, we'll watch that one with the consumer in mind as they edge up their guidance for the full year. Guy.
OK, which is good. Positive news out of the UK. We're in need of that. Let's talk about what these markets are delivering this morning. Let's start the Tuesday session, get it underway. We are expecting a positive picture to emerge out of Europe this morning. Less tech maybe helps. Yesterday, energy did well in the United States. Does that feed through to what we're seeing here in Europe? The FTSE 100 can't make up its mind yet. Which direction is it going to go in? Looks like it's going to be positive. The Stoxx 600 is up 0.1%. These aren't big gains, but consider the losses that we've seen overnight out of Asia, then actually holding the ground may be a good thing. So we're expecting that to maybe persist across most of the rest of Europe. We are expecting most markets to be in just positive territory, and that's what we're seeing. Clearly nothing happening in Germany this morning. We are open. We're up by 0.3%. Most markets up 0.3%. Doesn't look exciting, but in the context of what we're seeing elsewhere, it doesn't look bad, Tom.
On the sector-by-sector basis, top of the list right now is personal care. That sector up close to 1%, followed by media. Another decent day for that sector, which was the best-performing sector yesterday, up 0.9%. On the downside, given the softness that we're seeing, particularly in silver prices today, but also gold a little weaker. Basic resources, the biggest losses coming through there on that sector, down 1.3%. Construction and materials also weaker by 0.4. Four sectors in negative territory so far, with the top gains coming through for media, at least for now, gains of more than 1%, Anna.
Yeah, it's a day where basic resources perhaps should have had a bit of a bigger mention, because that is by far and away the worst performing sector. There aren't many negative sectors, as you point out, Tom, but we're down 2% on Anglo-American, on Glencore and Antofagasta. So that's taking the edge off London, perhaps, which is kind of in the mix, isn't it? It's not really standing out today as looking very different. The CAC is up 0.1% or 2%, so is the Xetra DAX, so is the FTSE 100. So modest gains then, Guy, across these European equity markets.
Looks like, yeah, steel is an interesting area to maybe watch out for this morning. In terms of what we are watching, is it a feed across? Is today the day when actually Europe's, can I say boringness? No tech? Actually shines a little bit. And maybe this is going to be the future, because potentially there is significant volatility. We're going to see maybe some of these trades rolling off. Are we going to see people looking for that diversification trade to deliver? I don't know. Let's try and find out. OK, let's get another perspective, certainly on what's happening in the UK stock story right now. We'll get some analysis from Alexandra Jackson, Director of Equities at Rathbones Asset Management, with us on set this morning. Hi, Alexandra. Morning. Nice to see you. So I know that you have quite a lot of conviction around UK mid-caps, and it's the mid-caps area I think you focus on, and there are a number of underpinnings for that. So today looks fairly quiet, so a good day to take a step back and talk about maybe some of the reasons that you have conviction around that UK narrative.
Yeah, absolutely. I mean, the UK does look kind of messy at a headline level, at a macro level. We've got the domestic politics, we've got rates, we've got the geopolitics. But actually, when you look underneath a little bit, you can see this divergence appearing. Valuations are low. You don't need me to tell you that. Balance sheets are very strong. And actually, M&A has really picked up. We're running at double the usual level in the UK. Premiums are actually higher and average deal size is higher. So that's interesting. Someone is buying these companies.
Somebody is buying these companies. How much do you worry about the macro effect then, certainly at that mid-cap level? Because if you look at the 250, it's underperformed. The FTSE 100 hasn't it of late, and part of that is, I guess, to do with concerns around the macro story. This morning we had numbers out from the UK, and the labour market story there. The number of payrolled employees dropping by 100,000, which was a lot more than expected. We're edging higher on unemployment. Is this something that threatens to take the edge off your investment thesis?
Well, I think it's kind of double-edged. It's both the gating and the unlock for me. So rates are really important to the mid-cap trade. The FTSE 250 is very correlated to yields. And actually, that unemployment data this morning, it looks a bit softer, but it suggests maybe that companies and the companies that we talk to will get more of a steer on that later this week. But the companies maybe are choosing to lose workers rather than raise prices. So maybe that keeps a lid on inflation throughout the rest of the year. Keeps a lid on yields as well, and again, that's the unlock for this 250 trade.
And you talked about 250 being sensitive, or those mid-caps being sensitive to high yields. Yeah. What assumptions then are you making about rates going forward from the BOE?
Well, the market is forecasting a kind of 80% chance of a hike before the end of the next two meetings. So that looks pretty aggressive to us. Sarah Breeden over the weekend was saying she didn't see a need to raise rates from here. I think she was indicating they're in a wait-and-see
Do you need
mode.
rates to be on hold for that, to continue to have that conviction in UK 250?
Yeah, I think the ideal scenario is for rates to be on hold and then to start to come down, and that's where you see the mid-250 really start to move.
At the moment, you've got a gilt yield 10-year, north of 5%. You've got a yield on the 250 of, 3.5%. Why am I buying the 250?
I think you've got some really interesting companies there. So we are looking at ways to play the AI trade in the UK, for example. As you said this morning, not a lot of tech in the UK. It's one of the reasons the UK is probably underperformed, but might give some protection now. For us, industrials are where the AI names are hiding. So even just this morning, we had Diploma out with numbers today, a nice beat, talking about high teens organic growth. And they are a play on the kind of build out of physical infrastructure, physical data centers. So they provide cabling and wiring and connectors into data centers. So that's one of those examples where you can access interesting structural growth. In the mid-250, they trade on a cheaper valuation than their sort of US-listed peers.
Why do you think people are missing them?
I think they probably have been overlooked because a lot of the macro keeps people out of this market. Probably they're not single plays. They might do a couple of different things.
Do you need? Okay, so they're not pure play.
They're not pure play.
Okay, so that dilutes maybe the argument a little bit, but I'm wondering what will it take for people to notice them? And is it important? Does the investment case need people to notice them? Because if they don't notice them, then it's great, we're going to do really well, we're going to kick out a decent return, but we're not going to get that kind of stratospheric performance that the rest of the AI trade is delivering. How do we get people to notice these stocks, other than you coming here and telling us about them?
We've got a graphic to put up next, as you answer. There you go, then people will notice.
A graphic sounds great. I think part of that will be other companies coming in and buying these names. We see strategic, we see trade buyers, we see PE all over these
Right, so this is
UK
just a takeout
companies.
trade. It's not an organic, it's a people are going to buy these companies for better multiples than they're trading on at the moment.
I would say the takeout trade is is there to prove out the valuation, and then we can move forward because these businesses are generating incredible levels of organic growth. A lot of them will grow their margins. They're returning lots of cash to shareholders. They're becoming very shareholder friendly.
So we just put up a graphic. It had Renishaw and Halma, which I know are two companies that I think that you own, Alexandra. So industrial tech, is that the way that you played in the UK, to Guy's point? And what does that mean? What is it that these guys are doing? How does it feed into the data centre story?
Yeah, so you could either play the kind of physical build-out like a Diploma or something like that, a Hill & Smith, or you could play those names that provide kind of components into the semiconductor equipment manufacturing piece. So that's what Oxford Instruments and Renishaw both do broadly. You need to be able to measure the position when you're, making semiconductor chips very, very carefully at the kind of nanometer level, and Renishaw provides some technology
and
to do that.
Are these businesses seeing sort of step changes in their profits or their sales, or big pivots in their business lines to focus on this stuff, or are these sort of at the margin interesting dynamics?
A little bit of both, depending on the company that you're looking at. But certainly, when you look at the divisions of these businesses that are focused on the semi customers, you can see a step change, certainly in levels of organic growth, in the investment that companies will put behind that, because they can see the duration of this demand really proving out that revenue visibility. But yeah, they're not 100% AI trades.
As we talk about the takeout trade and maybe the role of private equity and others in terms of looking at acquisitions in the UK, on the other side of the dynamic, in terms of the IPO pipeline, how closely do you monitor that? Is that pipeline, how healthy is that looking? Are we going to get more tech names from that currently in the private sector? We have some strong tech, but in the public world, less so.
Yeah, we do have some strong tech in the private world. We have recently had meetings with, I would say, 7 or 8 UK private companies, most of them tech or tech adjacent, that are thinking about listing. They won't give me a timeline, but
in the UK.
In the UK, yeah, mainly in the kind of mid-cap space, not huge companies for sure. But that gives me a huge amount of confidence that we can, at some point, when that IPO market does sort of unlock, and we need a bit more confidence, we need that market to unlock for these companies to really want to come to market and get the right valuation. But they're very keen.
That's interesting, because in the States, well, in lots of parts of the world, they tend to skip the mid-cap phase, just list as giants. It seems that's the more recent trend.
Yeah, well, that will be a good differentiator, I think, for the UK.
Right, yeah, so some mid-cap tech names to play for.
If we get a change in government, how do the macro story is ever present in the UK? How does that put investors off? When you talk to international investors, how do they feel about the UK right now? Do they look at the politics and go, do you know what, I'll put that one to one side for now? How does what is happening domestically here change the international investors' perception? How is it changing the international perception?
Yeah, I think it's fair that global investors have been able to ignore the UK in recent years. What we see now is actually a bit more interest coming from my clients, coming from other global investors. Yeah. And when I go to conferences and things, I can see that there are more global investors there who are looking at interesting UK businesses, particularly those kind of global growth stories. We see the UK as kind of a hunting ground for global growth names that are mispriced just because of where they list.
But this is individual names. This isn't a wholesale, we're interested in the UK. There's some underpriced assets here that we think we can take advantage of.
I think that's probably mainly right. This isn't a market that you want necessarily passive level exposure
to. You don't know an index. This isn't an index market.
For me, I would prefer to be much more selective.
OK, really nice to see you. Thank you very much indeed for stopping by. Alexandra Jackson, Director of Equities at Rathbones Asset Management. Call 6 looks a little bit like this right now. Let me just give you an idea of what is going on in terms of the main names that we watch. Tech is under a little bit of pressure. You can see that in ASML and Schneider. You are also looking at a fairly decent bid actually coming back into Nestle. That was a story yesterday, maybe we saw coming out of the States as well. Some of the more consumer-facing stocks doing a little bit better. But let's get more detail on what is happening here. Charlie Wells is starting with Anna's stock of the morning. Currys.
Yes, I am, Guy. It's an interesting start, an optimistic start, I would say, for Currys. They raised their forward guidance, and basically the market is liking what it's seeing here. This really seems to speak to the consumer, right, of strength. Of Currys basically saying they're really not impacted, at least so far, by some of the uncertainty that we've been seeing across the globe. Consumers continuing to buy these electronic devices, so the market liking that, giving an optimistic tone that we haven't seen across the board, really. Let's flip and stay on a similar story with Doc Martens, right? That shoe company. They're up over 7% this morning. And again, they met expectations. And this really kind of brings to bear that tone on the consumer, given a lot of the uncertainty, given a lot of the negativity that we've seen, still holding up. So the market liking what it's seeing there. Different story with Vallourec. Let's bring this up. This is that French tube-making company. They are down almost 8% this morning. ArcelorMittal sold about 10% of outstanding share capital. The market really really not liking that, despite the fact that ArcelorMittal said that really they continue to believe in, the strategy of this company, but a lot of negativity around there. Let's end this morning with Eichstron. That is one of the main European semiconductor companies. They're up just over 1.5% this morning. They reported some strong orders. So this is really going to be in focus, these semiconductor companies, because we're seeing jitters in Asia. This is some green on the screen here. We'd seen earlier, some red for a number of these other semiconductor companies across Asia. So how does it kind of spill out here in Europe? We're seeing positivity from these orders in Eichstron, and of course, a lot of focus on semis given those NVIDIA earnings tomorrow.
Charlie Wells, thank you very much indeed on some of the stocks on the move this Tuesday. Coming up, global memory stocks, as we've been talking about, taking a hit after comments from the Seagate CEO, sparks fears about the industry keeping up with demand. That is next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest. And this is Bloomberg.
Earnings season is here.
Certainly valuations have shifted quite significantly.
Maybe a bit of optimism.
Bloomberg is first to break the numbers.
We're talking about a move away from U.S. assets. So much corporate issuance.
Let's get the reaction and context.
With the smartest insights.
We're observing what's happening in the Middle East. The situation is volatile.
We're closely monitoring the impacts on supply chain and logistics.
Cross-border M&A, still such a difficult thing to get done in Europe.
Continuing coverage on Bloomberg.
The Chinese government has to decide how much of their local market do they want to protect, and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
That, of course, was NVIDIA CEO Jensen Huang speaking exclusively to Bloomberg's Ed Ludlow. Asian memory stocks, meanwhile, lower in today's trade, tracking losses from US peers after Seagate, the CEO, said building new factories would, quote, take too long, sparking fears it won't be able to keep up with soaring chip demand. Neil Campling, our senior market strategist, joins us now. So the blistering rally then in semiconductor stocks. It was interesting to see that software stocks actually performed quite well in the US session yesterday. Semis under pressure. Is this a blip? Does buy the dip come back in to rescue the chip makers? Or does it point to over-exuberance in terms of the capital that's been piled in to the chip stocks, both in Asia and the US?
A great question. I think as far as whether it's a buy the dip or not, perhaps we'll rely on what Jensen says tomorrow night when NVIDIA report numbers.
Yeah.
In terms of exuberance, you could just look at some of the products that are created in the markets around some of these semiconductors. For example, there is a XXX levered semiconductor ETF. It went from the end of March until the end of last week up 350%. And it's down.
So Guy Johnson put his entire pension into.
Guy put his entire net wealth into this product, and he obviously got out at the end of last week before it fell 25%.
It's amazing, isn't it?
So, well done, Guy. I mean, I'm not sure why you're still sitting here. You should be a trader, clearly working at one of the big investment banks.
Yeah, it's my moonlighting job.
Well, I mean, I'm a man of many talents, but we've discussed before that some of the money that's flowing into this. We've got fund manager surveys, which we'll be bringing out some detailed analysis on in the next couple of hours. But again, it shows there's a massive drive in terms of asset allocation into semis, into AI, into the chip sector. Yeah. So on an institutional basis, it's very difficult to see where incremental money comes into. In the meantime, retail investors have been borrowing money to buy into a leveraged product. So momentum works both ways.
Double leverage. That would be
triple.
Yeah, no, but that's 3 times plus a bit of leverage on top. Yeah.
Plus the original investment vehicle it's invested into. Yeah. So it's momentum works both ways. It's great on the way up, and it can also hurt. You
can see it in factors. If you go to FTW on the Bloomberg, you can see factors to watch. And you look at kind of momentum has been at the top of that board for a long time. Last few days, not so much.
Absolutely. Last 2 days, last 2 sessions, and where are in the US? What sectors are performing well? Energy for obvious reasons, but also catch up from things like utilities, which is and some very defensive areas of pockets of the market. So it's going to be interesting to see how things play out in the next couple of sessions, whether it's by the dip, as Tom mentioned, or whether it's more of the same in terms of a further sell-off.
Neil, I wonder what you thought of the comments by the Seagate CEO. We were discussing at the top of the programme. Should this have been positive or negative for those in that memory sector, the memory chip makers? Because the CEO says new factories would take too long. Does that give you comfort? He's not going to spend too much money and the bottom line is going to be damaged by that. Or does it make you think he's going to miss out? But that doesn't make sense because the whole sector sold off. So who's he missing out to? What explained the negativity around those comments, do you think?
The negativity, I think, is perhaps because of this momentum factor. As far as profitability is concerned, what he's doing is maximising profits for his company because he knows that this is a highly cyclical industry. It has been always. And even when you have the AI impetus, it's likely to remain a cyclical industry. So you maximise the profitability because, as he was saying, regarding building out new capacity, it takes between 3 and 5 years to build a new plant.
Is he saying that the time? Basically, he's saying in 3 to 5 years' time, I think this is going to be. Maybe this will be.
You could read into that. You could read into the return on an 8-figure investment into a new facility. You won't get those returns in 5 years because the chips won't be commanding. We've seen some chip prices go up by 600% in 6 months. You can't sustain that for the next 5 years. So why would he look to be building out now in that increasing capacity? Because we've seen before the margins in these parts of the market, when they are supernormally high, can also go to depressed levels. There are some memory companies, don't forget, that in previous cycle downturns get to negative margins So we are at extremes on the other sense at the moment.
Yes, they may have some memory of that. Terrible joke. Meanwhile, Blackstone. It's awful, isn't it?
I'll be the trader, he'll be the comedian.
That even made Neil cringe. Meanwhile, Google and Blackstone, though, if they have that 3 to 4 year horizon, I mean, they're looking to spend pretty heavily with some leverage, 25 billion with leverage on data centres that will need to be filled with those chips.
So the announcement on our overnight, if we look at the capacity increase that they talked about, it's actually year-to-date deals that have been announced amount to 100 gigawatts of capacity being added over the next 15 years in data centre gigawatt capacity alone. To give that some context, that is the entire output of Germany today, as far as installed capacity is concerned. And what they announced last night is less than 1% of data centre capacity that's been announced of new capacity year to date. So it's a tiny piece of the ocean of a massive build-out spend. Yeah. And obviously, as you mentioned, the memory cycles are very short-dated. The capacity built out for electricity, for power, for AI data centres, unless something happens from left field, then this is a 15-year kind of time horizon that we're talking about here.
OK. Neil, thank you very much. Always something to talk to you about every morning. Yeah. Neil Campling with thoughts on the tech beat this morning. Let's pivot to the banking sector. Standard Chartered CEO Bill Winters delivering a blunt message on the future of the bank's workforce, warning that a push into artificial intelligence will eliminate thousands of roles as the lender replaces what he calls lower value human capital with technology.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
Bill Winters there. Tom Metcalf, our managing editor of EMEA Finance, joins us now. Talk to us about these comments from the CEO. Tom, lower value human capital. Ooh. That sounds pretty bruising.
Don't we call those people?
Somebody.
I think some people, bankers don't call them people. But,
sorry.
It's lower value human capital. No, I do think those comments, he'll probably look back and think he could have maybe phrased them a bit better. I suspect that's probably going to be a lot of people's takeaway when they read the story is, wow, what a way of phrasing it. But obviously this speaks to, this huge trend going across banking. And I think it's, you've seen it with HSBC. We understand they're looking at, 20,000 jobs. For Standard Chartered, this would be about, in the order of about 8,000. Largely support staff. But, that is the interesting thing. It's kind of really looking to replace a lot of these jobs that are done by humans, obviously with the technology of AI.
OK, people have got an interesting future in this sector. Just in terms of kind of what we're seeing across the industry, how does this tally?
I think 10-15% is sort of what executives are kind of thinking about. That seems to be the baseline in terms of where they're looking to get efficiencies. I think there is a distinction between like the total number of jobs in finance, which may well actually increase, at least in the short term, just because you need different types of expertise. But certainly some kinds of jobs, data entry, anything more routine mechanical, you're going to see that become a much smaller part of the finance workforce.
Do we have any more clarity in terms of the investments that these banking executives are putting into AI? I mean, do we just assume that they're going to be investing more through 2026 into 2027? How much commitment is there? How much ability is there from their boards to back that kind of investment?
Yeah, I think that's exactly the right time frame for, where you'll see that capex increase and you're probably not going to see anything on the bottom line. But no, I think every bank you talk to, AI is, right at the top of their agenda. And I think just institutionally, they're all pushing for this. What's interesting is we're hearing, on the regulatory side, there's obviously plenty of concern and, perhaps the sense that maybe the industry is getting ahead of itself, right? Like the technology, is it really there that they can, remove these jobs, remove that human element?
And are we all paying the proper cost of AI when it comes to what is going on here? Look at these companies that are losing money on that story. Tom, thank you very much indeed. What are we going to do next? The EU economy chief, Valdis Dombrovskis, is telling reporters at the G7 conference in Paris it's not time to ease up pressure on Russia. We'll talk about that next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Happy Tuesday. This is the opening trade. We're 30 minutes into today's session and you are seeing green on the screen. So a little bit of optimism coming through for European equities, building on the gains of yesterday as well, of course. Up 0.5% on the index, the main index, the Stocks 50, of course. When it comes to the UK, with all the political risk that we continue to factor in, the FTSE 100, despite that, is pushing hard by 0.5%. Some mixed data when it comes to the job story in the UK. The DAX is up strongly, outperforming so far across these indexes, up 0.8%. And this is a point that Guy's been making, is Europe today at least benefiting from the anti-AI trade. Guy.
On that front, I have good news and I have bad news. So let's start with the good news. 4-to-1, basically the ratio in terms of stock gainers versus losers. So the market is reasonably broad in terms of what we are seeing. The bad news is that actually volumes are a little light today, which maybe tells you there's less conviction in this narrative than maybe we would hope for. Let's talk about some winners and losers. Anna's been talking about Currys all morning. Let's get back in and see exactly how it is doing. It's up by 6.8, doing very nicely. Evolution confirming a buyback out of the Nordics, up 11%. SAP, to Tom's point, the software stocks bouncing back. SAP out of Germany, up by 4%. So there's some good news in this market. Downside, let's talk about where we are seeing some of that this morning. We are seeing ACS, I think it's making an offering. That stock is down on the back of that. Infineon had a good day yesterday. It is down by 2.14%. Chip stocks generally have been a little bit lower around the world, and that is a story you need to fold in there. Glencore's also giving back a little bit of ground. 2.3, that sector under a little bit of pressure this morning, Anna.
Guy, let's get an update on some of the other news flow this morning. The Financial Times is reporting that China's Xi Jinping told Donald Trump that Russian President Vladimir Putin might end up regretting his invasion of Ukraine. According to sources, the comments to Trump came during the summit in Beijing last week. The US is stepping up its response to the Ebola outbreak after a missionary tested positive for the virus in the Democratic Republic of Congo. Washington has now imposed new travel restrictions, and the CDC is expanding its emergency response as concerns grow over the spread of a rare strain of the disease. And European Union officials are meeting today in an effort to finalise legislation for the bloc's trade deal with the United States. Failure to reach an agreement risks missing President Donald Trump's July 4th deadline and could trigger a fresh round of tariff escalation. Tom.
Meanwhile, G7 finance chiefs are meeting in Paris today. OECD Secretary General Matthias Cormann speaking to Bloomberg on the sidelines of the event, saying risks to the global economy have worsened as the conflict in the Middle East drags on.
Normally you would be able to see through an energy price shock, but of course, if it starts contaminating prices more broadly, if you see increases in wages as secondary effects, then central banks will need to take action, even if the economic growth outlook is somewhat weaker. Across advanced economies, what we see is that core inflation remains, relatively okay. But of course, that's precisely what we will be looking at.
Well, let's bring in Bloomberg chief Europe economist, correspondent, I should say, and part-time economist as well, Oliver Crook, standing by. Ollie, so you've been talking to leaders there, and notably, of course, the head of the OECD. Interesting talking about the second and third round effects of the impacts of the closure of the Straits of Hormuz. What are you hearing broadly about the concerns, the inflationary aspects and the inflationary concerns emanating from and around what is happening in Iran?
For the officials we're hearing from here, really it's a question of not panicking people, sort of impressing the severity of the crisis, while at the same time saying some things so far, so good. That's what we heard from the French finance minister yesterday when we were speaking yesterday morning. We hear it from Matthias Cormann that they're not quite seeing yet that contagion within the inflation complex back from the headline into the rest of the inflation complex. And that is, of course, the big question for everybody, Tom, is where inflation is going to go. It's not just the quantity of inflation, not just the headline rate, but the quality of inflation. Whether it goes into services, whether it goes into wages, food, all the other parts of the inflation complex. And that is really going to be the red alarm for the European central bank governors, many of whom are in attendance here and have been deliberating with the finance ministers to give their sort of appraisal. We should say, though, it is interesting what Matthias Cormann was saying there, that basically, there is a certain point here where the European Central Bank is going to have to face this issue of trading growth for inflation. Which of the two are they going to sort of put the fire out on? And he's saying that effectively you might have to raise rates despite the fact that we're seeing that growth weakening. And that's really going to be the center of the discussion we have a little bit later with two of the governing ECB council members, the Banque de France governor and the president of the Deutsche Bundesbank, who we'll be speaking to a little bit later, to give us a sort of breakdown. What is their read on this inflation? Is it going to remain segregated? And as a consequence, what is the rate path going to be?
Really looking forward to that conversation a little bit later, Ollie. Just give me a status update on the US-EU trade deal.
Yeah, so this is, as we've been talking about for about a year now, and that is, of course, the big frustration for the Trump administration, is that basically you had a handshake deal at Turnberry between Ursula von der Leyen and the United States, and the EU has not ratified the deal. We don't have to go through all the reasons why that is. Of course, it was the Greenland threat. There was the Supreme Court striking it down. But effectively, the Trump administration has now lost patience with the EU, and the fact that this trade deal is not in power yet, is not in force yet. There are deliberations today happening among the European officials and leaders trying to get the legislation sort of finalized. The deadline that the Trump administration has set is July the 4th, the 250th anniversary of the United States, to get this legislation going. And really the discussions today in Brussels among these leaders and among these policymakers is to see if we can get there in time to really make the progress that's required. The EU has added a few more clauses into the deal. The U.S. was not too happy about it, but it seems that they have sort of accepted it. And the question is, can the Europeans move quite fast enough? And that's an answer we'll have a little bit later today to see if they can nail that July 4th deadline.
Absolutely. We'll keep a firm eye on what is happening there. And as you say, Ollie, looking forward to the conversation a little bit later on. We've got an exclusive sit-down with the heads of the central bank from France and from Germany. That is a conversation you do not want to miss.
So they'll certainly be reflecting on higher energy prices. Coming up on the programme, with the global economy wrestling with those higher oil and other energy prices, we will talk to the CEO of Portugal's EDP, one of Europe's largest renewable companies. That's next. This is Bloomberg.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back. You're watching the opening trade. We are 40 minutes into the equity market session, and thus far it looks fairly good for Europe. We are looking at a picture that is, as you can see, largely green across the screen. You are seeing a bunch of single stocks actually doing fairly well, but there is this kind of anti-AI narrative that maybe is in the trade this morning. Cosby didn't have a good night overnight, and maybe people therefore look towards Europe. That said, some of the software stocks are having a fairly good day today, so maybe that trade coming back into the picture, Tom.
And of course, at the macro level, the global economy, of course, and global companies are still wrestling with higher energy prices. Right now, Brent is actually a little softer, down 1.4% at 110, still $110 a barrel. So the spotlight has shifted, at least to some extent, during this conflict and during what's been happening around the Straits of Hormuz, to what is happening in the renewable space as we look for additional sources of energy. For more on this conversation, let's bring in Miguel Stilwell D'Andrade, CEO of Portugal's EDP, one of Europe's largest renewable companies. The stock is up about 35% in the last 12 months. Miguel, thank you for joining us.
Thank you.
Around the desk this Tuesday. How has that conflict impacted your business and demand for your energy?
So clearly the impact, of the war in Iran has been very felt on oil and gas in particular. I think in relation to power, what we've seen in some markets, that has obviously had a slight increase in the power prices, but still very, very different from what was the situation back, for example, in the Ukraine crisis back in 2022. So it's order of magnitude different. The TTF now is at around 50 euros per megawatt hour. It used to be sort of 200 plus a couple of years ago. So yes, it's having an impact, but not as much. I just highlight, though, that in markets like, for example, our core markets like Iberia, it's actually having almost no impact. And why? Because we have a lot of renewables. So a lot of wind, a lot of solar batteries. So actually gas is not setting the price, or it's only setting the price for 15% of the hours, which means we actually have not felt the impact, for example, in Portugal and Spain.
Are you hearing more from governments and others about the demand to build more renewable capacity? You've talked about how much there is in Iberia right now. Is there more? Does it change your strategic capex plans? Do you plan to invest more? Are you seeing more of an impulse?
Yes, I think, this is recognized by the President of the European Commission, Ursula von der Leyen, by the Commissioner of Energy, Dan Jurgensen. It's very clear they want Europe to be more energy independent. That means using our own internal resources, whether it's hydro, wind, or solar. So there's a renewed push to be more energy independent.
Fast-tracking licenses?
Fast-tracking licenses, investment in networks, investment in conventional generation. So really trying to push. The only thing I'd say, it's a little bit frustrating because it feels a little bit déjà vu versus 2022. And a lot of the recommendations that came out of 2022 still have not been implemented. And now they're giving an additional push. But it's like we should already have done that.
What are the things that should have happened that didn't?
Well, things like accelerated licensing times, one-stop shops, sort of specific areas where you already have pre-authorization for permitting. So there are some lessons and sort of recommendations that have still not been implemented in many of the member states, going all the way back to 2022. So I think that's been one of the big pushes we've been pushing for.
Meanwhile, the solar build-out in Europe has been quite impressive, and to such an extent that it seems other parts of the infrastructure, Miguel, can't necessarily cope. I was reading colleagues reporting about Spain leading the way in Europe's surge of negative power prices, as there's too much solar power for the grid to cope, for storage to cope. How is that impacting on your business? What can be done to stop that kind of wasted opportunity?
Yeah. So obviously investment in batteries, I think that's one of the key issues. And so what we've been also advocating is to have more capacity payments and sort of making sure that you can actually build out of batteries. If you look at, for example, Iberia, it's got one of the highest penetration of renewables, but one of the lowest penetration of batteries. And so clearly you need to do more on that front. More investment on networks, so you don't have that curtailment. Sometimes you've got negative prices in some areas, but not in others. And so if you can get that energy to flow, that will also make a big difference.
And this is all your job to do in Portugal? Is this your job and other people's job in Spain? I mean, where's the bottleneck?
So there's a lot on the regulatory side, on the legislative side. I would just add one additional point, which is what we are beginning to see is a lot more demand also coming. And so I think over time, this will be like these cycles. You're having cheap energy now. You're seeing a lot of demand coming in, for example, from data centers and industry that is taking advantage of that. The power prices in Iberia are 20% below the European average. And so as that demand comes in, you'll sort of see that convergence also of supply and demand.
So are you an AI stock? Should I think about AI, you as being an AI stock?
So the AI is clear our largest customers. Amazon is our largest customer globally, Microsoft number 2. So all of these guys are the ones that are buying big amounts of power
So
from us.
corporate power purchase agreements, how big a part of your business going forward is that going to be?
So it's a huge part of our renewable business. 60% of our power of the projects that we are sort of building and selling are having these corporate power purchase agreements. And the remaining 40 is to utilities that are themselves then having sort of this increase in demand from data centers.
So the extra demand is coming from AI?
It's a huge amount of it. It's not the only thing. For example, in Iberia, you're also having increasing population, electrification, heat pumps, electrical vehicles. So all of that is driving demand. Portugal's had one of the highest demand growths in Europe over the last couple of years.
There was obviously the issue of the blackout.
Yep.
I'm assuming that when you sign these contracts, you are guaranteeing that there's enough. The flywheel effect in the system to keep you at 50 hertz is there. That you can can you guarantee that now?
Well, when you sign these contracts, you're signing it's pay as produced. So as long as you're producing, if there was some sort of.
But are we past that?
I think we're past that. I mean, that was clearly a very exceptional issue that happened in Spain. It was a over sort of voltage charge. But I think people are managing the network in a much more prudent way now, and so I think the risk is obviously much reduced.
Okay.
Just another on the data center demand. Where do you see that demand growth? How do you see that demand growth evolving in the years ahead? Are we getting close to peak demand? Where are we in that story, in that journey? And does the infrastructure, does the grid have capacity to meet that demand?
So in the U.S., undoubtedly, this is one of the best times. You know, we've been investing in the U.S. now for 20 years, and this is one of the best times to be investing there. I mean, we're seeing huge amount of demand driven by, as I say, these big tech just taking sort of all of our projects. In Europe, in particular in the markets like Iberia, Portugal, you're seeing a huge amount of demand also coming online. I normally mention one of these data points, but just one of the data centers that's being built south of Lisbon is going to represent 20% of Portugal's consumption. And so there are many others.
20%?
20%.
One data center?
One data center. And there's several others that have requested connections. So we're talking about structurally huge amount of demand.
Can the region build all the data centers that are being that it could build at the moment? Are you turning business away because they cannot be built and connected to the grid?
The way we've positioned it, we want to be part of the solution. So investing in the networks, investing in the generation to make sure that we can incorporate all of that demand. But there is a huge amount of demand that wants to connect.
Is there pushback? Are you facing pushback? I mean, we've seen Portugal's government announce plans for a windfall tax on energy companies. Maybe that's not just oil and gas. Maybe that's renewables as well. And are you seeing pushback from communities affected by data centers? We've seen a bit of that in the US.
Yeah. On the windfall tax, we don't believe it's directed at the power sector. As I say, the power prices are well below the European average, and so I think it's more tailored to the oil and gas sector. In terms of pushback from the communities, I think that's one of the points. We need to make sure that we are bringing the communities along with us, that they see job creation, that they see, cheap power prices.
Is there job creation? Because a lot of the AI story we've been covering this morning is about jobs going away. So that would be a positive.
I think if you think about it sort of in the, at least where those are located, you're going to have a lot of construction jobs. You're going to have, obviously, people working in the data centers. I think one of the Portuguese government's focus, and rightly so, has been it can't just be about building the warehouse for the data centers. Like, they have to bring additional value added to the local communities, whether it's in terms of high tech or, R&D centers. It has to add something to the local community.
Okay. Thanks very much, Miguel. Really good to see you. Thanks
Thank
for stopping by. Miguel Stilwell Andrade, the CEO of EDP. We've been talking there about oil prices, and earlier oil prices fell after President Trump said he'd called off a strike on Iran that apparently had been planned for today, following appeal from Gulf allies. For more, we're joined now by our Middle East energy reporter, Anthony De Paula. Good morning to you, Anthony. So how are oil traders viewing these comments from President Trump? We saw oil prices retreat, then they kind of came back to the flat line. I see they're retreating once again. It's been a volatile 24 hours.
Yeah, good morning. Of course, when there's comments like this, when Trump says he's averted an attack, that is going to cool off the oil prices as some of that risk, that immediate risk, goes out of the market. Of course, we're still around $110 a barrel, which is not the highs that we had earlier in the conflict, but it's not really low either. So there is some of that threat still in there. The main point is that we still have Hormuz shut. And so that's what's supporting the market, that we don't have the flows that we need of oil getting out of the market. Obviously, good news in the immediate that these attacks were diverted, but we have a long way to go in terms of the diplomacy around that. The sticking point at the moment is the opening of the Strait of Hormuz. Iran wants the U.S. to take its blockade off of the spot where it has it south of Hormuz. So they want to take that blockade off. The U.S. wants, for its part, to get Iran to open it up, have a free flow of crude and products out of the region, in order for the parties then to talk about what they might talk about in a future set of negotiations around the nuclear. So there's a lot of heavy lifting to do there before they do get Hormuz open again, and I think that's one of the things that the market is watching. If they can't reach an agreement around that, then does the U.S. return to the military threat? There are still a lot of military assets in the region. We did see over the weekend the USS Ford has returned to base in the U.S. in Virginia, but we've still got lots of assets, aircraft carriers, Marines in the region. So if Trump wants to act, he might see that as a tool, and as a tool that can't stay in the Gulf forever. So that's going to keep some of that support under oil prices, even though we do see that easing with those comments that Trump made earlier today, Anna.
And Anthony, in the meantime, the US has extended these sanction waivers for Russian oil. How much of a gift is that to Putin?
Yeah, well, that's certainly helpful to Putin. It is going to increase the income, and we are at the income where these prices are very high. The Secretary of Treasury, the last time that the U.S. eased those sanctions, tried to make the argument that by releasing those barrels into the market, by allowing them to be freely traded, that would bring the overall price down so that the Russians wouldn't be getting a higher price and a higher premium because prices in the market would be even more elevated than they were. So that's a little bit of a difficult argument to kind of get your head around. The point is that we are at $110 a barrel, and Russia will be able to sell those barrels for an extended period of time. That's probably going to be helping a big customer like India, which had been using a lot of Russian oil. They didn't really make much of an uptake of the Iranian oil when sanctions on those barrels were lifted, but they have been using the Russian, so they're used to that. They would be happy to get back in that. So that's going to help one of those big producers like India, which has really been suffering as well because of the cut off of Hormuz and the stop of the flow of crude and other products coming out of the Gulf, Tom.
Okay, Anthony De Paola, thank you very much indeed for that update. Here's what else we are going to be watching throughout the day. 9:10 UK time. So coming up, the Bank of England's Sarah Breeden will be speaking at City Week as traders price in more than 2 hikes from the BOE this year. G7 finance ministers, meanwhile, continue to meet in Paris. We're on the ground for you there. And Russia's president, Vladimir Putin, is travelling to Beijing. And after market, we're going to get Euronext earnings results, plus in the US, numbers out of Home Depot.
So European stocks this morning outperforming. Will it last? Let me ask that question to Adam Linton, sitting next to me. You're not convinced?
No, not massively convinced. I mean, if you look at kind of the broad equity setup that we're seeing today, we're seeing a bit of froth taken out of the markets in certain areas. You look at the Kospi, you look at the TAIEX and this broader kind of AI theme with, you know, these higher yields acting as kind of a bit of a catalyst. But there's no real kind of massive AI negative catalyst that we're seeing at the moment. I think, you know, Mark made the point, we may get this AI earnings rug pull at some point, but we're not really kind of there at the moment. So, you know, I've spoke about, you know, the lack of tech sector in Europe hamstring its performance relative to Asia, relative to the US. So today things look, you know, relatively better on a short-term basis. But, you know, the thing is relative and short-term. Ultimately, you know, what is the backdrop for Europe at the moment? ECB going to be tightening into a growth slowdown. And if you look at the pockets of, you know, strength which drew European equity performance last year, it was financials. Well, performance is flatlined. Yes, you could be in a higher rate environment, but lower, you know, credit quality, economic slowdown, and then industrials as well. They're burdened with the prospect of higher energy costs and supply chain disruptions.
I want to ask you about bond markets, Adam, and what's happening there. Because, of course, we tie this all back to Iran because they're an inability to get the energy that the world needs out of the Strait of Hormuz. But today, oil prices are weaker. But we have quite a disparate picture coming through on bond markets today, as if we're sort of pausing for breath after the sell-off that we've seen. JGB's telling us one story with higher yields. The European story is different with lower yields. And in the midst of that, the US yields are sort of edging a little higher. I mean, where are we in this story?
Yeah, I mean, big picture, obviously, it's all about Iran, right? And we saw, you know, that kind of bit of reprieve from that Trump not, you know, escalating things yesterday. But for me, that's kind of a bit of a non-development. We weren't really bracing for it, so the fact it doesn't happen isn't, you know, a massive source of relief. The key story is we saw negotiations yesterday completely at a deadlock. The US is rejecting, you know, the overtures from Iran. The US isn't giving them any relief on oil. Meanwhile, the Strait of Hormuz remains blocked. And, you know, I've got Brent at 110. Risks still remain to the upside, in my view. And then, you know, the US rates space that's playing a bit of a catch-up. We've talked about this inflation angst is creeping in. But I think in terms of, you know, what to look out for the bond market, I think the most interesting thing I've seen in the last 24 hours is the RBA. You know, so they were, you know, quick out the gates when it came to tightening policy in the wake of the crisis. You know, they've hiked policy, I think, it was like 3 times this year, and yet they're still concerned about inflation and expectations being de-anchored. So if, you know, they're, you know, the first out the gate, they're ahead of the curve and they're still concerned, then for those that are quote unquote behind the curve, that's a real source of concern, and that can make its way felt throughout, you know, the back end of the yield curve, which, you know, there's some idiosyncratic risk in Japan, in the UK, and I think that's what we should be watching out for now.
Okay. MLive's strategist, Adam Linton. Adam, thank you very much indeed on what to focus in on today. Tomorrow, of course, we have NVIDIA earnings as well, so that could prove to be a catalyst. Maybe that revives the semiconductor
Recent history suggests that it won't. Recent
because
history
expectations are so stretched.
It's early days, a tough day for NVIDIA, weirdly. You would have thought it would be amazing.
It doesn't tell you the story, does it, necessarily?
Precisely.
The way the share price reacts isn't necessarily where it ends up days later. I mean, we've already heard from Jensen Huang this week, haven't we?
Multiple times.
US futures have turned around moderately.
Yeah.
S&P
well,
is up a tenth of percent.
Weren't they?
So there's a bit of a turnaround there with European markets up. Currently 0.9%. A decent day for European stocks. That's it for the opening trade. The Pulse is up next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And
I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
President Trump says he called off a strike on Iran planned for today after an appeal by the leaders of Persian Gulf allies who called for more time to pursue a diplomatic resolution. The head of the OECD tells us the global economy is at risk of further deterioration over the Middle East conflict. We're live in Paris for the meeting of G7 finance ministers. Plus, Standard Chartered plans to eliminate thousands of support roles over the next 4 years, joining the ranks of global lenders using AI to trim headcounts. Now, this hour, we'll hear from some of the top names in banking and finance. This hour, including the chief executive of Moelis. We'll talk about deal making and market volatility. We'll talk to the EQT chief executive on winning the mandate for a new €5 billion tech fund, also on behalf of the European Union. Plus, we have the co-chief executives of Goldman Sachs International. Again, a good conversation coming up in about half an hour on market volatility and their plans for expansion in Europe. But first thing is first, let's check on the markets. U.S. stock futures holding pretty steady after a two-day pullback, while oil falling modestly. I guess traders still waiting for signs of progress towards this peace deal in the Middle East. We had a rally in stocks fueled by the build-out of AI, which seems to be cooling off after powering global equities to record highs in the face of higher bond yields and elevated crude prices. Dollar resuming its climb. And then if you look at the European markets, look, they're kind of following what Asia has been doing, following on from the U.S. has been doing. We're seeing a little bit of gains across the board, nothing huge, but you can see, for example, the DAX gaining 1.2%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump says he's called off strikes on Iran scheduled for later today after Gulf allies asked for more time to seek a diplomatic breakthrough. Now, Trump says the U.S. remains prepared to attack if an acceptable deal is not reached,
but did not give a deadline. Now, the Iran war, of course, continues to drive inflationary pressure and market volatility. Global investment bank Moelis has also been a key player in the region with a history of advising Gulf transactions, including the Aramco IPO. Now, beyond the Middle East, Moelis is expanding in Europe against a wider industry backdrop of consolidation by boutique banks. Well, I'm delighted to be joined by Navid Mahmoudzadegan, the company's co-founder, stepping into the chief executive role in October, replacing Ken Moelis. And he joins us now. Navid, so great to speak to you. Thanks
great to be here. Thanks for having
being
me
with us here in London. Look, there's a lot going on in the Middle East.
Yep.
What does that mean for deal making in general? Are people nervous? Are they holding back? Or do you expect it to pick up?
Well, so we have about 50 people in the Middle East, and I'm really happy to say they're doing well and safe and sound, given all the turmoil over the last few months. And what we're starting to see is really a return to normal, if you can believe that. Even though not all of the conflict has been resolved yet, life in the Middle East, life with our deal makers is getting back to normal. They're doing meetings, they're traveling, and there's a real resilience in that part of the world to try to get back to normalcy as quickly as possible. So I'm optimistic about deal making in the region.
So what are your clients saying in terms of the impact of the war?
Well, I think there's a real opportunity when we get on the other side of this to have a new Middle East and to have these incredible countries that are doing incredible development and building great companies. I think there's an amazing opportunity for the importance of that region and the countries in that region to be enhanced. We, as I said, have a major presence there, and we're big believers in the future of the Middle East.
Yeah, I mean, you have especially a big presence in Saudi Arabia.
Yeah.
When you look at the sectors, is it oil and gas, or is it other places?
Oil and gas, it's infrastructure, it's telecommunications, it's travel, hospitality, and leisure. It's many sectors that there's a lot of investment happening, and we're pleased to be there to advise companies and governments in the region.
Navid, I mean, I guess there's always a problem of timeline, right? Because we don't know what happens if there's a resolution, if it's a diplomatic resolution. Like, how do you live through the next couple of months?
Well, look, we're committed. As I said, the safety of our people is our first priority. We are committed to the region long term. We've been there for many years. We will be there for many more years to come. And we're going to continue to add senior talent and continue to serve our clients in the region. We're bullish on the importance of that part of the world, and there's a real opportunity if the war is successfully brought to a conclusion for that region to flourish in a major way.
Do you think it's had an impact on deal making in general?
In the short run, for sure, and clearly geopolitical conflict, rising oil prices, some of those things aren't helpful in the near term to deal making. Despite that, when you look at the overall, deal flows, especially on larger deals, both in the United States and in Europe, the numbers are actually pretty good this year, all things considered. Better than you would have expected if I told you there was a war in the Middle East.
That's true. Why do you think that is? Is it just a resilient economy or chief executive? There's been so many shocks, tariffs, it's COVID, that they've just gotten used to it a little bit more.
I think it's a few things. I think first, if you look at earnings growth and the numbers that the companies are putting out, it's still quite good, and there's still optimism about the economies in all over the world, essentially. And second, we're on the cusp of major technological change with AI and the build out of infrastructure around AI, and companies feel that they absolutely cannot sit out the opportunity to scale their businesses on a global basis. And so I think all of those factors, have helped deal making, especially again with the larger deals.
So Moelis is also moving to a larger office in Marylebone. Yeah. How do you plan to continue investing in Europe?
We have about 200 people in Europe, and you're right. We moved to new space over the last couple of weeks in Marylebone. I think it's a testament to our presence in the region. We're going to continue to invest and hire people here. We see great opportunity in Europe. Europe is a very important part of our global network and our global client base, and we're very, very optimistic and love our team here and looking to expand further.
Any specific sectors? Again, it does feel, being European, that sometimes Europe is just trying to play catch up, either with technology giants or AI or even energy and infrastructure.
I think most activity right now is happening in financial services, in defense, in infrastructure, in consumer. I think that's where you're likely to see a lot of elevated deal making here over the next, period of time, and I think those are some of the areas we're looking at continue to invest.
I mean, there's again a lot of question marks politically here in the UK. What happens with the Prime Minister? It can be in France and other countries as well that are going through elections in the next 18 months.
Yeah.
Does that weigh on chief executives' minds?
Sure. Look, political turmoil and change usually is not a confidence builder. But look, we have political turmoil in the United States too, and some of these forces that require M&A. Again, technological change and innovation, the large amount of backlog of portfolio companies that are sitting in the hands of private equity that need to turn over. Some of these major structural forces require M&A to happen. And so once we get through some of the geopolitical noise, once hopefully oil prices come down, interest rates subside, I think that could lead to a really great environment for enhanced deal making.
I mean, I was going to ask you if you thought that inflation, would lead to higher interest rates, and therefore that some of these deals had to be accelerated. Not the good type of M&A deals, but the ones that look a little bit desperate.
Yeah, look, generally higher interest rates is not a positive for deal making, and so our hope again is that we'll get resolution, and rates can come down, and some of the supply shocks we've seen on the energy side, which are creating some of these inflationary fears, subside. I think if that happens, again, when we came into the year, it looked like a banner year for deal making, maybe one of the all-time great years in terms of the environment. We've had a little bit of a setback. I think once we get through this, and hopefully we get through this in a positive way, I think we could be off to the races again.
So just delayed, no
just
fundamental
delayed.
changes.
I think that's our hope. That's our hope. Again, there's risks, but that's our hope.
Now, talk to me a little bit about your industry. So there's been a lot of M&A amongst, boutique banks recently. Yeah. Perella Weinberg, for example, buying Gleacher Shacklock, Robin Warshaw. Then, what do you make of this consolidation?
Yeah. Well, look, we're in the business of serving as many clients as we can. So our own philosophy on growth has been internal talent development and hiring great world-class bankers from the outside. There is a third strategy, which is also to buy other boutiques. Right after the global financial crisis, there were many boutiques that were formed, including our firm. And some of those firms, 20 years later, are potentially looking to exit. And we're looking at some of those opportunities as well. So, but for the most part, our strategy is really revolved around internal talent development and hiring bankers as opposed to buying firms.
But if you were to buy a firm, is it a specific kind of firm? I don't know what you're doing, for example, private capital advisory.
Yeah, we're building our own private capital advisory franchise, and we're very excited about that. Look, whenever you look at a business like that, the question is, are the people additive to what you're doing? And is it additive to our culture? And can we do a deal that makes sense for both sides? If we found an opportunity that was additive to the culture, that would enhance our capabilities, and where we could do a deal that made sense for both sides, we would certainly look at it.
So would this be a regional play to get into somewhere else, or would it be more of
Could be regional, could be product capability, could be sector capability, could be any one of those three or a combination of those.
What makes a success of an M&A deal? Because you touch on culture, and this has been one of the most difficult things throughout decades, actually, in financial services.
I think that's one of the most underestimated parts of this, especially in a people-based business. We're in a people-based business. And so at the end of the day, what are we buying? If we were to do a transaction, we'd be buying a group of people. And what makes the most important thing is, will those people thrive at our firm inside of our culture? I think we have a very distinct and unique and collaborative culture. And if we could bring on people through an M&A transaction where we would improve their capabilities, they would bring something to us in terms of a product or sector or client skill set, and we could work together in a collaborative way to grow our respective enterprises, that would make the most sense.
How will AI change your business? Or change
It's
your
already
industry?
starting to. Yeah, it's already starting to. So we're actively evaluating and deploying AI tools for our bankers. I think AI has the opportunity, a really incredible opportunity to enhance our business, to make bankers and all of our employees much more productive. Look, we're in the business of giving advice to clients and doing smart transactions with our clients. And AI can help us do that at an advanced pace and could help our bankers be more productive. And there's a set of tasks that our bankers sometimes do that can be automated, that could help their quality of life and could help us with our clients.
Does it change the culture of investment banking?
I don't think so. Look, we're on the precipice of a real sea change here. My hope is that it will improve morale and happiness in our industry for our bankers, again, lead to more productivity, and most importantly, enable us to provide even better advice to our clients.
How important are to be involved in large deals? I mean, it feels like it's in an era of, the large deal of like 10 billion plus is really what works. I mean, is your strategy to try and get some of those deals, and how do you go about it?
Yeah, you're right to point out the sweet spot of the market right now is 5 and 10 and up billion-dollar transactions, both in the United States and over here in Europe. Absolutely, we work on lots of large deals. It's very much part of our strategy. Those deals are important to demonstrate our client capabilities and our skill sets.
Is it different getting a big deal compared to a medium-sized deal? Do you pitch differently? Is it, do you have to know the founder from the start? I don't know what the magic sauce is.
Look, big cap coverage and big deals are really about long-term relationships. To earn the right to work on very, very large transactions, you have to be there giving very good quality advice for a long period of time. You have to be integrated with the management teams. You have to be known by the boards. And, to have the ability to win and work on those kinds of transactions, you have to have a long-term perspective.
Now, so you've been, you co-founded Moelis, but you've been in the top job for a little less than a year. What have you learned? What surprised you the most?
There's nothing that really surprised me. As you point out, I've been with the company since the beginning, and this has been more of an evolutionary change. But look, I could not be more excited about the quality of our people and our talent, the direction of our business. Yes, we are, as an industry right now, going through a geopolitical crisis and rapid technological change, but those are the things that excite me. Those are the dialogues we love to have with our clients, and I've never been more excited about the trajectory of the company and the quality of our people.
Navid, thank you so much for joining us.
Thank you.
That was, of course, the Chief Executive of Moelis, Navid Mahmoudzadegan. Now, coming up, the EU taps Swedish investment firm EQT for its latest move in the AI race. We'll speak to Per Franzen, the Chief Executive, next. And this is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Well, the conversations that matter, the insights you need. This is The Pulse. I'm Francis Nakwa here in London. Now, EQT has secured the mandate to run a new €5 billion EU fund investing in quantum computing, AI, and other deep tech companies. Now, it comes as companies and countries across the world are really racing to fund the AI build-out. Google and Blackstone only today announced plans to create an AI cloud business with data centers using Google's homegrown AI chips. Well, Per Fransen is the chief executive of EQT, which manages around 269 billion euros in assets. Per, thank you so much for joining us. First of all, congratulations on the mandate. Exactly how much will it work? So now you have to fundraise, and will you be putting any of your own EQT capital?
Yeah, we're very happy and excited about being given the opportunity and the responsibility to manage this fund for the European Commission. The initial fund size target is 5 billion euros. A substantial amount of that capital will be coming from anchor investors, the European Commission, but also from our own balance sheet. Yeah, I think the timing couldn't be better for this initiative. The world is moving fast. AI technology is advancing rapidly, and like the growth rates that we're seeing are really unprecedented also in AI and other areas where the fund will be focusing.
So, first of all, why is Europe struggling to hold on to homegrown champions?
So what we've seen when we looked at the numbers is that over the last 50 years or so, there's been approximately 250 startups in the US that have reached a market cap of $10 billion or more. But in Europe, there's actually only been 14 of those. EQT, the firm that I'm representing, we're one of those firms. So today we're still listed here in Europe, in Stockholm, and we have a market cap of approximately 40 billion euros, right? But the point is Europe needs more success stories like EQT. And so what we're doing with this initiative is giving startups, promising entrepreneurs access to the scale-up capital required to also reach their full potentials and become global champions.
So, I mean, I guess this is a problem, right? It's a capital problem. I mean, often it's a money problem. I don't know at what stage some of these European companies need that money to become European champions instead of moving to the US.
Exactly. So what this analysis shows is that Europe doesn't have a startup problem, it has a scale-up problem. And that is what this initiative is addressing.
So when you look at, the European tech ecosystem, where do you see that system needing money faster or more money?
Yeah. So I think the opportunities that we see where this fund will focus is across the early stage technology and healthcare ecosystem in areas such as AI, quantum computing, clean energy, but also life sciences and medtech. And of course, at EQT, we've been investing into those areas out of our early stage technology and life sciences funds for years, and we have a deep pipeline of opportunities. And yeah, with this initiative, we're even better set up to support those entrepreneurs and to invest into those startups.
Per, is this about national security? So we don't often think about the fact that you could see U.S. companies, and I don't know whether this is true, but do we need to think about the fact that big U.S. companies could have a switch that actually says, well, now we're only mandated to do the U.S. I mean, is it that critical that Europe builds its ecosystem for tech?
So the way we think about it, as I said earlier, right, the world is not standing still. It's a competitive world. AI technology is advancing rapidly, and we're a global investor at EQT. But we have European roots, and we have the largest part of our organization in Europe. So, of course, we support an agenda that drives a more business-friendly and a higher growth agenda wherever we invest, and certainly also in Europe, and that's why we're so excited about this initiative.
Are there parts in Europe that they shouldn't focus on, for example, in the tech ecosystem? So if you look at LLM languages, is it too late? Does Europe need to think more about data centers or other parts of the value chain?
So what we're seeing is that when it comes to AI, that there are massive investments being made into AI infrastructure. And so I think that continues to be an opportunity for Europe. But we're also seeing an unprecedented number of native AI startups at the application layer. And I think here Europe also has a real right to win. If I look at some of the investments that we've made recently into companies such as Lovable, the vibe coding platform based out of Sweden, I mean, the growth rates that we're seeing here are unprecedented. They've gone from 0 to 400 million euros of annual recurring revenues in record time. So we really see opportunities across the AI ecosystem.
I mean, you know, realistically, does Europe need a Google or an OpenAI? Would it ever have one? So, you know, a company of that size and scale?
I'm not sure we'll be able to produce companies of that size. I mean, we have businesses such as Mistral, of course, when it comes to large language models. But I think what we're focused on is really investing into the opportunity set more broadly across the AI ecosystem. Yeah.
What do you think makes investing in Europe so attractive right now?
I think we have access to world-class talent. We have some of the best universities, academia in the world. And so the talent is there, the startups are there, we just have a scale-up challenge. Yeah.
What are you most excited about? And again, is it different investing in France than investing in Germany than investing in the UK? And how do you bring that together?
We really take a pan-European perspective to this. The pipeline that we have across those target subsectors is really across Europe, from the Nordics to Central Europe to Southern Europe. If I look at some of the subsectors, I think Europe has a right to win in all of those, right? Whether it's in quantum computing, whether it's in space, whether it's in AI or in life sciences.
I mean, and I've always been told that Europe doesn't have to choose between the US and China, but sometimes it feels like we're stuck in the middle a little bit. Do you think European companies, European tech companies, in the next couple of years will have to choose?
I'd say, I mean, there are a lot of external factors that we can't control in Europe. What we really need to focus on is just driving a competitive agenda ourselves across Europe to make sure that we drive a more innovation-friendly, a more business-friendly agenda. And this scale-up fund initiative is one of many, I think, promising actions that are being taken right now across Europe.
So the mandate is very fresh because we found out about it only late last night.
Yeah.
So congratulations. Can you give me a sort of timeline of how much, you know, so it's 5 billion, I guess, in all. How's fundraising going? When can we see the first kind of, cash being deployed?
So as I mentioned earlier, right, a substantial part of that 5 billion euro fund has already been raised. So I think, and the pipeline is there for us to invest into. So we want to get going as quickly as possible, and I'd say we expect to make the first investment at the very latest during the third quarter.
So, I mean, it's fast. I mean, things are moving so fast in quantum computing and AI and tech companies. So is that why you have to move, like put the accelerator?
The opportunity is here right now in front of us, and the world is not standing still. So, and we're ready to make those investments. We have the infrastructure, we have the people on the ground, and we have the pipeline across those target subsectors to invest into.
Do you believe it's been harder for a lot of the companies that you've been talking to because of the war in Iran? Has that had a spillover effect, or is it fairly immune because the sector has still seen buoyancy even in Europe?
If you think about these subsectors and the opportunity set that we're looking at, is relatively speaking less impact by sort of what's happening geopolitically in the world and where oil prices are. But of course, that does have an impact on overall economic environment and also risk sentiment. So from that perspective, it has an impact. But I think these businesses, these founders are more focused on executing on the opportunity ahead and getting access to that scale-up capital that they need.
So interesting. Per, thank you so much for joining us. That was Per Fransen.
Thanks for having me.
The EQT Chief Executive with us here in London. Now, coming up, we're joined by the Co-Chief Executives of Goldman Sachs International. We'll discuss inflation, we'll discuss market volatility, and of course, the deal-making outlook. That's coming up next, and this is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here in London, and these are your top stories. President Trump says he called off a strike on Iran planned for today after an appeal by the leaders of Persian Gulf allies who called for more time to pursue a diplomatic solution. The head of the OECD tells Bloomberg the global economy is at risk of further deterioration over the Middle East conflict. We're live in Paris for the meeting of G7 finance chiefs. Plus, Standard Chartered plans to eliminate thousands of support roles over the next 4 years, joining the ranks of global lenders using AI to trim headcount. So if the conversations we've been having so far today have taught us anything, it's really now it is certainly not a boring time to be an executive in finance. That's true. Between navigating market volatility, negotiating cross-border M&A, supporting colleagues and clients in the Middle East, but also finding new talent to hire, every day brings new challenges and new excitement. Well, my next guests know this better than anyone, and I'm pleased to be joined by Anthony Gutmann, co-chief executive of Goldman Sachs International and global co-head of investment banking at Goldman Sachs, and Kunal Shah, co-chief executive of Goldman Sachs International and global co-head of FIC at Goldman Sachs. So thank you both for joining us. So you've been in this job together as co-CEOs for a little over a year. I mean, everything's been thrown at you. There's there were Middle East war, there was Venezuela, there's a lot of, inflation, central bank. How's it been?
Yeah, well, look, firstly, thanks for having us. Great to be here. There's no question it's been a pretty turbulent environment. In these kind of environments, we see huge opportunity. It's a point in time where our clients need advice and they need support. We're obviously spending a lot of time trying to give them that and helping them navigate this environment, as complex as it is. And, and that's really key to us. As you know, everything in our business is about our client relationships and engaging with them. Look, I'd say the thing that's really critical in Europe, and I'm sure we'll talk about it, is we have to run a global business, but we have to run a local business. We want to be close to our clients. Right now we're operating in 29 offices across 23 cities, and really what Kunal and I have been focused on is making sure we get to all of those offices, see our people, and see our clients. And our clients want us to be there on the ground, close to them and near to them, to give them the advice and the support that they need. I would tell you that beyond investing in those relationships, there's 3 or 4 things that are really key for us, and that's what's been key in the last 12 months. Firstly, regulation. I'm sure we'll talk about that, but we want a pro-growth agenda. You've heard it from the earlier speakers today, and so we're spending a lot of time with European regulators and governments. We're leaning a lot into operational growth, by which I mean productivity gains and everything that can accrue from what we're doing on AI and collaboration within the firm across the divisions. We see enormous opportunity there. And then we're also very invested in our culture. You know this, Francine, the culture of the firm is really important to us. And so we're spending a lot of time with our people trying to engage in the collaboration that comes from the divisions working with each other. And so far, so good.
Kunal, I mean, if you look at global deal making, has there been a slowdown, or do you anticipate one because of the regional war?
Look, as Anthony said, times are uncertain, but even though our clients don't have clarity, I think the good thing here is that hasn't actually held up activity. Because although they may not necessarily know how the current war plays out, there are key structural themes they're focused on, whether that's resilience, whether that's diversifying supply chains, whether that is AI and technology. So actually, when you look at deal making at large in the region, there have actually been some real tailwinds there.
Yeah, and we'll talk about regulation in a second. We'll talk about the UK. But actually, when you look at, the feedback, I guess, from large sovereign wealth funds in the Middle East, will they continue to remain active amid the conflict?
Yeah, I mean, look, we're spending a lot of time in the Middle East. I was actually down there a couple of weeks ago. I think they are trying to operate in a fashion which is as consistent as can be with business as usual. The level of capital deployment, to us seems unchanged. There's no question they're maneuvering to adopt and adapt to a new environment. That's a thoughtful approach to it, and they're navigating it well. We're seeing a lot more focus, obviously, on technology, on AI. We're also seeing an enormous focus on infrastructure spending, both domestically and internationally, and we think that's a thoughtful place to be. We think it's a good opportunity for them and for us. I would just say, we remain highly committed to the region. We have over 100 people there. We have 5 offices. We're trying to do our best in this environment to support our clients and the sovereign wealth funds there. And I'd say, some of the things we've announced in the last few months have been consistent with that. I'm sure you saw this MOU that we signed with the Qatar Investment Authority for $25 billion. That's really about Goldman Sachs Asset Management working in partnership with the Qataris as they seek to invest globally across public and private strategies. We've done the same with PIF in Saudi. We're very excited about that. The other thing I would say, by the way, which is really critical to our business in the region, and we think critical to our clients in the region, is there is an enormous swathe of ultra-high net worth clients who really will benefit from our services, and we're trying to invest in that.
I mean, there does seem to be a difference between some of the private deals, private equity deals, and actually what we're seeing elsewhere. I mean, do you see that difference?
I think on the deal-making environment overall, you're touching on an important point, which is if you step back and look at what's been going on in the investment banking business, we had a first quarter with just shy of $1.5 billion of advisory revenues. That's up about 90% year on year. We've seen M&A volumes up about 35-40% versus 5-year averages. But that activity is largely coming from big corporate M&A.
Right.
Deals in a size range of $5+ billion are up significantly. And that's really generally been about corporates trying to drive industrial leadership. What we're seeing in the market right now is that there is a real premium attached to being a market leader, having the scale and liquidity that comes from that. And the markets are rewarding you for doing those kind of deals. It's definitely been more muted on the private equity front, although we think that you'll see more activity there. Yeah, we think so.
Second half or sooner?
Look, in part it's going to be driven by what happens in the IPO market.
Yeah.
The IPO market really is looking pretty healthy, particularly in the US, but we think there are signs of it building here in Europe. That's an important liquidity mechanism, as you know, for private equity. But I think they're also going to be leaning more and more into M&A activity. I mean, we all know well that there's a lot of pent-up inventory sitting in private equity hands. And I think that there's a degree of pragmatism both on the buy side and the sell side around finding appropriate asset pricing to get these deals done.
Kunal, the UK. I mean, there's a lot going on in the UK.
There is.
None of it is really that good. How are you expecting, first of all, client behavior to change given the political uncertainty?
Now, when you say it wasn't that good, actually Q1 growth was better than expected. So there were actually some tailwinds going into this. Of course, the war has had its effect, and whether it's the UK or Europe, just given the energy import requirements, of course, that's going to have a hit on growth. You're seeing this stagflationary impact on inflation. It's meant the Bank of England, as you know, went from expected rate cuts to now largely market pricing a couple of hikes. So that has led to pressures. I'd say it's also at a time when sovereign bond markets on a global scale have been facing pressures. You see this with treasuries, Japanese bonds, bunds, and the UK. And then, of course, you combine that now with the political uncertainty that's there. Look, we're not in the business of making political predictions. What I can tell you from our client base, when they look at the UK, it's a market which has actually served them very well. It's a great base to have for business and to be able to really transact and deal globally. But what our clients really need is certainty. And when it comes to the policy framework, which of course gets discussed as we think through what the next leadership may look like, what they really want is clarity, predictability, and something which hopefully is sustainable, so our clients can then go back to actually focusing on their businesses or their portfolios, which I think is really what's needed, because ultimately what this country needs is growth.
I mean, this is the one thing. Everybody wants stability. The UK Treasury recently announced new plans on ring fencing, expected, in a couple of weeks. Does that make you rethink anything in terms of Goldman Sachs plans? Any impact, for example, for Marcus?
Yes, so look, when you look at the ring fencing regime, as you'll be aware, it's a particular quirk of the UK.
Yep.
We think it's constructive that they're now following up this consultation, which for the ring fence banks should lead to some reduction of friction and costs. We're not a ring fence bank ourselves. We have capacity up to a headroom limit of £35 billion right now. So we have been, of course, growing our Marcus deposit product in the UK. Now, I think what's been especially productive in the recent announcements is the fact that that limit's now going to be reviewed on a 3-year basis, which is important. When you think about a global bank like ourselves, we've now got more clarity on the end zone for regulation, whether that's the implementation of Basel III, but also in the US, we now have clarity on the supplemental leverage ratio and various other rules, which means that we can now really project forward for growth and how we can really scale our business with our clients. And it's important that the UK remains within that. So now having more clarity that our ability to raise deposits and fund our business in the UK will have periodic review, of course, helps.
I want to talk about regulation in a second, but Wes Streeting has also put a Brexit reversal on the table. He's trying to challenge the Prime Minister, Keir Starmer. At this point, do you think the City of London would even want to rejoin the EU?
I think when you talk about Brexit reversals, of course, having a more open trade relationship with Europe would help. And there have already been discussions and some hints towards that direction already. There are clear lines for cooperate when it comes to defence. So I think that too is constructive. As for financial services, we can see what I can tell you is London still remains a vibrant centre. To Anthony's point, we've absolutely extended and expanded in the continent over recent years. For us, that's been very productive because it's really just meant that we've got closer to our clients in Europe.
Talk to me about regulation in Europe. I mean, it's kind of, there's a sweet spot, and it feels like we're not there yet in Europe, that maybe there's too much regulation.
Yeah.
Are regulators, understanding what's at stake?
Yeah, by the way, I think you're right. There is a sweet spot. Look, Europe continues to have huge opportunity. We feel very strongly about that. And we actually are optimistic about Europe. It represents 9 to 10% of the global population. It's 10, 15% of global GDP. But it requires Europe to operate in that capacity as Europe, not as 27 separate member states. And so what are we focused on? We're focused on that goal. And it's a simple goal. We really want Europe to operate in a cohesive fashion. What you just heard from your prior speaker around this technology fund, that's an enormous opportunity. I think they are leaning into 2 simple goals, which is consistent with our philosophy. Number one, we need to make it easier for business to operate pan-Europe. We can't have local jurisdiction, local regulations, and local
admin. You really believe that? 'Cause we've been talking about it for a while.
Yeah, we do believe it. We do believe it. Look, we think it's going to take some time. Yeah. We think you have to be patient. You think you have to be persistent. But I think European leaders and regulators get the need to make Europe an easier place for people to operate cross-border. And they also get the importance of having a deep, unified capital market so that actually when those corporates, when those startups scale up to a sensible place, they can access, a proper capital market that has the depth and liquidity of both the US and Asia.
Look, there's just a lot going on in markets, and it's AI. It could be the AI trade. How do you see the risks over the next 6 months in markets? It doesn't feel like the Middle East is getting any better, but I guess businesses have also a way to adapt and adjust.
Yes, so global stock indices, of course, have really been strong. Many of them at now all-time highs. As you point out, AI has been a dominant theme. There is very narrow breadth when you really look at that outperformance. The US has really led this retracement post this conflict starting, but it is quite concentrated. And you're now starting to see some wobbles since Friday where the momentum trades are starting to turn, but it has really been a big structural trend. The market is, of course, looking at earnings coming out, like NVIDIA, et cetera, to really path forward. I'd say what we see from our own business and our own clients is real commitment to continue to scale. Now, some of that is just down to the insatiable demand for compute and really this race for capacity. But I'd also say from a corporate level, people are really starting to see the benefits from a productivity lens of this technology. So we do think that structural trend is there to continue. Of course, there'll be bumps along the road. We can have a debate on AI on whether the value is going to accrue at the chip layer, the infrastructure layer, the model layer, the enterprise layer, and a lot of that is going to remain to be seen over the cycle, but it's clearly a place that our clients are focused. Now, of course, one of the disconnects we get, though, is the fact that stock indices are at the high, but the price action in bond markets is obviously problematic on a global basis. Thus far, most of the sell-off we're seeing in bond markets is because of the inflationary impact of the current conflict. But there's a vicious cycle where the raising interest rates starts becoming a fiscal problem, and that's when things can sour and turn. I'd also say that right now the market's focused on inflation and those impacts from the war, less the growth impacts. Now, that can bite too. We've survived thus far to May because inventories and commodities were higher. There's been some substitution, but at some point those stockpiles can run dry. So if we don't get resolution on opening up of the strait, of course, that can start to have a real supply side impact. And that's when the confluence of these things can become more problematic for markets.
Yeah, and that's maybe it's something for the second half of the year, right?
Absolutely.
That's when it can become problematic. Thank you both for joining us. That was a great conversation. Anthony Gutman and Kunal Shah, co-chief executives of Goldman Sachs International. Now, coming up, oil prices decline as President Trump offers Iran a reprieve. We'll have plenty more on that next. We'll also go to Paris for the G7 finance chiefs. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bill Winters, the chief executive of Standard Chartered, says artificial intelligence will eliminate thousands of jobs at the bank as it replaces what he called lower value human capital. Now, the lender plans to cut more than 15% of support staff by 2030 as it expands its use of AI to streamline operations. Now, Standard Chartered employed about 52,000 people in those roles at the end of last year.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
Jensen Huang, the NVIDIA chief executive, says semiconductor demand in China is incredible. And he expects authorities there to eventually allow the import of AI chips from the U.S. Now, Huang was a last-minute addition to a delegation of business leaders who traveled to Beijing for President Trump's summit with Xi Jinping. Now, he spoke to us exclusively in Las Vegas alongside the Dell chief executive.
The president wants America to win everywhere. Right. The president wants America to lead the AI revolution. And so H200s are licensed to sell to China. The Chinese government has to decide how much of their local market do they want to protect and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open. President Xi was very clear that he wants China to be an even wider open market. Premier Li Qiang was very straightforward and to explain very eloquently that China will be an open market. So I'm looking forward to China being a more open market.
To clarify, Jesse, you were able to meet with those officials directly to discuss whether or not you can sell to those Chinese tech companies.
I didn't discuss directly with them about H200. Right. I was there to represent the United States, and I was honored to do so. I was there to support President Trump, and really glad to do so. But that was really the focus of my trip. President Trump had some conversations with the leaders, and I'm looking forward to what they decide.
Michael, you did not go to China, but I think what's interesting is you are a member of the President's Council of Advisors for Science and Technology, as is Jensen. Your net conclusion on whether or not China will become open to American technology companies to do business there?
You know, we have a business in China. Obviously, we comply with all the restrictions and various controls that are in place. But I hope that there's more economic collaboration between the United States and China. That ultimately is what will lead to greater outcomes and prosperity for everyone, and a greater likelihood of a successful relationship between the countries and around the world.
Jensen Huang, the NVIDIA chief executive, and Michael Dell, the Dell chief executive, speaking exclusively to Bloomberg's Ed Ludlow. Now, President Trump says he's called off strikes on Iran scheduled for later today. That's after the Gulf allies asked for more time to seek a diplomatic resolution.
I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
Well, joining us now is Jumana Barsechi, Bloomberg's Horizons Middle East and Africa anchor. Jumana, thank you so much for being here. I mean, the President Trump's Iran threats are a little bit discombobulating, because we thought they were looking for a diplomatic solution, then there were threats, but then he backed down.
Yep, escalate, de-escalate, escalate, de-escalate. We've been here many times. But I think if we rewind back 24 hours, remember, President Trump also threatened that the clock was ticking for Iran to come to the negotiating table to make a deal or else. And now we know, in his own words, if we take it at face value, they actually did come very close to launching a second wave of attacks, if we believe what he said. And indeed, there was lots of media reporting yesterday suggesting that he had been briefed on various military options, but at the request of Gulf allies, and he specifically cited Saudi Arabia, Qatar, the UAE, he's decided to hold back, at least for a couple of days, with the view that maybe Iran this time around will come to the negotiating table. Now, at the same time, Francine, we are back where we were discussing the same issues that we've been discussing for the last couple of weeks. The fact that they have a different timeline vis-a-vis how they're going to reopen the strait. The Iranians are asking for the blockade to be lifted. The U.S. are saying that they're not going to do it until the Iranians lift their own blockade of the strait. The nuclear file, obviously very complicated, and the Iranians are saying that they have a right to continue with nuclear enrichment. But in order to get to that level of discussion, you have to pass through the other items sequentially. And of course, of top of mind for the U.S. administration right now is what they're going to do with the Strait of Hormuz.
Of course. And I mean, the U.S. also issuing a new Russian oil waiver to free up supplies. That feels significant.
It does feel significant, and also just a reflection of how much pressure energy markets are under. The U.S. administration is doing what they can to cap the move upwards in energy prices. We have Brent once again sitting at $110. There were some, again, media reports coming through from Iran yesterday suggesting that the U.S. might actually introduce a waiver or reintroduce a waiver on Iranian oil exports. That was not the case, but they did extend the waiver on the Russian one that expired a couple of days ago for Russian oil that's already on water. But the point is here, they are under a lot of pressure. The price of gasoline per gallon keeps the tick up in the U.S. We're heading into midterms. The war is increasingly unpopular, and this is one way, perhaps, to cap the upside that many energy analysts are expecting to come throughout the month of June.
Jumana, thank you so much. Terrific briefing there from Jumana Bersachi, of course, on what's happening in the Middle East. Now, G7 finance chiefs are also meeting in Paris today with an inflation shock looking likely to endure. They must come to terms with the new economic reality. The OECD Secretary General, Matthias Cormann, spoke to Oliver Crook on the sidelines of the event.
Normally you would be able to see through an energy price shock, but of course, if it starts contaminating prices more broadly, if you see increases in wages as secondary effects, then central banks will need to take action, even if the economic growth outlook is somewhat weaker. Across advanced economies, what we see is that core inflation remains relatively okay, but of course, I mean, that's precisely what we will be looking at.
Well, let's bring in Bloomberg Chief Europe Correspondent Oliver Crook. Ollie, good morning. So what more have we heard about the impact of the Iran war?
Yeah, so it's very interesting because obviously for central bankers and finance ministers here, everybody's focused on A, inflation, and B, the impact on growth. And of course, that stagflationary dynamic we've been talking about as a consequence of this war, particularly here in Europe. It seems so far from the conversations I've had and what we've heard from a number of finance ministers, and we'll be quizzing the chief of the Bundesbank and the Banque de France a little later on this, is that for the time being, obviously inflation is rising, but it's staying more or less segregated to the headline level. They're not seeing very explicitly the secondary effect, but you heard it there from Matthias Cormann, the OECD Secretary General, that this is a risk, and that even if you do get that, inflation spreading from energy to the headline to other parts of the economy, you may still need to sort of hike rates in the face of diminishing growth, and that is the very difficult conversation and scenario for many of these politicians and policymakers here in France meeting, and of course speaking to Scott Bessent in the search for sort of what the U.S. policy is going to be going forward, particularly since we get some conflicting reports. On the one hand, Bessent wants to see more sanction enforcement on Iran. On the other, potentially they're putting out this idea that they may waive some of the sanctions on oil in order to keep the prices diminished. So those are some of the conversations that are happening here just behind us.
And Ollie, EU officials will meet to finalize a trade deal with the U.S. to avoid more tariffs.
Yeah, that's right. I mean, this is the other conversation that is being more centered around Brussels, trying to avoid that increase in tariffs from the Trump administration. You'll remember President Trump has set the deadline of July the 4th, the 250th birthday of the United States, for the EU to get this deal agreed to, ratified, and put into power. There's going to be a meeting a little bit later today to try to make a sort of meaningful step to get towards that deadline. The real question is, given how slow the EU moved, can they hit that deadline? That's going to be absolutely crucial, because the last thing you want, Francine, in addition to a stagflationary shock, is another trade war.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, from the G7 finance chiefs meeting in Paris. Now we'll have an exclusive interview with the Banque de France governor and the president of the Bundesbank. Ollie Crook will be conducting that. It's at 1:30 p.m. London time. Don't miss it. It's probably one of the last ones by Monsieur François Villeroy de Galhau before he steps down. Now the picture for markets is one of, it's very tentative, actually. If you look at tech stocks, they're slipping. Traders really trying to find out what will happen in the Strait of Hormuz. Money managers increasing their exposure to stocks by the most on record last month. That's according to a survey by Bank of America. Up next, Bloomberg Brief. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Trading with caution. Stock futures slip as longer end Treasury yields in particular rise to flirt with levels last seen in 2007. Hold for now. President Trump refrains from scheduled attacks, he says, on Iran as Gulf allies ask for more time to form a deal. And job reshuffles and reductions hit industries from tech to financials as they push harder into AI. Let's get a check on markets around the world now. We'll start with Winnie Su in Hong Kong for the latest from Asia. Winnie.
Good morning, Bonnie. We're seeing today another risk-off day in Asia with the MSCI Asia here down for a third day. That is its longest of such streaks since March. Now, you are seeing oil prices easing a little bit, but still it's the concern around inflation given the lack of clarity around the Middle East situation, and that's keeping bond yields higher. Here, Kospi index is leading declines as you see chip makers actually tracking declines overnight in the U.S. given some concerns that Seagate Technology might not be able to meet the soaring demand when it comes to memory chips. Now you flip the board and take a look at today's bright spot in Asia is actually in Japanese banks. You're seeing the bank index here up about 3%, driven by the higher bond yields and also stronger than expected GDP numbers coming through, raising the bets around Bank of Japan to raise rates earlier than later.
Winnie, thank you so much. That's Winnie Su there in Hong Kong. Now let's get to London for a look at Europe with Charlie Wells. Charlie.
Good morning, Vonnie. Well, it's a different story here in Europe compared to a lot of those indices in Asia, where we're seeing optimism across the board that Euro Stoxx 600 up almost 0.8%, and similar optimism at a lot of these country-level indices as well. This seems to be something of that anti-AI trade that we get here in Europe, because there isn't that serious IT play, and also some potential optimism coming out of the Middle East. Let's flip and take a look at bond yields, a really crucial bond yield here in the UK, that 30-year. It is It's down some 6 basis points, potentially linked to some comments that we heard from Andy Burnham, the potential front runner to potentially replace the Prime Minister of the UK, talking about how he would stick to fiscal rules. So that giving a little bit of a relief this morning on that optimism narrative here.
Yeah, the bond market is certainly the narrative here in the United States as well. Charlie Wells, thank you so much. And that's where we begin. We have a curve steepening here with the 2-10 spread now at 53 basis points. The 2-year yield up 2.5 basis points. The 10-year yield almost at 461, and the 30-year yield now at 515 practically. This, of course, levels that we haven't seen since 2007. We're right about there. Now, this is partially the story. We have Brent crude still trading above 110, but it's down 1.5% on this idea that President Trump had scheduled attacks on Iran and then decided not to when some Gulf countries got in touch with him. That would all have happened today. So a little bit of relief in this market, but the potential for escalation or de-escalation is definitely something that could prompt this market to, destabilize, particularly the bond market. We have S&P futures down about 0.2%, and NASDAQ futures down a little more than that. Of course, the stocks sold off yesterday, semiconductors and memory chips in particular selling off. So we'll see if there are any dip buyers today or what, in fact, happens with equities, given where bond yields are at the moment. All right, let's get to some individual pre-market movers now. Back over to London and Chloe Melly. Chloe.
Good morning, Vonnie. Alphabet is up slightly this morning after Google agreed to build an AI cloud business with Blackstone. So this is part of a broader boom in spending in infrastructure and computing infrastructure. And the aim there is to be able to compete with companies like CoreWeave in this really increasingly competitive market. And so we're up about 1% for Alphabet this morning. Moving on to NVIDIA, which is on the move and seeing a little bit of weakness this morning ahead of the earnings expected tomorrow. We had the CEO, Jensen Huang, saying that China will eventually allow U.S. chips into its market, but the comments were not necessarily seen as that reassuring or that encouraging, it seems, and so we're seeing a little bit of weakness there. And finally, SanDisk is also in focus today. It's also seeing a bit of weakness this morning, part of this broader memory sell-off in memory, storage stocks, etc. And it is worth noting that the stock is still up about 460% year to date, but we have seen this massive rally start to cool a little bit, and so this is really what is in focus this morning for SanDisk.
For sure, those Seagate comments really injecting a little fear into this market. Chloe, thank you so much. Chloe Melly there in London. And coming up this hour, more on price concerns and the challenges ahead for central banks. We'll speak with Christopher Hodge of Natixis. But first, President Trump calls off apparently new strikes that had been intended for Iran.
Other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to.
Joining us now is Jumana Bersechi. Jumana, what do we make of the president's latest comments? How will they be received in Iran?
Yeah, well, Vonnie, 24 hours ago, remember, President Trump also put out a threat and said that the clock was ticking. Unless Iran returned back to the negotiation table, they know what will happen to them. And indeed, we found out throughout the course of what President Trump said yesterday, his Truth Social post, that the U.S. were actually planning on another round of kinetic actions. So that's not to be dismissed lightly, certainly from the perspective of people in the region. And President Trump also explicitly said that it was at the request of those 3 Gulf nations, Saudi Arabia, the UAE, and Qatar, that he decided, or the U.S. decided, to refrain from another round of those attacks, and then said that he's hopeful that a deal will be reached in the coming days, the next 2 to 3 days. So it's not completely eliminating the possibility of another round of hostilities. It's just a deferral at this point. But then the question becomes, how are we going to get this diplomatic breakthrough? And here, again, the stances and the respective stances are still extremely far apart on those key matters when it comes to the reopening of the Strait. Obviously, the U.S. are insisting that Iran unconditionally reopens the Strait. The Iranians are saying that they're not going to do it until the U.S. lifts their blockade. And then sequentially, the Iranians want to tie in the reopening of the Strait to a later discussion around the nuclear file. President Trump does not want to wedge the 2 issues. He wants them to be compiled together into the same round of discussions. And key here is enrichment. Once again, the Iranians saying that they have a right to low-level enrichment. The U.S. are saying that they have no right to enrichment, or if they do, only for civilian purposes, that 3.67% number over an extended time frame. So these are the same core issues that we have been discussing over the course of the last few weeks. And ultimately, Vani, there's going to have to be some form of compromise between the two sides. But ultimately, once again, we're in a situation where President Trump is threatening to go down the path of military action unless a deal is agreed to in the coming days. We'll see what happens. But I will say from the chances of a diplomatic breakthrough expectations are pretty low here. The best bet is that we may get a framework around how those negotiations are going to take place in the coming weeks, months as well.
Meantime, Brent's still above 110, and interestingly, WTI is around 107.50, which is pretty close to the highs of the war. Jumana, thank you so much. Jumana Resechi there. The Iran war giving Russia a chance to deepen its energy ties with China. President Vladimir Putin set to travel to Beijing to meet with President Xi for talks Wednesday. Joining us now from Singapore is Bloomberg's Roz Matheson. So the prompt reason for this, Roz, is to talk about a gas pipeline. Tell us a little bit more about sort of the headlines that will emerge just in terms of energy.
Well, that's right. So one of the key points of this meeting will be about this proposed pipeline, which runs from Siberia through Mongolia to China, or will rather. And Russia is obviously hoping that, given China's imperative right now around energy, because they have limited supplies coming from the Middle East, that they might be able to negotiate some kind of better deal, some kind of long-term contract price for this pipeline and get China to commit, because it's been going pretty slowly so far. And we know from officials that on the Russia side, at least, they're keen to speed this up and perhaps get some kind of commitment or even a timeline for pricing for this project while President Putin is in China. And so the sense is China's been taking their time. They're wanting to discuss it. They're willing to get a good price, because China has always had that leverage with Russia about generally getting a lower price for energy, because they are such a loyal buyer for Russia. And so we're going to have an interesting time, at least behind the scenes, on those conversations when it comes to energy. But there's also a lot of broader conversation that no doubt is going to go on around the relationship. He's coming there on the heels of President Donald Trump's visit to China very quickly, although this was apparently scheduled to be interesting. He want to know exactly what went on in some of those conversations. He'll want to know what was discussed about the Middle East, but also if the topic of Ukraine and Russia's war there came up at all. And so he'll want to get a readout of sorts from Xi Jinping about that. But certainly what he was primarily wanting to do is get some kind of assurances from China around that energy relationship.
Yeah, the Siberia 2 pipeline. Speaking of the interlocking trips, the FT is reporting that Xi Jinping actually told President Trump that Putin might end up regretting his invasion of Ukraine. Now, we have to say we haven't got any independent verification that this was actually said. And China itself, its foreign ministry spokesperson, is saying these things are not based on fact. But surely this will colour in some way Putin's visit, or will it?
Well, it might be interesting again to see to know what they say behind closed doors. As you say, China's foreign ministry coming out and saying they have no sense of where that would have come from, and they feel that it was probably made up, or at least that's their accusation. But certainly you can imagine Donald Trump asking Xi Jinping for his perspective on Ukraine, because this is a conflict that Donald Trump came into office saying he was going to bring to an end very quickly, and yet after his time in office so far, the war is continuing in Ukraine. So he probably wanted to get Xi Jinping's sense of where he saw the war, because for China, obviously, that they don't want to get too involved in Ukraine, but I'm sure they don't want this war to be continuing necessarily. So what has Russia been saying to China about that? And the US has been trying to get China to use its leverage on Russia when it comes to Ukraine. So perhaps an arched eyebrow, maybe, from Vladimir Putin about that comment, and maybe he'll ask Xi Jinping. But he probably really knows already where Xi Jinping's thoughts are on this conflict.
Absolutely. Roz, thank you so much. That is Bloomberg's Roz Matheson. The impasse around the Strait of Hormuz keeping investors cautious. Stock futures staying lower after 2 days of losses, and 30-year Treasury yields flirting with levels last seen in 2007. Citi now warning that the 30-year yield may reach 5.5%. Let's get more with Bloomberg's Ven Ram. Ven, are these markets still stable, and at what point do we start to worry about instability?
Well, not at the moment, Vonnie. I think that, we will start to worry about instability if we get to the 550 levels that you mentioned from Citibank. But I think that, what is important is even though oil prices have come off the boil at the moment, we have done $100+ a barrel for a long time now, and that is kind of giving the markets reason to worry about inflation. We got those inflation prints out of the US last week. Those were ugly and point to the direction of what the Fed is likely to do. The Fed's March dot plot is already blown out of the water. They need to revise up their macroeconomic projections, i.e. specifically inflation. And that means that, long-dated yields are going to be on the march higher. Although I think that, there are going to be pockets of opportunities for buying duration here. I think that, if you're talking about 515 on the 30-year yield, which is where we are at the moment, I think that you want to scale into duration at this point because, anything from here is probably not going to endure through the life of the bond. And I think that, assume unless the whole world goes topsy-turvy, I think these represent bargain levels for long-dated treasuries.
Well, it's not out of the question that the world goes topsy-turvy, Ven. I mean, we had Andy Burnham try to calm the bond markets today, and indeed he did, with gilt yields coming back by about 6 basis points or so. But then on the other hand, you've Japan, where the 30-year yield there is just rising to, not infinity, but like serious levels. And we have the yen beyond 159 once again. So how at risk are the UK and Japan, and how much in need of central bank action are they?
Well, in the case of the UK, Vonnie, I think that, long-dated yields, again, specifically referring to the 30-year yield, if you swap that out into, you are going to get a much higher pickup than you get on US Treasuries, comparable US Treasuries and bonds, German bonds. So I think that, there is a case for, compelling yields on long-dated gilts, but I don't think they're going to rally anytime soon because of the Burnham factor. If you're talking about Japan, I think the selling has got more to go because, the Bank of Japan is deeply in accommodative territory at a time when they need to be raising rates quickly. If you pass the Taylor rule, Vonnie, I think that suggests very conservatively a Taylor rule rate of 2.8%. They are not even at 1% at the moment. So I don't think, the sell-off in JGBs is going to abate anytime soon. And we got the GDP data this morning that showed the economy was pretty resilient heading into the Iran war. So I think that the concerns about growth aspect have been overplayed by the BOJ. I think they need to raise rates here to quell the riot in bonds.
Ven, thank you so much for all the context this morning. Very interesting markets, and that is Ven Ram of our MLive team. Now, to other top stories trending on the terminal this morning. Sources say the SEC is expected to release a so-called innovation exemption for tokenized stocks this week, creating a new framework for betting on the fortunes of publicly traded companies. The move could reshape the landscape of the U.S. stock market as the Trump administration continues to loosen the rules for crypto markets. EU officials are meeting today in an attempt to finalize legislation for a trade deal with the U.S. They must reach an agreement by July 4th to avoid triggering tariff escalation from President Trump, as promised. NVIDIA CEO Jensen Huang sees China eventually opening its market to AI chips from the U.S. He spoke to Bloomberg from the Dell World Conference in Las Vegas.
The Chinese government has to decide how much of their local market do they want to protect, and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
Jensen Huang there. Coming up, AI-driven staffing shakeups hitting industries from tech to financials. Standard Chartered and Meta, some of the latest companies restructuring their workforce. More next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. The push to utilize AI hitting jobs across industries. Meta is moving 7,000 workers into AI roles while cutting staff in other areas. Standard Chartered announcing a plan to eliminate thousands of support roles as they shift to AI to streamline processes. Standard Chartered CEO Bill Winter is saying, quote, "It's not cost cutting, it's replacing in some cases lower value human capital with the financial capital and the investment capital we're putting in. We don't have job losses, but we do have job role reductions in favor of the machines, and that will accelerate as we go forward into AI." Bloomberg's Tom McKenzie joins us now. Wow, Tom, lower value human capital, it's a bleak phrase. What is going on in the industry? I mean, Standard Chartered just the latest to announce the potential for many thousands of job cuts.
Yeah, there's quite the sting, isn't there, coming from that comment, and you can imagine rippling through, of course, the offices of Standard Chartered globally on the back of this announcement. It will be taking place over 4 years. It's about 15% of their 52,000 or so global employees, but it's a reminder that Standard Chartered is really leaning in to the AI efficiency theme. They're going to be scaling their investments around AI and implementing it pretty aggressively, and as a consequence, it seems trimming some of those back office roles, some of those support roles, as the CEO was saying. Others, though, in the financial space, of course, in the banking space, are looking at similar measures. We've heard from the CEO of HSBC talking and considering potential job cuts as they also invest around AI. Similar comments from Goldman Sachs' leadership as well. So you can imagine this won't be the last of this story. And at the same time that Meta is talking about realigning 7,000 jobs. So essentially phasing out 7,000 roles and replacing those or moving those current employees, 7,000, into different roles around apps and agents. And that's on a week when, on Wednesday of this week, employees at Meta are expected to find out that about 8,000 of their jobs will be cut. So there's 7,000 being reassigned, 8,000 job losses on Wednesday. That's been flagged already, the 8,000 number. So they're just waiting to find out where the axe lands on that. But again, it's a reminder that it's not just the hyperscalers, it's not just those building the AI solutions, but also those incorporating it that are increasingly trimming their headcount as they invest along these lines.
I'm sure it's not the last of these headlines we'll be receiving. Tom, thank you so much. Bloomberg Tech Europe anchor Tom McKenzie there. Coming up, staying with AI, the Wall Street Journal reporting the American rebellion against AI is gaining steam. We'll have a look at that and the rest of your headlines in your front page news. This is Bloomberg.
in case you missed it on Bloomberg Crypto.
There's a debate going on right now in D.C. that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, on the New York Times, the shooting at San Diego County's largest mosque. The Times reporting a mother of one of the shooters called police that morning to report her son, her car, and some guns gone. She said he might have a friend with him. By the time the police located the shooters, the teenagers had killed 3 people and shot themselves. Next up, the Washington Post reporting on President Trump's decision to drop his family's lawsuit against the IRS. The Post says it's part of a highly unusual agreement that established a nearly $1.8 billion fund to compensate those who claim they have been targets of a weaponized justice system. The Post says the fund could result in payouts to Trump allies and supporters. And the Wall Street Journal reporting the American rebellion against AI is gaining steam. The Journal says industry leaders are trying to address the negative sentiment by highlighting AI positives and finding solutions to problems such as energy costs and children's safety. Coming up, we're going to be speaking with Christopher Hodge of Natixis on price pressures as the Hormuz standoff drags on.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country.
We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Trading with caution, stock futures slip as longer end Treasury yields rise to flirt with levels last seen in 2007. Hold for now. President Trump refrains from scheduled attacks, he says, on Iran as Gulf allies ask for more time to form a deal. And job reshuffles and reductions hit industries from tech to financials as they push harder into AI. Let's take a look at the bond market first. It's going to be in focus all day today. Look at that 30-year yield at 5.15 and change, now up another 3 basis points. We're seeing it across the curve, particularly the 2-10 spread widening. We're at 53 basis points on that now, with the 2-year yield almost at 4.08 and the 10-year yield above 4.61. Lots of commentary. Goldman Sachs seeing some emerging measures of value. Barclays and Citi talking about the 5.5% mark being breached potentially on the 30-year. And the head of BlackRock's research unit is now recommending investors reduce their exposure to DM government bonds. We're also seeing it across the world. We're seeing it in Japan, where the yen is above 159 again. And then we're also seeing it in Europe, although less so in the UK today, with Andy Burnham making some comments that seems to calm the bond market there. Now, Brent crude is still trading above 110, but we're down about 1.5% after the president said he had threatened to bomb today, essentially, Iran, and that he withdrew that decision after some requests from Gulf countries. We do have futures pointed lower as well on the equity indices. This could be a slightly different story. I mean, obviously yields have something to do with it, but we also had a sell-off in stocks yesterday. The stocks index was down 2.5%, and memory chip makers, after Seagate's CEO said they wouldn't really be able to build factories fast enough to meet demand for memory chips. Let's get to some individual movers now. Here's Chloe Melly in London.
Good morning, Bonnie. Alphabet is up slightly this morning after Google agreed to build an AI cloud business with Blackstone. This is, of course, part of this broader move to invest a lot in computing infrastructure. And it seems that the market is reacting quite positively to this new partnership this morning. Moving on to Hyperliquid Strategies, which is in focus this morning and reacting to a report that the Trump administration will soon be rolling out a plan to trade the digital versions of securities. So this is a move that could reshape the American stock market and could potentially be a big boost for companies like Hyperliquid. And so we're up about 10% in pre-market trading this morning. And finally, SanDisk is also in focus and slightly weak this morning, part of this broader sell-off in memory stocks, and also reacting to those Seagate comments that you've just mentioned, Vonnie, about not being able to keep up with that demand for memory chips. And so there's a bit of investor fears around that and around that whole sector. And so we're down about 3% for SanDisk this morning.
All right, Chloe, thank you so much. Chloe Melly there in London. The 30-year U.S. Treasury yield hovering close now to its 2007 highs, while consumer prices don't show signs of slowing down. Christopher Hodge of Natixis weighing in, writing, quote, "We don't think that inflation will continue to trend upward, but instead stay in a range as consumer demand falters in the coming months." Joining us now is Christopher Hodge, Chief US Economist at Natixis. Chris, we haven't seen demand fall off too much just yet. What will be the trigger for that demand to fall off? Will it be oil prices at a certain level for a certain amount of time, bond yields? What's going to do it?
Well, I think the longer that you see these higher oil prices and a combination of these tailwinds from the one big beautiful bill. So, taxpayers have gotten about 20% more money back from the government than they had as of April 2025, and that's going to fade as well. And you're just looking at an overall weakening consumer as wage growth slows as well.
Yeah, I mean, I'm sort of surprised that the one big beautiful bill payoffs are still out there, right? I mean, are consumers really still using that money in order to keep up with inflation?
Yeah, we think April was the last month where you're going to get a tailwind and a boost to consumers for that. So we do think that that is really going to drop off when we get the numbers from May. And, in combination with higher gas prices, lower consumer confidence, that's where we see the dampening consumer demand throughout the course of 2026.
Chris, it's the long end, yields rising, but around the world, I mean, Japan seems to have completely decoupled from the rest of the world at this point. It is just out on its own at this stage, but it's essentially the same problems: fiscal expansion, capex in the AI sphere, increased issuance, another one. Where do we stop, particularly in the US? Are we at levels where we might actually pan out for a while here?
Yeah, well, I mean, I think from the administration's perspective, the bond market is really where you've seen a change in trajectory for certain policies, right? So, I do think I would watch out for something from U.S. policymaking, but ultimately, you have a fiscal trajectory that politicians have no appetite to bend down. You have the end of QE. Or at least a slowing of QE in the future. And ultimately, bonds are not an inflation hedge. Stocks are. But as you get more and more inflationary pressures, or at least perceived pressures, you're going to get upward pressure for yields.
Chris, you say that you don't think that inflation is going to continue to trend upwards. What will cool it off, given that oil prices are going nowhere? In fact, WTI, the spread between WTI and Brent is only about $2 for the prompt month contract, at least.
Yeah, I think unless you see a spiraling upward price for oil, the price shocks that you see for core inflation are going to be, to use the dreaded word, transitory. So, those are going to push up prices once, but on a month-over-month basis, I do think that the weaker consumer is going to put lower pressure on products where consumers have a choice whether or not to spend. So, I think some of the bleed through from headline inflation to core is going to be offset by the lower consumer demand.
So we get some FOMC minutes this week. Are they going to be relevant, and will they teach us anything about this committee, given that it's already changed essentially?
Yeah, I think they're less relevant than they have been in the past. And that's just primarily because Fed officials, particularly Fed voters, have been so vocal about how they view the economic trajectory. We don't really need the minutes from the meeting, to see where everybody stands. One thing that I would watch out for, though, is the Fed staff estimates. So does the Fed staff view the inflationary dynamics as being less transitory than they had previously? Do they think inflation is going to be stickier? That's something that I really think could shift Fed voters, especially on the board, throughout the course of the year.
What will we see in June? Are we going to see, a Fed chair that's more conservative, hawkish? Or are we going to see a Fed chair that's willing to maybe consider that this economy would be able to take a rate decrease?
Well, I don't think, to be completely honest with you, I'm not sure that Kevin Warsh is going to have a huge impact on the near-term trajectory of Fed policy. Through no fault of his own, the process of him being picked and him being confirmed was very much politicized. And I would assume that some of his colleagues would think that he's got some preconceived biases about being dovish. So I think he's going to have a hard time convincing his colleagues, at least in 2026, to bring rates down very quickly. There's a genuine divide on the Fed right now, and I think it's going to take a little bit of time for him to be able to swing those voters on the Fed. So his appointment, I don't think really changes my calculus about the near-term policy trajectory.
Well, of course, the yields at these levels also will do a little bit of the Fed's job for it in taming some kind of inflation, I imagine.
That's
Chris,
right.
what is the Natixis view on what happens with rates between now and the end of the year?
Yeah, ultimately, we do think, because we think that core inflation is going to stay within a very narrow corridor, the Fed's going to look more on month-to-month inflation. Of course, year over year is going to be elevated because of the price increases, but month-to-month inflation, I think, is going to be cooler throughout Q3 and Q4. We have the Fed cutting twice, actually. We see a little bit more softness in the jobs market, and because inflation is still high but not accelerating, the Fed's going to be comfortable cutting.
When are we going to see that labor market weakness?
Well, it's not going to take much, right? So we have the unemployment rate ticked up about 8 bips to still rounded 4.3. But demand for labor is still pretty low. So you have a lot of people dropping out of the job force, and that artificially keeps the unemployment rate fairly low. So I think any sort of upward pressure, which we think we're going to see in the next few prints, is going to put additional pressure on the Fed to cut, which, as I mentioned, ultimately, I do think we're going to get 2 cuts. Now, I don't have a whole lot of conviction about the timing of cuts, but I do have a lot of conviction about the directionality of Fed policy. So I think what's being priced in the market, which is hikes right now, is a little bit out there. I really can't see a path to the Fed hiking when wage growth is very slow and longer-term inflation expectations are still very well anchored.
It is going to be an interesting few months then, Chris. Thank you so much for joining us this morning, Christopher Hodge of Natixis. Now, to other top stories trending on the terminal this morning. New York City Mayor Zohran Mamdani is set to hold individual meetings with JP Morgan CEO Jamie Dimon and Goldman Sachs CEO David Solomon. The meetings are part of a string of conversations Mamdani's held with business leaders as he pushes for higher taxes on the wealthy. The spread of a bushfire in Southern California's Simi Valley is slowing. Fire activity has decreased significantly due to calmer winds and higher humidities. The fire nearly doubled in size over a 2-hour period Monday evening. Evacuation orders have been issued. The LIRR strike has ended. New York Governor Kathy Hochul says the MTA reached a tentative deal with 5 unions on wage increases. Some services will resume today at noon New York time. Coming up, President Trump calls off new strikes against Iran. For now, more on that next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to.
President Trump halting what he says were scheduled strikes on Iran after Saudi Arabia and other Persian Gulf allies wanted more time to pursue diplomacy. There was no immediate confirmation from Tehran of renewed talks. Bloomberg's Kasia Klimashinska is live from Washington. The president has repeatedly threatened going back to physical or kinetic warfare. Kasia, this is another example of it, but we haven't got there yet. Is there real optimism in D.C. that something is actually happening?
There is not much optimism here in Washington, D.C., and I think there isn't much in the markets either. I see Brent oil prices are stuck around $110. So the one thing we know is that the U.S. will not attack Iran today, but President Trump himself said that maybe he postponed this attack just for a little bit, for 2-3 days, or maybe forever. He said that there are talks going on. He also said that this particular delay came after a request from his Middle East allies, but we didn't get any more reports about exactly who is talking to whom and where there is progress. The one thing that came was this report that Iran floated that perhaps the U.S. is offering lifting sanctions on Iranian oil. But that I find it hard to believe. I find it hard to believe that the U.S. would agree to this. The one leverage that the U.S. seems to be having over Iran is cutting the flow of dollars or of funds to Iran because Iran is not able to get this oil out. So while we don't have any new military attacks, which I guess is good news, we also don't have any credible, reliable reports about whether there is any progress in negotiations.
So basically a stalemate. On the domestic front, the SEC apparently, Kasia, is going all in on crypto infrastructure. So it's apparently planning for more synthetic versions of stocks. So explain to us what's going on at the SEC.
We might hear more details about this week. The SEC is looking at what they call an innovation exemption, where they would allow basically much broader trading of tokenized versions of stocks, of real assets. That's like a big move in the crypto market this year, and we know that Trump and his family is very interested in those markets. The Trump administration has been supportive, cutting regulations for the crypto markets. So that's what the SEC is looking at now, whether to allow the trading of tokens of those assets, including the tokens that wouldn't have any backing or support of the companies that issue the stocks. So if that were to happen, it will be like this real-life, multi-year experiment of whether the trading in assets can move into the crypto markets.
Yeah, I mean, it's fascinating. It would likely be 24 hours. It would be a different way of discovering prices for stocks and so on. We'll see what happens. In terms of the drug pricing expansion, though, we did have the president making an announcement with Mark Cuban. Tell us what they both said.
Trump definitely wants to move the attention away from international issues, away from Iran and high gasoline prices, and he wants to talk about his affordability plans. One of them is these lower drug prices. All the presidents here at the White House are trying to cut the cost of healthcare and drug prices for Americans. This proposal unveiled at the White House yesterday by Trump and Mark Cuban, the billionaire, was about allowing Americans to buy more generic drugs directly from Trump RX website. So that would lower the prices for those generic drugs. This is new indeed, because previously what Trump has been doing was those deals with drug companies. So then that allowed Americans to buy some the original brand names via the Trump RX website. There are also some other efforts. Trump is, for example, trying to lower the gasoline prices by asking Congress to lift the federal tax on gasoline. We'll see whether Congress will go with that.
And Kasia, you know, as gas stays above $4.50, albeit pretty stable up there, we are seeing more state primaries. Give us the update on what we are looking at in terms of Georgia, Philadelphia, and some other states.
We have several primaries today. The most interesting one for me, anyway, today is in Kentucky, where Thomas Massie is up for re-election. This is a Republican lawmaker who has criticized and went against Trump several times, including on his signature tax proposal last year. Massie also sought the release of the Epstein files and is also a critic of the war in Iran. So he's up for re-election in a Republican primary today. President Trump has been actively supporting his opponent, and he has, in fact, sent his defense secretary yesterday to Kentucky to campaign against Massie.
All right, it's going to be fascinating. Kasia, thank you so much. Kasia Klimashinska there. Back to tech now. Firms are ramping up efforts to increase productivity and cut costs, they say, by utilizing artificial intelligence. So Meta is moving 7,000 workers into AI roles, but also cutting staff in other areas. Standard Chartered, meanwhile, announcing a plan to eliminate thousands of back office staff. Here's what Standard Chartered CEO Bill Winters said earlier, quote, "It's not cost cutting, it's replacing, in some cases, lower value human capital with the financial capital and the investment capital we're putting in. We don't have job losses, but we do have job role reductions in favor of the machines. And that will accelerate as we go forward into AI." Bloomberg's Neil Camping joins us now. I mean, that sends shivers down the spine, Neil. Not only are some humans lower value capital than just investment, I guess, but also, you know, it's going to turn in favor of the machines. Is that what we're seeing at Meta as well, or is it just Standard Chartered?
Morning, Bonnie. We are seeing this at a number of companies. Actually, we saw a few announcements last week as well. It's about efficiencies. It is really about the some of the tasks that you can do quicker, more efficiently, and more accurately with these AI tool sets than we can as humans. It's not necessarily going to lead to huge job losses. It's just in terms of job efficiency that you move some of those roles into more efficient processes. And to be honest, we've had that over decades in terms of where you've seen tech developments and advances. We just have more efficiencies in the actual systems in place. And in fact, if we are losing some of the lower intensity jobs, you can potentially retrain people to have more efficient roles, and perhaps even to code some of the future AI efficiencies that we need in this digital world.
Lower intensity might be a nicer way of saying it, though, than lower value, right? Let's get to the Google Blackstone deal. So what are they actually doing? They're creating some kind of an AI cloud firm with in-house chips?
Yeah, so this is about kind of competing with the neo clouds that are out there. Companies like CrudeOil, for example, that obviously was a very successful IPO last year. What this is basically an investment of $5 billion in cash, which actually then gets leveraged up. So it could be as much as $25 billion that Blackstone will invest in this. And this is all about generating that power that's required for data centers. The amount that we're talking about, the generation here, actually is very small relative to the overall capacity that's been announced so far this year. We are looking at over 100 gigawatts of capacity required over the next 15 years for data center power. So that's quite significant in terms of the amount of power that's coming on stream, huge increases. The amount announced so far this year is as big as the entire power output of the German economy.
Wow.
So it's very huge numbers. Yeah.
Gosh, that is great context for us, Neil. Thank you so much. Bloomberg Senior Market Strategist Neil Camping. Coming up, we have employment data and retail earnings on deck in your day ahead. That's next. This is Bloomberg.
trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now let's take a look at what's ahead for today. First up, we get ADP employment data. That's out at 8:15 New York time. We also get pending home sales coming out at 10 a.m. Plus some more earnings, Home Depot before the bell, and then Cava reporting after the market close. And then we'll be jumping on the Fed speak before the FOMC minutes this week. Philly Fed President Anna Paulson is going to be speaking. That's at 7 p.m. Eastern. Some movers before the bell now. That memory chip sell-off looking to continue today, down another 2.7%. I mean, relative to the gains, we're talking really small beer, but SanDisk definitely feeling the impact today. Blackstone a little higher on the news that it's creating an AI cloud firm with Google with in-house chips, as Neil Camping says, to compete with the Neo clouds. And then Hyperliquid Strategies moving this as the SEC is said to be readying a plan for more synthetic trading. That would benefit Hyperliquid or PER. Let's take a look at your macro environment as we head into the Tuesday session now. We have Brent crude still above $110 a barrel, and that is down. So we're down more than 1.5% at this point, but still above $110 a barrel. I think that tells you a lot about what you need to know about this market. That and the fact that yields are crawling higher once again. And NASDAQ 100 futures looking to continue yesterday's sell-off. The index was down 0.5%. That's it for Bloomberg Brief. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
We're seeing a bifurcated S&P 500 for sure.
The AI theme is best expressed right now in U.S. large cap growth stocks.
It's hard to know who's in a bubble.
We are seeing a weakening in the overall AI story.
If it is in fact a bubble, nobody knows when it will pop.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday, whipsawed by verbal intervention.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever, because we've had very big discussions with Iran, and we'll see what they amount to.
The White House claiming it's delaying planned military strikes, helping to reduce the tension and putting a lid on crude's advance as the Treasury is opening the door for energy-starved nations to buy some Russian crude.
Which is so interesting because the Treasury Secretary is meeting with his counterparts right now at Paris, and his opening remarks was about making sure that they up the sanctions when it comes to Iran, when this administration is extending a waiver to let countries buy Russian crude for another 30 days. Says to me, Jonathan, they are very concerned about potentially the premium we were going to see in the oil market that is going to drip into the gasoline market here in the United States.
The blockade phase, and we should call it that, has lasted longer than the so-called kinetic phase. The military strikes feel like a long, long time ago. The blockade phase comes with its own problems, so you need to do these tweaks here, there and everywhere to make sure that everyone's got enough energy. That's going to get more problematic in the months to come.
Which is why it was so interesting yesterday with an Iranian news agency coming out and saying the administration, as part of negotiations, were saying we're going to give you some waivers, lift some sanctions to get Iranian crude moving. Why would you do that if you had the blockade? I go to what UBS's Paul Donovan had to say. He said equities failed to rally because no attack is the status quo. Why did the president come out with this truth, saying that he's holding off on a planned military strike when he didn't tell the world that he was actually going to make that military strike?
The status quo comes with its own problems. You'll notice this morning that crude is pulling back just a little bit. Look at what's not happening. No rally in the bond market. No rally in equities. Yields are higher across the curve. 2s, 10s, 30s look like this morning. 10s back through 460, up by 2 basis points on the session. This from Citi. I see markets underpricing the risk of a Fed rate hike starting the year. Jim McCormick.
It's incredibly worrisome for some of these banks. They're now going from potentially we're going to have rate cuts to now having to price in rate hikes. This is another top discussion happening right now at the G7. The French finance minister basically put it, yes, energy prices are higher. Yes, inflation is higher. We might as well worry about low growth, a.k.a. stagflation. But you know what? On optimistic, and they were all smiles yesterday in a selfie, we're not in a recession.
Feels difficult, still difficult to internalize the prospect of a rate hike at some point this year. And I know I'm not the only one. Check out this language coming from Standard Chartered. We need to talk about this story. They're planning job cuts, and this is how they're communicating them. Bill Winters over at Standard Chartered with this quote. It's not cost cutting, it's replacing in some cases lower value human capital with the financial capital and the investment capital we're putting in. They have got to come up with a better way of talking about this than lower value human capital.
100%. This is not how you address your staff. This is not how you address the public. And if you are, say, a top-tier student coming out of university and you're getting offers across the banking sector, are you going to work for a company that regards you as low-value human capital that maybe you're going to be replaced in 6 months by a bot?
It's not a good look. Think about the commencement speech we saw over the weekend.
All the boos.
From the former Google boss and a host of other individuals as well, getting booed by the graduate class of 2026.
So you have these luminaries stand up on the stage and say, look, the future is going to be bright. What's happening in technology is going to be amazing. This is like an industrial revolution time. And the students are sitting there and they're booing. Do you know why? They're worried about job prospects. They're seeing their job prospects basically be evaporated by Claude, Google, Gemini, and the like.
Speaking of technology, the JP Morgan Global Technology Conference taking place in Boston. That's where Bramo is this morning. We'll catch up with Lisa a little bit later this morning, 6:30 Eastern Time. Kevin Brunner, the Global Chair of Technology over at JP Morgan. Do not miss that conversation. Equity futures this morning on the S&P slightly lower. We're down by 0.4%. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth as tech stocks slide. Bloomberg's Tyler Kendall as President Trump calls off fresh attacks on Iran. And Jeff Curry of Abax Markets on the next commodity super cycle. We begin this hour with stocks struggling to rally following back-to-back losses. Cameron Dawson of New Edge Wealth writing equities became overbought and narrow with an upside driven by a small cohort of names. This was a recipe for a pause in the recent powerful moves. Cameron joins us now for more. Cam, good morning.
Good morning.
Is that what this is, just a pause or something more than that?
Well, it's perfectly normal and perfectly prudent to see markets pause after having what was a very parabolic advance in a narrow cohort of names that were driving the vast majority of the upside in the overall market because they became such a huge weight in the index. And we were seeing certain extremes in some of this trading. You saw flows into leverage ETFs, option flows being very extreme. And you also saw this narrowness really not be consistent with an overall new high in market. So it made this fragile. We think it is a pause, but at the end of the day, when you have an over 18% weight in a cohort of names that went vertically up, a simple correction in those names back to trend could be damaging for the overall market cap weighted index.
Where do you think the bond market fits into this? New numbers again this morning. We're back to 460, 30s, pushing 520 now, getting closer at 515 and up 2 basis points today. Where does that fit into your outlook?
I think that equity markets were able to ignore the bond market and ignore oil as well for a period of time when it was effectively re-rating semiconductors after a huge upside move in those earnings, meaning that the earnings were moving up so much that you had the ability to look through everything else. Now you've effectively reset the earnings, you've reset the valuations on those semiconductor names, and so now the overall equity market has to look around and say, is this valuation consistent with a 10-year at 4.6%? And what does that 10-year tell us? Because it's not necessarily just because growth is coming in a little bit better than expected. It's also because inflation is coming in hotter. What does that mean for policy? What does that mean for financial conditions?
Well, let's get to the policy call. So I mentioned the name over at Citi, Jim McCormick. Of course, Andrew Hollenhorst will have his own view on things. I think they're still looking for 3 rate cuts. But from the market's perspective, do you think we're underpricing a rate hike and a rate hike that might come this year?
Yeah, the WIRP screen shows a 62% chance of a rate hike by the end of the year. You have a 2-year yield that's now about 30 basis points above the Fed funds rate. So we've been saying it's not a very warm, warsh welcome because that's a really tough position to be in when you are expected to cut rates. Now, there has been a little bit of an easing in some of the commentary, we think, coming out of Trump about the urgency to cut rates, which just means that we had been talking about the potential that Warsh could be pushed to dissent at his first meeting, which would be absolutely wild, a bit unprecedented. It seems like he now has a bit more wiggle room to say, given the movement higher in inflation, given the ability for unemployment to remain stable around 4.3%, that we don't have that same urgency. It really depends on whether or not you see inflation metastasize throughout the overall economy, meaning that core measures start to pull up in a more meaningful way that could get them to hike rates. We think for now it's a hold.
And he's getting sworn in on Friday, so potentially maybe that's why the president is lowering the temperature in terms of the rhetoric. But at the same time, he's going to be there without Steve Myron. Who would line up with him in terms of a dissent?
Yeah, it's a really good question because he's taking Myron's seat. So we effectively remove a dovish dot from the dot plot, assuming that the dot plot does stay around. But it does move the center of gravity of the Fed over into a more hawkish stance, which just puts him in a tougher position to be able to get everybody to coalesce around his views. You know, the question we have is whether the bond market believes in their willingness to defend the 2% inflation target. The thing that continues to catch our eye, look at 10-year break-evens. They're at the highest level they've been since 2022. They've moved up by about 30 basis points. That doesn't sound like a lot, but that is a lot for break-even since the start of the war. So the bond market seems to have a lot more consternation that maybe this new Fed isn't as serious as getting inflation back to that 2% target.
If the war persists, are they going to be forced to hike and not just look through this?
It depends, again, on the metastasizing of this inflation. If we continue to see inflation really just be in that headline number where it remains contained in energy prices, we do expect it to move into food prices, but not show up in other portions of inflation measures, then they can have this potential to look through it. It really depends, I think, also on wage growth as well. That's really the ability for higher inflation to be passed on and into other areas. And what we're seeing now is that wage growth remains anemic because the job market isn't necessarily as robust for new jobs. But the problem you have for consumers in that environment is that real wage growth is now negative. And so as you think about the consumption outlook through the end of the year, you have effectively little upside for consumers simply because real wage growth is negative. You're seeing that in the way that markets are trading as well. Equal weight discretionary versus staples is rolling over, and you're seeing a concomitant cut in consumer household consumption forecasts within GDP. They've gone from 2.1% to 1.8%. So the market is pricing in some of this consumer worry.
Do you think a lack of clarity around the incoming Fed chair and his personal view on his reaction function, so to speak, do you think that's complicating things as well?
I think it is to an extent. I mean, the old phrase is that the bond market always tests a new Fed chair, and potentially he was more dovish in the interviews and will be more hawkish going into it. But at the end, once he's in the seat, but this is a global phenomenon. Look at what you see, of course, with UK yields, Japanese yields. I thought that the Japanese GDP data was really interesting. It came in hot on real GDP. The GDP deflator came in hot. So you effectively have nominal GDP in Japan at 5.5% with a 2.8% 10-year Japanese yield. So as much as we're talking about what's going on with the Fed, the reality is this is a global bond market that has a lower and lower appetite for duration.
Japan, the UK, Germany. It's not just the US. Cam, it's good to see you. Cameron Dawson of New Edge Wealth is going to be sticking with us to respond to what's happening over in the Middle East in just a moment. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. President Donald Trump calling off what he says were planned strikes on Iran for today. Trump saying Gulf allies asked for more time to seek a diplomatic resolution, adding the U.S. remains prepared to attack if an acceptable deal is not reached. Home Depot shares are higher in the pre-market. The company did beat estimates on net sales in the first quarter. Sales at locations open at least a year, though, rising just 0.6%, and that missed estimates. Home Depot's core business has faced high housing prices and a pullback on customers taking on larger projects. Standard Chartered says it's replacing, quote, lower value human capital with technology. CEO Bill Winter is saying the bank will cut more than 15% of its back office roles over the next 4 years. And that is your Bloomberg Brief. John.
I don't think you need to call McKinsey to fix that one. Vonnie, thank you. Just get in a room and come up with a better name than that.
Yeah.
A better phrase.
That's not a good phrase. Whoever decided to give that advice to the CEO, I'm sorry to say it, that person should be fired. Maybe AI would have given him a better response
phrase than that,
honestly.
Yeah. That's not a good look. Up next on the programme, holding fire against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever.
Up next, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Kicking off earnings from the big retail players earlier on this morning, about 15 minutes ago. Slightly softer from Home Depot. Looking ahead, you'll get numbers from Target and Walmart. The big one, of course, coming up on Wednesday after the close, we'll have numbers from Nvidia. Heading into all of that, equity futures just a little bit softer, down by about 1/3% on the S&P, following a back-to-back slide on the S&P 500. Minor losses yesterday, very mild stuff, but still the first two-day losing streak we've seen so far through the month of May. In the bond market, yields still elevated. Up this morning by 2 basis points at the long end of the curve. 10s at 460, 30s around 514, getting closer and closer to 520. Even with this move in commodities this morning, pulling back on both Brent and WTI. Brent crude still around 110 and down by close to 2%.
So oil potentially is leaning into the fact that clearly this administration does not want to go back to strikes, does not want to go back to kinetic war. Everyone else is sort of confused. Is this, the boy who cried wolf once again? Because why did the president come out and say you're holding off on planned strikes when he didn't tell the American people he was going back to the said planned strike? So it felt like he was looking potentially maybe for something he gets usually with an Axios article.
Whipsawed by verbal intervention once again, and that's been the experience of the last 2 months. Under surveillance this morning, holding fire against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal.
So here's the latest this morning. The president pausing planned strikes on Iran. The decision giving Gulf allies more time to continue diplomatic efforts with Tehran. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John, good morning. Well, President Trump says that this planned attack is off for now as he credits these regional allies for pushing for a deal. Saudi Arabia, Qatar, the UAE have all repeatedly been targeted amid this conflict. But keep in mind, the president did keep the threat of escalation on the table, going on in that post on Truth Social to say that he advised his national security team to be ready at, quote, a moment's notice for a large-scale attack. At this point, the White House didn't provide any additional details to us on what this planned attack would have entailed, as the president has long maintained that there could be the threat of military escalation, while also maintaining that a diplomatic solution is still viable. I will point out that our own analysts at Bloomberg Economics say that their analysis is that the White House very likely could revert to short and intense strikes in a bid to change the status quo, amid reporting that the president has been advised in recent weeks that limited strikes could help push Iran to the negotiating table. Because the latest is, just yesterday, both sides did reject the freshest counter proposals, as Iran says that it is not interested in negotiating around curbs on its nuclear program, and the U.S. says its naval blockade isn't going anywhere. In fact, CENTCOM confirmed just yesterday that so far the U.S. has redirected 85 commercial ships in its efforts to secure the strait. John, we're hearing from these regional allies. We'll see if any other headlines come from other countries later today, as Russian President Vladimir Putin visits China, where he is expected to discuss the ongoing conflict in Iran with Chinese President Xi Jinping.
Tyler, price of gasoline up again today, $4.53 as we go into Memorial Day holiday weekend. What's the administration doing when it comes to gas prices?
Well, Anne-Marie, at this point, President Trump has proposed that we could see a temporary suspension of the federal gas tax. It is our understanding that lawmakers are set to unveil new legislation related to this in the coming days. But at this point, we don't really have a firm timeline on when that would pass. And there are some questions on just how big an impact that really could have. This is an issue that has been plaguing the administration. As we know, affordability remains the top concern as we head into the midterms. A very pertinent conversation for today as a flurry of states are holding their primaries. And we know that President Trump is facing the pressure when it comes to the cost of living. Still, many Trump-backed candidates are winning their primaries. And the president at this point is trying to urge patience with the American people, saying that this will only be a short-term disruption, as we know that those costs are still filtering down.
Tyler Kendall with the latest from the nation's capital. Tyler, thank you. We need to define what short-term disruption is now. We're 2 months into this, approaching 3 months, and maybe going through the summer. A lot of people at the beginning thought that 1 month was too long, 1 month too long, and now we're in multiple months. And at some point, you have to sit here and say this is not about the short term anymore. This is the status quo and it continues.
You have to plan for the rest of the year, basically, and maybe as well into next year. When you talk to the administration about this, they quickly push back and rattle off the Iraq War, Vietnam, Afghanistan, et cetera, and they say comparatively this is very short. The issue is, when they presented this to the American people, they said it was going to be an incredibly short, just a few weeks. And now, to your point, we are months into this conflict.
So how does the consumer feel about things? We know the sentiment, if you look at you, Mitch, is rock bottom at record lows. We'll get corporations reporting throughout this week. We had Home Depot a moment ago, weaker than expected. You'll hear from Target and Walmart later this week. Cameron Dawson of New Edge Wealth is still with us. Cam, when you look at the data, what are you paying attention to and what are you ignoring with regards to how the consumer feels and what the consumer's doing?
Yeah, well, the mantra over the last 4 years has been watch what they do, not what they say, is that sentiment has been in the doldrums for quite some time, and yet they've continued to spend. I think the big question is now that we're back in this period where real wage growth is negative, do we see spending start to moderate? We go back to the last time we had negative real wage growth, it was back in 2022 during the last inflation spike. The difference with 2022 is that savings overall were higher and you had a more room for the savings rate to drop. So effectively there was a cushion that consumers had to dip into in order to keep spending, even though real wage growth was negative. The big question is as we go into this summer, could we see them start to pull back on spending? Does that start to show up in things like economic surprises? Remember, there's a really tight relationship with economic surprises and the 10-year yield. So if you're looking for a bond rally, that could be the source of it.
What's the relationship between that and the stock market, weighted to something very, very different away from the US consumer?
When we think as equity investors of when geopolitical events matter, it's when you have a prolonged increase in oil and retail gasoline prices that eventually weighs on GDP and eventually weighs on earnings. And that's been the disconnect this time around. We're cutting GDP estimates, but we're raising earnings estimates, not because the economy is necessarily holding up broadly on a better basis. It's because you have this one cohort of names, being the semiconductors, who are seeing massive earnings estimate upsides. You've seen the SOX increase its 2026 estimate by 42% this year. That masks a lot of weakness under the surface. And you see it within the GDP line as well. Look at household consumption forecasts going down, but private fixed investment going up. So were it not for AI, this would be a very, very different story for the economy as well as the overall equity market.
You mentioned, Cameron, what happened last time we saw higher inflation and consumers went into their savings. Aren't they getting tax refunds that are bigger than they normally would this time around? How is that helping them?
Well, it's effectively helping to offset some of the increase in oil prices. What effectively the math has been working out is that the increase in gas prices has effectively offset the benefit from the OBBB. The big question is how long do these gas prices persist? It is a duration question. So now that we're effectively offsetting those tax cuts, if we continue to see oil prices and gasoline prices remain elevated through the end of the year, we're watching the Brent December futures like a hawk, effectively saying that's the market finally coming around to the fact that this could be a more prolonged issue. And if you continue to see high gasoline prices, then that's where you'll start to see the pain. So it all comes down to duration.
At any point, will higher gas prices hurt the likes of a company like NVIDIA that are holding up the S&P 500?
Yeah, we'd like to think that we all do breathe the same economic air, but it's multiple steps away. I mean, the people who are paying for all of this capex are companies like Google and Meta, who are primarily advertising companies. Meta's 98% of its business is coming from advertising. That is a cyclical business that is, in fact, related to overall economic growth. Don't forget, Meta had negative revenue growth in a year like 2022. So if you were to see more pronounced economic weakness, then certainly it could filter through, because the reason they've been able to spend so much on NVIDIA chips is because their core business is so strong because the economy has been holding up.
Cameron Dawson of New Edge Wealth. Cameron, it's good to see you. Thank you. Reminded me to look at the December futures contract on the Brent curve. Looking at the Brent futures curve, we're trading above 90 all the way out through December. That contract right now, as I'm looking at it, 91.55.
Markets starting to wake up that this might be a prolonged conflict, or at minimum, this might mean that structurally it has changed in the region, where Iran has a bigger control of the Strait of Hormuz, and it might not be smooth sailing as it once was. And you have to start to incorporate more geopolitical risk premium into the oil price.
Won't be smooth sailing for Kevin Walsh either over at the Federal Reserve. This is why things are slightly different compared to how they have been over the last 10, 15 years or so. The last few Fed chairs have come from the existing Federal Reserve Board. So they aren't unknown entities, so to speak. Neither's Kevin Walsh, but this is slightly different. He hasn't been on the board for a long, long time. We understand his views, but only really in media circles when he's sort of having a go at the balance sheet and QE and things like that. We don't really know what Kevin Walsh stands for coming into this Federal Reserve. Things are slightly different compared to what we knew about Powell and what we knew about Yellen.
That's why this first meeting is going to be fascinating. Is it the Kevin Walsh that we knew when he once was at the Fed, who was a hawk, or the individual that interviewed the President of the United States and gave testimony that sounded very dovish? Which Kevin Walsh is actually going to show up?
Yields slightly elevated across the curve again this morning. 2s just north of 4%, 10s back above 460, and 30s. 30s just feel unhinged worldwide at the moment. The long end of the curve feels very untethered. Yields up by 2 basis points, 514 on 30s. Up next, we'll catch up with Kevin Brunner of JP Morgan on the outlook for tech investments and M&A.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, But when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Pulling further back from all-time highs on the S&P this morning, negative by 0.4%. Back-to-back losses on the S&P, the first two-day losing streak of the month so far. Yesterday's losses very mild. A turnaround in the equity market as we got a bit of verbal intervention from the president about delaying planned attacks we didn't know were even happening. In the commodity market right now, crude pulling back, Brent and WTI. Brent down to 110, down by close to 2%. You take that screen and typically you can predict what's happening in the bond market. Not this time. In fixed income at the moment, 2s, 10s, 30s, yields creeping higher. At the front end of the curve again up by 2 basis points. 10s still around 460 and 30s north of 5%. Your 30-year yield up by a basis point or two. More on the bond market a little bit later in the programme. That's across asset price action. Let's get you some single names, some morning movers. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Well, let's start with a little read into the consumer, and particularly an interest rate sensitive area, right? So Home Depot out with earnings. It's actually higher now, but it did miss estimates in terms of comp store sales. They were up 0.6% as opposed to analyst estimates for 0.9% of a gain. Consumers just not buying those big houses or engaging in those massive projects in their houses, right? But they are doing a little gardening, and so things weren't all that bad. As I said, Home Depot holding on to its guidance for the full year, and basically margin guidance as well is what it had said earlier. Now, that does miss estimates. We'll see what executives say on the conference call that's scheduled for 9 a.m. Eastern. Let's move on because we have another AI deal today, and in this sense, it is an AI infrastructure deal. So BlackRock, through its funds, investing $5 billion with Google in order to gain access to Google TPUs through an infrastructure project. It will be competition really for CoreWeave. So CoreWeave selling off just a little bit today, although CoreWeave has had a lovely run up, but positive for both of these players. Blackstone expects to see 500 megawatts coming online by next year. It's a massive amount of energy. And then let's take a look at the memory chip makers, because of course we saw the Seagate CEO's comments yesterday caused a little bit of a sell-off for that stock. It was down almost 7%. He basically said, look, we're not going to be building massive factories. It's probably not going to be worth it. It's going to take too long. It's going to be 5 years before they're online, and at that point, who knows what memory chips will cost, causing another little bit of a sell-off today. But I mean, in relation to the run up in these prices, I mean, if you look at just SanDisk alone and Seagate, they've been up multiple hundreds of percent. Micron up 600%, 3,500% gain practically for SanDisk over the last year. So I think they can sell off a couple of percentage points. It won't break the bank, John.
Hey, Vonnie, thank you. Appreciate it. Massive run up for those names. A bit of negative follow through so far this morning. On our radar this morning, President Donald Trump calling off a planned strike on Iran after speaking with Gulf allies. Trump announcing a pause for, quote, 2 or 3 days, saying the countries are very close to reaching a deal.
If we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
Tehran yet to confirm the latest round of discussions. Elsewhere, Standard Chartered set to cut its support staff by more than 15% as it builds up its use of AI. The CEO, Bill Winters, saying the bank is replacing, quote, lower value human capital with technology.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
The job cuts would take shape by the year 2030. And finally, the NVIDIA CEO, Jensen Huang, is saying he expects China to open up its markets to imports of American AI chips. The CEO speaking with Bloomberg's Ed Ludlow following his visit to Beijing with President Trump.
My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
China, notably, yet to sign off on accepting NVIDIA's H200 chips following the US greenlighting access for some firms there.
They greenlit it, the United States, in January. Then once again in March, NVIDIA said that they did get some orders. But then those customers went to NVIDIA and said, actually, we're not allowed to go through with the purchasing orders. So now we wait and see if the summit produced potentially China and the CCP telling these firms they can buy it. For Jensen Huang, he's definitely hopeful because NVIDIA said that it's a $50 billion opportunity when it comes to China. The real question I have is China worried about national security risks within their own market? Do they want to make sure that they could almost ring fence their own AI? Or do they feel like they don't even need the U.S. chips anymore? And if that's the case, how much leverage has the United States lost at the negotiating table?
NVIDIA, a difficult couple of days, down slightly again so far this morning. Let's talk about technology. JP Morgan holding its annual TMC conference over in Boston. Bramo's there at the event with a special guest. Good morning, Lisa.
Good morning, John. Thanks so much. I am here in Boston at the TMC conference held by JP Morgan with the global chair of investment banking and mergers and acquisitions, Kevin Brunner. Thank you so much for being here with us today.
Thanks, Lisa. I really appreciate it.
So,
thank you for being here, by the way.
Well, this is such an interesting moment because it seems like the AI cycle is driving everything right now. You've been working on tech M&A for 25 years. How is this moment different than previous ones?
It's completely different. It's impacting every client that we have. There's not a client that we talk to that's not actually thinking through where they are in the landscape, what's their long strategic narrative, and how they're going to adapt to a changing environment.
What's driving most of the tie-ups right now? Is it the idea of trying to get economies of scale? Is it to shore up cash to invest more efficiently? Or is it just sort of a quest for survival?
You know, I actually think the M&A market could be defined by selectivity, scale, and really creativity these days. And so we're obviously seeing strategic acquirers be highly selective in where they're putting their capital use. The deals they're doing are actually done with high conviction, and they're actually changing the long-term narrative for a lot of these companies, and that's probably the number one focus. At the same time, scale's very important. So cash flow to be able to reinvest in the business is very important. We've seen the equity markets really embrace what I would say is scale overall. And frankly, when you're going through business transformation at the same time, scale's been very important to be able to fund that. And then creativity's been the most interesting part. We've seen deals of all type, minority investments, we're seeing collaboration, we're seeing consortiums do deals together, we're seeing partnerships, a lot of structure, and that creativity, I think, is something that's really very interesting to me as we look forward.
What are some of the barriers to these tie-ups? I mean, how high is the threshold? We've been talking all about how bond yields have been surging to the highest levels going back to 2007, at least in the 30-year in the U.S. Globally, you're seeing long-term yields rise. At what point does that stymie some of the activity in deals that we've seen so far?
You know, I think capital has not been putting a barrier on M&A whatsoever. Obviously, we have a constructive regulatory environment. And at the end of the day, I think while we're trying to balance all the geopolitical and all the macro issues that are out there, at the same time, it's so imperative that many of these companies change their long-term strategic narrative, that we're seeing people push forward, do deals of size, and making sure they're actually repositioning themselves on the chessboard for the path forward.
We've seen a lot of mega deals so far this year. That has been the driver, at least in the overall volumes. Is that the same in technology? Does it have a different flavor?
Yeah, it's a great question, because technology a little bit is a tale of two cities. AI is actually a catalyst within technology, and it's also a disruptor. So we're actually seeing those companies with AI tailwinds be very acquisitive, adding capabilities, adding different tools to their system, and making sure that they're continuing to reposition themselves to be the leaders that they are today. On the other side of the technology market, we've obviously seen a little bit of a pause. We've seen people assess their own business models. Where are they in this evolution? But I actually think that uncertainty as we go forward is going to actually turn into differentiation in the marketplace. And that differentiation is going to lead to continued consolidation, more traditional M&A activity, I think, in the second half. And we're really enthused about that.
Can you put some specifics around this in terms of what we're actually talking about? I mean, is it the hyperscalers versus the software guys that are all fighting for survival, that are all going to try to band together or else die?
Well, let me tell you where we think we'll see differentiation on the software side, right? So we're going to see, obviously, companies of scale. We'll see mission-critical platforms come through the other side. We'll see systems of action, right? Obviously, I think there's a lot of discussion around SaaS moving to an outcome-based platform. We'll also see what would be companies with data moats come out the other side. And that differentiation, obviously, we went through one earnings season. We're going to go through another one here in a couple months. And I think we're going to lead to those that are actually have reassessed their models. They put the moat around their business. And I think those are some of the characteristics we'll see.
Would you say in the next year this is going to be a big shakeout period where some of these models get put to the test in the way that they haven't so far? Which are the ones that actually can be deployed in an effective way and those that can't and that ultimately go away?
100%. I think we're going to continue to see, and maybe see even a little bit more than we have today, the capital kind of focus into the winners. And this is more on the hyperscalers, the large providers, really building out the infrastructure. On the other side of the market, we're going to see consolidation, right? As we hit that point of differentiation, we're going to see the winners. The winners are going to be acquisitive. The winners are going to add to their portfolio. They're going to apply the same techniques that they actually applied to their own business, and we'll start to see them build their scale along the way to have all the benefits that we were talking about previously.
How much pushback are you starting to see from investors, whether it's the private capital or whether it's public markets, in terms of financing some of these transactions, given how much risk is coming in and given the competition for capital elsewhere?
Yeah, investors have actually been very resilient. Investors obviously on the top of the market, right, where there's a lot of growth and there's a lot of AI tailwinds, everyone wants to participate. We've obviously seen a pause on the other side of the market where the transformation's taking place in the business models. But as that differentiation starts to happen, we're going to see investors be very focused. I mean, I expect, take private equity, for example, let me back up. Private equity actually has been very focused on being patient, assessing their own business models. They're part of the creativity I talked about. But as we move through to the second half and we see that differentiation, I think we're going to see capital for take privates. I think we're going to see capital for consolidation. And I think that'll come from both sides of strategic and financials.
Do you think that we're going to see also a lot of failures among some of the private equity firms that have had companies that have not gone public for a very long time because they couldn't reconcile the valuation that they were booking versus the valuation they could get in the markets, and they have to kind of do something with that in order to free up cash to be able to go out there and do something?
Well, a number of the private equity veterans are obviously very AI savvy, very focused on the transition. We're actually reading now, about some of the new announcements, partnerships, collaborations that are taking place. And I think we're clearly going to see some winners, but with all success, there's obviously some that'll be on the other side of it.
This is one of these annoying questions that help benchmark where we are. Where are we in this process? I hate using the innings kind of analogy, but yeah. I'm going to use the innings analogy. Where are we in this process of build out with respect to AI?
It's still early, but as I look at the conversations taking place here at the conference, we've really moved from it just being AI, agentic, infrastructure build out to actual execution and scaling as part of the plan. Every company here is very focused on what's their long-term strategic narrative and are in the early stages of doing so, but we've actually gone from hype to real execution and scaling.
This, to me, is a fantastic moment to be speaking to all of you. Kevin Brenner, thank you so much for being with us. Kevin Brenner there, the Chair of Investment Banking and Mergers and Acquisitions. John, I will send it back to you.
Lisa, thank you. Great work. Looking forward to Lisa's coverage throughout this morning from Boston. From New York City this morning, let's get you an update on stories worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. 3 people were killed in a shooting outside an Islamic center outside San Diego. Authorities say 2 teenage suspects were also found in a car with apparent self-inflicted gunshot wounds. San Diego's mayor is saying there'll be extra police protection at local mosques. EU officials meeting today to try and finalise legislation for a trade deal with the United States. They must reach an agreement by July 4th to avoid triggering higher tariffs threatened by President Trump, who previously threatened to raise those levies on European auto imports because the EU hadn't moved quickly enough to implement the deal. Fund managers boosting their stock allocations by the most on record. The May Bank of America Fund Manager Survey shows managers are the most overweight equities since January of 2022, and they've made big cuts to their cash levels. The survey identifying inflation as the biggest tail risk. That is your Bloomberg Brief. John.
Hey, Vonnie, thanks for the update. More from Vonnie in about 13 minutes' time. Up next on the programme, AI meets the physical world.
If we're getting to a point where we don't have enough supply, what that means is there's more duration
to the good news. We can't be in a bubble if we don't have enough capacity to supply all the demand right now.
Up next, we'll catch up with Jeff Curry of Abax Markets from New York City. You're watching Bloomberg TV.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
The losses resume. We're down by 0.5% on the S&P. On the Nasdaq 100 this morning, pulling back by some 0.8. On the Russell, small caps, negative by 0.7. Under surveillance this morning, AI meets the physical world.
Memory is one of the main areas of constraint right now because there's not enough physical clean room space to put the tools in place to build all the memory we need for AI. Months ago, the big concern was that we wouldn't have enough demand. Now, if we're getting to a point where we don't have enough supply, what that means is there's more duration to the good news. We can't be in a bubble if we don't have enough capacity to supply all the demand right now.
So here's the latest this morning. The Seagate CEO, Dave Mosley, issuing a warning for the AI build-out. Mosley telling a JP Morgan conference that building new factories would take too long. The comments weighing on memory and hardware makers after plunging in Monday's session. Jeff Curry of Abax Markets writing, capital has chased the AI trade while ignoring the physical assets it requires to run. Assets that have quietly become the best performing asset class of the decade. Jeff joins us now for more. Jeff, welcome to the program. I've been excited to catch up with you, sir. I think we need to take a giant step back and think about the mining bust post-China boom. We need to think about the shale bust of a decade ago and why that set the stage for this period of what you call capex starvation. Just where are we and why?
Well, when you look at history, going back the entire post-war era, there's two sectors that lead the equity market. One is energy, the other is tech. If you can't turn on the lights, nothing happens. If you can't innovate, you never progress. And that's what you see. So we go back. Tech was a leadership in the 90s all the way up to 2002. Then we transitioned into energy. 2002 to 2014, 14 to now has been technology. And the way you think about it is in those periods when energy lead and commodities lead, you build overcapacity. That lowers the overall price. Inflation gets low and stable. Interest rates drop. And investors chase duration, which is growth stories, tech, and the rest of it. But eventually you run out of energy, run out of commodity capacity. And that's where we are today. With this geopolitical event, it just pulled forward. And Jonathan, we've been on here talking about the revenge of the old economy over and over and over. This rotation out of tech into hard assets, that was already underway before this happened. What this did is just accelerate it.
As you know, Jeff, discipline has really hardened at some of these C-suites. What will it actually take to break out of this capex starvation phase that we're currently in? And do you see us breaking out of it anytime soon?
Higher prices, higher returns. But ultimately, you ask, what creates that huge upward trend in prices that you saw in the 70s and you saw in the 2000s? It's once investors take capital out of tech, dump it into commodities, they begin to spend, and then you get cost inflation. The PPI that came out last week at 5.1% is telling you you're already seeing signs of it combined with the huge supply shock that you're seeing in the Middle East. So in terms of thinking about where we are on that, we are just in I'd say the bottom of the first inning of the super cycle, despite the fact commodities are the best performing asset class this decade. So you're already 6 years into it in terms of pricing. And when we think about the forward, you've probably got another decade to 12 years left, just looking at history.
Jeff, this is important. Let's just compare what's happening with tech then. So I imagine you think as capital intensity picks up, capex intensity picks up at the tech players, we get a re-rating. And then you get the rotation into the more energy-sensitive parts of the market, the mining sector, the energy sector. We're not seeing that equal and opposite move, though. In fact, Jeff, those particular parts of the market have lagged so far. That's interesting to me, that the energy names haven't done much at the moment. What gives?
I think right now there is no concern about the supply of energy and commodities. Even with the largest supply shock the world has ever seen, 2x what we saw in the 1970s. And I think there's three reasons why they're not concerned. One, we're in the middle of the shoulder months. This is the weakest demand that goes down and then back up. We're in that weakest demand part of the entire year right now, so there's no stress on the system. The second reason is right now we're in a deficit, meaning that demand's up here, supply's down here. We're drawing inventories. Once you exhaust inventories, boom, you have to push demand down in line with supply. That's when the shortage hits, that's when the pain hits, and that's when prices go nonlinear. The third point I want to talk about is that every policymaker, macro forecaster, central banker, tech promoter is telling you right now there is no problem. Every commodity CEO, commodity trader, anybody who gets their hands dirty is telling you you have a problem. You have seen this movie before back in 2020, 2021, when, remember, inflation is transitory. And then, a few months later, boom, you hit the wall and, we went to double-digit inflation. And I think you're seeing the same dynamic here. One last point, though. Carter in 1977 made a fatal mistake. It was the sweater speech. It was, February 1977. He was wearing a sweater kind of like this. Went out, was brrr, and told everybody, turn your thermostats down, and then prices of commodities explode. And I think every policymaker has learned from that, you don't want to create fear. My job is, if I was advising the president, telling him to do the exact same thing, keep everybody calm. But my job is telling you how to make money. And at this point right now, this is really serious.
Yeah, Trump definitely doesn't want to come out, especially with the 95-degree weather, saying don't put your air conditioners on. But Jeff, you say that at this moment, supply has never been more constrained, yet Brent can barely hold on to 110.
Again, you have that seasonal weakness right now. You're not in a shortage. But another really important point here is because nobody is buying the energy companies. In the back end of that forward curve is anchored to the cost of capital of those companies it is too low. And, you know, I call this the biggest asymmetric trade in modern finance in historical terms. Why? When you look at the free cash flow yield of the oil companies, they're 15.5%. The hyperscalers are 0. Let me say that again. 15.5% free cash flow yield for the oil companies, 0% for the hyperscalers. We call those oil companies the Munificent Seven. What does munificent mean? Giving you lavish gifts. And at 15.5% free cash flow yield, I'd call that a lavish gift.
And just when it comes to supply and demand, you mentioned this, it's going to get rough when inventories are drawn down. When will we hit tank bottoms in your analysis?
It depends on where you are in the world and what products. Some products, you're already there, like motor oil in the U.S. And by the way, motor oil in the U.S. is critical because parts of the world, jet fuel, you're there. We would expect to see here in Europe, diesel and jet fuel run into very serious problems by the end of this month. The United States, gasoline by July. And at that point is when you start to get to that nonlinear part and see prices go higher. But I want to emphasize, when we look at the spread between spot prices and the back end, this spread has never been higher. And everybody goes, oh, we had, prices were at 122 in the Russian invasion. By the way, the back end of the curve was $10 lower. And then everybody goes, we saw 147 in 2008. By the way, the back end was at like 140. So 147, 140. What is mispriced here right now is the back end of the oil sitting somewhere around 70, 75. This is a long-term problem. The cost structure is going to go up. There is no spare capacity left. It's going to take a long time to reestablish it. We need to reprice that market. That's going to reprice the Munificent Seven. That's why I tend to think the trade here, just looking at pure economics, has the most upside to actually own these oil companies.
Jeff Curry, fired up. Jeff, when you're next in town, you need to co-host the program with us.
Yes.
Looking forward to that. Jeff Curry there of Abex Commodity.
The major macro indicators are actually pretty strong.
Begrudgingly, the consumer has held on to their spending trends.
The U.S. consumer is in a better position than most of the world.
The bond market is definitely, the narrative is driven by inflation right now.
I don't think that these interest rate levels are helpful, if anything.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Two-day slide on the S&P 500, negative this morning on the S&P by another third of 1%. In the bond market, yields elevated through the curve. 2's around 4%, 10's around 460, 30 still north of 5% on a 30-year yield in America, a number we haven't seen for quite a while. You've got to go back to 2007 for yields that elevated at the very long end of the yield curve stateside. The problems in the bond market, not just a problem for the US, a problem for the UK, for Germany, for Japan as well. Japan, the one to watch through the week so far. In the commodity market, check out crude this morning, Brent and WTI. Brent crude is a little bit lower, WTI as well, but that's not unlocking gains in this equity market. That asset class whipsawed by the verbal intervention of the last 24 hours.
Once again, how many times have we been here from verbal intervention from this White House? The president coming out and saying that at the request of Arab partners and allies, that he is going to hold off on our planned military attack on the Islamic Republic of Iran, which was scheduled for tomorrow. What I find so interesting is no one knew about this scheduled attack, but the president decided to tell us he's holding off on an attack that no one was expecting. For the oil market, though, this obviously everyone is clinging to the fact that this White House wants to wrap up this conflict. On top of that, they're also extending a Russian sanctions waiver to allow more Russian crude to stay on the market.
And there's an important why to that. You have to keep massaging the story. Find little pools of crude and energy here, there and everywhere. Unlock them while you can, just to make sure that this crude price, this move, doesn't get away from you. We heard from Jeff Curry, legend of the commodity market, about 10 minutes ago, talking about how much time we have left before this becomes an even bigger problem. It hasn't become an even bigger problem because we've been drawing down inventories aggressively, not just stateside but worldwide, over the last 2 months.
Yeah, we're living on inventories right now. We hit tank bottoms on these inventories. That is when the commodity complex is going to get incredibly challenging, and we can see parabolic moves. We could see. We don't see them yet. What is important to keep in mind is that depending on where we get into the inventory levels, how low we get, depends on where you live. And that's what Jeff Curry said. That's what we heard from Michael O'Leary yesterday. It's going to be much harder in Asia, as it has been, and then it's going to ripple through to Europe and then potentially pockets of the United States.
Stock so far this morning, slightly softer, not a major move. Think about the run-up. The run-up's been absolutely massive. The losses have been muted, very mild yesterday, adding to the losses on Friday. 2-day losing streak could become day 3, down about 1/3 of 1% on the S&P 500. My port in the storm, my bullish port for a long, long time has been Steve Orth of Federated. And Steve has this to say: stocks can pass through and or manage inflation, especially when productivity is booming due to AI. We're raising our forward earnings and market targets despite persistent inflation worries. I'm pleased to say that Steve joins us around the table. Steve, good morning.
Good morning, John.
You're the guy I turn to and have done for the last decade or so to kind of get me out of this bearish mess or this hole I've dug myself into. Why can you still be optimistic in a moment like this one?
Well, you know, I was thinking this as Anne-Marie was talking about hitting bottoms on tankers and things. We have an expression at Federated Hermes: if it can't happen, it won't happen. And sometimes you can outsmart yourself. You know, you're looking at everything and saying, you know, this looks really bad, but we're not the only ones who see that. And so I have to assume that some combination of Donald Trump, President Xi, the whole crowd, this is not good for anybody. And so I don't think we are going to run out of oil. I think they'll figure out a way to solve this one way or the other.
As you say that, I'm reminded of what happened yesterday, this Iranian report that part of the negotiations, this is what the Iranians were saying, the United States was willing to give waivers to Iranian crude. If the situation gets so bad, they're just going to let crude go freely from their enemy that they're in a conflict with?
Well, I think that they do whatever they have to do to have this not be an issue. And in the meantime, the other thing that I think people are sort of missing here is bond yields are up because inflation's up. But bonds are the asset class with a problem, not stocks. Stocks have always been an inflation hedge. It really doesn't matter what inflation is doing. If you look at the data and sort it, as long as growth in earnings is strong, stocks go up. Whether it's driven by inflation or driven by real growth, it doesn't really matter because stocks eat nominal earnings. And look what just happened, you know, in the last earnings season. 8 of 10 sectors had double-digit earnings growth. People talk about a narrow recovery, and it's one of these fallacies where people look at percentage moves off of lows. Absolutely off the lows, the AI stocks have driven the rally. However, year to date, and I was kind of laughing, during your last telecast, you're talking about how it's AI-led, and in the background, they're showing the returns on Exxon, up 33% year to date. Year to date, value stocks, small cap stocks, emerging market stocks have all performed double-digit ahead of the Mag 7, which is up 8%. So this is not simply an AI-driven rally. It's a broad rally. AI itself is spreading out. The AI theme keeps spreading from one thing to the next. It's all over the economy. This is one of the biggest technological changes in the history of man. And the trajectory of earnings right now, based on what we're seeing and what has been coming out of the street, as street estimates keep rising every day we go through earnings season, we found that our number, we had a number, we always use a 3-year out earnings number to project a 2-year forward market return, which at the time we were at 8,200. The number keeps going up. We had a $400 earnings estimate for 2028. We were way ahead of the street 6 months ago. You know, I woke up Monday morning and we're behind the street. How could that be? The street's now at 425, so we're at 450. If you look at the numbers, that's what's happening. Stocks are passing through, and productivity gains are helping them, you know, pass through. And their margins are going up, not going down.
Steve, this is the struggle people have, and I had this conversation with Alex Altman over at Barclays, that we seem to be putting more emphasis on how we've got here and not enough on where we are. And a good example of that is, say, look at the charts versus look at the numbers. If you look at the charts and look at the parabolic move, particularly in chips, coming off the March low, you can see why a technical strategist becomes a little bit unnerved about how detached we've come from the daily moving averages.
Yeah.
But if you look at the actual numbers, there's a source of comfort there. Do you have that struggle speaking to investors at the moment? They struggle to detach one from the other and just focus in isolation, look at where we are, and where we are is okay.
Right. I try to focus our clients on where we're going, and that, I think, helps calm everybody down. For sure, as a technical strategist, and all the ones we work with are all telling us, you know, we're overdue for a pullback after a sharp run-up. Absolutely. Absolutely. And one reason we'll put out a bullish note like we're about to do here, you mentioned our new target on the S&P 9,000, is we're almost anticipating a correction. And we want to get ready, get people ready for that. And actually, the situation in our mind is actually getting better, not worse. Technically, we're certainly overextended. Could be a pullback. But it's never as deep as you'd think it's going to be.
You've alluded to the challenge, though. You need to think about pricing this market for the economy we'll have 12 months, 18 months out, further down the line.
Yeah.
Not the one we've got. That's another struggle for a lot of investors. They look at the economy we've got, they look at the energy price move, they hear Anne-Marie, the prospect of things getting a little bit messy later this summer, and they struggle.
Much less Lisa's not here.
There you go. It could have been even worse. They struggle to think about where the economy will be 12 to 18 months on a rolling basis. Just walk us through your discipline with regards to that.
Yeah, well, we just look at the underlying, what's going on in the economy and in the companies, because we're talking, our analysts, we have 170 PMs and analysts in the equity group at Federated Hermes, so we're talking to companies every day all over the world. And what they're telling us is that the situation looks pretty good. They're all seeing their sales are expanding, their earnings, their margins are going up, and their earnings are going up. And it looks to us, as AI gets more and more adopted into the economy, that margin expansion trend is going to continue. This is one of the things that has made us more bullish than the average bear or the average market investor. Most people keep talking about peak margins. We've heard about peak margins for a decade. And yes, that has always been true. Every time someone has said that, we are at peak margins. And guess what? The margins keep going higher because the mix of companies in the economy is getting increasingly mixed towards higher margin businesses, and even the older companies are improving their margins, partly because they're using AI.
Do you think this story can continue in the way you're describing it if the Federal Reserve has to hike interest rates?
Yeah, I think, well, I don't think the Fed is going to hike interest rates, so that's a loaded question. But even if they did, yeah, the market would probably have a quick
do you think
pullback.
they're going to cut?
But I said earlier, I think bonds have a problem, not stocks. Stocks are growing their earnings at double-digit rates. Bonds can't grow their revenue stream unless there's a rate hike. In fact, they need to get bond yields higher to compete with stocks. That's been the problem.
You keep talking about the E. If we've got a problem with the bond market, will we have a problem with the P in the equity market? The price that people are willing to pay for those earnings if yields start to continue backing up like this.
Yeah, it's fair enough. The discount rate could go up marginally. But look what's happened with the earnings growth rate over the last 3 years. It's way above the increase in the discount rate. So I think you can get overly focused on that. It will certainly cause a near-term correction. If the Fed turns around and hikes, which I doubt that they would do. If you think about it, Anne-Marie, it's like a bifurcated economy here, right? The low end right now is being protected by the One Big Beautiful Bill. That's offsetting the gasoline price hike by 6 to 8 months. The high end's being protected by the wealth effect. So that's why the economy is going along. The Fed, if it raises rates, what that is going to hurt is the interest rate sensitive part of the economy, which is not as big a hunk of the economy as it used to be. And it's the part of the economy that currently right now is sort of in a recession. Look at Home Depot's numbers this morning. So the housing market is the thing that's struggling. That employs a lot of people. That's the area that needs lower rates. And Warsh understands that. So I think it's really unlikely that he's going to hike. All he's going to do is further hurt the part of the economy, the one part that's not growing fast. And it's not going to have anything to do with AI. The investment there is being driven largely by cash flow, not by borrowing. So it's not going to have any impact on the AI boom.
Just to remind us, just to wrap it up, new price targets, what are they?
We've gone to 9,000 for the end of 27, and we're at, I want to say, 8,000 for the end of 26.
Pretty bullish stuff, Steve. It's good to see you.
Yeah, likewise.
Appreciate it, buddy. Thank you. Steve Author of Federated Hermes. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. We're getting new details about President Donald Trump's meeting with China's Xi Jinping last week. The Financial Times reporting Xi told Trump that Russian President Vladimir Putin may end up regretting invading Ukraine. Putin is in Beijing and scheduled to meet with Xi tomorrow. A legal setback for Elon Musk. A California jury tossing out his lawsuit against OpenAI and its CEO, saying Musk should have sued sooner. The jury didn't rule on his core allegation that OpenAI abandoned its responsibilities by pivoting to maximize commercial profits. Musk says he'll appeal. The LIRR strike coming to an end after 4 days. Railroad workers agreeing to a potential agreement to get the country's largest commuter line back up and running. Now, the unions still need to ratify the accord, which delivers raises for workers while protecting riders and taxpayers. And that is your Bloomberg Brief. John.
Some good news going into the long weekend. Vonnie, thank you for that. More from Vonnie later this hour. Up next on the programme, delaying strikes against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever.
Up next, we'll catch up with Henrietta Trate of Vader Partners, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
A summer tease from New York City, getting into the 90s a little bit later. For the Brits out there, for the Europeans, that's 34 Celsius. Into the 90s.
It's unbelievable.
Sneak peek of the summer.
The Brits don't experience this ever, so come to New York. What's sad, though, is that it's not carrying through the weekend, which is a long weekend for Memorial Day. So.
Temperatures are going to come down pretty aggressively over the coming few days into the long weekend. That's the situation with the weather. This is the week ahead for the economic data and the earnings. Later on this week, the main event, of course, is NVIDIA after the close on Wednesday. You'll also get Target that morning. Look out for that. Walmart on Thursday. This is a new one on the calendar, the swearing in of Kevin Warsh as Fed chair. That's coming on Friday from the White House, I believe.
From the White House. And the last time a new Fed chair was sworn in at the White House was Alan Greenspan in 1987. Normally they're sworn in at the Federal Reserve Building, and then there's some sort of celebration announcement at the White House. but Trump's going full hog on this one. It's the party and the swearing in. The first time since Greenspan.
People going to complain about the optics of that. Kevin Walsh at the White House alongside the president.
I was in the last cabinet meeting where the president said because of all the renovations that's happening when it comes to the Federal Reserve, maybe we're going to have to find a desk for Kevin Walsh here at the White House. I immediately looked at Susie Wiles to see if her face was just kind of like, oh my God, no.
The building they're in right now, the Federal Reserve, is a beautiful building already. Could have used that, but anyway. Futures right now on the S&P 500. Yeah, we'll move on. We're down by about 0.4% on the S&P 500 this morning. Crude pulling back just a little bit. Let's focus on that. Under surveillance this morning, delaying strikes against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran. And we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal.
Here's the latest this morning. President Donald Trump calling off attacks against Iran in an effort to give Gulf allies more time to push for diplomacy. Bloomberg's Tyler Kendall joins us now from Washington for more. Hey, Tyler.
Hey, John, good morning. Well, President Trump maintains that the risk of escalation is still very much on the table, as he went on in that post on Truth Social to say that he has told his national security team to be ready at, quote, a moment's notice for large-scale strikes. At this point, the White House has not detailed any of these plans, as President Trump has long threatened additional military action, while on the other hand has maintained that a diplomatic solution still remains viable. But I will point out that our analysts at Bloomberg Economics say that it is increasingly likely that the White House could revert to short and intense strikes in a bid to change the status quo, amid reporting that President Trump has been advised in recent weeks that limited strikes could help pressure Iran to reach a deal. Because the latest is both sides are rejecting the freshest counter proposals just yesterday, as Iran underscores that it doesn't want to discuss curbs on its nuclear program, and the U.S. says that the naval blockade isn't going anywhere. In fact, CENTCOM confirmed yesterday that it has so far redirected 85 commercial vessels in its attempts to secure the strait, which at this point remains effectively shut, and the administration is looking for ways to get more oil supply to the global market, moving just yesterday to issue this temporary waiver to allow for the sale of some Russian crude barrels already loaded onto tankers and at sea. John, in fact, a person familiar with the matter tells Bloomberg News that this 30-day general license could very likely be extended as the war in Iran drags on within the next month. Considering that we saw the last general license lapse, it's something to watch here as the administration faces this increased pressure when it comes to rein in higher fuel costs.
Tyler, there was also a report yesterday from an Iranian semi-official news outlet saying that part of the negotiations, the United States was even willing to lift sanctions on Iranian crude. Is that potentially one of the tools in the toolbox?
Well, at this point, Anne-Marie, we did hear from a White House official who said that that report from Iranian state media was false and that that was not going to be something on the table. It was interesting because it did come, of course, the same day that we saw the U.S. Treasury Secretary Scott Bessent urge G7 allies to ratchet up their sanctions when it comes to Iran. In terms of any other sanctions that we could be watching, as you well know, we were just in Asia, President Trump telling reporters on his way back on Air Force One that maybe he would be looking at easing some of the sanctions on Chinese oil refiners who import Iranian crude, though at this point we haven't gotten any further update on that. It is very clear, though, that the administration is looking for some other ways that they could tamp down when it comes to rising fuel costs. But so far, we haven't really seen recent moves. I mentioned last hour on this program that the White House is looking at asking Congress for this temporary suspension when it comes to the federal gas tax. Anne-Marie, I will also quickly mention that yesterday we got some other reporting from Iranian state media, including that the U.S.'s latest proposal did not include payments when it comes to war damages. That is also something that at the moment is being disputed by the White House.
Tyler Kendall with the latest in Washington. Tyler, stay close. Thank you. Henry Trace of Vader Partners writing the U.S. and Iran could negotiate a narrow reopening of the strait while the thornier tax issues are sorted out. Military escalation remains distinctly possible. Henrietta joins us now for more. Henrietta, welcome to the programme first. And secondly, I want to pick up on that last line. I think it's really important. In markets, overwhelmingly, the consensus is this administration is committed to a diplomatic effort to end this war and avoiding the resumption of hostilities, to the events of that announcement in the last 24 hours, reinforce that or highlight that maybe we were closer to a resumption of hostilities than many people believed?
I think there's actually a lot of confusion on the street. My inbox is constantly, what are your odds of military escalation? I don't think there's a lot of confidence in one direction or another about what the president is going to do here. And that's because he doesn't have any good options. The fact that Iran's neighboring countries are telling the president, per his own words, that this is not the time to escalate militarily is because they're the ones that are going to get retaliated against. And they don't want their energy outlets, their energy refiners to be the ones that are targeted, which President Trump understands because it'll drive inflation and gas prices even further. I thought your last guest was really interesting, and it's disturbing to hear that this is not a widespread problem when you're pointing to earnings from Exxon as a reason for good news. The Gulf is closed, the strait is closed, and inflation continues to seep across the entire economy into wholesale data, into PPI data, and the strait is the problem. So escalating and further incapacitating energy refiners in the entire region is only going to exacerbate the problem. So the president doesn't have a good choice here.
So, Henry, why do you think that the strait at some point could be reopened while they negotiate other issues? If this is the one piece of leverage the regime has, don't they want to hold on to this as long as possible?
Exactly. And so I think, Anne-Marie, the way I think about it is that this would have to be the United States allowing for the movement of freight and ships through the Ayatollah. It always comes back to this fifth and final point that Iran always includes on its ask list, which is, I want to have the ability to control flow through the strait, which means collecting a tax. And in my opinion, if you really think about it, it's pretty easy and painful, obviously politically, for the president to allow some transit through the strait, at least clear the backlog of ships that are in there, maybe get some of the oil out that's locked in, get those poor souls that have been stuck there for 80 days out of there, and get the flow through. But you'd have to allow for Iran to continue coordinating, which, by the way, the insurers want. And Iran is generating its entire own insurance policy to get those guys through. So in comparison to a military escalation, it's theoretically easier. Diplomatically and tax policy-wise, it's a disaster.
Well, Henry, are you saying that the strait could open with Iranians collecting a toll, or potentially the United States using the Fifth Fleet and just having naval escorts?
Well, the naval escorts are extraordinarily expensive. They let 2 ships through. Each one costs $10 million, and that's going to escalate. And obviously, the president called that off after 36 hours or something because the manpower cost and the risk was presumably too high. If it was effective, we'd still be doing it. We're not. And that's the problem with the military sortie from the United States side. So the path of least resistance, if you're more worried about military, manpower, loss of life, is to create a formalized route to go through that goes through the tax policy angle. It's from a human cost, less problematic.
Henrietta, appreciate your take. Thank you. Henrietta Trace there, Aveda Partners. On the options available to this White House right now, they're limited, which is why they've committed to the blockade. Because at the moment, that's the low-risk option for now, because you've got the inventories. But as you aggressively draw those inventories down and you start to get hiccups here, there and everywhere, that becomes a higher-risk option. And that's where things get more complicated.
It's why you see OFAC extending these waivers when it comes to Russian oil. They're willing to allow Russian crude hit the market because they don't have a lot of choices for some of their partners, especially in Asia and in Europe. It's going to be a very challenging environment. Right now, to Henrietta's point, the Strait of Hormuz, John, has an X account, so you can message them and pay them to get your vessel through.
That easy, right?
Yeah, with some Bitcoin. Yep.
Okay. All right. Brent crude this morning around 111. WTI around 108. Equity futures negative. We're down by about 1/3 of 1%. Up next, we'll get the latest on Home Depot with Drew Redding of Bloomberg Intelligence.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Hi from New York City. Welcome back to the program. Bramo on tour today. She's up in Boston. She'll be catching up with everyone over at JP Morgan at their tech conference. Coming up a little bit later, look out for this conversation with the Liberty Media CEO. Coming up a little bit later with Derek Chang. That's happening in the next hour. Stacked hour. In about 60 minutes' time, we'll also catch up with the central bank governors of France and of Germany. So a read on the ECB. Ollie Krug on the ground at the G7, bringing you the latest from that a little bit later this morning. For the week ahead, this is how things are stacked up. We had Home Depot earnings a little bit earlier on this morning. Sales falling slightly short. Stock's not been hammered. That's interesting. Later in the week, we'll hear from Target. We'll hear from Walmart. We'll also hear from Nvidia. That is the big earnings report for the week, given its massive contribution to the S&P 500 and to the NASDAQ. And then later in the week, we mentioned this earlier in the program, Kevin Walsh, Fed Chair, sworn in on Friday, entering a really, really complex moment for any central bank anywhere, particularly for this Federal Reserve. Unclear what his reaction function is. Want some clarity on that. We do know the committee is incredibly divided at a time where inflation has picked up to multi-year highs, driven by this massive move we've seen in energy over the last few months.
Cameron Dawson was talking about, is this going to be potentially one of the first Fed chairs that comes to a meeting and dissents? Remember, he is taking Steve Myron's very dovish spot. So he might have to, assert himself in that way. I do think it is interesting, though. First, it was the Treasury Secretary, and then it was the president of this Fortune magazine. It wasn't a full-blown, I'm going to give Kevin as much space as he needs, but it was a sense that you might have to wait to see the figures to after the war is over. Basically, considering the fact that we are seeing a higher inflation environment with higher energy prices, potentially cannot come in and cut rates immediately.
I mentioned this quote from Jim McCormick over at Citi earlier on this morning. I see markets underpricing the risk of a Fed rate hike starting this year, not next year, but this year. And I think many of us, including myself, struggle to internalise that. I mentioned this yesterday. We heard from Neil Kashkari. He dissented against the language in the statement. And when he talked about why, he talked about the financial conditions tightening somewhat so they wouldn't have to do more further down the road. And my translation of that was ultimately, if you change the communication of the Fed, if you tighten financial conditions up somewhat, you get that done, you won't actually need to hike further down the road. So even the dissenters to the language on the easing bias in the statement right now, I don't see them as inclined to wanting to hike anytime soon.
No, but they want to set the bar and make sure that inflation doesn't run away from them. I mean, when you talk about an individual coming out and saying potential is going to be a hike, which some of the banks and analysts are starting to see this year, did you see Steve Auth, how he responded to when I said, can stocks continue to where you think they're going? That story persists if we have a rate hike. And he says, whoa, I don't even think there's going to be a rate hike. And that is a loaded question. It's so interesting right now. The debate is so different and robust. Citi yesterday, Veronica Clark is still expecting, her and the team, 3 cuts this year, while individuals are starting to price in a potential hike.
Let's start with the bond market then. 2s, 10s, 30s, and check out 2s first. Yields elevated by 3 basis points. You'll notice the yield here is still north of 4%, close to 4.1%. That is quite some way away from the policy rate on the Fed funds. Now, this is important because the gap has opened up. And this is why people are talking about the prospect or the risk of a rate hike in the year to come. On the 10-year, further out along the curve, north of 460. We've seen that over the last couple of days now, up another 2 basis points so far this morning. And on 30s, up about 2 basis points on the 30-year to around 5.15 yields at the long end of the curve at multi-decade highs. In Japan, at record highs on certain maturities. In the UK, numbers we haven't seen for almost 20 years.
It's not just a problem in the United States, although this would be a problem screen for the Treasury Secretary. Remember, he wanted 3% in the 10-year yield, Jonathan, when he came in. That was his hope and ambition. This is a global problem, and this is something that is actually going to be dominating the G7 finance ministers meeting happening right now in Paris. We already heard from the French finance minister who said this is a problem. Energy costs going up, it's inflation. Potentially there's going to be a little bit of a drag on growth. This has a stagflationary fear.
That's the bond market move. Equities this morning down by about 1/3% on the S&P 500. Slightly lighter, negative across equity markets today on the S&P, on the Nasdaq, on the Russell. On the Russell this morning, we're down by 0.5. Just to round things out for you, to check out commodities, Brent and WTI. Brent's down by about 1%, but still holding on to 110. Call it 111. On WTI crude, 108. We're down about 1/3% on the session so far. On our radar this morning, President Donald Trump delaying strikes on Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, because we've had very big discussions with Iran, and we'll see what they amount to.
While there has been no immediate confirmation from Tehran of renewed talks, President Trump saying the countries are very close to reaching a deal.
But how many times have we heard that? I mean, I spoke to the president weeks ago when I called him and he said they're desperate to make a deal. Right now, when you get the readouts from the Iranians and the White House, they are still so far apart and on their red lines. And neither side is moving inwards, which is why the president talks about the fact that he could still go back to strikes. What I find so interesting about this truth yesterday is that no one was planning for a strike. And the president came out and said, I'm not doing one, which is why it feels like it's verbal intervention. And for the oil market, it's working. And Kit Juke says the market buys taco more than nacho. Taco, we know Trump always chickens out. Nacho, not a chance. Hormuz open.
Still trying to work out what came out of that meeting in China. You were in Beijing for it, trying to work out the details of what was agreed, if anything, with regards to what's happening in the Middle East. And, of course, the latest on NVIDIA, the CEO, Jensen Huang, saying he expects China to open up its markets to imports of American AI chips. The CEO speaking with Bloomberg's Ed Ludlow following that visit to Beijing.
My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
China, of course, is yet to sign off on accepting NVIDIA's H200 chips following the US green-lighting access, and that right now is the sticking point.
I spoke to sources about this. They're waiting on Beijing. The United States has allowed the H200s. Remember, this was a huge U-turn for the Trump administration when it comes to the H200s. First, they were banned. Then in January, they gave the green light. Then in March, there was a lot of talk about specific Chinese companies that went to NVIDIA and said, look, we want to buy these chips, and then went back and said, oh, actually, we can't purchase them because the Chinese Communist Party, the government told us we're not allowed to. After this meeting, does potentially that open up? And that would be a big win for NVIDIA.
The marketing around this AI story is absolutely dreadful right now. It's something they all need to address. I'm sure you've seen some of the scenes from over the weekend with some of these commencement speeches at various colleges around the United States, and some of the individuals delivering those speeches getting booed every time they mentioned AI. Why? Because of language like this. Standard Chartered slashing more than 15% of its workforce leaning into AI. The CEO, Bill Winters, saying the technology will replace, wait for it, lower value human capital.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
The job cuts would take shape by the year 2030. Interestingly, with this announcement, the stock is lower in London trade. It went down by 0.8%. I can't think of a clumsier way to talk about this. That is not the way to talk about this, and I hope the lesson is learned in the years to come.
Well, as I said in the last hour, maybe you should have asked AI. So I asked Google Gemini, what is a better way to phrase this? Google Gemini, first word, Oof. That original phrase is a textbook example of corporate speak gone wrong. Calling human beings lower value human capital and comparing them directly to investment capital sounds incredibly cold, robotic, and devaluing. Maybe before the next time a CEO goes out, or they go out and give a commencement speech or speak to shareholders or their company and their employees about AI taking over people's jobs, they should ask AI how they should deliver that message.
I think it's fair to say this is why some of those commencement speakers right now are getting booed
Absolutely.
off some of these stages. Looking at some of the data we're getting for the consumer, big week for retailers. We heard from Home Depot a little bit earlier on, the company missing expectations, pointing to high borrowing costs and slower consumer spending. Home Depot CFO Richard McPhail telling us here at Bloomberg, shoppers continue to defer large projects, telling us they have a higher degree of uncertainty. Drew Renning of Bloomberg Intelligence joins us now for more. Drew, welcome to the programme. It's not as if the bar was particularly high for these companies. We knew things were going to be difficult. How difficult were they in the last quarter?
Yes, it was a relatively neutral print for Home Depot. They had a slight miss on comparable store sales. But as you mentioned, coming into the quarter, expectations weren't all that high. The stock's down over 20% since mid-February. I think the more important thing and what investors will latch onto is the fact that they maintained their guidance for the full year despite these choppy macro conditions. Now, their guidance did assume that sales would be either flat to up 2%, so I think they did provide themselves with a little bit of wiggle room to kind of see how this macro ultimately shakes out. So I don't necessarily think we've seen the impact yet of the recent inflation and heightened consumer uncertainty. So we do think that there could be some risk through the remainder of the year.
Drew, that's the cyclical backdrop. There's also just this massive structural problem with interest rates because of what happened with the pandemic. Within the space of like 12 months, we had record low interest rates and then interest rates at multi-decade highs. So if you've got that mortgage at the right time, you've still got it. And you certainly don't want to cycle out of that into what we get in the market right now, which is something closer to, say, 6%. Drew, do they have to think about this just being a longer-term structural problem that people just aren't going to be moving until that's addressed? And I don't see any solution for it at the moment.
Yeah, it's certainly one of the biggest headwinds to increased housing turnover. Somewhere around 70% of outstanding mortgages are below 5%. And without a whole lot of labor market stress, there's not a whole lot of incentive people being forced to move from their homes. Housing turnover right now is about 20% below normalized levels. We know that movers tend to spend more on home improvement spending. So we think that the existing home market continues to bounce along the bottom. We don't necessarily see it as a headwind to home improvement retailers at this point, but the catalyst just hasn't come yet.
Drew, what's going on with the tariff refunds? I know Home Depot signed up for them. Are they going to get some of this money back?
So I think they mentioned that they have signed up for them. They have got some of them back already, but I think the CFO had mentioned that it's not going to have a meaningful impact for them.
How challenging has it been for the C-suite? They dealt with tariff last year. They're dealing with high mortgage prices, a housing crisis really in this country, and now potentially consumers just on edge because of everything going on with higher inflation and conflicts around the world.
Yeah, it's really been a perfect storm against the home improvement retail industry. I think one of the main things you highlighted, and it's what we continue to hear across the housing landscape, is just the elevated uncertainty, which is causing consumers to scale back spending, particularly on big ticket projects, which was mentioned by Home Depot. The other thing to keep in mind, with rates where they are, you're tending to see less spending on those big ticket projects because they're typically financed. So think of things like large-scale kitchen remodels, bath remodels, flooring, window projects. Those are all things that really haven't come back, and that's what you need to see in order to get the next leg of growth.
It costs a lot of money, that's for sure. Drew, it's good to see you. Thank you, sir. Drew Renning of Bloomberg Intelligence. Stock slightly lower. Bar was pretty low for this company. Name was down by some 13% year to date. Following last year's losses, that stock was down something like 10-11%. Let's get you an update on news elsewhere this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Meta is cutting jobs and reassigning 7,000 workers to new roles related to AI. According to an internal memo, the Facebook parent will announce staff cuts later in the week as part of an effort to improve efficiency and offset its investments in AI. SpaceX could make its trading debut as early as this week. Elon Musk saying the IPO is coming pretty soon as it seeks to raise as much as $75 billion on a valuation of more than $2 trillion. That would make it the largest IPO in the history of capital markets. New York City Mayor Zohran Mamdani is set to hold meetings with JP Morgan CEO Jamie Dimon and Goldman Sachs CEO David Solomon. This as wealthy New Yorkers and Wall Street push back on the mayor's proposals for higher taxes on the rich. And that is your Bloomberg Brief. John.
Vonnie, thank you. I wish we'd just say employers. I keep reading these stories about the billionaire class, just employers. The mayor today is meeting some of the biggest employers of people in this city. That's the headline.
Yes,
JP
Morgan
that's
alone
news is shocking.
Yes, because this was a mayor who didn't want to engage with the biggest employers of this city. JP Morgan alone has more than 24,000 employees who work in New York City. And more broadly, according to our statistics, Wall Street accounted for basically 20% of New York State's tax revenue. So meeting with the biggest employers and also the biggest revenue generators when you look at your budget.
The fact that's even a story is just ridiculous. Right?
It's sad, actually.
It's really sad.
All these meetings should have been going on. I think there was maybe one ahead of the election.
At least they're actually happening, unlike under de Blasio, where these kind of things didn't happen at all, which was also ridiculous. Up next on the programme, testing consumer resilience.
Consumers are making difficult choices based on where prices are, but we haven't seen the consumer stop spending. Begrudgingly, the consumer has held on to their spending trends.
Up next, we'll catch up with Michelle Meyer of MasterCard from New York City. You're watching Bloomberg TV.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released.
Hey guys, 5:30 होने वाला है. New York session is going to open. CrudeOil देखोगे कुछ खास करा नहीं है. एक थोड़ी देर पहले न्यूज़ ज़रूर आई थी. that there will be some attack news in ईरान का जो खर्ग आइलैंड है उसके आसपास। खर्ग आइलैंड है वहाँ पर शायद कुछ अटैक हुआ है, कंफर्मेशन नहीं मिली, प्राइस वहीं स्ट्रक हो गया उसकी वजह से। कल आई थिंक यूएस प्रेसिडेंट ने कहा था कि हम अटैक नहीं करेंगे, बट ऐसा हो सकता है कल कहें अटैक नहीं करेंगे और आज कर दें। वेरी हाई प्रोबेबिलिटी ऑफ दिस। नेचुरल गैस भी देखो कल सेलिंग अच्छी आई थी, बट टुडे अगेन हाई लेवल से एक बार लो लेवल से सॉरी एक बार फिर वापस बाइंग करी। इसके नीचे गया ही नहीं, एक पॉइंट ऑफ इंटरेस्ट बना था 288 के आसपास, वहां से वापस बाइंग ही चल रही है। लगता नहीं कल का लेवल होल्ड करेगा। ऊपर एक रेजिस्टेंस है अब 305-6 के आसपास, वहां पहुंचता है तो नीचे 288 के नीचे जाता नहीं। सपोर्ट है डे लो आज का 288 के नीचे गया तब थोड़ा सा और हो सकता है मेरी साइड पे जाए, अदरवाइज इसके ऊपर तो बुलिश ही है। देखते हैं 306-7 के आसपास पहुंचता है क्या डायरेक्टली। बाकी आई थिंक अडानी केस जो अडानी पे था वो भी ड्रॉप कर दिया यूएस ने। US Department of Justice permanently dismissed all criminal charges against Gautam Adani.
Yeah, well, I mean, that's I remember a long time back. I mean, I want to say this and sort of brag about my foresight. When it first came out, I'd actually had a press conference, and I said that this whole was a case initiated by the DOJ, the Department of Justice, and it was that you had hoodwinked American investors. That there was I think it was for the solar plants. It was for the solar plants, and it was some money raised from American investors, and they said, there was some bribery scheme behind this whole thing which you hadn't disclosed to. And I said that at that time that there was no real bribery scheme at all, right? And this was an extremely weak case. I mean, this almost seemed to be a case of vendetta. And I said I was pretty confident that we'd succeed before the Adanis would succeed before the DOJ, and that's exactly what happened today. The DOJ moved the court in New York, I believe it was, and asked for a dismissal of their indictment, right?
खबर इस वक्त आ रही है। अमेरिका में गौतम अडानी को बड़ी राहत मिली है। अमेरिका ने सभी आपराधिक मामले बंद किए हैं। अमेरिकी न्याय विभाग ने सभी आपराधिक आरोप स्थायी रूप से वापस ले लिए हैं। न्यूयॉर्क की अदालत में दायर दस्तावेजों में डीओजे ने कहा कि वो इस मामले पर आगे संसाधन खर्च नहीं करना चाहता। भतीजे सागर अडानी के खिलाफ भी अमेरिका में चल रहे सभी मामले बंद। अदालत ने आरोपों को स्थायी रूप से खारिज किया। अब ये मामला दोबारा नहीं खोला जा सकता है। खबर इस वक्त आ रही है। अमेरिका में
Multiple explosion reported on Qasim Island in southern Iran. Explosions were heard in Iran Qasem Island on Tuesday due to the disposal of enemy ammunition, the semi-official Iran Tasmin news agency said, citing a local official.
Explosions heard in Iran's Keshem Island due to disposal of enemy ammunition. By Reuters. Dubai, May 19th. Reuters explosions were heard in Iran's Keshem Island on Tuesday due to the neutralization of unexploded enemy ammunition, the semi-official Iranian Tasnim news agency said, citing a local official. The country's mayor news agency had earlier reported the sound of explosions, saying the cause was unknown. U.S. President Donald Trump said on Monday he had paused a planned resumption of attacks on Iran after Tehran sent a new peace proposal to Washington, and that there was now a very good chance of reaching a deal limiting Iran's nuclear program. Reuters could not determine whether preparations had been made for strikes that would mark a renewal of the war the U.S. and Israel started on February 28. Reporting by Elwilly, editing by Allison Williams.
आगे नेचुरल सॉरी क्रूड ऑयल में पॉसिबल है अगर फॉल होता है तो ये सपोर्ट है एक 9840 का, ये होल्ड शायद ना हो बिकॉज ऑलरेडी टेस्ट हो चुका है. कैंडल ओपन इक्वल टू हाई है नेचुरल गैस में 15 मिनट देखेंगे स्मॉलर टाइम फ्रेम पे अगर कोई रेजिस्टेंस बनता है क्रूड ऑयल में, मुझे लगता नहीं यहाँ तक प्राइस जाएगा वापस, चांसेस कम ही है, कोई न्यूज़ नहीं आती बिकॉज ऑलरेडी हिट कर चुका है, कॉन्ट्रैक्ट चेंज हुआ है तो गैप डाउन हो रहा है। ये 5:30 हो गया, लेट्स सी, देखते हैं। न्यूयॉर्क सेशन ऑलरेडी ओपन है।
trading. And you also saw this narrowness really not be consistent with an overall new high-end market. So it made this fragile. We think it is a pause, but at the end of the day, when you have an over 18% weight in a cohort of names that went vertically up, a simple correction in those names back to trend could be damaging for the overall market cap weighted index.
That was Cameron Dawson of New Edge Wealth on this equity market a little bit earlier on this morning. Your equity market right now negative by some 0.4%. On the Nasdaq down by 0.75%, call it 0.8%. Going into the cash open 1 hour and 12 minutes away. That's the price action. Let's get you some morning calls. First up, Citi raising its price target on SanDisk to 2025, seeing persistently strong storage demand and a highly favourable pricing environment. That stock struggled in the last 24 hours. It's down this morning by 3%. Your second call from Mizuho raising its price target on Micron to 800, seeing positive impacts from AI data centres on memory chip makers. That name also lower down by 2.4% this morning. And your third and final call from HSBC, raising its price target on Nvidia to 325, expecting a beat and a raise in the company's earnings report tomorrow after the close. That name is down by some 1%. Let's head back over to JP Morgan's annual Technology, Media and Communications Conference underway in Boston. Lisa standing by with another special guest. Hey, Lisa.
Hey, John. Thank you so much. I am here with Derek Chang. He is the CEO of Liberty Media, also sitting on the board of the Oversight, Liberty Media's subsidiary that oversees Live Nation. Derek, thank you so much for being here. Really appreciate it.
Lisa, thanks for having me.
So I want to start with the idea that everyone here is talking about scale, getting enough scale, merging up, particularly in the media space. You moved in the opposite direction last year, breaking up into a host of different entities. Can you talk about why you decided to do that?
Well, I think if you look at Liberty Media over its history, it's had a history of sort of expansion, contraction. You know, we kind of go with the flow a little bit depending on what the circumstances are and what the market is you know, asking for and what we think that we should be doing for our shareholders. So I don't think in this particular moment it was a specific strategy of we're ultimately going on a trail of just sort of getting smaller. It was clarifying and simplifying the structures, and so delivering to shareholders sort of what assets they want in what places at this particular moment. But, you know, over time, we have had tracking stocks, we have spun out companies, and now we're sort of back to a more simplified structure. And it's really to provide that clarity for shareholders.
So you oversee your two main properties at Liberty Media are Formula One and MotoGP, which is relatively new in the U.S., very big in Europe and Southeast Asia. I'm just wondering how you're thinking about a media strategy. You just signed this 5-year deal with Apple in terms of streaming rights. Is it the same between streaming and legacy cable networks? Is it sort of all the same at this point when it comes to sports licensing?
Well, I think it still depends on what markets you're actually in. And so in a lot of markets like the U.S. at this point, the streamers have you just spoke about scale, a lot of scale. And I think that historically people have said, oh, you got to be on a broadcast network, otherwise you're not going to have the reach. I don't think that's true anymore. And I think the deal that we did with Apple basically has shown that is, for us, we've seen no real drop off in terms of viewership, and in fact, engagement overall is higher than it was before in the early sort of going here, the first 3 or 4 races that we've had this year. And I think what that speaks to is streaming platforms certainly in the U.S. have reached a level of maturity and even beyond, you'd say. And you see it right now with sort of what's gone on at the NFL, their recent deals that they're doing. So clearly it's part of sort of mainstream viewing habits. And this whole concept, I think, that the knock on streaming was also you lose sort of the sampling effect. And I think what you see with our deal with Apple is that people sample in different ways. So you go into an Apple store, or you watch other content that's on Apple TV or Apple Music, or what they do with Apple Maps, which they did in the Miami race, where they sort of created an app, integrated it into Apple Maps with stuff around the Miami race, and they had special content for that race. So you've got platforms now that, because of the technology they have, because of their sort of, in Apple's case, singular focus on Formula One, the ability to actually expand your audiences in different ways than you ever have.
Do you think that you're going to move to a Netflix type of model that you did with F1 when it comes to MotoGP in the U.S., where you have a TV series about it and you sort of broadcast it to popular consumption in a way to democratize exactly what it is?
Well, I think what you're going to see with MotoGP is a lot of what we did with Formula One. There will be similar applications of that. So the biggest thing for us with MotoGP is how do you take the sport, which at its core is a very pure sport and a huge, passionate fan base, and how do you expand that? How do you get more people engaged, whether it's in the U.S. or worldwide? And I think you do that by telling the story. And we haven't told, MotoGP has never really told that story. And you do that through riders, you do that through the action on the track, and you do that sort of in multiple ways through content, through fan activation at races, through the licensing partners and the sponsorship partners that you have. But I do think the content piece of this is a very important part. Whether you do a show just like Drive to Survive, I don't know if that's necessarily going to happen because it's a different sport and you want to remain authentic to your fan base and to the fans that you're trying to attract. So we will figure out things that we can do in and around MotoGP that sort of creates the same impact and making it available and making it accessible to as broad a fan base as possible.
You also help to oversee Live Nation, the Live Nation investment through the Liberty Board. And I'm curious from your perspective, ticket prices are really expensive. Everyone talks about it. Everyone complains about it, that the inflation in ticket prices to go see events is incredibly high, and then they still go. How do you understand the inflation in ticket prices, whether it's World Cup and what's going on there, or whether it's basketball at Madison Square Garden, and understand what's the right pricing? How do you do that strategy?
Well, the reality is it is simple supply and demand, right? And so I think what you're seeing is there's huge demand for live entertainment, live events. And, I see this through the Formula One lens where our Paddock Club is, for the most part, sold out through the rest of the year here already.
The high-end club.
That's the high-end, tickets and hospitality that we offer. And I think there's just so much demand for these sorts of experiences that the reality is you could probably, create multiples of availability and it's still going to sell. I don't know about, the specific ticket pricing strategy for those, but I think ultimately what you're speaking to is there's just this demand, this pent-up demand for live entertainment that you continue to see, despite the fact that there are a lot of different things that people can go to. But I think it's the allure of that and the appeal. And for different people, it's different reasons, right? Some people go specifically for the racing. Some people go for the racing and for the food. Some people go for the racing and for the celebrities. Whatever it is, there's this just attraction to it. And I think we're bringing that to the fans.
Derek Chang, thank you so much for being with us. Derek Chang, CEO of Liberty Media. See that, John? You're talking about how expensive the World Cup tickets are, and maybe it's just that the food is really, really good if you go to the right seats and you get to be part of a great experience.
I'm doubtful of that. Doubtful of that. Bramo, thank you. Appreciate it. Looking forward to 6 weeks of complaining about ticket prices at a World Cup. Coming up on the programme, a pair of central bank governors. Check this out. This is going to be fantastic. We will hear from the French central bank governor and the German central bank governor as well, from the G7 on the future of rate policy at the European Central Bank. That conversation just around the corner. Plus, Danny is going to have some morning movers for you. Memory stocks falling as the chip slump continues.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
The open about 60 minutes away. Equities pulling back by 0.4% on the S&P. We're down by 0.8 on the Nasdaq. Some jitters in tech. We'll talk about that a little bit later. Danny's going to have some single names for you. For the S&P 500, also some headwinds coming from the bond market. Fixed income yields drifting higher again this morning. 10s at the moment around 462. 30s at around 515, and 2s still comfortably above the policy rate at the Federal Reserve. The 2-year yield around 4.1%. As we count down to that cash open, let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. Starting with earnings in apparel, Amer Sports doing very well today, up 3.6%. Their Solomon shoes, they're very popular. You can see them basically going everywhere, and so that supported their earnings along with their brand Arc'teryx. Interestingly, they said that people are buying full-priced items. They're not having to put things on sale, which is helping them against shares moving higher in the pre-market. Now, some of the jitters around tech that you mentioned, a lot of the AI stocks continue to sell off. The chip makers, after this huge run that they've been on, you look at SanDisk down 3%, Seagate down 3.5%, Micron down 2.5%. Part of that is just higher yields, a turn in risk sentiment, but also you had the Seagate CEO saying at that JP Morgan conference that Lisa is at that they can't meet all of the demand. They don't have enough capacity. It's maybe a good problem to have, but even so, the sector's selling off. But one little piece of evidence that might show that this is something mechanical, this is taking profit and covering your shorts, is what's happening in software. Because while AI has been selling off, the flip side of that are the best performers pre-market in the S&P 500 are software names. ServiceNow, one of the best large cap performers, up 5.3%. Workday, Salesforce, all of them are up around 2%. Again, no specific news tied to them, but maybe just the flip side of the AI sell-off, John.
One to watch going into the opening bout. Danny, thank you. Thank you for the update. Just had to double check that Miller is in the building today before I promote the show. Matt is here. Matthew Miller will be attending his own show at 9 a.m. Eastern Time in about 30 minutes' time alongside Danny Berger. So look out for that. They'll guide you into the opening bout. Let's talk about monetary policy, the future of monetary policy, and the pressure building on some central banks to maybe consider hiking interest rates. Perhaps the ECB will be the first, with two special guests. Our good friend Ollie Crook on the ground at the G7. He joins us now for more. Hey, Ollie.
Yeah, that's right, Jonathan. We're here at the G7 finance ministers meeting with central bank governors in Paris at the French finance ministry. The big question in the room, the effect of the war in Iran on inflation, on growth. And we're very lucky to be joined not by one, but by two ECB governing council members, the governor of the Banque de France, François Villeroy de Galhau, and the president of the Deutsche Bundesbank, Joachim Nagel. Thank you both for joining us today. Since you're the host, I'll begin with you, Monsieur de Galhau, and trying to get your assessment first of the conversation in the room among the G7 and what the sort of idea of collective action, what is appropriate at the G7 level to dampen the effect that we've seen from this war?
So first, as you are perhaps aware, this happened to be my last G7 meeting, and I was delighted to welcome my friend Joachim Nagel and all my colleagues from the G7. So I can compare through the last 11 years, and I can frankly say that this Paris G7 won a very good G7. We are in difficult circumstances. You mentioned them. But the discussion was lucid, without any complacency. It was a free discussion at the highest possible level. And it was a confident discussion. And we shared the analysis on global economies, we shared the will to reduce global imbalances, to address the negative consequences of the conflict in the Middle East. And for us central bankers, we are fully determined to bring inflation back to target.
And I'd like to get in, if you could share with us some of your joint analysis of that situation right now. The ECB has given us a framework by which to think about this, the base case, the adverse effect, the severe. I'd like to get both of your perspectives on where we lay on that in terms of the impact of this war.
Maybe before I come to this, I have to congratulate François as well. I think it was an excellent meeting, and you alluded to it. We were, let me say, outspoken in a way. We really recognized this is a delicate situation, and we had an open discussion. And so this was a very fruitful meeting here in Paris. Coming back to your question, where we are, I think this whole conflict started more or less 3 months ago. Now we know that this energy supply shock is more persistent. So we are moving away from our baseline scenario. And so this is, I guess, I believe, a fair description of where we are at the moment.
But does that mean that we are now in the adverse and severe scenario? How are you thinking about it? Because that's the framework the ECB has put out for us to think about.
It is, as always, we will take our decision on data. We will come together in June, and then we will have our decision based on data. But I alluded to it. There is it's a higher probability now that we are now away from that baseline scenario. That means that maybe we have to do something.
And one of the big questions is about the secondary effects and whether or not this inflation is spreading from just the energy, the headline level, to the broader core. What is your analysis of that at the moment?
Can I first insist on the fact that figures are very volatile if you look at financial markets. So we shouldn't focus on data points, but look at the trend. As Joachim just said, as this conflict is lasting for longer, we have to look at more structural, long-term consequences. To give two obvious examples, we discussed financial stability and the bonds market situation. We also have to accelerate our energy diversification and reducing the dependency of most of our countries, starting with Europe, from fossil energy. It's obvious, but let us not limit our response to an emergency answer. On the monetary answer, I think the data will matter more than a precise date. And this is focused on the second round effects.
So for the market's expectations, so they say that there's going to be 2 to 3 rate hikes from the ECB this year, beginning in June. Are you comfortable with that analysis? Do you find that that is a correct interpretation of what we've seen so far?
I guess it's not helpful to speculate about maybe the numbers or when do we what. I think this is not helpful. I think this meeting-to-meeting approach based on the data that we have on that meeting, this is the right way to do it. So we showed our commitment over the last 4 years. We hiked 10 times, we lowered 8 times, and we will show the same commitment when we're coming together for our next meeting.
You think of the French... Yeah.
Can I add on markets 2 things? We are not market-driven, we are data-driven, obviously. That said, through markets there is a tightening of financial conditions, and it already plays a role in fighting inflation threats. So we will see, and I think that this is the most important commitment. We showed it in the last 4 years, but European households, European firms can trust us, ECB, Bundesbank, Banque de France, to bring inflation back to target. And this is, believe me, the most important commitment.
And though you're not market-driven necessarily, the market can have bearing on the economy and how things develop. We've seen a move in the bond market recently. How do you interpret that move? You just spoke recently about, obviously, part of it is inflation expectation. You said part of it is political risk. What political risk?
Look, Sarah, first, it's a global phenomenon, and not only a European one, beyond the G7. And there are at least 3 explanations. First is global uncertainty, obviously, and political uncertainty in some jurisdictions. Some question about fiscal policies, and they must remain sound and sustainable. And third, let us be honest, fears of inflation. This is where of our commitment matters most.
And I think just to try to nail you down on this one point, on the question of inflation, do you find that it is currently still segregated to the energy sector? And if it is so, is there a world in which you look through it, this next rate decision, in the sense that it is just at the headline level?
So what I know from inflation and how inflation might develop, it's pretty much dependent on the duration of the shock. And I already said it, I alluded to it. The probability is rising then that we will see more inflation everywhere. And this is something we have to take into consideration, and we will do this in our next meeting.
And how much do you think the story on yields is not just about inflation, but also concerns in Europe that we're a bit stretched sort of fiscally? There isn't the firepower, because we look at the sort of fullness of what we've seen in financial markets, growth being dampened, inflation rising, while at the same time equity markets in the United States parabolic, and now yields rising, the bond market catching up. Does that not sort of hold some of the ingredients for sort of untidy unwind in financial markets? Does that concern you?
Well, I think it is not a comfortable situation, this is for sure. I think we, on the monetary policy side, we should be focused on our mandate, and this is price stability. And everyone has to take responsibility here. Is it fiscal? Is it our job? I think it is a delicate situation, but if everyone is taking the respective responsibility, then we can more or less calm markets.
If I can add two things. First, fiscal policy must remain sound. That means that there could be some measures to address the negative consequences for the most vulnerable in our countries. But these measures must be targeted, temporary and tailored. We said it unanimously in the G7. And can I add another thing, if I compare with the US or some Asian jurisdiction? There is also in this jurisdiction a positive supply shock on artificial intelligence, AI. And it's really of the essence that Europe accelerate on its innovation and on its growth. This is about the Draghi and Letta agenda. We called for it together 18 months ago. And the present situation is not a reason less to focus on structural reform. It's a reason more to accelerate on innovation in Europe.
And I couldn't agree more. There's a lot we can do on the European side. We have to do our homework. Is it the savings and the investment union? Is it the banking union? We have so many things on our plate where we can do a lot to more or less diminish this whole uncertainty.
And in those conversations you were having with finance ministers from the monetary policy perspective, what advice did you give about fiscal policy in terms of not stoking the inflation side of the equation?
Triple T.
Yeah.
Can I add that the IMF was around the table, and they have an interesting tracker of the fiscal measures taken so far. I don't say that they are all fully compliant with the Triple T, targeted, temporary and tailored. But if you look at the magnitude is much more limited than 4 years ago. And this is welcome.
Well, gentlemen, thank you so much for your time. The governor of the Banque de France and the president of the Deutsche Bundesbank for joining us here at the sidelines of the G7 finance ministers and central bankers meeting here in Paris.
Ollie, thank you, buddy. Appreciate it. Thanks for all of that. Fantastic conversation on the European Central Bank. Two individuals well aware of the history of hawkish policy mistakes at the ECB. Then it was under Trichet going into the 2008 financial crisis. Also heading into the sovereign debt crisis in the Eurozone as well. Hiking interest rates in response to, guess what, a move in crude, particularly around 2008. And the jitters around the inflation outlook and the inflation mandate. The date's important here. The next meeting is June 11th. The two individuals there were talking about the duration of the shock. There's time here between now and then. I've got no idea where we'll be between now and then, where we'll be on June 11th. Communication's important here. And I would say this is a communication exercise for these central bank governors right now. They want to commit to the idea that they'd be willing to hike interest rates if they need to. And that's important because what it achieves is a tightening of financial conditions, which helps to anchor inflation expectations. And you heard them say that themselves.
Yes.
That the markets right now is doing some of the work for them.
Right. And you heard that from Nagel. Maybe we have to do something in June. Maybe we have to do things in June. Everyone knows that June is going to be a live meeting. And just those words himself may help set the bar and anchor, as you say, those financial expectations. It's going to be an interesting time because, to your point, we don't know where we're going to be with energy prices, which is heavily impacting Europe right now, between now and June 11th.
Still a few weeks away. just a few weeks away. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The Sandy fire in Simi Valley, California remains uncontained. California authorities saying fire activity is slowing thanks to calmer winds and higher humidity. 750 firefighters are working to build containment lines while helicopters drop water on hotspots. Meta is cutting jobs and reassigning 7,000 workers to new jobs related to AI. According to an internal memo, the Facebook parent will announce staff cuts later in the week as part of an effort to improve efficiency and offset its investments in AI. In sports, the Mets beating the Washington Nationals in historic fashion. New York becoming the first National League team to score at least 10 runs in an extra inning since the 1919 Cincinnati Reds. The Mets topping the Washington Nationals 16-7 in 12 innings. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Looking forward to earnings from Nvidia tomorrow after the closing bell. Numbers from Target as well through the week. Plus, of course, we'll hear from Walmart later on this week on Thursday. In just a moment, we'll catch up with Jay Goldberg of Seaport. The lone sell on Nvidia heading into a monster earnings report tomorrow afternoon. That conversation just around the corner.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There's two sectors that lead the equity market. One is energy, the other is tech. In those periods when energy lead and commodities lead, you build overcapacity. That lowers the overall price. Investors chase duration, which is growth stories, tech, and the rest of it. But eventually you run out of energy, run out of commodity capacity, and that's where we are today.
That was Jeff Curry of Abex Markets. Great to catch up with the legend of the commodity market a little bit earlier on this morning, breaking down on what he thinks is going to happen here. We've seen the bust a few times, haven't we? Saw the bust in mining, post the China boom, saw the bust in shale about 10 years ago, middle of the last decade or so, and that's led to a long period of this sector, those sectors being starved of capex, and Jeff thinks you need much higher prices ultimately to get that investment to come back in.
Unloved, and politics also at play. How many times have we been warned about peak oil? Also, remember, as the Biden administration talked about stranded assets when it comes to the oil space. Obviously, that's not happening now. But what's so interesting, and Jeff is basically saying we're just living off of these inventories, is when is it finally going to bleed through prices? What he is talking about in terms of the concerns of the physical market.
Jeff's talked about the revenge of the old economy. Check out the full interview on Bloomberg.com and, of course, on the Bloomberg terminal. Here's the price action for you. Going into the opening bar, the cash open just around the corner, about 41 minutes away. We've got equities down by 1/3 on the S&P 500. On the NASDAQ, we're down by 0.5. Some problems with chips and memory stocks. These are the names that have run up aggressively since the March 30th low, the end of March, and that low up by something like 70% on the chip players. Going into Thursday, Friday, and the problems we experienced going into the weekend. We've got some negative follow-through. On the NASDAQ, we're down by 0.6. In the bond market, yields high once again notable. 10s at 462, up by 3 or 4 basis points at the front end, and on 10s. On 30s, up by 3 to 5.15. That's the story in the bond market. Here's the story for the week ahead and the next couple of days. Wednesday, earnings from Nvidia and Target. Plus, in the mix, in the middle of that, you'll get some Fed minutes. Look out for that. Let's see if there's any more hawkish dissent within the minutes. Just some hawkish pushback to that easing bias of the Federal Reserve. On Thursday, results from Walmart, another round of jobless claims, PMI data in the mix as well. On Friday, main event, Kevin Warsh steps up to the plate, sworn in as Fed chair.
That's going to be interesting. First time at the White House since Alan Greenspan in the late 1980s. It's going to be really an interesting moment for the President of the United States because he has been jawboning Jay Powell. He wants lower interest rates. But just this week, he told Fortune magazine, basically resigning to the fact that it might take longer due to the fact that energy prices are higher, and saying we're going to have to see where the figures are when this war is over. And right now, Jonathan, we're in paralysis with the conflict in Iran.
That's the story for Friday. Let's talk about the big story out tomorrow. Nvidia earnings out after the close tomorrow afternoon. Jay Goldberg of Seaport with the loan sale rating and a street low price target on the chip maker. He writes, we think the semis market is going to be choppy in the near term. Nvidia remains constrained by high expectations and serious supply constraints. Jay joins us now for more. Jay, welcome to the program. What are you expecting tomorrow afternoon?
I think Nvidia will print a good number, but not a great number, and it'll be, it'll be good. People will be, won't be running for the hills, but I do think people won't see anything that will meaningfully alter the story or their outlook on Nvidia. The stock has been sort of underperforming the sector all year long. I think that will continue.
Jay, I would just love to get your read on what's going on with China. I was with the president on the trip. Obviously, Jensen Huang was a last-minute addition, picked up at the refueling stop. Do you think that this summit is going to be the breakthrough for Nvidia to be able to sell those chips into the Chinese market?
So I think there has been some progress there. Nvidia has been lobbying very hard to get access back to China. I think they've made some progress. It's always hard to tell, but I think first there's a question of will they be able to, will customers actually buy them there? I think there are going to be limits within China on purchases of Nvidia chips because just the whole thing is so political. And I think we're also at the point where the damage has already been done. We have a number of Chinese competitors already loose in the ecosystem running around, and that sort of cracked open the door a little bit on Nvidia's moat.
When it comes to that market, though, Nvidia at one point talked about it being $50 billion for them. What kind of numbers do you think actually it could represent?
I think, the potential for the market is absolutely that big, if not bigger. I think in the near term, I don't see them getting much above single-digit $1 billion in revenue from China this year, assuming the restrictions are actually opened.
Jay, can we talk about this sell rating? You've had it on for quite a while. Let's take the last 12 months. You've got a sell rating on the stock. The stock is up by some 65% over that period, Jay. What would it take for you to change your mind on this name?
So I've always positioned this call as an underperform. Like, I've never told anyone to go out and short NVIDIA. That's obviously dangerous. But I do think NVIDIA has grown so big and become so dominant that it's hard for it to sort of beat that, right? And we've seen that play out this year, or even longer, even late last year, where it's just underperformed the sector. We've seen a lot of these stocks run 50, 100% even in some cases this year, a lot of their peers and their competitors. And NVIDIA just can't run like that. They're a good company. They have good products, but they're supply constrained. They're sold out for the year. And once you're sold out, how do you beat expectations, right? We all have a pretty good beat on what their supply chain looks like. And they have limited scope to raise prices. Adding China to the mix will help a little bit. But in the grand scheme of things, there's not much upside to expectations here possible for them anytime this year.
Jay, with that in mind, is that why you think AMD might be the better opportunity in the sector?
Yeah, I think AMD is becoming a serious competitor to NVIDIA. Their upcoming product, the MI450, which is launching later this year into next year, is on paper very competitive with what NVIDIA is going to be offering. I think it's the first time we've been able to say that about AMD. They've always been close, but now they're fully competitive. And we have customers who can't get enough NVIDIA products, and so they're turning to alternatives. NVIDIA is effectively leaving a lot of money on the table, and that's opened the door for everybody else. And AMD is top of that list.
Jay, appreciate the clarity on that. That's important. Jay Goldberg there of Seaport. AMD, the preference here versus, say, NVIDIA, and that sell is not an outright sell, it's just an underperform within the sector. I think getting clarity on that is important when people see that lone sell call on that particular name.
And as you said, he's had that sell call for months, and the stock has just gone up double digits and absolutely carrying basically the entire equity market. But his point is, we know what the supply chain is, we know what their outlook is, and if they have no more chips to sell, then where's going to be the upside when it comes to this name?
At one point, we are up 20% in 7 days through Thursday last week, which is something close to, that's $900 billion plus, close to $1 trillion of market cap on that name.
I was shocked that the market just moved on the mere fact that he joined the president on the refuel stop to China to go on this trip to Beijing. But I guess the market viewed that as potentially this is an opening for that market for the H200s. NVIDIA was talking about at one point a few months ago, $50 billion they can get from China. And you heard there from Jay, he doesn't think it can even crack $1 billion.
That's the main event tomorrow afternoon, earnings from NVIDIA. Right now, as we count you down to the opening bell, about 35 minutes away. Equity futures still negative here and down by 1/3 of 1% on the S&P 500, down across the board, driven by moves in chips and memory stocks. That's going to be a feature of the story going into the cash open. The bond market's not helping out this morning. Yields are up across the curve. 2s are up by 4 basis points, close to 4.1%. 10s are up 3 or 4 basis points, north of 460, and 30s at levels we haven't seen in a couple of decades. You've got to go back to 2007 to see a 30-year at 515. 515 this morning and up by 3 basis points to the long end of the curve. Crude, stable, negative by 0.5 of 1% on WTI. Brent crude around 110, but the tension and the blockade continues, and that's going to keep those numbers up there. Coming up tomorrow, Keith Lerner of Truist, Monica Guerra of Morgan Stanley, Angelo Zeno of CFRA, and David Kelly of JP Morgan Asset Management. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country.
We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start in the third floor or the lobby. You actually have to start in the basement.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Futures down 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, futures fall as yields flirt with 2007 highs and chip stocks extend declines.
From Meta to Standard Chartered, the AI push is reshaping workforces across industries.
And Home Depot's sales fall short as high borrowing costs curb consumer spending.
A down day, as you pointed out, but it's really the chip makers having another really bad run to start this morning. Let me show you what's happening in the pre-market session, because Micron and SanDisk are both down by 1.9%, almost 3% for SanDisk. A couple things going on, just higher yields pressuring everything in tech. And the winners, you also had the Seagate CEO saying that they can't meet all the demand that they have. But Matt, I would point to ServiceNow, that the software stocks are having a really, really good morning. In fact, most of them have been up for 3 consecutive days. So maybe this is all just a little bit of repositioning. You sell some of your winners, you cover your shorts. At least that's what some of the market action indicates.
Right, and get ready for NVIDIA.
That's true. Get close to the ground and just see what happens with NVIDIA.
Yeah. CoreWeave is moving as well. So you can see some of the NeoCloud stocks are getting hit after competition from Google, which agreed to create its own NeoCloud business, so to speak, with Blackstone. Meta is moving 7,000 jobs to AI roles as it restructures. Of course, that's separate from the 8,000 jobs it's taking out. And a check on NVIDIA ahead of tomorrow's earnings. Remember, that's after the bell tomorrow. So we have 2 sessions between us and NVIDIA, but you just heard on surveillance concerns that they're supply constrained and you don't really see any purchases coming out of China, so maybe they won't be able to beat and raise as analysts anticipate them doing.
It's the big event tomorrow and the last of the big earnings. Before all that, Bloomberg spoke with NVIDIA CEO Jensen Huang and Dell CEO Michael Dell about the growth rate of AI at the Dell World Conference.
We're going to be building this out for a decade, maybe more, because after this, digital agents will be physical agents.
Then we go to the physical AI. We haven't even started that. I mean, you saw some examples of that, you know, in the keynote, but that is a way bigger market, and it will require all sorts of new infrastructure capabilities.
We're going to, for the very first time, bring IT to the world's 90 trillion other industry. And so there's a giant industry ahead of us to build towards. Now, meanwhile, the supply chain is more than doubling every year. I mean, it's probably quadrupling every year, but we'll still have a hard time keeping up with the build out for at least a decade.
Bloomberg Tech co-host Ed Ludlow conducted that interview and joins us now. Ed, I guess it's the right kind of problem to have, the fact that you can't keep up with demand and capacity constrained.
Yeah, and you guys set it up really well for the print after Market Wednesday, right? That for quite a while, the street has had this beat and raise expectation for NVIDIA. But, you know, Jensen Huang couldn't be any clearer, right? That they are supply constrained. Demand is massively outpacing their ability to supply. And I tried to get a sense of how severe that is. The bottleneck is still memory chips, principally. And I guess the warning that he gave there is that even in a world where supply chain is doubling or quadrupling on an annual basis, it is still behind the pace of demand growth, which is like a nice position to be in ahead of earnings. How the market interprets it and swallows it in the moment, who knows? But China, still the big overhang on NVIDIA right now.
I was just showing, and by the way, we're going to obviously focus on NVIDIA throughout the program. You're going to on your program at 11, and then tomorrow it'll be like NVIDIA all day until the earnings come out. Then we'll do NVIDIA all day the next day with the reaction. I want to talk about the NeoCloud fight here, because we just showed shares of CoreWeave. They're getting hit today because Blackstone and Google are creating, their own kind of NeoCloud business with Google chips?
Literally a NeoCloud that runs on Google TPUs. The NeoClouds that already exist largely rely on NVIDIA GPUs. And it's as simple as that. So Blackstone brings $5 billion. There's a debt component where they fund this $25 billion of investment to try and bring 500 megawatts online. But, you know, NeoCloud is just a fancy term for a data center that is very specific for AI workloads. And what Google and Blackstone are doing is saying, hey, there's a really great market. There's a lot of interest in using the TPU technology. We can go out and compete with the likes of CoreWeave, which, as you're showing, down almost 5% in the pre-market. And given, you know, the performance of the TPU relative to all the other AI chips that are out there, the market's clearly taking this seriously as a threat to those existing NeoClouds that have largely NVIDIA-based architectures.
All right, Ed, very much looking forward to your coverage and looking forward to chatting with you after we get those earnings as well. Bloomberg Tech co-host Ed Ludlow after his exclusive interview there with Jensen Huang and Michael Dell. Staying now with AI, Standard Chartered Bank plans to eliminate around 8,000 jobs by 2030 in an AI push, with the CEO saying the company is replacing, quote, lower value human capital with the investment capital we're putting in. Let's discuss the AI jobs market, or the jobs market and its the effect of AI with Bloomberg editor Tom Metcalf. Tom, first off, it's a pretty harsh way to describe your workforce. Is he going to get pushback for this?
Yeah, it's really fascinating to see that word, and you know, it's probably getting more attention than the actual substance of the 8,000 job cuts, because, as you say, you know, what is the message out there? And obviously, you know, there's probably some nuance there. You might be referring to, you know, a certain cut of the workforce. But if I was at Standard Chartered, that'd be my main takeaway. And I'm sure there's plenty of memes out there already. But I do think, you know, that sort of semantics is starting to kind of emerge more strongly across Wall Street. So we saw Goldman have similarly kind of, like, I guess, blunt language on that front. And it's just a reminder of how much this job market has completely flipped on its head since sort of the post-pandemic period, where really now the sort of, you know, the power sits now with the employers.
And is there any degree, I guess, which, you know, I was listening to this interview with Peter Orszag of Lazard, basically saying that this time last year, what AI could do for banks, there's so many hallucinations, so many errors, but now the thing is really, really good. Tom, do we have any tangible evidence of not just this lip service of, you know, we're hiring less people, we're firing people, we're going to switch to AI, and things like S1s completely being written by AI? Or is any of this actually ongoing yet?
Yeah, no, I think it is, and you know, you've got firms across the whole spectrum in terms of deployment, but you know, there's plenty of banks out there that are, you know, transforming their workflows. I think the biggest point is right now where we are is still at a stage where you do want, you know, at least for most of the data that banks are deploying out to clients and stuff, you want that human kind of eyeball on it, just because the sort of the potential risks of getting it wrong are still too high. You know, it's not reliable enough yet. But that's probably the most interesting thing about today is, you know, for me, Standard Chartered's first bank out there to really give quite an explicit, hard target on this sort of thing, rather than just say, hey, we're going to sort of expect to see kind of a move towards more technical staff and less kind of routine mechanical back office staff. And I think that's the fascinating thing about this technology is, you know, we're not talking in years and years, we're talking months, sometimes even weeks in terms of big big changes. So certainly everyone I speak to, it's kind of the thought in terms of how to run your organization. But right now, I would say Standard Chartered definitely being the boldest in terms of how they're going about it.
All right, Tom, thank you very much. That's Bloomberg's Tom Metcalf. Elsewhere in earnings, Home Depot reported this morning sales missed as muted housing demand and higher borrowing costs limit consumer spending. Bloomberg's Matthew Griffin joins us now. I guess it's one of the sore spots in
that these pressures just aren't letting up. So you look at comparable sales. This is a key growth metric for the home improvement retailer. Growth there was 0.6% year over year. Wall Street analysts were looking for 0.9%. And the problems, again, are the same ones that have faced Home Depot for several quarters. Interest rates are high, and so are housing prices. This means consumers don't want to undertake big remodelings that might require financing. They aren't buying new homes and undertaking the projects that go along with that. And so expectations were low coming into this report. Again, this has been a problem for a while, but it seems like investors were still disappointed that here. Shares now down about 1.5% in the pre-market.
Matthew, I filled up my Dodge Challenger Scat Pack wide body yesterday with gas at $6.38 a gallon. It was over $110. Is that going to affect the outlook for Home Depot in this quarter?
It absolutely could. It seems like it hasn't affected results so far. So the company's CFO said consumers aren't changing their spending behavior, and also that it's unclear so far how much they're going to have to raise prices. That being said, if you look at the effects of the war, consumer sentiment falling, high gas prices have a lot to do with that, and mortgage rates rising. I mean, that just adds to sort of the perfect storm of problems for a company like this. And again, it seems like investors don't think they're going to catch a break anytime soon. Shares down already about 21% over the last 12 months.
All right, Matthew, thanks so much for joining us. Matthew Griffin there covers Home Depot for us on the print side. Check on markets right now. We're looking at futures that are lower. Not a huge drop, right? 0.5% lower on futures. We closed yesterday at 74.01, so just 100 points under the all-time high, if you lock that in your memory, of 75.01 last week. We do see the 10-year yield continuing to push higher, and the higher it goes, you're more likely to see the drop get bigger in equities. So right now, 464, 465 if you round up on the 10-year. And I think investors are paying even closer attention to the long end, right? And we got over, I think, 516 on the 30-year. Yeah. Brent crude right now at 110.44. So it's actually off $1.66. But the relationship has been the higher you get in crude, that drives yields higher and that hits stocks. Well, finally, it's starting to hit stocks a little bit harder.
And now that 30-year yield is at the highs for the year. Some of the other single-name stocks that are on our radar this morning, StubHub is surging on a Guggenheim upgrade to buy as its 2026 numbers look strong. Shares up more than 5.5%.
So gas prices not hurting high-end ticket buyers. Amer, they really need
it's like America.
I know, but they just need to change it a little bit. Amer Sports raised its full-year guidance. It's a serious company, right? With Salomon and Wilson, demand for shoes is jumping, and that's helping the company in the pre-market up. Shares up.
Arc'teryx, is that how you pronounce it? Arc'teryx.
Arc'teryx,
yeah. I feel like the finance bros like to wear their vests.
Yeah, it was very trendy for a while.
Is it not anymore?
Stad. I'm not sure lately. I haven't been to Switzerland for a while.
Elsewhere, DeFi platform Hyperliquid is surging. The SEC is said to ready plans for trading crypto versions of stocks. So there's your 24-hour stock trading getting ready for you.
Coming up, President Trump says he called off new strikes that he had planned on Iran after Gulf allies pushed for more time for diplomacy. That's next. This is Bloomberg Open Interest.
least tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top of the bottom, make the sushi shape the more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is the 1 to 6.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Let's get to high interest. Look at what's making headlines around the world after attacking billionaire second homeowners and clashing with Wall Street executives. New York City Mayor Zoran Mamdani is meeting privately with top finance leaders, including J.P. Morgan's Jamie Dimon and Goldman Sachs's David Solomon. The talks come as his tax proposals face backlash from billionaires and real estate leaders, whom those other two guys know pretty well. Long Island Railroad trains are set to restart today after New York Transit officials and union leaders reached a tentative deal ending an historic strike. Limited service resumes at noon on 4 major branches with full system service expected by 4 p.m. New York Governor Kathy Hochul says the agreement avoids new taxes or fare hikes after nearly 300,000 commuters were stranded, some of them probably fairly happily. The New York metro area now ranks ahead of Miami and Houston for the most homes vulnerable to hurricane winds. A property analytics report says that over 3 million homes in the region face moderate or greater risk, amounting to nearly $1.93 trillion in reconstruction costs if we did those reconstructions. Experts warn the Northeast lower storm preparedness makes rare hurricanes even more dangerous for our residents. Danny?
That's not great. Anyway, let's turn to one of our top stories this morning. President Trump pausing a planned strike on Iran, saying Gulf allies wanted more time to pursue diplomacy. In a Truth Social post, Trump also warned that warning Iran that more military action could follow if no deal is reached.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal.
Joining us now is Bloomberg Washington correspondent Tyler Kendall. Tyler, the president saying they're putting off any planned strikes, maybe forever, maybe temporarily. What do we know about the thinking behind this?
Well, Danny, at this point, as you mentioned, the president says that escalation still very much remains on the table. He went on in that post on Truth Social to say that he has told his national security team to be ready at, quote, a moment's notice for large-scale strikes. At this point, we haven't gotten any further details from the White House when it comes to these plans, though President Trump has long threatened that we could see renewed military action, though he's yet to take that step yet, as he maintains that a diplomatic solution is still a viable viable option. I will point out that our analysts at Bloomberg Economics say that it is becoming increasingly likely that the White House could revert to short and intense strikes in a bid to change the gridlock and the status quo, amid reporting that President Trump has been advised in recent weeks that limited strikes could help pressure Iran to reach a deal, because at this point, the latest is that both sides are rejecting the freshest counter proposals from each one of them, right? We have Iran really maintaining that they don't want to discuss any curbs around their nuclear program, while the U.S. says that its naval blockade isn't going anywhere until a deal is reached. In fact, we got an update just yesterday from CENTCOM confirming that so far the U.S. has redirected 85 ships in the U.S.'s attempts to secure the Strait of Hormuz.
Hey, I want to ask about the fund that I guess President Trump's lawyers have set up with the Department of Justice, $1.8 billion in taxpayer money that will go to people like the January 6th attackers, whom the president pardoned. How does this administration justify that when so many Americans are struggling with high gas prices, struggling to pay for child care, struggling to pay for medical care?
Well, this is a point of criticism that we are hearing raised when it comes to this fund. I liked how the Wall Street Journal put it this morning, saying that it was big on money and symbolism, but so far it's pretty small on specifics, Matt. So we're still waiting for more information on exactly how this fund is going to work. But it is part of President Trump's settlement with the IRS over a $10 billion lawsuit linked to the leaking of his 2019 of the leaking of his tax returns back in 2019. You'll recall this was a big data breach that happened and included many wealthy Americans, not just President Trump, but also Elon Musk, Jeff Bezos, people like that. At the end of the day, so far what we've heard from the Attorney General is that this is set up to be the anti-weaponization fund, to formalize a process to address the claims of those that have suffered alleged weaponization. It is set to end just a month before President Trump is set to leave office in 2028. We'll have to see where it goes from here, but the criticism is coming particularly from Democrats who are alleging that this is a slush fund. We got this statement yesterday from House Democrats saying, in part, quote, "This is pure fraud and highway robbery." At this point, we should say an agreement. Under this agreement, President Trump would not receive any money directly, but the mechanics appear most likely to benefit those allies of his.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall back from her trip to Beijing and reporting live from Washington, D.C. Coming up, Jay Hatfield explains why he thinks the S&P 500 could, in the best scenario bull case, hit 8850 this year. That would be a 30% gain from the close in 2025. This is Bloomberg Open Interest.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
To the minute geopolitical news whenever and wherever it's happening. I'm Anne-Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Our next guest says that the S&P 500 could top 8,850 if the 10-year yields fall and earnings stay elevated. Infrastructure Capital's Jay Hatfield does note that for this bullish call to play out, they would need 10-year rates nearing 4%. And I'm so pleased to say that Jay joins us now. So 8850 bullish case. Is 8,000 still your base case, John, for the Jay, for the S&P 500?
It is, and you know it's critical. I just booted it up on my terminal to keep watching 2027 estimates. So when we did our target, they were at 350. They're now at 385, so they're up 11%. So we've kept, for the upside target, 23 times. But to justify that, if you do a DCF, you really need rates to be about 375 to 4, because there's an inverse 10-year rates. There's an inverse relationship between multiples and rates. But what's great about that is even if the strait remains closed and rates are elevated, you can still justify a 21 times multiple. So 8,000 in a way is our downside target, and that's all driven, of course, by this huge AI boom and the associated increase in EPS estimates.
By the way, Jay, I'm just looking, shout out to my buddy Tommy, just sent me a message. 30-year yield just moved above the high in 2023, highest since 2007. So the 30-year Treasury at 518, essentially. It used to be that, like, we said 5% will bring the buyers in. But now it's like either we have a much higher yield, or you get a Middle East de-escalation, or you get evidence that inflation's cracking. Like, what brings yields back down?
Well, actually, what's interesting, as you know, we follow MIPR, so that's the future Fed funds rate. There's a very reliable relationship. It's about 100 over that. And the 10-year, we focus on the 10-year because it drives the 30-year mortgage, has actually outperformed that. So it's really only about 80 basis points over. So there's been flows maybe from overseas, safe haven. But so the 10 years outperformed what you would have expected, given this huge bearishness in the Fed funds futures market. So the Fed fund futures market is assuming an increase, which we think is ridiculous, but true. So the 10 years actually pretty well behaved, but the bad news is it could trade off into the 4.85% range. That obviously put pressure on the stock market.
And your target, I mean, you need rates to be 4, and we're going like, we're getting towards 1% in the other direction.
Right. Or to get to 21 times, you'd need about 450. So if we sell off to 5, that could be a problem. So we do really need the strait to be reopened to probably resume the rally that occurred in April.
All right, you're going to stick with us because we're going to talk more about this. I will say that in the past, when you've come on with really bullish targets, we've thought, wow, Jay might be crazy. And then they keep hitting. So that's why we keep having you back on. You've been right. Not just that you're smart, and also you have great data. Jay Hatfield's going to stick with us throughout the opening bell. We are looking at futures that continue to move lower as yields move higher. So right now, S&P futures down 0.6%. But remember, we still closed at 7,400 yesterday. The opening bell on the other side of this break.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at equity index futures that are lower and continuing to fall further as rates climb. We just saw the U.S. 30-year yield rise to the highest level since 2007, which, you know, when I first heard that stat, I thought, okay, that was almost 20 years ago, but it wasn't that long ago. The point is that was before the great financial crisis. We haven't had rates that high since then, and there's a generation or two of traders who've never seen this before. So S&P futures, NASDAQ futures down, and the tech companies getting hit even harder. We have a decidedly untech company ringing the opening bell at the New York Stock Exchange, Kava. This is the Mediterranean
slop bowl.
So I wasn't going to say that. I still haven't tried it, but I'm sure it's delicious.
It. I love a slop bowl, not going to lie.
Well, and their stock, I mean, you know, I look at a 5-year period. That's my default.
Sure.
It's up 260% in 5 years.
That's pretty good. I feel like it hasn't been doing well. No,
it hasn't been doing much. It's been down and flat, but over 5 years, pretty damn good. Here we have MKS ringing the opening bell at the NASDAQ market site, and they provide a whole bunch of gauges and valves and capacitors and stuff that I don't understand. Jay's kid, who just graduated in electrical engineering from Penn State, he knows.
I'm sure he does.
But it's like they have gear to make semiconductors. Is it Penn State or Penn? Penn. Sorry. I guess that would be an insult.
Yes, it would.
Right?
Both wonderful schools. Slightly different schools, though.
In any case, they make the stuff for semiconductors, so they're up 85% year to date.
Wow.
Yeah.
Again, it's all these random companies that you've never heard of that are big AI trades like Boilermakers, MKS, or whatever they were. I'm looking at companies that are decidedly tied to the AI trade. Chip makers are down today, as they have been over the past 2 trading sessions. Micron and SanDisk down 0.5% for Micron. SanDisk is down 1.5%. That's not as bad as we saw pre-market, to be fair. But what is sticking is, for whatever reason, software companies are on a huge tear right now. They've been up for the three consecutive sessions. Today makes it 4th. ServiceNow up 3.5%. No clear catalyst, maybe just some short covering after this big run-up you've seen in the AI stocks, Matt.
All right, it's a little bit of a rotation there. Obviously, the semiconductors have had their day. Let's talk about CoreWeave moving after competition from Google, which agreed to create its own AI cloud business with Blackstone. So you see CoreWeave to the downside, off 4% in the cash trade. Meta moving 7,000 jobs to AI roles. So I'm not talking about firings here, although they are going to fire thousands and thousands of people. Anyway, the stock not reacting much, down 0.6%. NVIDIA, obviously, we just want to look at it ahead of the earnings, which are tomorrow after the closing bell. So we have 2 more sessions between us and NVIDIA, the all-important NVIDIA earnings. Right now, it's pretty flat. Joining us, or coming back to us right now, is Infrastructure Capital CEO and CIO Jay Hatfield. And Jay, let me just ask you, as you've been to so many graduations lately, congratulations on that. What do you make of all of this AI taking our jobs news? Because it does seem to be happening, right? And is it a concern for the economy? Because yesterday, Veronica Clark on Surveillance said she thinks the Fed could cut rates 3 times this year because the jobs numbers will look so bad this summer.
We don't agree with that. The key driver of jobs is investment. And obviously, you have tremendous investment coming from the hyperscalers. There's going to be a lot of job churn. You know, if you mention AI at a graduation, you get booed. So it is making it harder. My son does not have a job coming out of Penn. And that's because these huge companies are laying off people. But that's not the overall job market. I mean, we all obsess about it because it's our kids or friends. But the big job market is all those jobs building these hyper scaling situations, building power plants, building chip plants. So that's really the key driver.
He's an electrical engineering graduate. He should be doing just that.
Yes, he'll be fine. But it is creating a churn and dislocation, and that's why you should not mention AI in your graduation speech.
Well, I mean, I've made this argument to Matt before, this idea that, yes, it creates jobs because you need to build these data centers, but they're temporary jobs. Once they're built, you need essentially, on average, I think it's about 50 people running the place. It's just, you know, some HVAC men and women. And if you put the same amount of money in the pharmaceutical industry, for example, you'd be creating 1,500 jobs per data center. So it feels like maybe here and the now we're okay, but long term, is this a very different labor market we're going to need to contend with?
Well, there's going to be tremendous reallocation among job categories. But if you look historically, the only thing that's caused unemployment is a severe contraction in investment. So as long as the investment boom continues, there will be growth in jobs, and the market will clear. So obviously, software engineers are going to be less needed, maybe hardware engineers more needed. Other job categories. So there's going to have to be retraining. We have a very dynamic job market in the U.S. Think we're not Europe. And so people will adjust and the market will clear.
By the way, this idea that we're going to keep spending and going to keep building out, I understand the thesis. It makes complete sense considering that we are so far under the capacity for compute, for energy, you name it, that we need. But don't these hyperscalers and all the big companies have every incentive to find efficiencies? Is this not how this ultimately ends, that the scarcity economics gets flipped because we figure out some way to bend time and space?
Well, I think the productivity is spectacular for investment. And if you really just look at Silicon Valley, you get big layoffs from the big companies, and guess what? It creates startups. So there's always new jobs, market's dynamic. If technology created unemployment, then we would have mass unemployment because of the steam engine being developed. So those are all irrational fears, but it is not great for graduates right now, and you do have to monitor the job market and be dynamic.
By the way, your calls have been so spot on over the last few years when there have been a lot of fears, rational or irrational, right? A lot of them, you know, politically influenced. If you have TDS, right, you wouldn't have thought that this market is going to climb so far so fast. How do you do such a sober analysis of these markets when you have things like, you know, ridiculous tariffs or maybe a botched invasion of a Middle Eastern country leading to the closure of the Strait of Hormuz? Like, how do you separate that stuff?
Well, you have to look at economic history. So everybody who's on television implies that recessions are created because the consumer stumbles, but that's not the history. Recessions are created from the investment side, and that's why we're bullish on the economy. Is if you look at first quarter GDP, construction and housing in a pretty significant recession, but the tech business is booming like it's never happened before, up 15%. That's why even if the Strait remains closed, we're projecting 2.5%. But you have to be laser focused on the things that matter: money supply, oil prices, and investment. If you just focus on that, you won't make these bad calls like, oh, the consumer is going to roll over because of student loans. And you'll recognize when we are going to have a recession, you know, if the Fed raises rates, we don't have a tech boom, and housing crashes, we're going to have recession. That's 13 out of 14 recessions are created by that dynamic.
All right, Jay, thank you so much for joining us. Great to have you in studio. Infrastructure Capital CEO and CIO, Jay Hatfield. Let's get a check on your equity market because we're still down, but I just want to mention there is some very clear dip buying going on in the AI names, the chip makers, because before Micron was one of the worst performers in the S&P 500. Look at where it sits now, up 2.5%. It's helping to lift the index up by 2 points, as is Apple this morning. Nvidia also turning around after earnings, before we'll get their earnings tomorrow. AMD, Microsoft, and then I pointed this out before. All of these software names are oddly having a really good day. Salesforce, ServiceNow, Intuit, all up at least 2%. Though we are still down because you have a lot of these big mega cap stocks down. Amazon, Alphabet, Broadcom, Tesla, Meta, those are down. So a lot of the Mag 7. Home Depot falls after its earnings with a weak housing sector weighing on their results. If you look at the indexes, the only one that's doing better is Infotech. And that's because of, again, and utilities now, because you have twofold. You have some of these chip makers turning around, and the best performer in the S&P 500 is ServiceNow this morning. So software names doing well. Utilities, real estate, energy, those not doing as poorly. At the bottom of the pile, you have materials and consumer discretionary. Matt.
All right, interesting moves there in this market as we look at the 10-year yield eclipsing 4.65, the 30-year yield up over 5.17. Coming up, Jensen Huang expects Chinese authorities to eventually allow the import of AI chips from the U.S. More from our exclusive interview with him and Michael Dell next. This is Bloomberg Open Interest.
We are dealing with supply issues, and so therefore fertilizer, the planting season, food security is high up there, but so too is fuel and energy. So yet again, as we had with Ukraine, the energy crisis, the food crisis, the cost of living, and that kind of fiscal space needs to be created for countries that are going to be dealing with the debt crisis. They are still repaying their debts. Inflation will result in interest rates that will put many countries in jeopardy on the debt issue. So we're looking to find solutions here from the IMF, from the World Bank. There have been many offers of the windows and facilities that could be put at the disposal of countries. But I think at this stage we need scale. Many countries are still recovering from the previous shocks, and some of those crises are not over yet.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Just over 10 minutes into your trading day, let's look at the top calls, what the sell side is saying this morning. First up, CFRA, they are cutting Citigroup and Bank of America, saying that the Iran conflict could hit consumer spending and loan growth. CFRA says Citi's big run and strong first quarter make future upside harder. At the same time, Bank of America faces risks across lending, commercial real estate, and consumer activity as costs rise. The entirety of the banking sector is off this morning, but not by huge amounts. Next up, Guggenheim has upgraded StubHub to a buy, saying expectations for this year are too low, and even small wins in direct ticket issuance or advertising could drive upside. The firm also says that worries around regulation are starting to fade. Shares up a nice 5.7%. Finally, analysts are positive on Amer Sports. Oh, you're right, Matt. That is a tough name.
It's tough.
Amer Sports. They raised full-year guidance on strong demand for Salomon and Arc'teryx brands. Citi highlighting a sharp outdoor margin rebound. Evercore called it the strongest earnings delivery in the sector this season. I get it's supposed to be America and like Amerisport, it doesn't work.
If they said Amerisports.
Oh, Amerisports, that is what it should be.
You know, if they just add an I.
Yeah, Amerisports, that's way better.
In the middle. In any case, I doubt they're going to change it anytime soon. And it has, as we said, some really fascinating and sought-after brands. NVIDIA CEO Jensen Huang told Bloomberg that China will eventually open its AI market to U.S. chips in order to sustain growth. A little bit of wish casting there. He spoke with Bloomberg's Ed Ludlow alongside the CEO of Dell, Michael Dell, at the Dell World Conference in Las Vegas.
The president wants America to win everywhere. Right. The president wants America to lead the AI revolution. And so H200s are licensed to sell to China. The Chinese government has to decide how much of their local market do they want to protect, and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open. President Xi was very clear that he wants China to be an even wider open market. Premier Li Qiang was very straightforward and explained very eloquently that China will be an open market. So I'm looking forward to China being a more open market.
To clarify, Jesse, you were able to meet with those officials directly to discuss whether or not you can sell to those Chinese tech companies.
I didn't discuss directly with them about H200. Right. I was there to represent the United States, and I was honored to do so. I was there to support President Trump, and really glad to do so. But that was really the focus of my trip. President Trump had some conversations with the leaders, and I'm looking forward to what they decide.
Michael, you did not go to China, but I think what's interesting is you are a member of the President's Council of Advisors for Science and Technology, as is Jensen. Your net conclusion on whether or not China will become open to American technology companies to do business there?
You know, we have a business in China. Obviously, we comply with all the restrictions and various controls that are in place. But I hope that there's more economic collaboration between the United States and China. That ultimately is what will lead to greater outcomes and prosperity for everyone, and a greater likelihood of a successful relationship between the countries and around the world.
Let's discuss with Bloomberg senior technology editor Mike Shepard in D.C. And Mike, this has been fascinating to follow because first the U.S. said China can't buy any of our chips on national security grounds. Then the Trump administration said if we get like a 25% cut, we'll allow sales of certain chips. Then it seems like in the meeting with Xi last week, they decided to allow those certain chips again, which still confuses me. And the whole time China is saying, we're not buying them. So how does this end up?
Well, that is a great question, Matt, because heading into this meeting, one of the big unanswered issues was whether China would actually start allowing the imports of H200 chips that President Donald Trump had cleared at the end of last year. And early this year, the Commerce Department had even issued licenses for. And yet on the Chinese side, while there are signals of possible demand, authorities there remain wary of allowing those chips in. And there are two reasons. One is obviously, and it echoes the concerns here about Chinese technology, they are worried about security. Could this be some sort of backdoor for American technology to perhaps even spy on China? But more broadly, they are concerned about trying to protect their own domestic chip-making industry. And, Matt, we're talking about companies like Huawei, like Cambricon, like SMIC, which have their own chip ambitions. But then, on the other hand, you also have AI hyperscalers in China, like Baidu, like Alibaba, that also would be eyeing compute power, just like the AI companies here in the U.S. are trying to get as much as they can, as quickly as they can, and they don't really care as much about where it comes from. And that is what Jensen is getting at during this interview. He is saying that, look, the market demand on the AI hyperscaler side in China will be so strong that it will simply drive the market to allowing more of his company's chips in. And, Matt, this is an important question for NVIDIA. Jensen Huang has previously identified it as a $50 billion opportunity for NVIDIA in China. And we'll be hearing more about it, no doubt, tomorrow after the earnings are released.
Well, speaking of the crunch around compute, Mike, it's a problem that everybody is throwing money at, including Alphabet and Blackstone, and a new deal that was announced yesterday. It's having an impact. It's selling CoreWeave. Some of the neoclouds are selling off. What exactly does their partnership look like? What is it looking to solve?
Well, the partnership between Alphabet and Blackstone, they are really looking to accelerate this build-out. They are seeing the need for compute, and they are seeing an opportunity. And also, when you think about the two teaming up here, this is a question of scale. Blackstone is one of the biggest investors already in this space when it comes to data centers. And, of course, Alphabet is one of the biggest kids on the block. And they, as a longtime cloud computing provider, also have a little bit of a legacy edge. And, of course, their DeepMind and Google AI technology is driving a lot of this. So in a lot of ways, this is a match that looked to be written in the stars, Danny, and then we will look to see more about how this develops. And remember, they are trying to do this investment in the face of growing skepticism that you were talking about in the last block about job impact and also about what data centers are going to mean when it comes to cost of living here. There is a tension here in the U.S. about the impact overall of the AI rollout.
Hey, Shep, thank you so much for joining us. That is Bloomberg's Michael Shepard. Coming up on the show, G7 finance chiefs pledge not to overdo any fiscal aid as the Iran war raises growth and inflation risks to the global economy. We're going to get the latest from Paris. That's coming up next. You're watching Bloomberg Open Interest.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Treasury Secretary Scott Bessent is calling on G7 nations to increase sanction pressure on Iran. They are currently meeting in Paris, where Bloomberg chief European correspondent Oliver Crook is there and joins us now. Oliver, I mean, it's a precarious situation that the G7 finds itself in, where budgets are tight, deficits are high, and yet there's this pressure from Iran and higher energy prices.
Yeah, I mean, that's a very uncomfortable equation before a lot of these central bank governors and finance ministers who are all gathered here in Paris at the French finance ministry. And that's really been at the center of the discussions. I think at the end of the day, it's very difficult for everybody, even the most sort of sophisticated economists, central bank governors and finance ministers, to really know what to make of it, because they just don't know how long this war is going to last. But I've just caught up with the president of the Bundesbank, the ECB governing council member, saying that, listen, we're now 3 months into this war. It's very clear that this is something that is here to stay, and that is something that we're going to need to factor into the rate path ahead of us, and really indicating to us what I think the market is already priced in, that it's very likely that you're going to have to get a rate hike here from the Europeans. But Danny, you point to something else. It seems that there are all these conversations happening. There are these two wars happening, oil elevated at $100 a barrel. You have fiscal space completely constrained, and it seems now all of a sudden the bond market has woken up to this fact, and you're seeing it represented across yields across the G7, where you're seeing the highest yields you've seen basically since the financial crisis, and in some cases since the late 1990s. And meanwhile, you have equity markets in the United States completely parabolic. And I asked the central bank governors, what do you make of this situation? And all they were able to say is that it actually is quite uncomfortable.
What are they prepared to do about it, Oliver? There's been talk about the potential for G7 for concerted intervention, right? Which may make sense if you have the highest long rates in some cases 30 years. So have you heard talk on the edges of that conference about the potential for a concerted intervention here?
I think we're not there yet, Matt. What I think, though, is very interesting is that you're talking about the G7, which is a format that was originally defined by the G6. And this was something that was rolled out in the 1970s. And one of the things it was rolled out to do was to deal with the global oil shock from the 1970s, right, in collective action at the G7 level. And that is basically some of the sort of theory behind the architecture of foreign policy and the sort of American-led system that has really led the system for those 50 years. But that system is now over with the Trump administration. Right? So there is not very clear appetite to act at the collective level at the G7. For the French who are hosting this meeting, they went to great lengths to try to sort of frame all of these discussions in a way that they could get a communique at the end that the United States sort of signed off on. But it's not clear that there is appetite for that kind of coordinated actions. That being said, there have been a little bit of conversations at the margins here. No one is ready to do this yet, but I spoke to the French finance minister who said really one of the things they could do at the G7 level, and they're not ready to do so again, is to release potentially oil reserves. But that's not really actively in the conversation, though they did do that at the beginning of the crisis.
All right, Oliver, thanks very much. Oliver Crook, they are coming to us live from Paris at the G7 meeting of finance ministers. Coming up in the next hour, Raquel Oden from HSBC talks about fund managers boosting stock allocations to the highest levels that we've seen in years. And the CEO of Williams talks energy infrastructure as the Strait of Hormuz remains closed. Plus, Zach Brown from McLaren joins us at the desk as his drivers and engineers make great improvements in F1.
don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
ABC News. I'm Sherry Preston. As Attorney General Todd Blanche appears before a Senate Appropriations Subcommittee, there are continued questions about the legality of the fund that's been set up to help those the Trump administration says were unfairly targeted by the Biden administration. The ABC national correspondent Stephen Portnoy with more from Washington.
Under the arrangements made public by the Justice Department, the $1.8 billion settlement fund will be controlled by a 5-member board appointed by the Attorney General, with one of the members recommended by congressional leaders. The members can be removed by the president for any reason. Their decisions will be final, with no appeals allowed. The disbursement of taxpayer money is to be kept confidential, with the names of recipients provided only to the Attorney General.
Treasury Department's top lawyer resigned hours after the announcement of the fund was set up as a stipulation of the president dropping his $10 billion lawsuit against the IRS over leaked tax documents. The investigation goes on into those believed to have shot and killed 3 people at the Islamic Center of San Diego on Monday.
Sources tell ABC News that investigators are looking at those 2 teenagers, Kane Clark and Caleb Vasquez, as the suspects in the shooting. Police said after they got that warning call from one of their mothers, they were searching all over San Diego. They sent officers to a mall, even to the high school of one of the suspects. They were still searching for that vehicle when they got the call about shots fired here at the Islamic Center.
ABC's Trevor Alt in San Diego. Health officials around the world are monitoring the Ebola outbreak in Central Africa. ABC's Faith Abube is at the CBC.
The rare variant of the virus is suspected to have killed at least 131 people so far, and doctors are monitoring more than 513 suspected cases in Congo. A few others also reported in neighboring Uganda.
An American doctor working in the Republic of the Congo testing positive, but there have been no cases on U.S. soil. Oil trading internationally at $110 a barrel, and the Dow is down 91 points. This is ABC News. In the land of oil, the sun breaks through.
Electricity generated by solar farms, some spreading thousands of acres, is expected to surpass coal for the first time this year within the power grid that covers most of Texas. Natural gas remains the dominant power plant fuel, but solar's share has increased from 4% to 12% since 2021. Considering the Trump administration's new restrictions on wind farms, solar may soon catch up to wind as a force behind Texas electricity. Jim Ryan, ABC News, Dallas.
A mega utility merger is being proposed that would combine NextEra Energy and Dominion Energy. Both companies have customers from Florida up through Virginia, and many of them seeing their rates jump as a result of new AI data centers. Here's ABC's Sophie Flay.
President Trump recently got tech companies to pledge to pay for infrastructure upgrades to protect customers. Democratic Senator Adam Schiff claims that doesn't go far enough. He's proposing a new bill.
What the bill would do is it would say to data centers, bring your own energy and make sure that when there are changes in the grid that are necessary, that you pay for those changes.
NextEra says the scale and efficiencies brought by its merger with Dominion will result in more affordable electricity for our customers in the long run.
Others are questioning that claim. A new survey by LendingTree says 39% of Americans find owning a car unattainable when you take into account loan payments, insurance costs, and the rising price of gasoline. Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube. We're streaming live on Bloomberg.com as well. Coming up, we're going to check in with Tyler Kendall, Bloomberg Washington correspondent, get the latest news reporting out of the Middle East. Margie Patel, Senior Portfolio Manager at Allspring Global Investments, to discuss her outlook for the markets. We're going to talk about the bond market. That is the story today. Caroline Hyde, BTech co-anchor, will get her thoughts on some of the leading stories in technology. I saw the Meta moving 7,000 workers into AI roles ahead of job cuts, so we'll get the latest there. Brendan Greeley, author of the book, The Almighty Dollar, 500 Years of the World's Most Powerful Money. And he's a contributing editor to the Financial Times. He'll join us here in studio to talk about that. Drew Redding, Bloomberg Intelligence home building analyst, give us the latest on Home Depot. They reported some earnings. So it's Scarlett Fu and Paul Sweeney. This is the Bloomberg Intelligence program. Let's kick it all off with John Tucker, any Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash brought to you by Eisner Amper. Most advisors tell you what happened. Eisner Amper tells you what to do about it. Assurance, tax, outsourcing, and advisory services built for businesses that can't afford to guess. EisnerAmper.com. A headline's crossing the Bloomberg right now. It's a red headline. That means it's important. NATO to consider Hormuz deployment if Strait not open by July. So let me go right to Brent, the international benchmark for oil. It's down 1.7%, still well above 110.18 a barrel. So as soon as we flush that out, we'll bring you more details if anything crosses. I also want to start with the yields near a 20-year high. And Paul, you mentioned this earlier, the John Author's column. He pointed out that the yield on the 10-year Treasury bond now exceeds the earnings yield in the S&P 500 to an extent that we haven't seen since the end of the dot-com bust.
Really?
So, put that in your pipe and smoke it. Stocks right now, they are lower, but they seem somewhat immune to the rise in yields. The 2-year up 5 basis points, 10-year up 6 basis points, 464. The long bond 4 basis points higher, 516. The Dow right now down 140 points. S&P 500 45 points lower. The Nasdaq Composite Index down 257. And the Philadelphia Semiconductor Index, that is down right now 2.5%. Amanda Agati at PNC Bank, she says stocks, they can still push higher.
The underlying fundamentals and earnings season for Q1 just incredibly strong. Still, in our opinion, has a lot of legs left in this rally.
And Home Depot, do that real quick. We're going to take a deeper dive in just a second. Missing sales expectations Lower housing demand, high borrowing costs, that all adds up to bad news. Home Depot down 0.75% right now. I guess this is all the rage, but Intercontinental Exchange, they own the New York Stock Exchange, adding futures contracts for computing power. You'll recall that in Chicago, the CME did the same thing for compute futures contracts last week. Cost of running AI technology rises, so you have to, I guess you have to hedge against price swings. So this is a pricing mechanism and also something of a risk management tool for them. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Keeping cool. Scarlett and Paul.
Went to the beach yesterday. Could not stay on the beach. It was so windy.
Oh, yeah, that happens.
So you didn't even dip your toe into the water?
Yesterday, no. Today, I'm going to give it another shot. But I went in Sunday. But, I mean, yesterday it was hot at the house. Go to the beach. Winds is whipping off the ocean.
Yeah.
So, anyway, we'll see how it goes today.
Yeah, so we have, it's really hot in the metropolitan area. And then for Memorial Day weekend, it's going to be really cold.
And rainy. Yeah, exactly. That's how we do it here in the Northeast. John Tucker, thank you so much. Appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. Streaming live on YouTube as well. Market Drivers today is brought to you by IBKR. Trade election, climate, and economic outcomes with IBKR prediction markets right alongside your stocks and options. Earn interest on your position and receive $1 per contract if you're right. Learn more at ibkr.com/predictions. Let's take a look at what's happening in the marketplace today. Stocks on the move. We do that with Matthew Griffin. Matthew, what are you looking at today?
Well, the first one I've had on my screen this morning is Home Depot. It is an important read on the U.S. consumer right now, and investors not taking it as a positive one. That stock ticker HD now down about 0.9%. And if you look at comparable sales, that's a key growth metric for them. Growth there was just 0.6%. Analysts wanted 0.9%. And it's problems that have dogged Home Depot for a while. Interest rates are high. Housing prices are high. That means consumers, they don't want to undertake big remodelings that they'd have to finance. They don't want to buy new homes that they would then, do home improvement work on. They're still painting, they're still gardening, but that's not nearly as lucrative. And although the company isn't seeing a big hit from the Iran war yet, it is easy to imagine that's going to show up at one point in results. And so you've got a pretty muted investor sentiment here. Shares down about 14% now year to date.
Yeah, so here's a counter narrative to the U.S. economy is doing fine. Consumers are, spending as they were. The high gas prices, the high borrowing costs, it's certainly starting to affect how people spend. And we're seeing that show up in some of these consumer companies. Let's talk about Micron, which has been such a superstar earlier this year.
Yes, well, Scarlett, Micron now extending declines into a fourth session. Shares down about 2.5% now. That's ticker MU, and there doesn't seem to be a key catalyst here. Investors are just retreating from risk, and they're retreating from these semiconductor stocks that are up so ferociously this year. Of course, these memory names have been some of the leaders in the advance, and Dan O'Regan, he's the managing director of equity trading at Mizuho. He said earlier it's basically just an unwinding of momentum going on here. Of course, Micron's still up 132% year to date, so that rally has not collapsed, but there are maybe some cracks showing.
All right. Okay, ServiceNow.
Well, ServiceNow, that's ticker NOW, may just be the opposite trade here. They are up about 4.5% and in a fourth session of gains. And these semiconductor software trades have really been opposites this year. Traders very optimistic until recently about demand for semiconductors due to AI, at the same time worried that AI will eat software companies' lunch. And so you see maybe some money rotating out of semis, and where does it go? It goes into these names where there are fears of AI disruption. So the AI trade may be taking a bit of a step back today. I was actually looking earlier, the correlation between software and semiconductor stocks in the S&P 500, though, still stands at the lowest since 1994 right now. So they really have, they're still opposites to an extent.
All right, Matthew, thanks so much. Appreciate that. Matthew Griffin, equities reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Let's get right down to Washington, D.C. Tyler Kendall, Washington correspondent for Bloomberg News. She's down there in D.C. Tyler, a lot of news coming out of your neck of the woods again here. It looks like most recently was just NATO may be trying to get involved a little bit here with the Strait of Hormuz. What do we know about that?
Well, Paul, this would be significant. A senior official with the military alliance telling Bloomberg News that NATO is discussing the possibility of helping secure ships' safe passage through the Strait of Hormuz. We should say that this has support from several members of the alliance, but at this point, not full unanimous support that would be necessary in order for NATO to deploy military assets. But it comes as so far the alliance has been wary at best of President Trump's calls to have allies help secure the Strait of Hormuz. We've often heard that many of them want to see a stop in the fighting, a stronger ceasefire in place, because I think it's fair to say at the moment the ceasefire is very tenuous and very fragile. Now, this would be significant, and it's going to put more focus on the annual NATO meeting that's happening in Turkey in July, because President Trump has ramped up his threat since the conflict with Iran has started that he could pull out of the NATO military alliance. So that may be easier said than done. Legislation passed by Congress in 2023 forbids any president from withdrawing from the NATO alliance without 2/3 of support in the Senate. But Paul and Scarlett, we know that it's straining the transatlantic alliance, and there's other things that President Trump could do. For example, he could recall the U.S. ambassador to NATO, or he could cancel American involvement in joint military exercises. So definitely something to watch.
Definitely something to watch. And as you pointed out, NATO had wanted to see an end to the conflict. And if anything, they have insisted that they only really want to be involved in the Strait of Hormuz once fighting has stopped. So the fact that they're now considering any kind of deployment if the strait's not open by July would seem to indicate that they're giving President Trump kind of what he wants, which is NATO stepping in to do more, isn't it?
Yeah, I think that's the right read on this, though. Again, we should caution that no decision has quite been made yet, but it does come as President Trump has been making this outreach to other countries, right? He just came back from his travel to Beijing. Right now, Russian President Vladimir Putin is in Beijing. So there's a lot of heightened focus here when it comes to alliances. So we'll see where it ultimately goes from here, because President Trump has previously fumed about how some members of NATO have rejected his calls when it comes to the Strait of Hormuz. Though, Scarlett, at the moment, the strait does remain effectively shut. Yesterday, we just heard from CENTCOM confirming that nearly 88 ships have been redirected by the U.S. who have tried to transit through the Strait of Hormuz. The U.S. says that its naval blockade isn't going anywhere until a fuller deal is reached with Iran. And at this point, we haven't really gotten indications that we are any closer towards that happening.
Tyler, the news on Wall Street today is the movement in the bond market. We have rates higher yet again today in the bond market here. Is there any sense that the White House and this president is sensitive to what's happening in the financial markets as it relates to perhaps this war in Iran?
That's an interesting question. We've previously seen President Trump be sensitive to the markets, right, Paul? When it comes to the oil market in particular, that we've seen the administration try to keep and tamp down rising fuel costs. Just yesterday, we had the Treasury Department announcing this new license for a temporary allowal to buy purchases of Russian barrels that are already loaded onto tankers and at sea to get more of the oil supply to the global market, because we know that the administration is coming under pressure from the market, but also from consumers and Americans as they head to the polls this week for a slew of primaries in a flurry of states, and affordability and the cost of living remains that top concern. Just yesterday, there was reporting from Iranian state media that the administration could be looking at lifting Iranian sanctions temporarily. Doesn't seem like that's happening. A White House official did dispute that report, but we're going to watch closely, as the president said when he was coming back from Asia, that maybe he would consider lifting sanctions on Chinese oil refiners linked to Iranian crude. So again, something to watch, but very clear that the administration has their eyes on this.
All right, very good. Tyler Kendall, thank you so much. Tyler Kendall, she's a Washington correspondent from Bloomberg News. She's down there in D.C. And again, the story, Scarlett's in the bond market today, just grinding higher. We're going to hopefully get John Authers in the next hour. He's got a good column out about what's happening out there in the bond market. But that's where the angst is. But equity markets are hanging in there.
I know the contrast is really striking, and at some point, everyone says this is going to spill over into the equity market, but it hasn't yet. Just like the big moves we've seen in the bond market has not really enticed dip buyers either.
Yep, absolutely. So maybe it's the fact that you've got gangbuster earnings that we just reported, and some decent outlooks by corporate America. So we'll see how it plays out, but we'll be on top of it. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News, and with this Bloomberg Business Flash, it's worth recapping that headline we had. NATO discussing the possibility of helping ships pass through the Strait of Hormuz if the waterway isn't reopened by early July. Let's start with Brent crude, the international benchmark. That is down just about 1.1%. Still well above $100 a barrel, 110.78. Also, WTI is down about 0.5%, 108.12 on West Texas Intermediate. The long bond earlier did hit the highest level in almost 2 decades. Right now, the 30-year up just about 7 basis points. It's at 5.19. Then the 10-year will do that quote as well. That's 9 basis points higher at 4.67. And I mean, to oversimplify it, but its mortgage rates take their cue usually from the 10-year, and you know the drill. Higher yields could lift mortgage and corporate lending rates. Right now, in the equity space, 6 of the 11 major industry groups in the S&P 500, they are lower, led lower by materials stocks. And NVIDIA is going to report after the close of regular trading tomorrow. Those shares right now down 1.8%. After the earnings report from Home Depot and the sales miss there, the shares have actually turned around. Home Depot now up 0.3%. And the property analytics firm Cotality says more than 3 million New York metropolitan area homes are vulnerable to hurricane winds. That's actually the most of any region in the country. According to their 2026 hurricane risk report, 3.27 million homes in the area face moderate or greater hurricane wind risk, representing $1.93 trillion in reconstruction
More than
costs.
Florida, more than North Carolina.
Houston and Miami rank second and third at risk. This is according to the number of homes that are exposed to hurricane winds.
Yeah, okay.
There is, I mean, in my view, a simple fix to this. You know, mention Home. You can go to Home Depot, buy hurricane clips.
Hurricane clips?
Yeah, you fix them to the top plate of the roof, to the roof rafters. And
this sounds like it's going to cost me a couple $100s.
No, I mean, the clips themselves are like a couple of bucks.
No, but I can't
each.
get on the roof.
We'll get in the attic. You want it under the roof. That's where it goes. And just make sure you use the right nails.
Okay.
That have the shear
Anybody
strength.
needs that?
No,
John, you know where to find them.
I mean, it's a simple fix. And
Nails and roofs.
Yeah.
I mean, that's...
You
don't want me there.
I'll get some people for that. John Tucker, thank you so much. We appreciate that. Scarlet Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. And again, as John was just mentioned, we got stocks on the move. We got bonds on the move. We got 10-year Treasury up 9 basis points, 4 spots, 68. Ira Jersey, Bloomberg Intelligence out with a note. 30-year Treasury yield risk 5.44% target if key level breaks. So there you go. Margie Patel, she's been through a few cycles. She knows what she's talking about in these markets. Senior portfolio manager at Allspring Global Investment. She's up there in Boston. Margie, what do you make of this bond market here? Treasury yields kind of pushing higher to levels we haven't seen in some time. It seems like the bond market at least has some angst out there.
Yeah, that's true. That's true. But on the other hand, when you look at where inflation is right now, 3 to 3.5 to say 4.7% 10-year, I think isn't really a killer for economic activity.
Yet, if you look at just how the bond market is interpreting events versus the stock market, there's a pretty big divergence. At some point, are the two markets going to start seeing things more in sync, and who's going to give way first?
Well, I think in a way, because we have such an enormous amount of deficit financing to do, like many developed countries do, I think that says to me that interest rates for treasuries might be higher than you'd think compared to, say, the PEs or the dividend yields of stocks. So in other words, you could say, well, stocks look too rich compared to interest rates, but I think interest rates, the appropriate level of interest rates may be a bit higher. What's more important to me, though, is corporate profit margins have been very, very strong, and it shows companies have pricing power, so they have not been adversely affected by inflation, and that to me is a lot more key. Can they keep those profit margins rather than just do treasury rates move up a bit from here? I think their treasuries, are in a trading range rather than on a long trek to much higher levels.
Margie, where are you looking for performance in this market here? Is it some of the tech names that have reasserted their position in the marketplace, their leadership position in the marketplace, or maybe some other areas?
Yeah. Well, I think when you invest in the tech sector, the price you pay to make more than other sectors is you have to ride out these periods of volatility. We've had enormous volatility here, but it isn't because of fundamental bad news from those companies. In fact, we had the Mag 7, except for NVIDIA report, and they all reported really very good earnings, as the rest of corporate America does. So I think that it's more just traders. Also, we've had some IPOs come. We have some more large IPOs coming. People need to make room for those. And now you're in a kind of a news vacuum because you have only bad news about what's happening with the price of oil, except for NVIDIA, companies have all reported, so you don't have any new positive news. So I think it's natural that we'd see this sort of short-term trading correction rather than a fundamental revaluation of the tech sector. So I think it's just one of those short-term downturns that just the way the tech market is, the equity market is right now.
Margie, you are a senior portfolio manager. You also head up the capital allocation team at Allspring. What are you doing with your portfolio? How are you making adjustments or perhaps not making any adjustments?
Well, I think that looking at the bond weighting in the portfolio that I manage is really at a low point because I do think, one, in absolute levels of yields are low, spreads are narrow for corporates, and there is a chance we could see rates drift up. When you look at equities, it looks as if equities, the fundamentals actually look terrific. We had this last first quarter, we had 2% GDP growth, but we had S&P revenue growth of 11%, corporate profits 28%, record high EBIT margins. So that says to me we should disregard short-term changes in bond yields that go up and really look at equities as having the better return for the rest of the year. So we still think equities will finish the year at least well into double-digit rates of return. Bonds look really more like mid-single-digit levels for the year. So we think equities are still more attractive, even with a little move up in treasuries.
Margie, thanks so much for joining us. Really appreciate it. Margie Patel, she's a senior portfolio manager, Allspring Global Investments up there in Boston. We're doing that Zoom thing. Looking at the markets here, again, the sell-off in the equity markets. We got yields pushing higher. Let's talk a little technology. We can do that with Caroline Hyde, BTech Co. Anchor. She joins us live here in our studio. Meta cutting some jobs. I'm trying to read through the story here. My personal opinion is AI is a job destroyer, not a job creator. I'm going to stick with that one until somebody proves me wrong. What's going on at Meta?
Well, interestingly, to prove to the point, the one optimistic note I might on that last view of yours, MIT recognized a few years ago that if you look back over 60 years, I think it's even 40 years, only 60% of the jobs that currently are existing today didn't exist then.
Okay.
So there is hope that we find ingenuity in our lower value human capital. Language matters, folks. Language matters. I'm afraid a CEO who's going to talk out about eradicating jobs, up to 8,000 of them over at Standard Chartered, and calling it lower value human capital, that's going to hurt for the people out there, I've got to say. But by the by, I'm not in PR. I'm in a different type of communications. But the communications that we're getting from Meta is that tomorrow, folks are staying home. If you're working in North America, you sit at home because you're going to learn as to whether you're one of the 10% who are losing your job. That's about 8,000 people. But ahead of that, they're actually reassigning 7,000 people to more AI-focused work. So it's sort of a reassignment of the resources that they've got right now, saying that new jobs are going to be related to AI. So here's your new types of roles that you're going to be seeing more broadly, Paul. You're seeing people perhaps moving from the area of social media where they've lent into, and of course we've known that they've been moving the more hardware-related and augmented virtual reality play, and it's going more into augmented reality glasses, but into more apps and focus on artificial intelligence weaving itself throughout Meta's business model. So the chief people officer is just saying this is going to be a flatter ecosystem. This is going to be smaller teams. They think it's going to be higher value, more enjoyable work. We'll see what the talent think about that.
Yeah, absolutely. And I believe that there's this whole push towards smaller teams anyway across Techland. Everyone's singing the praises of this idea of keeping things really focused and concentrated.
Coinbase said that some teams will just be one person if you're an engineer.
That's not really a team.
I was speaking to a young fellow over the weekend, 29 years old, works in a very big tech company. Yeah. He manages, I think, a team of like 5 or 6 people. He says his people with AI, now this is in the last 6 months, are much more productive. Not 10% more, not 20% more, 3 times, 5 times, 10 times more productive on some of their output metrics. It's just crazy. It's amazing, he says. And I said, okay, I get it.
Maybe if you're a solo engineer, maybe your team is AI.
And I'm just thinking, as a young investment banker, for the first 3 or 4 years of my job, that can all be done by AI.
Yes, you are very high value human capital, Paul. Don't tell me that.
But having done that, you know how the process works too. If you haven't done that before, like you're not able to go in there.
Make me a high yield pitch book for company XYZ, credit rating blank, boom. 2 seconds later, it's out.
Then how do you go through it and fact check and know that it's correct?
Fact check that. Make me a pitch book for a high yield deal would take me 2 or 3 days. Now it's minutes.
Yeah, well, the formatting will certainly be taken care of by AI. That's the most painful part of those pitch books. Caroline, while we have you, I got to ask you about Google creating an AI cloud business with Blackstone. Is this a joint venture of some sort?
It is, and actually Blackstone's putting in most of the money. $5 billion in equity, you leverage that up, it's going to be $25 billion perhaps. Wow. We're talking 500 megawatts of compute in the next few years. That's, what is it? 1 gigawatt is about 750,000 homes in terms of energy. So this is a lot of compute, but this is as they really focus in on their TPUs. This is their tensor processing unit. This is their chip that has suddenly made their AI so much more powerful and really impressed the market with vertical integration. Now, Google builds cloud. They build data centers, but that's expensive. It's nice to get a partner on side to be able to do that heavy lifting for you, not have to put it on your balance sheet as they're expanding out their Google Cloud offering. And they're setting up basically a new neo cloud. So watch the shares, the likes of CoreWeave, of Nebius, of these other neo clouds out there, because it's getting competitive out there, folks.
But Alphabet, are they turning to Blackstone because they need Blackstone as a funding source, or what? I mean, it's a cool deal for Blackstone. I'm wondering why Alphabet's doing it.
Yeah, I think it is the money side of things. Like Alphabet's already announced that they're going to be, what is it, all told, these 4 players, whether it's Amazon, Alphabet, Meta, Microsoft, are spending up to $750 billion, $725 billion, $750 billion, let's call it, in 2026. Yes, people have actually applauded Sundar Pichai's decision to up its capital expenditure plans, but it's still a lot of money. It's still a lot of debt that they got to issue. And so it's nice to know that perhaps the financing of even greater expansion is being taken on by some other players. This is just managing to scale even further how much their TPUs and their chips are doing the work. I mean, I have to say, it's a big move ahead of NVIDIA's numbers tomorrow, because just think, all these other neoclouds, they use NVIDIA GPUs.
Yeah, this is definitely a play for NVIDIA's market, or at least carving up a little piece out of that market. Caroline, thank you so much. Caroline Hyde is co-anchor of B-Tech, which airs every weekday at 11 a.m. on Bloomberg Television. Be sure to catch her and Ed Ludlow then. I continue to kind of marvel at the move higher in yields, because this has been going on since Friday. Friday was really kind of the breaking point. And since then, it's been inching higher, and in this case, accelerating here with the 10-year yield now up 9 basis points of 4.67%. Paul, you were talking about the 30-year yield and how a lot of people are pointing out 5.5% could be within reach now.
Yep, absolutely. And that's not what people had on their bingo card to start the year. That's for sure. So rates moving higher. Today, at least, we've got the stock market moving lower with the S&P down 60 points, 0.8%. This is Bloomberg.
This is breaking news from Bloomberg.
All right, we are listening in to President Trump taking questions. He is at the White House ballroom construction site. Let's listen in.
You're talking about Cuba? Well, we're going to see. Look, Cuba's calling us. They need help. Look, Cuba is a failed nation. Cuba needs help, and we'll do that. Just hold them, though. It's like an exercise game. Give that to me. I'll hold it. I'll hold it. It's so beautiful. See, I look so thin. They'll say, oh, he's gotten so thin because I'm holding this. You don't have to look at my waist. You can look at this. You saw enough of my waist along with President Xi.
Are you confident that you can reach a diplomatic deal
with Cuba? I think so. Yeah, I think so. I am very prone toward the Cuban Americans. They've been incredible people. Many of them have lost family members. They've been very badly hurt themselves. They've been in prison. They've come to this country and they've been very successful. The Cuban American people in Miami, I mean, they are amazing people. Most of them are in Miami, in Florida, but mostly in Miami. I'm very, very prone to helping them. I mean, they've been, I think I got 97% of that vote. I want to help them. Now, they have family members in Cuba. They've been treated very, very badly. They've been treated extremely badly, and we're going to get that solved. That's not going to be hard for us to solve.
You can do that without changing the regime?
Well, I don't know about changing the regime. I could do that, whether you change a regime or not. You know, it's been a rough regime. They've killed a lot of people. But it's a country that really needs help. It has nothing. They can't turn on the lights. They can't eat. We don't want to see that.
Mr. President, how much notice did the Gulf nations have? How much notice did the Gulf nations have that you were going to do these strikes before they actually caught?
They called me over the last 2 days to say they made a lot of progress in because we have them negotiating with us, and primarily Saudi Arabia, Qatar, UAE, Kuwait, a little bit, and Bahrain, and some of the others. And we have them negotiating with them. We're all working together. It's like a team. And Israel, of course, and Israel's been a great partner. And so we are negotiating together. I got a call from numerous of these people. They know the people in Iran. Don't forget, when you talk about regime change, I think it's the ultimate regime change because the first level and the second level are no longer with us. They're someplace, but they're no longer with us. So we have real regime change. But I got a call yesterday, sir, could you wait? We think we're close to a deal. And that's okay. Now, I've heard it before with these people, and they change their mind. I made deals with them, no nuclear. We immediately get the nuclear dust. And they said, you're the only one can get it because the bombers did such an unbelievable job that the mountain literally collapsed on top of it. They said us, and they thought China would be the only two countries that could even get it. But I think it's important to get it, maybe psychologically more than anything else.
Mr. President, today how long did they know that you were planning the Gulf nations?
They knew I was getting ready to attack. I didn't tell them. I never tell anybody when.
You're in constant contact with
I never tell anybody when, but they knew that we were very close. I would say I was an hour away from making the decision to go today. And we would probably not be talking about a beautiful ballroom today. We'd be talking about that. And no, I had made the decision. So they called up. They had heard I made the decision. They said, sir, could you give us a couple of more days because we think they're being reasonable.
Mr. President, today's...
Well, I mean, I'm saying 2 or 3 days, maybe Friday, Saturday, Sunday, something, maybe early next week, a limited period of time. Because we can't let them have a nuclear weapon. If they had a nuclear weapon, they would start with Israel. They would blow it up, and they would blow it up fast. But they'd blow it up, and I'll tell you what, they go after Saudi Arabia, they go after Kuwait, they go after UAE, they go after Qatar, they go after, I think they go after the entire Middle East, and it would be a whole different negotiation. It would not be, it would be nuclear holocaust. And there's no question in my mind that they'd use it. There's no question. And I deal with these people. They're extremely radicalized. These are not people like when I deal with you. You're a very nice guy. These are people that are seriously radicalized. They would use it. The only question, would it be the first minute The first hour or the first day?
How many pause a few times? Has there come a point where you're no longer going to be
I'm not doing this politically. I'm just, look, everyone tells me it's unpopular, but I think it's very popular. When they hear that it's having to do with nuclear weapons, weapons that could take out Los Angeles, could take out major cities very quick. When they hear that, you know, when they're explaining, I'll tell you what, when we explain it to people, I don't really have enough time to explain to people. I'm too busy getting it done. When they understand, I think it's frankly very popular, but whether it's popular or not popular, I have to do it. Because I'm not going to let the world be blown up on my watch. It's not going to happen.
Mr. President, today is the primary with Thomas Massey and your endorsed candidate. Yeah. Do you think your candidate can beat him? And what are you seeing?
Yeah, Thomas Massey's a terrible congressman. He's been a terrible congressman from day one. Dealing with him is just horrible. I don't think he's a Republican. I think he's actually a Democrat. He's not a libertarian. You know, sometimes they say he's really a Democrat. He votes against us all the time. He voted against the border wall. He voted against men playing in women's sports. He voted against transgender for everybody, the mutilization of your children. He voted against, again, open borders. We have the best border we've ever had right now. Nobody's coming in. I mean, a report just came out. In the last 11 months, literally nobody has been allowed into our country illegally. We're taking people legally. They go through a process. But nobody's come into our country. But we've taken out hundreds of thousands of people. We had 11,888 murders. Many of these murders allowed into our country from prisons. They were in prisons. Many of these people killed more than one. More than 50% killed more than one person. This was gross malfeasance. This was on behalf of the Biden administration. I don't know Biden because I don't think he knew he was alive. But Kamala was the border czar. She never called, not one time, she never called the Border Patrol. She never called ICE. She never called law enforcement. She never went to the border. Think of it. I used to call every single day. And that's recently. Now I call less. We have nobody coming through. We had caravans coming through with tens of thousands of people pouring into our country. We had no idea who they were. We would have been, I'll tell you what, our country would have been destroyed. If they won this election, our country would have been, we have now the hottest country anywhere in the world. If they had won the election, our country would have been destroyed. Our country was a dead country 2 years ago, and now we have really the hottest country in the world. And this is the ballroom, and it's going to be something incredible. You see the quality of it, and they go right, those columns go right into the roof. And on top of the roof, we're going to have the greatest drone empire that you've ever seen, and it's going to protect Washington. Thank you all very much.
Mr. President.
We have a little breakfast for you.
Really?
Yeah. Where is the breakfast? I'd have it.
That's
Where is
so
it?
kind of you.
It's right over there. We have a little bit of a breakfast for you. I figured it'd be nice to you, Richard.
All right, the president taking questions and giving answers. At the construction site of the White House ballroom, he did make some comments about Iran, saying that the Mideast countries have asked for a few more days before the U.S. Would presumably attack Iran again. And so he's waiting on Iran for a limited period of time. We'll keep you posted if there are any further headlines. Meantime, we want to continue on with Bloomberg Intelligence, and we have a great guest right now. Let's talk about currencies, because people conflate a currency with the country that issues it, right? Like the US dollar equals the US and vice versa. But if you look at the history of the dollar, it tells us otherwise. Our friend Brendan Grilly has devoted years to studying this and based his PhD dissertation on it as well. He joins us now. And full disclosure, Brendan used to work at Bloomberg as a reporter for Business Week and as an anchor on Bloomberg Television, hosting Surveillance with Tom Keene and myself. So welcome back, Brendan.
Thank you. It's so great to be here. I have one correction to make. Unfortunately, when I arrived at school, they told me your book, your popular trade press book about the history of the dollar, cannot be your dissertation. So I have a completely different dissertation.
Oh my gosh.
It's too approachable.
Wow. Okay.
Yes.
Yeah. No, you didn't need it to be much more obscure in your dissertation.
Absolutely.
Well, let's talk about your book then. It's called The Almighty Dollar, and about 500 years of the world's most powerful money. The U.S. is about to celebrate its 250th anniversary this July, but how does the history of the dollar go back 500 years?
So I had to figure out how to write about the dollar. I had to figure out where to start. So I thought I would start in 1971. Nixon closes the gold window, and then I sort of like keep pulling that thread, and I end up in 1913 with the Fed, and then you end up with what I've been thinking of as the 1776 problem, which is that we learn in school to assume that countries have monetary sovereignty, that they have control over their own currencies. The problem with that is when you get to 1776, the United States declares political sovereignty, but it chooses as its currency a Spanish coin made of Mexican silver with a German name.
I didn't know that.
And so we can talk through like where that came from and how we got there. But for me, the most important part of this story is that at its founding, the United States did not have control over the dollar. It was very clear when you look at the correspondence from the founding fathers what they thought a dollar was. They saw it as a silver coin. Alexander Hamilton called this coin the ancient dollar. And I wanted to actually title the book The Ancient Dollar, and my editor was like, do you intend to sell any books? So, and you know, Thomas Jefferson said it's important when we choose a currency to choose one that the people are already familiar with. So I think of monetary sovereignty now, sort of after doing the work on this book, as something that has to be won with a lot of work, very slowly over time, and it's constantly in danger of eroding. So the story of the dollar is not the story of America. It's not the story of the Federal Reserve. It's not the story of the United States Treasury. It has its own history. So I ended up, you know, literally at the bottom of a Czech silver mine, looking at 500-year-old chisel marks to understand sort of the origins of this currency that is much older and much powerful than much more powerful.
So when did the dollar that we know of, when did that come into existence, really?
Define what we know of.
Okay, I don't know. When did
what we use now?
The U.S. dollar.
Well, okay, so this silver coin, I'll give you like a brief potted history. I think we can do this in like one radio minute.
Okay.
Which is that there was this silver mine in a place called Joachimsthal in Bohemia. They produced only very high quality large silver coins. Those were very useful for trade. Those coins became known as Joachimsthaler, from Joachimsthal, and then that got shortened to Thaler, and then in Dutch dollar, and then in English it became dollar.
Okay.
This is all in the 16th century, right? So early in the 1600s, Shakespeare used the word dollar in his plays. In the Scottish play and in The Tempest, there are mentions of the dollar. So it was clear that that was a coin that was familiar in English well before the founding of the United States. So when you actually get to the Constitution and what we think of as the actual United States, not just the colonies, there was about a 60-year period to take this silver coin and turn it into what we think of now as a dollar, which is bank money.
Okay.
So what we think of now as a dollar sits on the ledger of a bank, of a commercial bank. It's a bank deposit or a bank note that's printed by the Fed. But increasingly, nobody uses cash. So we're really just talking about bank deposits. So the United States had to win sovereignty over that very slowly. And there's this long history of panics in the 19th and early 20th centuries, and after each panic, there's new regulation. So Panic of 1837 introduces comptrollers of the currency at the state level. It introduces reserve requirements. You have to hold silver in the bank. 1861, or 1862, there's new legislation during the Civil War, introduces backing banknotes with treasuries, right? We had to figure that out.
Right.
1907, we have the Federal Reserve, which provides cash in an emergency. 1932, after that bank panic, we finally get national deposit insurance. That's huge. No other country, no other currency zone nearly the size of ours has unified deposit insurance. Only America has that. And so to answer your question, I think it was by 1932 that we had stable, regulated banks.
Gotcha.
Okay, so regulation was key here, and making a lot of mistakes and kind of addressing those mistakes was key in how the dollar system grew up. Where does that leave us now when we talk about things like stable coins or cryptocurrency? How do you think about the dollar's role in a decentralized financial system where regulation is less robust, if even there?
For me, the key to thinking about crypto is that it's not new. It's not that novel. I think of crypto as finance as if the past never happened. When you look at the various kinds of crypto, there's Bitcoin. That's basically a commodity. We know how that fits into the financial system. It's a commodity. You think about most coins they're essentially equities. Stable coins, to your point, are a really interesting case because, as you know, they're pegged 1-to-1 to the dollar. But to me, it just looks like a bank. So right now we have decentralized money. Commercial banks, when they make a loan, when you take out a mortgage, they are not getting that money from somewhere else. They're marking that up on their balance sheet, brand new deposits for you. A stablecoin provider has the same fiduciary responsibility as a bank. When you deposit, they've got to buy assets. Those assets have to have meaning. We have to know that they have the assets they say they have. Every time I hear like somebody in crypto say, we've got the first private decentralized money, my answer is, my dude, you just invented a bank. We know how those work.
Except they're not regulated like a bank.
That's exactly right. And so what I worry about, to my point earlier about monetary sovereignty, it's won slowly and painfully over time, and it's constantly in danger of being eroded. And what I see when I look at stable coins is these are bank dollars that are slowly slipping out of the regulatory control that we built up over the course of a century. Like, we know how finance works. We know how banks blow up. And I know that the Bloomberg audience right now are shaking their fists in anger at the radio. I do think that like the basic bulwark of FDIC, comptroller, Federal Reserve that we built up to protect banks needs to be extended full force to stable coins. And I think if you did that, they'd lose a lot of their appeal because it's no fun running a bank because it's very well regulated for obvious reasons.
Big money versus small money. What is that? Well,
there's this sort of theory of coins, physical coins, that points out that small coins are much more actual coins, jingle.
Okay.
That points out that small coins are much more expensive per unit of value to produce because each coin had to be hammered out. It's an industrial process. I've seen this.
That's why we're not printing or minting the penny anymore.
Yes, absolutely right. Like money is a product. Somebody's got to produce it. Money doesn't happen by magic. And so the big coins are cheaper per unit of cost to produce. And what we found sort of historically is that mints, almost all mints were privately run, would much rather make the big coins. So you have this constant demand for small coins to settle small retail transactions, right? These are not. It's not as if the small coins are units of the big coin. They're completely different economies. So when we look at the economies of Renaissance Italy, Florence, Genoa, Venice, they all had a big silver coin for international trade and small coins, and the exchange rate fluctuates between the two of them because the small coins are for local purchases and you've got to manage inflation in a slightly different way than you do with a big coin. So I think that's still true now. Banks are like mints. They produce our money. Banks, for the exact same reasons, would rather deal with big loans, big deposits, big transfers than small loans, small deposits, small transfers. And so I think we've replicated that system with banks. And when you look at the problems with banking in America, or rather the challenges of getting people into the financial system, it's the exact same problem. Banks don't want to handle small depositors. They don't want to make small business loans because the back office costs are higher. This is a problem that would be very familiar to a mint.
I want to switch gears and talk a little bit about currencies used in commodities and in international systems. We talk a lot about this petrodollar because oil, which we talk about constantly, given how much it's risen, is priced in U.S. dollars and how other central banks are kind of beholden to the U.S. because everything is priced in dollars and how they want commodities to be priced in other currencies, for instance. Is that doable given where we sit? Is this something that the U.S. controls or is it all way beyond our control?
I think so. I've been splitting hairs on this one. I think it is within our control, but beyond our regulation. And what I mean by that is when we think of the offshore dollar system, what we think of as the euro dollar system. This is just foreign banks producing their own dollars, manufacturing their own dollars using new loans denominated in dollars. Okay, so the Fed doesn't have any oversight. The Treasury, the comptroller, we can't look at what's happening. But the Fed does step in, as we know, 2008, 2020, with these swap lines with foreign central banks. To me, that says the U.S. dollar is unique in that since the 60s, we've been willing to tolerate in the United States some level of offshore activity. It's very useful to the United States to have these offshore dollars. And in return, we provide this service. Is it sustainable? It seems to be so far, when we look at measures of eurodollar growth, of offshore dollar growth, that line is still going up and to the right. There are 14 trillion eurodollars, offshore dollars. There are 19 trillion domestic dollars. They're comparable in scale, and they're still growing. So offshore banks seem to think it's sustainable.
All right, Brendan, great stuff. Thanks for coming in. We appreciate it. Brendan Greeley, he is author of this book, folks, The Almighty Dollar, 500 Years of the World's Most Powerful Money. It's about money, so immediately it's in my wheelhouse, so I'm going to take a read of this one. So appreciate that joining us here in
We want the book signed, by the way.
Oh yeah, absolutely. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour, Bloomberg Intelligence starts in just moments. S&P down 50.7%. The NASDAQ down 280. That's 1.1%. Bond markets moving higher, folks. 10-year Treasury yields up 8 basis points, 4.67. 30-year, 5.18. How about that?
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Tuesday morning. This is Bloomberg Intelligence from the Bloomberg Interactive Broker Studio in Midtown Manhattan. Paul Sweeney, Scarlett Fu, and John Tucker here with you to take you through the second hour of Bloomberg Intelligence. We have a bond sell-off underway. It's a continuation of the sell-off that we got on Friday, and this time it is dragging equities lower. So we're going to get into all of that throughout the hour, but we're also going to check in with Drew Redding. He's our senior housing analyst to talk about Home Depot's results. Certainly consumers worried about inflation and high borrowing costs are definitely having an impact on Home Depot's results. We're also going to check in with Michael Halen. He is our senior restaurant and food service analyst on restaurant spending and how that looks in this higher inflation environment. James Morrow, founder and CIO at Calodyne Capital Management, will join us to talk about private credit. That's an area that's certainly taken a hit. And Riley Griffin, our tech reporter, will join us on Meta's $200 billion data center and how it's rising from the bayou. Bayou?
Bayou. Yep.
Okay. Why'd you laugh?
Bayou. Bayou.
You know, sometimes I just got to double check.
I thought they were talking about Beowulf, the poem.
Bayou. Okay, got it. Let's go over to John Tucker, who's going to correct my pronunciation on something else for Bloomberg Business Flash.
No, I won't. Anyway, let's start with stocks, and I'm not talking about Bill Clinton's former cat. The Philadelphia Stock Exchange Semiconductor Index shedding right now, 2%, just about. Yeah, this is a three-day rout, and it's close to a correction, down almost 9% since the peak. The tech-heavy NASDAQ, as a result of that, that is lower right now. The NASDAQ is down 1.2%, shedding 290 points. S&P 500, 54 points lower. That's down 0.75%. And the Dow Jones Industrial Average down 208 points right now. That is down 0.4%. And you mentioned this, Scarlett, certainly isn't helping. Treasury yields, they continue to surge with a benchmark 10-year yield 8 basis points higher, 466. The long bond up 5 basis points, and that is at 417. Meantime, Cameron Dawson at New Edge Wealth says, you know what, the backdrop does remain positive for equity investors.
I think what's fascinating is that even if you remove tech from the revenue growth number, that ex-tech revenue growth for the quarter was still 9%, which is extraordinary in this environment. And we are in a very robust nominal GDP environment.
Investors waiting tomorrow after the close, get the numbers from NVIDIA. They open their books for investors. Right now, those shares ahead of that, down 0.5%. And Google shares, they are down 1.8%. Google agreeing to create an AI cloud business with Blackstone. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. And back to Paul and Bayou Scarlett.
All right, here's my Bayou story. The one and only time I found myself on the Bayou, I found myself in a duck blind at 4 a.m. waiting for some ducks to fly by so we could shoot them out of the sky. Why was I doing that? Because I was trying to get some investment banking business out of this company, and that was the way. I would go further than my competitors. And we got it, by the way. We got the mandate, took the company public.
I would expect nothing less from Paul.
Exactly.
Paul's investment banking tales never fail to surprise.
Duck blind at 4 a.m. somewhere in Louisiana. That's kind of how I roll.
That sounds about right.
Yeah, so it worked. All right, very good, John Tucker. Thank you so much. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on the internet thing here. Let's take a look at some stocks on the move today. We can do that with Vildana Heinrich, cross-asset reporter for Bloomberg News. Vildana, what are you looking at today?
Well, I'm thinking of the famous Bayou song that nobody's even mentioning,
What's
right?
that?
Down by the Bayou?
Oh,
No?
down by. Oh, yeah.
Creedence.
Right?
Yeah,
Very
that's
good.
a band that John knows.
Since you bring it up, there's a famous recording studio, or at least there was. The Stones recorded there. Allman Brothers. Dwayne Allman started there. They were called the Swampers in this studio.
Yep.
amazing studio.
I'm just a terrible singer, so I wasn't going to sing any part of that. But I'm looking at shares of Home Depot, which we were just talking about. That's ticker HD. Shares are actually flat right now, but it is a big item in the news today after the company's key sales, one of its key sales gauges missed expectations in the latest quarter. And that's given some of the muted housing demand that we've been seeing, high borrowing costs. All of that is sort of limiting consumer spending on improvement projects. That key gauge is sales at locations open at least a year, which rose 0.6% during the 3 months that ended May 3rd, according to the company, and that was below what analysts had been expecting. So just another way to be looking at how consumers are feeling in this economy.
Well, let's stay with that theme and look at how consumers are regarding their spending on wellness and sports and activity. You have another company that really showcases that.
I was hoping that you would try to pronounce this one because I'm going to be mispronouncing. Is it Amer Sports?
I think it's Amer.
Yes.
Amer?
Amer? Okay.
Oh, see, there's no
We're all
consensus.
having issues today. Yeah, like America. Amer. Okay, ticker AS.
Thank you.
Please have
okay,
the ticker.
good ticker.
Shares up as much as 8% today after it raised its full year guidance, and first quarter results beat estimates, and that's helped by demand for Salomon shoes. So I ended up, did I mispronounce that one?
Solomon, those are the ski boots I wear, Solomon.
I've not heard of this brand, which is why this company was interesting to me because
do you ski or snowboard?
No.
No.
Okay, all right, okay, that explains it.
But they have hiking shoes, it looked as well. I looked it up and I did not recognize the shoes, but
they're kind of old school ski company.
I see. So all of you are
or
fans
ski brand
of these shoes.
Paul Sweeney is like, what? It's been
Old,
around for a
old
while.
school.
Okay, very good. Yep.
Oh,
yeah.
What she meant to say is old.
Yep.
Yeah.
All right. So what did they do? They had some numbers out.
Yes, and now they're expecting revenue to go 20% to 22% this year, up from an earlier forecast of 16 to 18%.
Okay, one more.
One more, that's shares of hyperliquid strategies. This one is a little bit closer to my home turf, covering cryptocurrencies. That's ticker PURR. Shares are up some 12%, as much as 12% today after a Bloomberg report.
We have to have a safe country. We have to have a great country. We have to make sure that Iran doesn't get a nuclear weapon. All of the things that you see me fighting for so hard. And it's always tough. You know, we're negotiating with Iran, and then you have the Democrats, I call them the Democrats, putting in a bill that Trump should immediately stop. You know how it is to negotiate with a country where you're...
Zero to 2%. So I do think that they left themselves with a little bit of wiggle room to see how the rest of the year plays out. But to your point, you know, we mentioned stability. That is the case, but what the company is missing is kind of that next catalyst, and it's really housing that continues to remain frozen due to elevated rates. We're back up near 6.7%, and that's after getting to a 5 handle earlier in the year. And then, as you mentioned, consumer confidence. You know, we've heard this pretty much across the housing ecosystem, and it's that consumers are worried about the outlook for the economy, the outlook for employment, and they're just pausing on these big purchasing decisions.
What's your world, Drew, your world of home building and all that kind of adjacent stuff? Let's assume rates are higher for longer. How does your world adapt? I mean, it just seems like if I'm a buyer, I'm a seller, at some point I got to throw in the towel and say, hey, it's been a number of years here. This seems to be the new world here in real estate.
Yeah, it does seem like the level of demand that we're at right now is kind of a floor. We've been bouncing along a 4 million unit annualized rate in the housing market for a couple of years now. The new home market has been relatively stable for a couple of years now. So, there is a certain level of churn that's going to happen regardless of where rates are. Things happen, people get married, they have kids, they need to move. But to your point, I mean, there's still 70% of mortgage holders out there with a rate at 5% or below. So without any forced selling activity, there's not a lot of urgency in the market. Now, from the home builder's perspective, what this means is that they're going to continue to have to lean on incentives. That story's been well documented now that they've been very aggressive in their use of mortgage rate buydowns to kind of make the math work a little bit better for their buyers. Coming into the year, I think there was some hope that, rates were going to come down. They'd be able to take their foot off the gas pedal a little bit. But it looks like at least over the next couple of quarters, they're going to have to continue to offer those concessions to move inventory.
All right, good stuff, Drew. Thank you so much. Drew Redding is our home building analyst here at Bloomberg Intelligence, giving us a read on Home Depot and the home building industry as a whole. Of course, very, very dependent on rates and where rates are. And right now, Paul, rates are higher. They've been going higher since last Friday, but actually, if you take a step back, even long before then, it's just that Friday, it looked like it was everything moving in concert with bond yields in the UK, Japan, and Europe all moving higher. So, of course, we needed to bring in John Authers. He is one of our Bloomberg Opinion contributors. He's also an editor at large, some kind of senior editor title here, right?
Something like that.
Something like that. John Authers is in studio with us right now. And John, what surprises you the most about what we've seen in this March higher in bond yields, not just in the U.S., but around the world?
I guess what surprises me is that it finally happens, because I have spent the last 20 years of my professional life dealing with people who have been worried about this precise event happening. And there is still something slightly unreal when it actually does. There is little obvious reason that it has happened now, down to these last few days, other than it would be way oversimplifying to say that this is all down to the Strait of Hormuz situation, but plainly that's the trigger, that's the catalyst at the moment. So you could argue last week you saw December Brent get above $90, 93, 94. It's as high as it's been. So the oil market is telling the rest of the world, we are braced for this to be a longer interruption, for this to be a shock to supply that goes on longer. And that's what matters most to inflation dynamics. That maybe maybe that was the trigger last week, was disappointment around Beijing, the Beijing summit, and no pressure on Iran from China to reopen the straits. But I find that very strange, in that I didn't know anybody before the event who had any great hopes for it. So that's the most. There's nothing at all surprising that this would happen, because the logic for it to happen has been in place for years, if not decades.
And I love.
There's no clear explanation why this week. Why now?
Although I love you quote in your note here a gentleman from Barclays. Ajay is his first name.
Raja Diakshar or something.
I'll go with that. But he basically says, hey, it's simple and uncomfortable, the reason here. The developed world has too much debt, too little fiscal discipline, and no political appetite for fixing either. If there's a trigger, it has to be the Iran war and the resulting shock to the oil supply. That makes some sense to me, at least.
Yes. But the Iran war has been going on for more than 2 months now. But yes, that's it in a nutshell. But Bill Gross, the bond investor, used to talk about the British gilts market being built on a bed of nitroglycerin, and really open, particularly prone to importing inflation because it does more trade. But basically, it's anything that applies to the UK is only a slightly worse than it will be for the rest of the developed world. That's been true of the world, that we're sitting on nitroglycerin. Sorry.
So, John, one thing that we keep puzzling over, we do see equities weaker today, but for the most part, stocks have been on a tear, right?
Yes.
I mean, they're still near record territories. And as you've noted, the 10-year yield now exceeds the S&P 500 earnings yield by the most since 2002.
Yes.
At some point, something's got to give, no?
I would think so. Lots of my readers kindly point out to me that I often tend to be too bearish, which is true.
Occupational hazard.
Yeah, it is an occupational hazard. It is very hard to justify the extreme degree of enthusiasm in stock markets, given what bond yields are doing. If you go back to the model that Alan Greenspan, it became known as the Fed model because Alan Greenspan appeared to be using it in the 1990s when he was giving testimony that you compare the earnings yields, the inverse of the PE, on stocks to the 10-year bond yield to get an idea of where valuations should be. Then bonds have been a support for stocks ever since the GFC by a very big margin, and that has been totally removed now. And that's not necessarily a bad thing, but it's amazing that there is as great an enthusiasm for stocks as there is. Now, you spend a lot of time, obviously we all should be spending a lot of time talking about AI. There is this other very big positive shock coming from AI. But I do find it hard to believe, and it worries me, that in the minds of equity investors, it so completely floods out the warning they're being given by the bond market to rein in their horns.
What do you, we got about 30 seconds left here. What do you make of just the AI and the spending associated with it and the impact on our economy? If you strip out AI, would we really notice it?
Would we
like in the economic growth data?
Yes.
So it's been a big contributor.
The capex that is being spent on this is a very, very real, very significant deal. That is, actual money is being spent and being invested and employing people. There is no question about that. The great concern I have, having lived through .com, is that at the moment we are pricing all the hyperscalers, all the chip makers on the assumption that they will be the winner. And Amazon, it turns out you could have bought it right at the very top of the mania and you would have been fined 25 years later because Amazon was the winner. All the others would have lost you money. Some of the Magnificent Seven are going to lose. Some people are going to lose money out of this big time because they can't all win. And I don't think because they are borrowing and spending in the way that they are at the moment, somebody is going to be in a lot of trouble in a few years, logically. And there is no concern at the moment to work out who that is or to take evasive action. Which
sounds like FOMO to me.
Yes.
Yes.
All right, John Authers, thank you so much. And of course, be sure to check out John Authers' columns on the Bloomberg Terminal. You can all check it out at NIB Opinion Go. John Authers with us as we look at yields moving higher. The 30-year at 5.17%, the 10-year at 4.66%.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Major stock averages, they are lower. A gauge of semiconductor shares extending its 3-day rout. And then you have Treasury yields. They continue to rise. NVIDIA's results, they're due after the close of regular trading tomorrow, and that's going to help set the tone for stocks. Investors are going to be looking for reassurance. The AI story is alive and well. Right now, the tech-heavy NASDAQ is down 281 points. That's a decline of 1%. S&P 500, 53 points lower. That's down 0.7%. And the Dow Jones Industrial Average is down 216 points, a decline of 0.4%. The benchmark 10-year yield is up 8 basis points, 467 right now. The 30-year, the long bond, 5 basis points higher, and we're at 517. Home Depot's business taking a hit by elevated interest rates and housing prices. They sparked a pullback in home purchases and big projects. Instead of extensive remodels, folks, looks like they're tackling smaller projects, at least according to the retailer. Sales last quarter missing expectations, but the earnings did top estimates. As a result of that, shares of Home Depot right now, they were up just about 0.3%. We have big changes coming to Facebook. The parent there, Meta, the tech giant, planning to cut 10% of workers tomorrow. That's about 8,000 people. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and it's your Bloomberg Business Flash. Scarlett and Paul.
JT, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Here's what our next guest says. U.S. restaurant spending looks vulnerable as a 52% jump in gasoline prices and higher fertilizer and food costs tied to the Iran war siphon discretionary dollars. Not good for the restaurant business. Michael Halen, he's our senior restaurant analyst for Bloomberg Intelligence. He joins us here. Mike, how do you think about this? I mean, people are spending a lot more for gas and some other stuff, and I'm guessing that comes out of their discretionary spending, which would include restaurants. What are you seeing?
Yeah, it sure does. And restaurants are typically the first place that people cut back. So, I was on this show months ago. We were kind of bullish coming into the year about the first half because restaurants had suffered through 2 straight years of tough comps. Casual dining had a really rough 2024, quick service a difficult 2025, and people were ready to get back to restaurants. And we kind of saw it in the first quarter, even though there was some bad weather. People were taking their 11% higher tax refunds and spending them at restaurants, right? But now with gas prices up 53%, our outlook has changed mightily. And it's for the reason you stated, right? People, especially in middle America, have pretty tight fixed budgets, right? And if they're spending 50% more on gasoline, that's going to come out of, other spending, and restaurants typically see it first.
Restaurants typically see it first, and we've already gotten some indication of this. You mentioned weather as one of the culprits. We saw Shake Shack, for instance, in its latest earnings report, say that its first quarter revenue missed estimates due to pressures, including weather, as well as rising beef costs. So that's another headache for these restaurant companies. Yet some restaurants will inevitably fare better than others. When you look through your coverage universe, which kinds of companies are better prepared to withstand this difficult period?
Well, we have been seeing a trade down to cheaper options, right? But then it's also going to depend on a case-by-case basis. So first we'll talk about, the lower price chains. Taco Bell is an absolute machine. They are doing a phenomenal job with their marketing calendar, always have, and they're going to do even more LTOs this year than they have last year, and that should continue to drive traffic and same-store sales. Burger King, they seem to be benefiting from struggles out of Wendy's and Jack in the Box. They've improved their operations and the food quality. They made some, taking some share from McDonald's on some of the stuff they did around the CEO's kind of weak bite of the big arch. And they've done some kind of marketing around that with Tom Curtis, who heads Burger King. So those are chains we think can benefit from a trade down. And there's some other chains like Kava and Starbucks that just have some things, good things going for them. Kava, we came into the year saying same-store sales estimates were way too low. If you look at last year in a vacuum, they actually had a very good year. And the data we're seeing shows that 1Q's off to a great start. And Brian Nichols done a great job at Starbucks, improving the operations, now working on improving the food and beverages. And we think they can continue this pretty strong momentum we've seen over the last 2 quarters.
Yeah, my Starbucks at Route 35 in Wall Township, they do a great job for me every Saturday and Sunday. So shout out to them. Michael Halen, thanks so much for joining us. He's a senior restaurant and food service analyst at Bloomberg Intelligence. Let's get back to these markets. They are moving. We have stocks down. We have yields up. Boy, if it weren't for this war in Iran, one of the key driving issues, I think, for this market would be private credit and how systemic is the risk for private credit for the greater fixed income business, maybe the greater capital markets. James Morrow joins us here. He's the founder and CIO of Callodine Capital Management, joining us live here in our Bloomberg Interactive Broker Studio. Jim, thanks so much for joining us here. Talk to us about private credit. Is the risk there systemic to our capital markets or to our fixed income markets, or is it like a lot of people tell us, it's a one-off type of thing, don't worry about it. It's more of a liquidity issue than a credit quality issue?
Yeah, thanks, Paul. Certainly, our view would be that it's not systemic, that the size of the problem relative to the size of the capital markets and credit markets looks pretty manageable. We don't see a macro-driven downturn in credit. If you look across credit markets today more broadly, things are pretty healthy. Stocks are healthy. The economy is relatively healthy. And so really what people have been concerned about is a pretty isolated pocket of the direct lending or private credit market associated with software loans. And that, when you go through the math and try to quantify, it looks very manageable. So it wouldn't look systemic from our perspective.
So this concern about the software debt that's out there, and there's a wall of maturity coming due as well in the next couple of years. How far along that process do you think we are? If this were a baseball game, are we in the 3rd inning? Are we in the 6th inning?
Yeah, I think we're probably in the 6th or 7th inning of identifying the problem, but the maturities, as you point out, are going to stretch out over the next 3 or 4 years.